Walmart acquires Flipkart in a $16 billion deal. Investment bank raised China's GDP forecast after tariff pause. Investment banking salaries in India hit all-time high. You have probably heard headlines like these somewhere. But have you stopped to wonder who's really behind these massive deals? How banks can tell where a certain country's GDP is headed? Well, whether or not you have thought about this or not, there exists a high-stake industry that can make or even break a country's economy, that can help companies grow and can even issue loans to the government. The industry I am talking about here is investment banking. You might have seen glimpses of it through movies like The Big Short, Wall Street, or our own Zindagi Na Milegi Dobara, all showing just how intense and crucial investment banking really is. The investment banking is a type of bank that broker high-stakes deals like mergers and acquisition, government contracts, capital raises, etc. And the professionals who work around the clock to make above thing happens are called investment bankers. Take the Walmart Flipkart deal. For example, it was one of the India's largest ever acquisition. Behind that headline, investment bankers were negotiating terms, handling legalities, and making sure huge transfer of money happened without a hitch. They also built detailed financial models and pitched to help involved parties make decisions and look into future projections of the deal. Since these professionals work around the clock and do high-stake work, investment banks like JP Morgan Chase, Goldman Sachs and Morgan Stanley pay them really high salary. In India, that salary look closer to 54 lakh rupees per annum. And at this moment, there are around 16,000 and plus investment banking job openings on job board like Naukri and LinkedIn. So if you have got the right skills, the opportunities are massive. No matter which layer you enter from, there is opportunity, there is growth and there is money. A lot of money. The best part, the industry is only getting bigger. According to Statista, investment banking revenue is projected to reach $319 billion by 2025. So if you have ever thought about starting a career here, now is the perfect time. That said, investment banking isn't something you can master overnight. You need to build a strong foundation in key skills like financial modeling, valuation and capital markets. And to help you do that, we are bringing you a free investment banking and capital market course taught by top industry experts from leading firms like JP Morgan Chase, Bank of America and Goldman Sachs, all designed to make you job ready. Before we dive into the course, don't forget to hit the like and subscribe button for Intellipaat's YouTube channel. Now let me take you guys for the agenda for this particular course. We will start with what a financial system is. Then we will move on to understand how the financial system works. After that, we will explore the functions of a financial system. Moving forward, we will take a look at the structure of the financial system, which includes various elements like financial instruments, financial regulators, and financial markets. Next, we will dive into the roles of financial participants such as retail investor, corporate, and retail banks. Following that, we will cover the types of financial service provided within the ecosystem. Then we will shift focus to the fixed income market and continue with derivative markets, looking into the instruments like options, swaps, forwards, and future. After that, we will go through more instruments like credit default swaps and understand concepts like arbitrage. We will also touch upon various types of bond along with how stock exchange and depositories are involved in managing them. Moving ahead, we will cover asset management on the buy side and then examine the borrower-lender dynamics, especially within the stock borrowing and lending. We will understand the trading process, collateral management, fees and rebates, and the overall pros and cons of SBL. Finally, we will wrap up by differentiating SBL from Repo and conclude with some important interview question based on these key topics. So now, as you guys are clear with the agenda pointers, let's look at the very first topic in our list.
Now, what is investment banking? It is a specific branch of banking that helps businesses raise funds and provides them with financial advice and support. It provides a substantial financial advising, capital raising, government and financial institution services, financial and risk management services, and help to enterprises. An investment bank is a type of financial services firm that serves as a middleman in large and sophisticated financial transactions. When a new firm is ready to launch its initial public offering, or also known as IPO, or when a company combines with a rival, an investment bank is approached. For large institutional clients like pension funds, it also serves as a broker or financial advisor. Now let us move on to what does investment banks do. Let's begin with a simple example of a company named ABC. Suppose ABC wants to merge with another company. How will it know that the other company will be beneficial for it? Or how is it going to raise the desired funds? And who is going to handle the complete documentation and help in figuring out new investment plans? Well, the short answer to all these questions is an investment bank. Investment banks play a vital role in making a company go big by acting as a risk taker or, say, middleman. Typically, investment banking focuses on two main areas. The first one is the M&A advisory, and next we have underwriting. So M&A advisory stands for Mergers and Acquisitions Advisory. It is the process of assisting corporations and institutions in locating, evaluating, and completing company acquisitions. Underwriting is a procedure used by banks to get funds from investors for a client, mostly in the form of equity or debt securities. Now let us move on to the next topic, which is how do investment banks work? Investment banks are divided into two types, the sell side and the buy side. Now, the sell side shares of newly issued IPOs, provides market-making services, places new bond issues, and assists customers with transactions. Coming to the buy side on the other hand trades securities such as shares and bonds in order to maximize profits. It collaborates with hedge funds, mutual funds, and pension funds. Now let us take a look at the careers available in investment banking. Investment banking jobs are among the most desirable jobs in the financial industry. As an investment banker, you will be expected to assist the clients in raising funds and expanding their businesses. Though it is not that easy to get into the domain, once you make it through the journey, the results are really rewarding. The average salary ranges around $100,000. With years of experience, you can even earn up to $500,000 per annum. The main role that investment banking demands is to provide assistance to firms, governments, and wealthy individuals in expanding their businesses by acting as a medium that will handle the complete procedure of analyzing and evaluating the business and will also manage all the documentation work involved in the process. The world of investment banking is not for everyone to live in. This job profile comes with a very high competition and extremely tight working hours. But the financial perks offered are unparalleled. You will live a very fast-paced life and deal with exquisite clients while enjoying a lifestyle that others can only dream of.
See, if we talk about guys, financial system is nothing but, let's talk about first, the basic background, why financial system is important. Let's say if government want to distribute any, benefits, all right, any benefits, let's say pension benefits or any social benefits, how government send these benefits to the public? Come on. How government send the benefits? See, government send the benefits through system, right? Through system. So I believe, when this Modi government, NDA government come into, this regime, so we have seen that government supported to the payment system, right? Payment gateway or payment systems like Phone Pay, Google Pay, GPay, or different payment systems. So you can just scan it out and, make a payment, correct? The same way government also encouraged households or common people to have a bank account or to open a bank account at least, because see, before this government, the system was like in a manual system. So government used to issue the check payments, and that check payments, that final beneficiary will deposit in bank and then bank will issue the cash. That was a system and it was quite lengthy system. But now we have a infrastructure, we have a payment system. So in one click, government is sending payments to the final beneficiary. So that's what the system will call it as a DBT, direct transfer benefits to the final beneficiary. Am I right? So how this, becomes possible? See, through financial system only, it becomes, possible to transfer payments or transfer benefits from one account to another accounts within a flash. See, as a government entity, what is the government role, guys? As a government entity, what is the role of government in this particular system? See, government role is to provide infrastructure, right? Provide infra, then maybe develop a system and also look for regulations. Or government can also encourage to the private players, correct? Private systems or companies, because Phone Pay, Google Pay, GPay, all are private companies. So government encourage to them as well to see, be a part of this payment revolution, participate it, and allow people to transfer the money through system only. So this was one of the biggest, the revolution that I would say, because see, initially, if you see, if the people, if they have open accounts, so it means government can execute several programs. See, the point here is if government announce any policies, but what if that, the whatever delivery, that benefits, if the governments want to deliver to the end beneficiary, if you don't have a system, if you don't have an infrastructure, if you don't have a regulation in place, then you cannot deliver that benefit to the right beneficiary. But now, if you see through DBT system, you can transfer benefits to the original beneficiary. So that all comes under, guys, financial system. So financial system is not about something that, if you only talk about, let's say, banks, and if you believe, sir, only banks and companies, that comes under, let's say, this financial system. No, because see, guys, common people, what they do, people deposit money, correct? Where? In a banks, and then banks provide loan facility, basically loan to companies and loan to others. So that's how system works. So in one hand, banks basically accept the deposit, and on other hand, bank also issue the or disburse loans to the borrowers who want to borrow. Now your question would be, look, why this deposit and loans, which is important, and why we are discussing this? See, if you see more and more deposits, if bank, let's say bank received more and more deposit, then bank can issue more and more loans to the, other people who want to do business, who want to, let's say, maybe purchase something, because your entire system is based on your financial system only, because financial system, it works like an oxygen. It works like an oxygen. If there is no oxygen in the system, then your system will die. If there is again high oxygen level in the system, again your system will collapse, because the balance of the oxygen level, it should maintain in the system. So it means there should healthy cash available in the system, so that buyer, seller, depositor, lender, borrower, then banks or any other institutions, regulators, everyone can enjoy their privilege. Otherwise, if let's say, if you see cash level is high, then suddenly you might see the inflation will pump up. If you see there is no cash available, then you might see recession will come into picture, because you would see impact on buy and sell, and then again that impact goes on employment. Or if it is, let's say, there are no employment opportunities, then ultimately there would be no high economic activities, because everything is linked to each other, and that all combinedly we can call it as a financial system. All right, combinedly we'll call it as a financial system, including governments, banks, companies, common people, then your brokers, custodians, then other regulatory bodies, because everyone has a different set of responsibilities. If I talk about, let's say, normal banks, they accept the deposit, they issue the loans in the market, and they also help governments to establish, or maybe to if government want to execute any policy or program, like let's say if it is a economic benefit policy, then banks only support governments. All right, if any governments, or let's say state governments, or any municipal corporation, if they want to raise funds, they with the help of banks, they can raise the funds from the public or maybe from the potential investors, and they can invest in different variety of assets. So same applies for companies as well. If any company want to raise funds from the market, they can raise funds directly from the market with the help of a bank only, because banks are at a very crucial level in the entire financial ecosystem. Without banks, or without, let's say, cash, there is no financial system. So I hope you got this now. Means what is financial system? Financial system, it means not only your banks, but apart from banks, like companies, corporate, governments, common people, brokers, right? Then your stock market agents, or mutual fund companies, hedge fund companies, or private limited companies, that all comes under your financial system. All right. See again. So in a financial system, we'll have a participants, markets, products, and services. So that all combined, you can call it as a basically, the financial system. See, there are ways, okay? There are ways to offer funding to the business, or there are ways to offer funding to anyone. One is direct way, another one is indirect way. In a 90% cases, like common people, I would say, or in rural areas, if you see, you can see direct credit facility, direct credit facility. So it means lender can, like lender, it means you would have definitely heard this, right? Saukar, creditor, who actually offer credit facilities to whom? To the common people. So it means lenders, they directly offer credit. It means it's a loan to the borrowers, and borrowers, they can of course take loans from the creditors on an interest payment. So this is the one way, guys, and that way we'll call it as a direct finance. Direct finance, it means lender can directly offer funding facility to the borrower, right? And see, this facility is not only limited with the common people, but let me tell you guys, in a market like, private credit market, which is one of the highly growing market nowadays. Here you can see peer-to-peer funding facility. It means any individual can offer directly loan facilities to the others, right? Any individual, it can be institution or a company, can offer funding facility to the directly, borrower. But banks, they are not allowed to do this. They cannot means directly offer, P2P funding. But NBFCs in India, India, NBFCs are allowed to do this P2P funding. Now your question would be like, sir, look, as a businessman, if I want to raise fundings, then how can I approach? See, there are platforms, guys, like angel listing, allocations. There are platforms. If you can register your business there with the requirements, and also you can, publish your data like revenue, profit, whatever numbers that you have, just publish the data on those, platforms and submit all legal documents of your business. And if you are, let's say, ready to offer 8%, 9%, 10%, 12% interest payments, just update all the, all important terms on platform. Then potential investors will reach you for further discussion. And if they're interested, or if they're agreed with, the terms which you are offering to them, they'll directly provide funding to you without intervention of a bank. So it means private lenders can directly transfer funds in your accounts, from their accounts to your accounts. So that comes under private credit or direct credit. Credit, it means loans. Private, it means it's a very, you can means instead of a bank, you can directly reach out to the individual. So that becomes private credit. And in other words, that private credit, will call it as a direct finance or direct funding. All right. So including your households, businesses, governments, and foreigners, all can offer lending facility. And borrowers could be again households, business firms, governments, and foreigners. All they can raise funds. Borrower, it means to apply for a loans. So that person will call it as a borrowers to take a loan. And lender, it means who offer loan to the borrower. And apart from this, see, in a traditional, system, we have like a system where you can say it's a bank work as an intermediary. See, lender can deposit money with bank, and same bank offer can, credit facility or loans to the borrowers basically. So this way becomes indirect finance. Now, definitely that, you would have question like, look, sir, what is the difference between indirect and direct? See, indirect way is a costly way, because bank charge additional 1 or 2% extra cost. The reason is bank accept deposit with 7% and offer loan with personal loan rate is 15%, even 20% also. So see this. So difference that bank is making money around 13% or 12, let's say 7%, 8%. So bank is charging their percentage around 7 to 8%. So ultimately, who is paying this 7 to 8%? Of course, that borrower is paying, right? At the end borrower is paying payment. Like you can be end borrower if you're a businessman or let's say individual, and you have taken loan from the bank. So eventually you are paying payment from your pocket. So you're like overburdened as an individual or as an institution. Are you getting my point? But through private credit, see your direct rate would be around 9 to 10%. So you don't need to pay any middle, entity charges. You don't need to pay anything as such. But let me tell you something. See, every process has their own I would say pros and cons. This intermediate system, you can say safe system. If you compare with direct funding, if you offer direct funding, let's say to the borrower, and if borrower announce bankruptcy, then you can't do anything. So ultimately, your money, which is in risk. If as a private, a lender, if you directly offer credit facility to the borrower, then if the borrower becomes, let's say, insolvent, in that case, we cannot recover any money from the borrower. But if you go through the bank route, of course, if you deposit money with your bank, it means it's a bank's responsibility, right? It's a bank's responsibility. That bank will take care of it of your money, and bank will also deploy money in the different, with the different borrowers, I would say. So that's how bank will play role here, and that all banks or agents, they'll play role as a financial intermediary in this financial ecosystem. All right. So let's talk about now financial functions of financial system. If we talk about functions, see, financial system facilitate the flow of money so that businesses, governments, and individuals can finance their investments. All right, in this way. Apart from the financial system, basically work as a intermediaries and control the flow of money by acting in that capacity. Then monitor the and regulate the participants in the financial system as well. So it means, see, the important is flow of money. One, that is also important. Then second one is balance of flow is also important. Balance of flow. And third thing is regulation. This is also important because, see, ultimately, if you don't regulate any system, right? Let's take an example of crypto market. This crypto market is not a regulated one at the moment because still, which is at a very growing stage, and people they are investing in crypto market, but there is no assurance of that your money is safe. Because I lost $5,000 in crypto market in 2020 2018, I believe, in 18 or 19. In pandemic, I was just exploring new options to the stock market because stock market was down for a couple of months. So I was thinking like, if I can invest in different assets, so it might help me to grow, right? But I invested in one of the with one of the broker, and that after few months, I've seen that that broker system was not there. Even there was no website as well. So that happened. So it means when we say unregulated, unregulated market, that level of risk that you can see where anyone can cheat, anyone can do any frauds with you. But if the market is regulated, it means, so as per the regulations, will have to work, right? If you don't work or if you just violate the regulations, they can penalize you. On other hand, let's say same applies to the any investment firms also. So let's take an example of Satyam company. What happened with Satyam company? Satyam scandal. Do you know, guys, Satyam scandal? Have you heard about Satyam company before? Satyam was an IT company, guys. Satyam was an IT company. What happened with Satyam? Now you don't see that Satyam company on stock exchange because the Satyam company now renamed, and the Mahindra Group purchased it, and they have also changed the name of that Satyam company to Tech Mahindra company. What happened in Satyam company? See, Ramalinga Raju again. It's from South. That guy manipulated the financial statements of company, and pumped the share prices in the market and sold out same company securities in the market, and raised funds, and again transfer or routed that funds to his son's account in a shell companies, in onshore accounts and offshore accounts, and again that funds routed to the real estate business. So it led to the big scandal, and lots of people lost money. What about Tata Capital scam? Have you heard about Tata Capital? So now Tata Capital again they have renamed, and now they are operating business as under Tata Investments. But again, Tata Capital's, few directors, what they did, they raised the funds around 500 crores and transfer that funds to the personal accounts, which is not, means as per the regulations, which is not allowed to transfer any funds from, their accounts to the personal accounts. No, it is not allowed it, but they did. And finally, then Ratan Tata ji had to intervene in this matter and convince to the you know investors that look, your money is safe and we're gonna disburse that money, and they have actually disbursed the money, guys. So that happened, and if they, let's say, what if let's say Tata also capitulate from this, the responsibility that I don't want to take it the responsibility. I don't know what happened in my company. Then just think about it. What would have happened with the this investors? Another example, Sahara Group. We have seen that Sahara Group launched in a couple of schemes, which was cheat fund kind of schemes. Launched schemes, raised fund from the common people. The fund size was around 20,000 crores. Invested in Sahara City on his own name and manipulated in a few things like including regulations and everything. Finally, what happened? People got cheated, right? Then this government had to intervene. This NDA government had to intervene and return the money of people. Then apart from this, see, there are several cases which I can tell you. But the whole point here is how we can restrict all of this, this scandals. Because ultimately, if you don't have a regulation in place, you can see more and more, frauds or scandals, and which we cannot control it. And that's when your regulator rules come into picture. So regulators, the role is very important, in across all the segments and derivatives, your stock market, bond market, money market, commodity market, right? Even in insurance or everywhere, I would say, without regulatory body to bring more transparency, which is impossible. And that's when your regulators' role come into picture to monitor, to bring some new laws, or to ensure that the companies that are following the companies or participants, I would say in short, to ensure that they are following the rules and regulations, and everyone is respecting the all the terms and conditions, whatever that the regulator which has imposed on them. So that's how regulator, the importance come into picture. So one is flow of money, another one is balance of flow. It should again maintain high balance or low balance, both which are not good, right? And in terms of regulations also, so to prevent frauds or other risks, the role of regulatory bodies or regulations is also important. All right. So let's move ahead. So structure of financial system. So how is the structure of financial system? If we talk about structure of financial system, see, first point is financial instruments. So when we say instrument, it means, so we have a different instruments in the market like stocks, bonds, right? Then preference equity, ABS, asset-backed securities, MBS, mortgage-backed securities, then safe, simple arrangement for future equities, debentures, loans, cryptos, derivatives, FX, swaps, money market instruments, that all come into picture, right? So instrument is one thing. If you want to understand, the market, then also you should, go through the different financial instruments like stocks, bonds, preference equities, because each and every instrument is unique. Each and every product has different, features or characteristics. Each and every product has different, trade life cycle. Every product has different ways of calculate value in the market. All right. So if you want to become a, let's say, successful, financial, maybe planner, advisor, manager, fund manager, or businessman or entrepreneur, to understanding of each instruments is important. How they trades, how we can buy it, how we can sell it, how we can issue in the market. Because if you are a businessman, let's say you are a businessman, all the instruments which will help you to raise funds, right? So that would be part of your fundraising process. If you are let's say, if you're looking for a job, the job peoples, you're gonna work on all of this, financial instruments like equity bonds, debentures to, maintain the records or maybe to record the transactions in the books of account. So those would be helping you only to record the transactions in the books of account, like how we can record the derivatives, how we can record the FX, swaps, money market, loans or debts, or any means any, the financial instruments. If you are a fund manager, let's say, then from a fund management perspective, you should know the detailed, analysis of that particular instruments risk, then how that, instruments works in market, how you can hedge it, how you can uh, generate the money through differences and all. So that all comes under your fund management as well. See, same instruments helps to everyone, but you can see just, the perspective will change in terms of business. Entrepreneur will use the same instruments to raise funds. In terms of, let's say, job holder will work on all of those, financial instruments to maintain the records in the ERP system. And if you talk about, let's say, fund managers, as I said, fund managers again raise the funds from the people to invest in all of these financial instruments. So that's what financial instruments, which are very essential and important in this investment banking spectrum. See, guys, so all instruments, they are the part of investment. Investment and banking both are different. Banking, it means normal bank systems. So basically, we need, the banks like, let's say, HDFC, banks like Axis, Kotak, all of the banks to deal in all of these financial instruments. Because without banking system, we cannot buy and sell the securities. So ultimately, the point here is we calculate the value of financial instruments in cash and we exchange the financial instruments in cash only. So that's what your banks come into picture. So we need a banking system or infrastructure to exchange the value of financial instruments in cash. But investment, when we talk about investments, so it means all of this, the different financial instruments that come into picture, along with that, their risk or different ratios or parameters that we check while investing in financial instruments, or maybe even while issuing, the instruments in the market. We also perform the risk assessment checks to ensure that there is no, the means high risk, because if you see any high risk as such, so you might lose your money. As a businessman, again, it is very important that let's say if you're not aware about it and if you still raise money, then you might end up with your business empire also. So that happened. You can go and check, you can read stories as well, like how are the instruments which are critical. All right. Then now let's talk about financial regulator. So when we say financial regulator, guys, it is their responsibility to control the market activities. SEBI, you would have heard about now the Hindenburg, which is the research firm from the Europe, right? They have published or leaked some paper or information that the SEBI, which is SEBI director, right, which is involved in the Adani, that Adani firms or investments and all. So which is something not means good practice and this and that. But anyway, see if you just alleged to the Indian financial system, then it will not work at all. The reason is in India we have a judiciary system, we have Supreme Court, High Court, all other systems. So only your reports will work in your country only. So if let's say Supreme Court of India, if let's say give a judgment against any US businessman in US, this judgment, it will not work at all in US. So it means every country, we have our own sources, we have our own system, we have our own, the bodies which they works for. So any foreign institute, if they raise any voice against anyone, then it will not actually means, work in India, not in any country. Even if, let's say, Times of India, if raise voice against any British company in Britain, they'll not entertain at all, because they'll say, look, we have our system. Do you think that we are incapable to do all of this? No, we have our system. We are doing an investigation, so we don't require your advice. So that's how you can see, the role of regulator to ensure that they are supporting to the everyone, including the businessmen or common people or governments, right? To everyone means everyone. So most of the regulatory bodies, they're like non-profit organizations where they are just responsible for execution of acts. They don't produce any acts because all acts actually pass in the parliament of a nation, and the execution of that act, which is the responsibility of regulatory bodies like SEBI, RBI, or insurance bodies and all other the regulatory bodies, and all. So they just ensure it. But the regulatory bodies, the main responsibility is to execute the regulations and track it out very closely. If someone, let's say, violates the rules, they'll penalize them. If someone, let's say, don't file any tax filings or financial reporting filings or any other filings on time, again, it is a responsibility of regulator to ensure that all participants, they are following rules and regulations on time. So in let's note it down. Means in a stock market, you can see the SEBI who control everything. SEBI, it means Security Exchange Board of India. They control everything. In money market, you can see RBI. So RBI control everything. In insurance market, you can see Insurance Regulatory Authority of India. So they have it. So in every sector, we have now authority. So that authority, dedicatedly work for that particular market, and they ensure the execution of regulations at a grassroots level, and also they track it out, the performance, or maybe let's say they track it out the regulations and due diligence process in short. All right. So now, if we talk about, guys, financial markets, we have a different markets. We have a markets for like stock investments. We have a stock market, right? For a for a bond investments, we have a bond market. For commodities, we have a commodity market. So for every segment, you can see different market. For a derivatives, we have a derivative market. For currencies, we have a FX market, right? For let's say normal cryptos or debts, we have a debt or loan market. So for every products, you can see different marketplace. So we have a marketplaces where we can directly exchange securities and all. And now let's talk about financial participants, from common people to the companies to banks, or banks to government. And apart from that, you may see the brokers or custodians, that all comes under your participants. Even regulatory bodies, so they participate in this financial system and ensure, so everyone whosoever, whether it is individual or institution, it is their responsibility to ensure or maintain the good decorum in the market. As a common people, if you participate in market for buy and sell, so make sure that you are not violating any rules. As a company, if you list your securities, so make sure that you have you have a justifications for everything. The reason is, guys, as a businessman, if you raise funds from the public, and if you just spend that money on your personal things, then it is not a good thing, right? Because people, they have sent money to you, or let's say provided money to you to do business, not to spend money for your personal things. Correct? If I talk about banks, what if, let's say, bank have now accepted deposits from millions of people, and the same bank FD is now that MD, means managing director, now spending money on his personal things. What happened with Yes Bank? Rana Kapoor family disbursed loans to the few suspicious accounts, right? RBI scheduled audit and found couple of gaps, or I would say loopholes, where Rana Kapoor family transferred funds to the different accounts, and the accounts were like anonymous. So it means it was clear-cut fraud case or money laundering case. Correct? the big banks like HSBC banks, JP Morgan banks, Goldman Sachs banks, most of the banks found guilty in many cases, like in terror funding or anti-money laundering or different cases, I would say. All right. See, guys, ultimate point here is we all, should maintain the decorum. We should know your responsibilities. Let's say in class also, you have certain responsibilities like, to take a notes, to listen very carefully, to ask questions. Those are your responsibilities. As a trainer, my responsibilities is like to, explain everything in details and also support you if you need any more clarification, or let's say if you have any questions. My responsibility is to provide you an answer. So same way, if you see, it means we both have obligations. So in a market also, every participants will have an obligation. So they should follow that obligation and perform it within a time or on time, I would say. All right. And then apart from this, financial services. So financial services, which include investment service, all right, broking service, banking service, advisory service, accounting, audit, that all comes under, your business, merger, acquisition, also you can, add to it. So that all comes under your financial services. And that's when your role come into picture here, that maybe, you can join investment service or broking service or banking service, advisory service, accounting, audit, because based on your skills and knowledge, or let's say certification, you can join different service and offer that service to the end beneficiaries. It could be companies, banks, people, brokers, or anyone. It could be anyone, right? So that's how your financial system is designed for. So the financial system, if you see all factors that consist of main components, you can call it as a financial system. So let's talk about now structure of a financial system. See, we have discussed all of this. All right. So first one is investment banks. As per participants, first one is investment banks. How investment banks role come into picture? Or you can guess it even. What would be the role of investment banks? Come on, for infrastructure. See, investment banks, basically, they are, well sailor. All right. They are well sailor. They know it, how to sell the securities in the market. So basically, investment banks, their main service that you can say, help companies to sell the securities in the market. If any business want to raise funds from the market, they appoint investment banks to consult them, to advise them, to prepare financial models for their business, and also help them to sell the securities in the market. All right. So that's how your investment bank's role come into picture. And even if you see, we always call like, sell side firm. So sell side firm, it means investment banks, they work at a sell side because they help companies to sell the company's securities in the market to raise funds. If any company want to raise funds in the market, you can simply connect with the investment banks, share your business model. Also, you can, ask investment banks to prepare a model, like, the funding model, provide details, required details. They'll work on, your business model, and they'll help you to sell out the securities in market. Now, your question would be, sir, what is the benefit of investment banks then? See, they charge huge fees. If you raise 10,000 crores, right? 10,000 crores funds from the market, investment banks, the minimum charge around 500 crores to 200 crores amount. Why? Because to prepare a model, to schedule events, to announce or to decide marketing strategies, appointment of brokers, work with bank, funding, additional cash, that all comes under, the funding requirement. So basically investment banks help you for everything. They'll take care of your end-to-end needs. Even they'll help you to understand whether means you should raise funds or not. So that all activities comes under your investment banking department, or you can select, as the investment banks, they offer advisory services, merger and acquisition services, and sell of securities services. So if you want to sell any securities, you can directly reach out to the investment banks and they'll sell it out your securities. All right. Then if we talk about retail or corporate banks, this bank's main activity, if you see, sell it out, loans in the market, accept deposit. They directly accept deposit, right? Sell loans and issue, other banking services, including debit card, credit card, your home loan, personal loan, the different like online banking services, and also all that services or comes under your retail banking, segments. Apart from that, the corporate banking, it means so same retail bank can offer services to the companies as well, including like TCS, Infosys, or other startups companies and all for funding or payment system. So that comes under corporate banking. All right. But the services would be to facilitate on a payment transactions, to accept deposit, to accept cash payments and all. So that all comes under your retail banking and corporate banking stuff. And as a retail banks, they are responsible for everything, because even if governments want to disburse any funds, you need to have a retail bank account to accept the funds, correct? So retail bank's role is also very prominent in this entire market, or financial system. Now let's talk about mutual fund and hedge fund. So what is mutual fund? See, if you ask me mutual fund, let me just explain you in a very different way to understand this mutual fund term. See guys, mutual fund is just the vehicle. It's a vehicle. Mutual fund, it means it's a pool. When we say pool, it means it's a registered entity, right? Registered legal entity. So that entity basically open scheme for investments, and common people, let's say A, B, C, all are common people. They can invest. They can invest from 200, 500, 1000 for per month. So there are no limits. So they can invest directly in that particular scheme. Then who manage this scheme? See, fund managers who are like highly experienced fund managers, they manage that particular scheme. Now your question will be like, so what is the benefit of this manager? See, pool basically created by your fund managers. So it means pool charge 2% on AUM every year. So what is this 2%? 2% is management fees. Management fees. See, this 2% is the income of a fund manager. So out of that, they can pay other expenses as well. But up to 2%, 3%, even, you can see higher the fees rate also, you can see where fund managers, they charge fees to the funds every year. So for example, let's say if any fund has a 1 lakh crore, AUM, asset under management, and if that fund has, let's say 2% as a, management fees, or let's say, expense ratio, instead of management fees, we'll call it as expense ratio. Then that fund every year charge 2% on 1 lakh crore. So you just calculated the revenue guys from this particular model. Most of the mutual funds, see, even if mutual funds generate losses, they don't care about at all. They just directly charge 2%, at the end of the year, and debit the fees from the mutual funds investors account. And they earn huge money. So that scheme, we'll call it as a mutual fund, schemes. So it's basically a scheme where common people, basically they come together and they invest money in the scheme, and that, pool, we are highly professionals, like, the highly professional, experienced, I would say, people, they can manage that pool. They ensure that, diversification, or diversification, it means invest into different, variety of assets. Instead of investing in one, they can invest in other variety of financial instruments. All right. See, apart from this, see, most of the mutual fund schemes, they are like open-ended schemes. All right. And they invest directly into financial instruments. For example, let's say if I talk about, let me show you a site. Here is mutual funds, let's say multi-cap mutual funds. My favorite funds are like small cap funds. Most of the small cap funds, they offer huge returns. See, asset under management, 60,000 crore, 15,000 crore, 60,000 crore. See this. And they directly charge fees on this amount, guys. Even if you charge 1% on 60,000 crores, it would be around somewhere 600 crores, right? So around 1 to 2,000 crores, they directly generate the revenue from the assets. And this amount of money, which the mutual fund managers, they have invested into different variety of financial instruments, right? You can see the monthly returns also in a 1 month, how much that they have generated. So now just click on this funds. It's a funds. This is the NAV of this fund. See the companies, if you can see. See, this fund invested, right? This Nippon fund manager raised. If you want to see the fund manager details, let me see if I can show you that as well. Yeah, this one. Minimum investments, which is required 100, from 100, anyone can invest. Then fund manager details. Nippon Life India Asset Management. This is the official number. Register our details. Yeah, this one, fund manager. Samir Raj. Since last 7 years, that guy is working as a fund manager with this particular company, and Kinjal, Desai, again, around 6 years, right? So see how much they're, making money. Both guys, they're generating huge revenue. See this fund is charging around 0.6%. So it means around 1% they are charging. So 7 to 800 crores they're generating, as a revenue. So every year they're generating around 6 to 700 crores from this particular mutual funds. Now, see, think about it. Who is investing in this mutual fund? Who is investing in this mutual fund, guys? Just think for a while. Who is investing? Common people like us. We are investing in this particular funds. In all mutual funds, see, only common people, they have invested. Mutual fund market size, which is at around 100 lakhs crore. See the amount. Only the LIC is holding around 40% stake in mutual fund. LIC's mutual fund sizes, which is at 40 lakhs crore. AMC size. All right. So mutual fund, it means basically it's a scheme where highly professional people, they'll create a scheme and allocate the units to the investors. Investors can invest, and then that funds, the fund managers, they can deploy it in different securities. So here one more important point that you can note it down. Mutual funds, they are a buy side entity. Mutual funds, they are buy side entity. Now your question would be so why buy side entity? See, who is buying securities? Of course, mutual fund is buying securities. So they are buying securities to invest in the companies, correct? And then who is selling securities? Companies, they are selling securities to raise funds, and mutual funds, they are buying securities to make money out of it. All right. Okay. So any question around mutual fund, guys? So there are types of mutual funds, like multi-cap mutual fund, tax saving mutual fund, large cap mutual fund, mid cap, small cap, debt, hybrid, liquid. In terms of investment, if you ask me, sir, which one is better? If you are young and if you are ready to take a risk, then you can look for a mid cap and small cap investments. Again, sir, why mid cap and small cap? Because see, if you have multiple income sources and if you can take a risk, then you can generate at least 20 to 24% return on mutual funds. And see, 20 to 25% return, which is decent. If you have 1 crore, just invest in a 1 crore and you can generate, 20 to 25 lakhs per annum. What you want without doing anything. Without doing anything. See, with regards to the mutual fund, risk is like, the investment is linked with the market. If you see, if there is a change in, let's say, let's talk about this Nippon. Nippon invested in which company? HDFC Bank, Kirloskar, Tube Investments, right? Old map. If let's say price of this particular security changes, like in a world map, then ultimately the total value of funds will affect it. So it means you can see the impact on your investments also. So basically your investments value would be based on the companies where the mutual funds invested. See, around in 21 companies this mutual fund has invested it, right? So around 95% funds utilized for investments in different companies. If this companies grows, then your mutual fund will grow. if you see here, the loss, let's talk about this one. Volt map transformer, the loss percentage, if you see, which is at 15%. In a 1 month only, there is a loss of 15%, right? And on other hand, in Bharat Heavy Electric Limited, you can see profit as well, around 10% profit. Let me see. See the losses. HEG Infra, 10% loss. Century Textile, 10% loss. Imami, 1% loss. And other hand, Asian Paints. What a great 250% profit. Look, Bharat Heavy, 10%. Timken India, 4% profit, they have it. All right. So this is how you can, relate. And they have recently took a new position in HUL. Then see one of the stock, Blue Dart, the loss is 32%. So when we say loss, so that becomes your risk. Because if the stock price goes down, then your mutual funds value also it will goes down. So your basically mutual funds value is based on the company's performance, right? So it's a risky, guys. So that is all about risk. But yes, if you, as I said, if you have a, let's say, multiple income sources, you can choose a small cap because small cap has a huge potential. I personally prefer it because my age is just 29, 29 and running, you can say 30. So I am still ready to take a risk. So I'm investing in equities directly. Also, I'm investing in equities as well as I'm investing in small cap funds as well. Why small cap funds? Let's talk about the returns enabled with high long-term performance versus category. Let me see which one is offering best one. JM Finance small cap fund, 6% return in just 1 week. All right. See, Bandhan Bank, all are the funds. If you invest in that funds, then you can, see the huge returns. If I talk about, let me log in my another account. It's just a training, the training account that I use for the discussions and all. So where you can directly see the returns, this grow account. Let me see if I can quickly log in. See this. Motilal Oswal is offering almost 40% return. If you invest 1 crore, you can generate at least 30 to 40% return in just 1 year, and which is a good, right? See, there are two ways. There are two types of people, guys, available in this market. One is like employees who just burn their blood, work very hard, and earn money. So that is what we'll call it as a salary. And if you have your money, then you don't need to burn your blood. You can just invest your money in different asset classes, which has a huge potential. Just sit, relax, and generate money. Because ultimately, why you want to do a job? Ultimate purpose is to generate money. Am I right? So if I give you a job in Google, so will you work with me for free of cost? No. Even if I give you a job in government, let's say if I offer you collector position, will you work with me in free of cost for next 10 years? No, he will not. Then what is the ultimate purpose? Because ultimate purpose is to make money. And that's what mutual funds, hedge funds, private equity funds. See, hedge funds, it is like same, mutual funds, but hedge funds, they don't allow common people to invest. Common, it means we are common people. The people like who are earning in thousands, will call it them as a common people. So will not allow to invest through hedge funds. And same for private equities. Private equities, they invest in startups. They invest in real estate companies. They invest in different funds. But the pool nature, you can see like same. Pool nature would be same. Pool, it means it's again company. It's an investment company, right? It's just a wording that we'll call it as a pool. Pool is nothing but it's just a company. But they dedicatedly work for investments, right? If you see my portfolio, I have invested in a couple of investment schemes. So around 1,16,000 that I have invested in last 6 to 7 months, I would say, just a data of 6 to 7 months. Because every time, whenever, if any students want a demo, just we buy it and, We just discussed few things. If you see, every investment scheme is in profit. See this. So here I have invested 44,000. The profit which I have is like around almost 20%. So here you can see my profit around 15%. Here 16%. Again, Quant Momentum Fund 8%. Quant Commodities Fund, how much? 47%. See the profit, right? So this is how, means you can leverage it out, guys. If you have a funds, then invest in a right, the financial instruments and generate some money. I have a stock portfolio as well, but now means we can discuss that later on, not something that we can discuss. See, few years back, I had just bought couple of shares, purchase at around 55 rupees, and now same stocks price which is at 192, you can see profit of 246%. Now your question would be like, sir, why didn't you purchase huge quantities? See, this is just a trading accounts. I'm buying and selling in equities since last couple of years, but since last two and a half years, I'm into profit, and I'm started now generating profit. But initially, like 2016, 17, 18, 19, it was a training period for me. I lost money as well, not huge, but I lost money in capital market also. So, anyways, so this is all about your mutual fund, okay? And what about hedge funds? So hedge funds, it's a big brother of, you can see, mutual funds. Only the rich people like YouTubers, then big businessmen, business families, they are only allowed to invest in hedge funds. And hedge funds, they are very big. But let me tell you a secret. Only mutual funds, they are profitable, I would say, because most of the hedge funds, they are like loss-making entities. But the mutual funds, they have consistently delivered 20 to 25% returns annually. All right. And if we talk about private equity funds, they directly invest in a startups companies, because mutual funds, they are not allowed, guys, to invest in startups companies. Okay. So here, if you see hedge funds and private equities, hedge funds are also allowed to invest in startups companies, but private equity funds, they are not allowed to invest in startups companies like mutual funds and banks. So that's what they create there are private equity funds available like KKR, the list of private equity funds. They are allowed to invest in startups companies also. So that's what they create private equity pools, and they directly invest it. But now question would be like, sir, who invest in private equity funds? See, again, rich people are allowed to invest it, not common people. Hedge funds and private equities are for rich people, and mutual fund is for common people or poor people who can invest, or mediocre people, you can say, who can invest with a minimum amount of rupees 100. All right. And all three, like mutual fund, hedge funds, and insurance funds, they all are like buy-side firms. Buy-side firms. Note it down somewhere. As a finance professional, you should know it, who are like sell side and who are like buy side. Sell side, investment banks comes at sell side, and mutual funds come at buy side in investments. Why? Because they buy, hold, and sell. That's how they make a profit. Investment banks only sell and charge commission. Investment banks' main activity is to help or facilitate funds as well as to the companies to sell it out securities in the market. That's all. So they work as an intermediator, basically. All right. Now, what about the government? See, government also issue certain instruments, guys, in the market. Government issue T-bills. So what is T-bills? T-bills, it means it's a documents, where government issue that on a discount. Let's say if the T-bill price is 100. So government issue that on 120. And at the time of redemption, government pay 20 rupees extra. So bills can be issued for 31 days, 62 days. Then max to max, I would say, the bill can be issued for a 364 days. Right? It's a highly liquid financial instruments, and highly safe as well. Apart from that, governments, ministries like a National Highway, Authority of India or Electric Board, then other Renewable Energy Board. So, or even insurance, board, they can directly issue the bonds in the market to raise funds for a development. How Gadkari raised funds? Because Gadkari issued securities, right? Because the land which comes under the government's authority, guys. So governments can sell out any lands to anyone. So basically, governments issued bonds to the common people, raise funds from them to invest in again the same lands to develop bridges or highways or infrastructure. And through the same highways, governments will collect tools, and that same tools government will again distribute to the common public. So this is how you can say why government collect tools, because government raised funds from common people with the commitment of that government will offer interest payments to the public. Otherwise, how governments will pay it then? See, government now you'll ask me, look, sir, government is they have a huge power. They can print out the money. See, they can't. They can't print out the money on their own. So they will have to deposit the golds or collateral with the central bank to produce notes, guys, or print out notes. It's not something that any governments, let's say next day send notice to the RBI, look, produce 100 million let's say currencies and send it to us that we want to purchase this and that. No. If they produce more currencies, it will lead to the inflation, because supply of money will increase and your money, a value will erode. So it means you will have to pay more money to buy same assets. And this is what we'll call it as a inflation. Same practice that Venezuela country, they did it. Their governments, they printed out, notes and distributed notes across nation. Now, if you see, their inflation rate is around 10 lakhs. They need a 10 lakhs to purchase, the 1 liter oil. This is what the situation is. Same with Pakistan, same with, Sri Lanka, same with other countries. They printed notes and see this inflation across all, the other countries, neighboring countries of India. So printing of notes, the solution is very disastrous and nobody can, opt it like countries like India. So we have a different, system. But if the governments need funds, the best way is to governments will issue the T-bills for their day-to-day operations or expenses. And for long-term expenses or capital expenditures, government can directly, issue the bonds to the public. So public will again infuse or let's say provide funds to the governments to invest in different projects. Government will again invest in projects, build the roads and highways, and charge fees to the public who will use that highways, and same governments will return money back to the public once they collect it. So did you get this? So means government also raise funds basically. Now let's talk about stock exchange. What is the role of stock exchange? See, role of stock exchange is a platform, guys. It's a platform where buyer and seller both come together and they exchange in a securities or even cash as well, right? So companies, governments, hedge funds, retail corporate banks, investment banks, registrar, insurance companies, retail investors, brokers, custodians, they all come together here under exchange and they exchange in securities. Because broker like Zerodha, they work as a middleman. Right? It's a broker. They work as a middleman and they help buyer and seller to buy and sell the securities through stock exchange. Custodians provide safety and security to your financial instruments. Clearinghouse, they help you to transfer securities, purchase securities, because it is their responsibilities to take care of clearing part, clear the trade once the trade is executed. Registrar, they help companies to maintain the records of shareholders or outstanding shares details. And also, registrar helps companies to maintain the data of corporate actions like dividends, then stock split, right? Or different details. Insurance and pension companies, they are also buy-side firms. They buy huge, equities or bonds and debentures. See, most of the funds like insurance and pension funds companies, they invest funds in governments, T-bills, because T-bills offer interest payment, safe interest payment around 7 to 8%. So they invest it. Retail investors, again, they buy and sell securities to generate some money out of it. And what about depositories? We have NSDL and CDSL. So both depositories offer facility to convert physical shares into dematerialized form. So like a paper, right? If you have a paper, let's say 100 rupees note, what you can do, you can deposit that notes with a bank, and then bank will convert that physical notes into digital, and same amount it will reflect in your bank account, correct? So same way depositories works in an investment market. If you have a physical equities, you can deposit that equities with NSDL and CDSL. So NSDL and CDSL will convert that physical securities into digital, and then digital security it will available in your demat accounts to buy and sell easily. So that's how that system works. All right. Custodian, it means it's a bank, guys. It's a bank only. If you deposit your money with bank, right? What they do with bank, if any bank offer locker facility, so that bank you can call it as a custodian bank. Why? Because they are taking the custody of your, let's say, durable goods. It can be currencies, stocks, bonds, right? You can deposit that with bank. So bank will provide custodial support to you. Custody, it means safety. If you have a demat account and if you have investments with you, see, basically these custodians, provide safety and security to the hedge funds, mutual funds, and insurance funds investments, because they are a trust. And if fund manager, let's say, purchase any securities, it is mandated to transfer that securities under custodian. Custodian, it means again, it's another entity like a bank who offers safety and security services to the market participants. And what about clearing agent? Clearing agent, it means again, it's a party or it's a bank, you can say, which help you to buy and sell the securities. So once you buy it, they'll basically transfer funds from one accounts to another. They'll clearing agents again will transfer securities from one accounts to another accounts and announce it as a clear trade is clear. Because if you buy it, what happened? Let's say you have buy it, cash will out, right? Shares will in, correct? In the books of seller, cash in, shares out. So who take care of this? Cash out and shares in. Clearing agents, they take care of it. And they charge their clearing fees as well. So ultimately, if you purchase any securities, what you want securities in your demat account, and cash, it should debit from the designated bank account, correct? Same for a sellers as well. If sellers sell the securities, then cash will in the books of seller and shares will out. But who take care of that? Cash in, cash out, shares in, shares out. Who take care of it? Your clearing agent take care of it. Okay. CDSL and NSDL both are depositories. Okay. Depositories, it means you can deposit your shares. Where do you deposit your cash payment? If you have a cash, where do you deposit? With the bank, correct? So same way, if you have a shares, then you can deposit your shares with the bank. With the depositories. So depositories, it's like a bank. So we have a depositories, two depositories. One is NSDL, another one is CDSL. CDSL, it means Central Depository Securities Limited. NSDL, it means National Securities Depository Limited. NSDL work for NSE Stock Exchange Market. CDSL works for BSE Stock Exchange Market, Bombay Stock Exchange, and National, Stock Exchange. We have other stock exchanges also, like Kolkata Stock Exchange, Ahmedabad Stock Exchange. And there are many more, right? Pune Stock Exchange and all. But depositories actually help to convert physical shares into digital certificates. And once they convert into digital, so again, depositories offers demat account. So same shares you can accept in demat account. So then after you can buy and sell shares easily in the market. So let me just log in my account if I can. I have another account. CDSL login. All right, I'm not able to log in, but see this here, you can open the accounts and accept the securities in here in the demat account only. All right. So demat is basically a facility to accept the securities in digital format. So once you have a securities in digital formats, then you can. So there are no any other companies who can offer depository services. Only there are two companies, CDSL and NSDL. All other like they are member of depositories. We have a CDSL and NSDL, only two companies. Central Depository Services Limited and National Depositories Services Limited. Only there are two companies available so far. Okay. If anyone want to invest in these companies, you can invest. One company which is CDSL is listed, NSDL is yet to list. You can invest in CDSL. NSDL which is available in unlisted market. So if anyone is interested to invest in unlisted market, you can invest that. So now let's talk about, guys, financial market. This stock market, right? Under financial markets. What do you know about capital market? Starting investments. What else? Where they produce capital. Aditya, how capital market produce capital? Can you explain? What do you mean by produce? How they produce it? But see, market is just a platform, okay? This market is just a platform where government and companies raise capital by issuing shares or bonds, right? Shares and bonds both are like part of capital market only, and common people like us who participates and invest in the stock market, who participates and invest in this market. It's just a platform, guys. In India, if we talk about NSE, which comes under your stock market or capital market, BSE again it's a capital market, right? The other stock exchanges like Ahmedabad Stock Exchange, Pune Stock Exchange, then Bangalore Stock Exchange. We have stock exchanges across different countries. So even at the international level also you can select Nasdaq Stock Exchange, Singapore Stock Exchange, Nikkei Stock Exchange, Shanghai Stock Exchange, Japan Stock Exchange. We have means across globe we have different stock exchanges. So all are like a platform. All people they come together like governments or companies, they list their securities on a stock exchange, right? Once they list securities on a stock exchange, basically listing it means selling securities to the common people. Through listing, what they are doing, they're simply selling securities, right? Even government also, if governments want to raise funds, the government issues securities in the market. If any municipal corporation want to raise the funds, they can simply list securities in the market. So it means capital market will call it as it's a platform, right? On that platform, you can see multiple different or different participants who come together. It could be brokers, it could be banks, it could be insurance companies, mutual funds, hedge funds, private equity funds. You can see different participants who come together and as per their roles and responsibilities, they perform it and ensure that they are also supporting to this ecosystem. So common people, they always buy the securities by participating in different events, and in a day in day out also common people, they buy and sell the securities on a stock exchange. So that all comes under basically capital market. So all right. So capital market has two types, guys. Okay. One is primary market, another one is secondary market. See, primary market, which is for here companies directly sell shares to investor, right? So in a primary market, companies directly sell shares to the customers like or investors, I would say, like IPO. In IPO, what happened? Company directly ask you for applications, correct? So you guys send the applications to the companies, and company directly sells shares to you in your demat account. You can pay the amounts through bank account to the company, and company verify the payment and allocate the shares to you in your demat account, correct? So that activity happened in primary market. So all bonds, all debentures, loans, that all issues in primary market. Primary market, it's an invisible market. Invisible, it means this market is not visible like NSE and BSE. You can buy and sell securities anywhere, right? Anywhere means anywhere. If you execute, let's say, trades, let's say in your local area, near your home, so that marketplace, you can call it as your primary market. If you execute trades in any company's office, that place you can call it as a, again, primary market. So primary market, you can see everywhere and anywhere. And it's a fully unorganized market, highly unregulated market. Okay. So companies or governments both can directly reach out to the investors to ask for investments. Then now let's talk about secondary market. See, whatever securities, let's say, issued in IPO event, so that all securities, it will be available for a trading in secondary market. So we have a secondary market like NSE that comes under your secondary market, BSE that comes under again your secondary market, Bombay Stock Exchange, National Stock Exchange. And if you see any other stock exchanges apart from this, that all comes under your secondary market. And here, see, in a secondary market, there is no relation, between your company and investors. Here in this secondary market, buyer can sell it out securities to, buyer can buy the securities from the seller. Seller can sell this to the buyers. Buyers, it could be anyone. Sellers also, it could be anyone. So there are no limitations, right? So that's counterparties, it could be anyone. But here there is no relation of company and government. No. So basically, buyer and seller, they buy and sell the securities to each other only. So it means, let's say in an IPO event, you purchase securities from the ABC Corporation. Here you participated. Or let's take the example of Ola. You purchase securities from the Ola through IPO. And once the security is listed on a stock exchange like NSE, now simply, you can sell that securities to anyone in the open market. So then people like, let's say me, or people like, other, they can directly participate and buy the securities from their accounts. You can also sell it out securities in the market from your accounts. So that activity basically comes under your secondary market. Secondary market is like more formal market. It is a visible market like NSE and BSE. NSE has office in Delhi, BSE has office in Mumbai, right? Dalal Street, that you can say, correct? So NSE and BSE, that both market comes under secondary market, and secondary market is a very highly regulated market that comes under your SEBI regulation. So SEBI regulate that market. Did you get this, guys? So again, secondary market has two types. See, secondary market is for old securities. Again, old, it means once the securities issued in the IPO event, that all securities will trade in secondary market. Okay. Secondary market has two types. One is debt market, another one is equity market. Debt market is for bonds, private bonds, government bonds, and equity market is for stocks. So stocks will trade in the market. Okay, all right. Let's talk about money market also. Money market, which is something, which is for a cash transactions. Okay, RBI control this market. And who control the capital market? SEBI, right? Security Exchange Board of India. So RBI control your money market. How RBI control? Because RBI works for banks and also governments as well. If governments want to raise funding, right, government can issue treasury bills in the market. If any banks want to, let's say, raise funds, banks can announce certificate of deposit, so which is, normal deposit schemes where banks will issue the, deposit, raise the funds through deposit and offer interest payments on it. If any banks need a short-term funding, very small, short-term funding on a very short notice, then bank will raise funds through, again, call notice. Let's say Axis Bank. If Axis Bank need 1 CR immediately any of the branch, then they can approach to the HDFC Bank, right? But duration of this call notice would be like 1 day or 1 night, just to meet obligations, right? Bank can approach to the HDFC, then HDFC will transfer 1 crore, and next day morning, Axis Bank will transfer again 1 crore plus overnight interest to the HDFC Bank. So that all comes under call notice. Commercial paper settlements, your promissory notes, bill of exchange, and other bank check, that all comes under commercial papers. So all papers also you can buy on discount as a buyer. Seller can sell it out on again discount. So the discount would be the profit of a buyers. But again, duration of commercial paper should be like 1 month, 2 months, 60 days, 90 days. Within that, money will redeem, and your profit would be like discount of that the bill, the percentage you can treat as your profit, right? So that all instruments comes under your commercial papers. So commercial papers, basically, now your question would be like, sir, who issue the commercial papers? Commercial papers, corporate companies issues it, okay? Commercial paper, corporate companies issue that one. Then is there any minimum limit? Yeah, minimum 5 lakhs, or maybe sometime you can see lower the amount than that as well. Now means I have seen from even 10,000 rupees also. So depends on the transaction or trade size. If the trade size is, let's say, 10,000, then they directly issue it. All right, through commercial paper. So, sir, how it works? If you ask me question, this let's say you have traded, right, and you have a bill of your trade, and let's say bill that invoice price is 10,000, but this invoice payment it will redeem after 3 months. As a businessman, you are not ready to wait for, let's say, 3 months. Then how you can do it? So you can deposit this 10,000 rupees invoice with your means friends or with anyone who is interested, and assure them, look, my counterparty will pay me 10,000 in next 3 months, but I need a 10,000, let's say 9,000 rupees immediately. So do one thing, give me 9,000 immediately, and keep this bill with you. Once, means after 3 months, you will get the 10,000 rupees from the counterparty directly. So your profit would be 1,000 rupees. So this is how you can sell the bills. Like big companies, Adani, Ambani, Birla, they also sell the bills in this way only, commercial, through commercial papers. All right. They directly leverage out their bills. If you have your bills in your business, you can also do the same thing. Because instead of waiting for a 90 days or 1 month, 3 months, 4 months, you can quickly list your bills. There are platforms, right? There are platforms who offer this facility where you can list your bills. Other means the interested party will buy it directly. They'll transfer you the funds, but you will have to ensure that once you receive the funds from the original counterparty, you will return that funds to the person who have transferred funds to you now. All right. Call loan. Who issue the call loans? Call loan is for only banks, guys. One bank call to the another bank to bank call, and they'll raise the funds for a short term requirement. And it's in a bank that happens sometime, let's say I'm a HDFC bank and I don't have a liquidity right now, and I need a money quickly to manage my transactions. So I can call other banks to give me a money, right? And with that, bank can also ask for collateral sometime, but if it is let's say overnight, then it's fine. You can just transfer money to the other bank. Bank will pay interest payment to me as well. So I would win profit eventually, right? Certificate of deposit, again, it's a banks and even corporate companies also can offer it. Minimum certificate of deposit scheme size is like around 5,000. Sorry, my bad. 5 lakhs. Minimum 5 lakhs is the size. If anyone want to announce certificate of deposit, so minimum size it should be somewhere around 5 lakhs. All right, and multiplication of 5 lakhs, like 5 lakhs, 10 lakhs, right? Then 15 lakhs, 20 lakhs in that way. And you can raise funds and issue the certificates. Only reputed banks and companies are allowed to issue certificate of deposit. Now let's talk about treasury bills. Who issue the treasury bills? Governments, only government of India is allowed to issue the treasury bills. And it's a highly safe investment instruments, highly safe. If anyone is looking for like, safest return 7 to 8%, right? You can invest in treasury bills. If you have, let's say, 5 to 10 crores, then you can directly invest in treasury bills with no risk. Up to every 3 months, 4 months, 5 months, 6 months, your money will get redeemed and it will directly credited in your accounts from Government of India. If anyone is here and is really interested to invest in T-bills, you can reach out to me. I'll help you to open your accounts and you can directly, invest on your own. Means you can directly buy the T-bills from the market and invest into this particular, instruments. So as I already said, duration of this instrument should be like max to max duration is 1 year. Minimum is 90 days. Maximum is 1 year. Minimum is 90 days. Within a 90 days or within a 1 year, your investments will redeem and money will get credited in your account. All right. And if we talk about commercial papers, they are very risky. In terms of risk, the risk could be like default, payment risk of counterparty. Then, sometime you can select forgery. So forgery, it means fake documents also counterparties can submit it. Let's take an example of Nirav Modi. What he did, Nirav Modi submitted fake commercial papers, raised around 10,000 crores from the PNB Bank on LOI. And finally, through investigation, got to know that there are no goods. He just created a fake, invoice and raised funds from the bank. And when the bank was actually looking for collateral, there was no collateral. It was just a paper. So you can see that risk with the commercial papers. Call notice, again, it's a risky. What if, let's say, you transfer 100 crores to the Axis Bank as HDFC, your HDFC Bank, you transfer money to the, let's say, Axis Bank. And what if, let's say, Axis Bank announce bankruptcy through overnight? So you will lose your money eventually. Same for a certificate of deposit also. It's a risky one. At the time of maturity, what if, let's say, that company or bank announce bankruptcy? Who will take responsibility of your money? No one will take it. Because when you guys are asking for interest payment, so if you ask for extra money, so that extra money comes with risk. Don't forget this. Then you cannot blame to the government. Why government? See, you wanted a return, you wanted a money, you wanted to multiply, your money. Then where is the role of government into this picture? Because it was your risk only. Even if you start your, let's say, Vada Pav center or any, hotel or any resto, do you see any assurance that if you invest it, then everything will, all right, and you'll make profit? No one can give assurance. Even if you start your startups, let's say you fail to scale that business, then you cannot blame to the government. You cannot blame to the anyone, because it was your fault that you couldn't figure it out, few problems, and you lost everything. So it's your something, the decision. It was your decision. Did you get this? But yeah, in case of treasury bills, you can see a risk only like if government announce bankruptcy for governments. For example, let's say America governments announced bankruptcy several times. Then recently we have seen like Pakistan government announced, bankruptcy. Then Afghanistan government also did. Bangladesh, Sri Lanka, Nepal, Bhutan. So there are many other countries like announced bankruptcy. When the government announced bankruptcy, it means government is now unable to pay your interest payment. So government is not in a position to pay your interest payment. Basically, government has no liquidity left. All right. Then see, this happened with many other countries as well, not with only the Indian governments and all, but we have not seen any situation as such so far in last at least 78 years, because we got freedom in 1947. So till, so far we haven't seen that any situation as such. But in future, you might see due to government policies or any other issues. So we can't predict the future. But again, it's a safest, it means it's a safest investment as your treasury bills investments as compared to all other financial instruments.
Just a quick info, guys. Intellipaat offers an executive postgraduate certification in investment banking and capital markets in collaboration with IIM Ranchi. Through this course, you will master key skills like financial modeling, valuation, mergers and acquisition strategies, risk management, and even niche areas like private equity and wealth management. The program features 80 plus live sessions conducted by IIM Ranchi faculty and industry experts, real world case studies, hands on projects, and a 3-day campus immersion at IIM Ranchi. Plus, you will also get exclusive benefits like executive alumni status from IIM Ranchi and complete career support from Intellipaat. We have already helped thousands of professionals achieve successful career transitions in the finance domain, and you can check out the testimonials on our Achievers channel. The link is in the description below. And for sure, this course can set your career to new heights. So visit the course page link given below in the description and take the first step towards the rewarding career in finance.
See, we were talking about this IPO event we applied in primary market, because in a primary market, company directly issue securities to the investors. So I wanted to buy securities from a company, so I directly applied for an IPO here in the primary market. And once the now stock in next week stock will list, and that stock will list here in the BSE market, NSE and BSE both. See, one thing is very important, guys. If you apply for an IPO before the, let's say, IPO event, so it means, let's say maybe, when the company was private limited, at that time, if you, entered in any business, then you can multiply huge profit. How? I'll tell you. Private equity funds, okay? I don't know whether you guys have heard about this or not, like KKR, Blackstone, right? They are private equity firms. Warburg, there are many more. So they actually invest in a companies at a very early stage. Very early stage. See, your startup starts from 1 crore, and that 1 crore valuation reach to the 20,000 crore, or maybe even 1 lakh crore. And that 1 lakh crore value, actually they sell it out to the public. So it means IPO event is just like, to make a fool to the people. So through IPO events, companies is the, fool to the common people, and they raise very long-term capital, or you can say like very, long-term or perpetual capital for their long-term business objectives. So it means if company raise capital through equity, then company don't need to return that capital to the, let's say, shareholders back. That's how basically, this game works. All right. So my point is, now just imagine if anyone, if let's say even you also, let's say you have invested your 10,000 rupees when they say value of that startup was 1 crore. Just imagine, what if your 1 crore reached to the, let's say, 1 lakh crore, then see how much value that you can generate. And duration would be like max to max 5 years or 10 years. Within 10 years, you can multifold your profit. And private equity firms or venture capitals, they basically generate, huge profit. Huge means huge. Again, in terms of risk would be high, but the universal law of the law of return is like more risk, more profit. The private equity funds, venture capital funds, they always entered in a business at a very initial stage. Let's talk about Flipkart. Flipkart was a startup, right? Flipkart was a startups, and not Blackstone, Tiger Group. Tiger Group, again, it was a P fund. It is a P fund. They took an exit with 28,000 crores, profit. So it means they booked the profit in Flipkart around 28,000 crore. So just imagine the profit percentage. So it's a bet actually. If you know the risky businesses, and if you just invest in a systematic way, then you can multiply your money. So this is how you can multiply your profit if you're really interested. So I'll walk you through one of the deal which I have invested. I don't know means how long this, again, it's a practical insight, so you should know it as a working professional. I have invested in this ambition rail. Let me just search it. Relbus project. Relbus project. See this one. Can you see my screen? Okay. So see this. So this is the another project where I have invested not a huge amount because see, I'm also like, I'm not a rich person, right? But I invest like 2 lakhs, 3 lakhs, 5 lakhs, 4 lakhs. This is how I'm just building my portfolio. I don't know how this will scale, but this is at a very initial stage, as I said. So this is how you can, tap the market opportunities. I have invested in this project. So this also reduce carbon, support to the environment. It's a capsule. And again, you can means save the time as well, right, through this infrastructure. And it's a very cost-effective one, 100% congestion-free elevated rail network. So it means you don't need to use any fossil fuels to operate this system at all. All right. So see, this is how the project is. So I have invested at, let's talk about some numbers because we are finance professionals. So along with that, we also talk about numbers as well, right? Numbers, it means in terms of growth, how much growth that we can expect. Let me see investors column. I don't know why system is get a transition. Okay, so they have got memorandum. Government interested in adopting Railbus as a modern, affordable Dubai and sign and welcome to visit our showroom in Dubai and sign an MOU. So they have signed MOU with the government, Dubai government. So that's what I meant, got more traction on this project because they are not like India or any other. Because in Dubai, they prioritize the infrastructure. So thought like let's take a risk and invest. I'm not able to see that. I have invested, when the share price was like $1, or below the $1, I would say. But now the price, which is at more than $1, around $3 to $4. So it means again, I have around 300% returns. But in 2027, the stocks we are anticipating, this project will like up and run, and then they list their stocks on the stock exchange. At that time, maybe we'll get the value around $100 per shares. And at that time, maybe I can generate around 1 CR profit from all of this investing activities. So this is how I see, again, it's a risky, right? When you invest in any business at a very initial level, it becomes more risky, guys. But yeah, so I'm at a very young age. So I thought like, let's take a risk, because if you don't take a risk, then again, eventually you cannot make a profit. Yes, infrastructure could cost a lot. That's what I said. It's a risky one, but if you want like, see, the entire world is now focusing on carbon footprint. The reason is the world is now facing three big problems. One is the clean air, rising temperature, and clean food. Most of the underdeveloped countries, they don't have a clean food and even clean water as well. And the entire world is now shifting focus on all of this. You can go and check the data on, let's say, global investment trend monitor. You can go and check that, so where the world is investing. See, world is investing. Foreign direct investment flows in the second quarter of again down. The investment was down, but the most of the investments. Let me see the tracker first, so that where world is investing, that we can see. Data center, country profiles, infographics, trade and merchandise. Let me see, there is one more tracker. This is not something. Global investment data tracker. We don't want China, we want map, we just. Because world is investing in, the clean water, clean energy, and clean air. So the world is focusing on that only, including India as well. Because for us also, the priority is, food security, energy security, clean energy, health infrastructure. So we have lots of challenges. And our political system is like, again, very corrupt. The opposition leaders, they don't have a vision. Then ruling parties, half of the leaders, they don't know how to do next. Half of the leaders, they are good, but the support system is like weak. they're working very hard, but the people like always they create unrest, from different corners of the country. Like you can say farmer protest, student protest, girl protest, yeah, that a number of things. But we should, as an investor, we should always, see the vision, like how we can, divert our money and put into the different, buckets. So yeah, so you can means, review the different data, guys, metrics, data, and all other, resources if you want to become a successful investors or even banker as well. As a banker, let's say if your target is to become, the research analyst or financial modeling analyst or fund manager, fundraiser. See, for all of this role, then, the requirement is how you're good at, tapping new opportunities or understanding, the market sentiments, or let's say understanding of different, geopolitical issues, and see how you can capitalize them for your benefits and your investors' benefit. Because see, as a banker, see, beyond the, profit making and all, so we should always look for an impact as well. If we talk about, let's say, poverty, data, so we have like around 30%, the poor people, and they are like under very grave poverty line. All right. So again, when we talk about, let's say, unemployment, data, which is a shocking. See, to blame a government, it will not resolve your purpose or problem. As an investor, so as a good, investment banker, you can always route the money into the different, the opportunities, and see how you means your decision as an investment banker can, help governments, or maybe let's say society, to create a more and more, the job opportunities, and also like, scalable and sustainable model as well, by ensuring that, your model is not affecting on environment, social lives, as well as on, let's say, the, the employments as well. But we should also ensure that how your companies, like investing companies, they're following due diligence reports and all. So let me tell you one example why it is, important is, let's take an example of, the Bhopal factory. What was happened in Bhopal factory? Gas leak, right? So what the foreigners they did in this, in the gas leak, that we know it. So more than 15,000 people, they lost lives in Bhopal, Madhya Pradesh, due to gas leak, right? So we should always, means as a responsible investors, we should look beyond the returns. Returns cannot be a target, but yeah, of course, returns, which is again, it's a byproduct. But apart from that, see how you can, means from your expertise, like how you can do, some better deals for everyone, every stakeholders. That's how your role come into picture, and why we are discussing different markets and all. See, the purpose is not to just understand, let's say, the market and, crack you into. That is, of course, means initially we means all are looking for a job. That could be your short-term goal, but for a long term, see, always broaden your view. All right. So just see how, see the longer picture at your lenses, and see how you can create a big, footprint. All right. Because you guys are now, of course, future, and young, you're young, to see how you can, means leverage out all of this, financial products, maybe finance, the market. Because what I believe personally, finance is like an oxygen. If you have a control of oxygen with you, so it's on you where to, infuse the your oxygen, and where not to infuse. So you know it. So see that how you can leverage it out. So let's discuss about, further things. If we talk about, guys, the money market is one of the highly liquid market. Highly, it means very highly liquid market. RBI control the money market. Okay, who control the money market? RBI control the money market. So RBI take care of everything. So why now, your question would be like, sir, why RBI take care of everything? See, guys, cash is an oxygen of the economy, and always, we should have to have a system in place who can control that oxygen, because excessive oxygen is also not good for your health. So same applies for money market, for economy or country as well. If you see excess supply of a cash, right? If you see excess supply of a cash, excess, it means very excess. Let's say we have a high supply. Your spending capacity your spending capacity will go up, correct? So it will lead to an inflation. So how inflation? Let's take an example. Let's say the banks, right? If you apply for a banks, they are charging low interest rate, let's say around 5%. So more people will apply for a loan, right? Let's say bank approved your 20 lakhs loan, personal loan. So you can spend this money on anything. Maybe you can spend on car, you can spend on mobile phones, clothes, garments, and also like you would pay the more price than the market price. That's the human tendency or behavior, I would say. You can read in the behavior. There is a theory called like stupid price something theory that I'm not able to recall that exactly, because I means few years back when I was doing the study of behavioral finance. At the time, I gone through the one term like stupid price. There is something stupid price. It means something where, let's say, the actual price is available market of for the product is 20, but he will ready to pay 21,000, 22,000, 23,000, 24,000. Because for you, when the supply of money is high, then the money value will actually go down in your eye, and your spending capacity would be high. So that will lead to the inflation, I would say. Inflation, it means teji, that you can call in Hindi, teji, so that you can be more and more fees, more and more money on a products. And again, that inflation is also not good. Now your question would be like, sir, look, why inflation is not good? Because I'm ready to pay, repay the debt, and it's my money because I took a loan. I can do anything, whatever that I want. See, question is not about you. See, just because of your stupid act, see, entire markets, prices that you have manipulated. If you buy the, let's say, mobile phone at 21,000, then from that point, mobile sellers will sell the mobile at 21,000 only. See, you are like, let's say you have received loan amount of 20 lakh. That doesn't mean everyone have applied for a loan, and they'll also pay the same amount, right? As I said, we have a poverty line as well. So poor people, they can't afford it. Same can applies to the essential goods as well. 90% cases that most of the poor people, they can't afford your let's say oils, good oils, means the refined oils, they can't afford it, right? Even branded clothes, 30% of your country's population, they can't afford the branded clothes, right? But just because of you, if you just want to manipulate the price of goods, so that doesn't make any sense at all. And that's what we need a system who can control the oxygen, who can control the supply, and vice versa. What if, let's say, there is a low supply, there is a very low supply of money in the market, very low supply. What will happen in that case? Low supply, it means it will lead to the high interest rate, right? High interest rate. People, they'll not apply for loans, means apply for a loans. The number of people, they'll think about, it's a behavior. They'll think about, the interest cost is high, so why should I apply it? Instead of that, I'll wait until the rate, gets down. So it means the loan growth would be low. So in that case, what will happen? Supply of money would be again low, and that will lead to the inflation. So now your question would be like, sir, see, if we have a low supply, you are saying inflation. If we have a high supply, you are saying, my bad, very low, not inflation, recession, right? In terms of, let's say, low supply will have a, recession. In terms of high supply, you're saying, inflation, recession. So how to maintain a balance? See, balance of payment, which is a very critical part. Very critical part. It means very critical part, because see, to maintain a balance is a very important in terms of the equal economic. You can say like the means everyone they can afford it, for affordability of durable things. See, ultimately your paper has no value. Let me tell you something. You can just access the services through paper, because your note is your paper money, right? Let's say when you are on a bid and now you don't have a time, because it will means let's say you don't have a time. You don't have a time. It means, let's say your age is at 70, 80, 90, whatever it is. So what will you do with that paper money? You tell me. Nothing, because that money also, it will not save you, right? Now, question would be like, why we wanted to build all of this, maybe business, empires, all of this. See, ultimate the purpose is we want to support to the system, right? Maybe let's say if you're an entrepreneur, then you can build product, you can build your business empire, you can create a more and more employment opportunities, you can support to your community system, and in return of that, you will get a good life, right? You'll get a good life. So that's the whole and sole purpose. Even if you are a rich person like Ambani, Adani, they have also same 24 hours of time and 70 to 80 years of life. Same applies to us as well. Correct. So this rule is applies to everyone. So ultimate purpose of doing all of this is means everyone want better life, right? Better life, it means clean energy, clean water, clean food, clean energy, and safety and security, I would say, like defense. That's all. That's the means ultimate purpose. Why we want to make a money? For that purpose only. And if we look at now, to that purpose, then your oxygen matter a lot. So let's go ahead with the other market. The other market is FX market, foreign exchange market. See, foreign exchange market, again, it's a very highly liquid market. Highly liquid, it means highly liquid market. Let's talk about, some major currencies. The world's largest currency is, USD. Then also you can say like, GBP, Euro, JPY, and even Chinese currency as well. China's currency, right? These are the world's largest currencies or highly tradable currencies in the market. In FX market, if we see most of the currencies, they have, pairs. USD, you can see USD with INR, USD with Ruby, USD with, POK, USD with ED, USD with this and that, and SGD, right? So you can see pairs. Currencies always trades in pairs. Indian government recently, listed our currency as well in the international market, that Indian government want to settle the, the payments. Or eventually the intention was like US government wanted to support to the Russia to settle their, international payments and all, because when this invasion started, like, Ukraine and Russia invasion or the border escalation or war, let's say, started at that time, entire, the big countries, they banned the Russia from the USD, GBP and Euro currencies, or even other, Canadian currencies and all. But India facilitated, like, India purchased everything from the Russia and then also settled the payment in, the USD. How? Because see, India listed their currency INR, right? India listed their currency INR and pair that currency with ruble. So it means INR and ruble will trades. So where India will, buy oil through their pair only, correct? And same India will help, the Russian companies to trade that same oil in the international market with INR and GBP or, USD or all other countries, because our currency was open to trades with other currencies and still which is open. So that's how they actually been supported in this particular, this pandemic. We have seen that this government also, facilitated, like, buy more and more oil from the Russia and sell it out to the other countries and settle the payments, their INR. So that's how, guys, FX market works. Did you get this? So FX market is one of the largest market. At the international level, it works in a very different way. And even if we talk about at a banking system level, so most of the, your foreign currencies that, banks actually book the spot contracts. Spot contracts, it means check the market price of currencies, your currency versus other currencies, and settle that particular contracts. For example, let's say you can go to this market, FX marketplace, like, let's say this one here, see the different currencies. rate. Let's say $1, if you want to convert dollar into INR, convert that. So we'll have to pay almost 83.887636 rupees to buy $1, right? To buy $1. So this market rates continuously changes. But if you want now, if you just see, we have also listed now means your currency have a pair now in international markets. The most of the the investors or even most of the, let's say, the countries, they're ready to pair with us. And what we did, as I said, we have supported to the Russia as well in the past. But here you can see the rates. If the rates is, let's say, $1 for one, then you can book this rate basically. You can book this rate in your system as well, like the 83.8876 rupees, which will have to pay for $1 or dollar cost, you can select 83 rupees in India. Are you getting my point? So this is how actually we book the swap contracts. Swap contracts, or you can select spot contracts. Spot, it means check the rate at spot. What is the rate at this point in time? 83.66. And this will continuously, changes. Continuously, it means continuously it will changes. So from FX perspective, few things are very important. One is the global currencies like USD, GBP, JPY, or Chinese currencies. They are the at a very top, and most of the countries even they prefer to trade in only top currencies. Okay. Then another one is the another the big thing is here, if you see, Indian government also listed our currency, and now you can see the pair for your currency as well. Apart from this, FX market is a highly liquid market, and in terms of like investing part, it gives you more, you can say it gives you more, margin as well. If you want to, let's say, if you have only $100 and if you want to buy, lakhs of, let's say, Indian INR, you can buy it through options. Not exactly options, but you can say like, future contracts which are available in the FX market. But yeah, so FX market, in terms of FX market, you can say the RBI control it. Just let's summarize it. RBI control the FX market. FX market is a highly liquid market. Most of the contracts that we book at a spot price by referring market, which is XE, or there are many other markets as well. There are few big currencies or dominating currencies like USD, GBP, Euro, and JPY, right? And even India also listed our currency as well. So this is how your FX market is all about. All right. So the topic would be the derivative market. All right. And also we'll try to complete this portion as well, which is financial instruments. So would be little bit interesting as well. I'm not going to refer this PPT and all, because derivative is something that we should learn it from the very practical ways. So I would like to share my screen and walk you through some practical things. So it would be little bit interesting, but I would request you again, derivative, it's a very complex topic. So if you don't have, let's say, trading exposure, and also you will not be able to understand it very quickly. So it's a humble request that you should note it down, everything, all important points. Okay. So if we talk about, guys, derivatives, it means it's a contract of financial instruments. It's a contract of financial instruments. Okay, so we can sign a contract, we can buy any assets, but see, you don't need to actually buy any assets. Instead of buy, what you can do, you can just buy a rights of that particular assets and hold that assets rights with you, maybe for a month, for a week, for a year. And once you see, let's say, the price, let's say, which is reached to the certain level, then you can sell it out, that same thing, in the market and generate some profit out of it. So this is how basically your derivatives works. In India, we don't have any derivative commission, but your stock exchange only, they manage the derivatives market and all. In a derivative market, you would see different contracts like option contract, then your future contracts. All right. And swaps as well. So we'll discuss that each contracts in details. All right, swaps, options, futures. But when we talk about derivatives in market, so it's simple that it's a contract of financial instruments market, and financial instruments which can be your stocks, bonds, debentures, commodities, all other different instruments. Okay, so let's talk about the derivative market first in details. Means along with their instruments and all. In details, it means in detail. So we'll try to understand derivatives from the very scratch. So let me take you through the board. So have you heard about derivatives, guys, before this? See, derivatives, it means it's a contract of financial instruments. It's a contracts of financial instruments. Okay. So when we say financial and instrument, guys, see, we are talking about, again, equity, bonds, debentures, interest payment, cash, commodities, right? So that all comes under your financial instruments. And when we say contracts, see, contracts talks about the obligation. Contract talks about obligation. Obligation, it means buy obligations and sell obligations. If you want to buy or sell any assets, instead of buying assets, what you can do, you can just simply, buy the rights of that particular assets. See, assets, it could be anything, as I said, equity, bonds, debentures, interest, cash, commodities, anything. So to understand this process, how we can, let's say your question would be like, so look, how we can, buy the obligations. So let's take an example of, let's say, any stocks. Any stocks, it means any stocks. All right. So let's say the stock price which we have available is 10, 15, 20, 25, 30. This is a duration. Week 1, week 2, week 3, week 4, week 5, week 6. All right. Let's say there is one stock which is called Wipro. Stock name is Wipro. The price of a Wipro, which is at, let's say, this level, 10 rupees. All right, 10 rupees. And here, let's say, if you are, let's say trader or investor, right? Let's say your means forecasting for future would be like, let's say, see, there would be 3 situations, right? One, price of this particular stock, it may go up, right? Price of this stock, it would be same. And third would be price may the stocks, it may go down, maybe up to 5 or even 1, right? High, low, or you can say medium or at same level. Correct. Now, let's say if your, let's say, research says stock price will go up. Now, my question is to you, what will you do with this particular stock? If your research says this particular stock price will go up, if your research says price will go up, then in that case, what will you do? You tell me. This is a Wipro stock. Will you buy or will you sell it out? If you have 100 rupees, then how many quantities you can buy of this particular stock? let's say current market price is, this is the current market price. So how many stocks you can buy? 10. Okay. Let's say you have purchased 10 quantities, right? And after, means in a third week, let's say stock price reached at this level. You purchase at this one, you sell it out this one at this, this level, and the price of stock is at, in third week price, which is at 15, and you sold the same, 10 quantities at 15. So how much would be your profit? 5 rupees. And quantities you have purchases, how many? 10. So total profit would be 50 rupees, right? So now my question is to you. Okay, this was just a simple example. Let's say if I want to multiply my profit, so how can I do it? With the same capital. I don't have any extra capital. My capital is 100 rupees, but with the 100 rupees capital, how can I multiply my profit? See, if I have 100 rupees, and if you ask me, so sir, how would you do it? Then instead of, this buying dip and this and that, I'll simply look for a derivatives. So this 100 rupees, I'll, use as a margin. I'll use as a margin. And I'll use 100 rupees to, buy the financial instruments through contracts. So it means I'll just pay the fees. Let's say initial fees, 10 rupees, 20 rupees for XYZ quantities. I'll buy quantities in bulk. I'll hold and I'll multiply my profit. Now, how I'll do it? Let's talk about it. Instead of buying 10 quantities, what I would prefer, I will pay, let's say, 1 rupees margin, for each, shares. So margin is kind of advance, in terms of, let's say, if you want to book any tickets or anything as such, what we do, we just book the, seats in advance by paying 10%, 5%, correct? So same way, I'll pay 1 rupees margin as an advance fees for each quantities, and in 100 rupees, I will buy 100 quantities, right? And if same, let's say, thing happen like, share price from 10 to 15, it goes, then I'll book profit at 15. In this case, my profit would be 100 into 5. See this, 100 into 5, 500. See, on a capital of 100 rupees, I have multiplied my profit from 50 to 500. So it means almost 10x profit that I have generated from the same margin. Now your question would be, look, sir, what about risk? See, if the share price goes from, let's say, from 10 to 5, then I lose my entire capital. Means whatever fees, let's say, that I have paid 1 rupees for per shares. So definitely means I'll have to pay 100 rupees as a fees. And if I pay 100 rupees to the parties, and let's say if my, let's say, stock price goes, down from 10 to 5, or maybe, below the 5, then I'll lose my entire, profit, entire capital, whatever that I have paid. So this is how, guys, derivatives, works. So derivatives, it's a contract of instrument. It means through, contract procedure, you can pay only minimum amount, like 1 rupees, 2 rupees, 10 rupees. You can pay very minimum amount, and you can, acquire quantities in bulk, like 1,000 quantities, 200 quantities, 300 quantities. So let me just log in my account. So I'll walk you through few things. It's my training account, okay? I use for, because we are into the stocks market training, and also let me access how, means we can leverage out, through the derivatives. I'll show that now, this to you. Let's talk about some, other things before touching to this, the derivatives. Let's talk about profit first. See, this is the profit, realized profit, okay? From 1st April only. Did you get this? The profit from 1st April only. In last April, May, June, July, right? And we have completed with August now. So you can see in last 4 months, we have generated 3,93,000 profit. And it is a realized profit. Realized, it means we have drawn this amount. Okay. Last trade was, let me see if I have the details for a last trade. Which one was the last trade? Yeah, this one. So I have booked profit of almost 23,000 profit that I have, sorry, purchase rate. So somewhere around 23 to 19,000 something that I have booked from this one. All right. So yeah, so 3,93,000. But what I want, I have booked losses as well. So it's not something that I have not booked any losses and all. So I have booked it. But how I have achieved this 4 lakhs, which is a realized profit from my portfolio. So, and how I have, let's say, means benefited of took a benefits of, let's say, leveraged, right? So we'll discuss that part because that is important from your training perspective. So now this realized profit. So let's talk about now capital, how much capital that I have invested. So here if you see, so I always leverage out the brokers margin. I have invested 1,95,000, but the position value which I have is 3,80,000, the current position. And yes, so I have loss in couple of positions, like because in last week there was the big there was something happened in the market, and most of the position reverse it out, but that's fine. So we have a loss. The Geo Finance I'm holding since I have already booked profit in Geo Finance, but this was like in a position that I took it at very high level, but that's fine. Again, it will reverse it out, so not to worry about it. But rest other, like all are good stocks or scrip. Just wait for some time, maybe 1 week or 2 weeks. After that, you will see that price will reverse, and then you can see this in profit as well. Apart from this, you can also understand this one. See, this is a demat account holding. So in demat, I have around 7 lakhs. So total portfolio, if we just talk about worth of portfolio. So we have a worth of portfolio which is at 14 lakhs something. So out of this 14 lakhs, around 3,93,000 that you can add as a realized profit that I have received. Okay. So now let's talk about the fund which is available in the account. Oops. I don't see fund which is available. Why? There was a fund. Maybe due to the bank holiday, the fund is not here, but fund was there. Okay. So let's talk about now again the options, because we were talking about derivatives, right? If I have any open position, yes, I have open position of Reliance Industries, right? Purchase at 59. There was a profit as well around 4 to 5,000, but then after when the company announced bonus issues, I have seen some downfall in the price, but still I'm bullish on this one. So let's see, not to take a call at the moment. So now let's talk about, guys, why I have entered in this call option. Here if you see, I took a call option that I am anticipating that price may reach to the 3,100. Why and how? Let's see the now chart of Reliance. Where is it that? And in one lot, you can see 250 quantities as well. Reliance Capital, Reliance Industry, RELIANCE. Yeah. Let me open that in a big chart. Reliance Group. What is this? RIL Infrastructure, RIL Industries. Yeah. So price was actually reached to the this level, but then after, as I said, suddenly I have seen downfall. But maybe I'm anticipating that, this is the support which that you can see where, this stock price, which is at support level. But in last couple of days, I have seen something you can say. So what was happening with this stock? Because stocks announce your demerger of Geo Finance business, right? And then it was trading in between this line only. See this. In the month of July, we have seen breakout in the price, right? And again, I have seen breakout here. But I don't know whether, nobody can predict that whether it is a false breakout or it will go up or it will go down. Again, it's when we take a risk, it means, if your probability says, let's say price will go up, then only you can enter in, contracts, correct? So I thought like, if you see, maybe this stock will, give a breakout. And if this, give breakouts, the next level would be somewhere around 3,100 to 200, 3,200 in between. Or maybe even if, reach to this level, then it can also give a breakout as well. Correct. And that's what I entered in position. But now if we talk about, let's say this price, 3,100, right? 3,100. If you just multiply this price with the 200 quantities, okay, let's say 3,100, which is a quantity which we have, and the price, sorry, my bad, quantity which is 250 and price which is 3,100. So let's talk about amount. Into this one. So 7,75,000 rupees, which is required to buy this particular means, 250 quantities. But the fact was like, see, I hadn't, 7,75,000, but I wanted to enter in a contract to make some profit. I wanted to enter in a contract to make some profit. So what I did, I thought like, if I instead of investing 7,75,000, what I'll do, I'll just simply, let's say if I calculate the 5% of this price, which is 78,000, not even that much. Let's say 1%. It goes around 7,70,000, 7,750. If I pay advance amount, as a fees, means contract fees, and hold the rights, okay, hold the rights to buy this particular stock in future date, then I'll get the rights of 250 quantities to buy them in future. Buy them in future at future price. Right? So if I pay, let's say 7,750 rupees now, I'll pay this one. Or if you see, I paid it, I'll show you that as well. I paid this amount to hold the rights of a buy almost 250 quantities. Correct? Now your question would be like, sir, why did you pay this? See, if price, let's say now the current market price, which is below 3,100, if this price moves from 3,100 to, let's say, sorry, 3,050 to 3,100, then you might see, which is premium, which I have paid. Let's say this one, we'll call it as a premium. Premium, it means it's an advance fees which I have paid it. So this price will move from 3,050 to 3,100 if this happened. So here actually you can see gain of, let's say, 50 rupees, right? And in my option, even if you see 5 rupees, or let's say even 5 rupees, 6 rupees, or 10 rupees, right? Or even 20, whatever. See, the moment which is, there are other factors as well. But in an option, you can see different price movement. Or let's say in a premium change from, so if you now just calculate this one, premium for per shares, first calculate this 250 divided by 7,700. 250 divided by this. what happened with this? 7,000 that I have paid it. Let me calculate. 250 divided by 7750. So it means I have paid something, this price for per equity, right? Let me compute this one. No, this is not right. Something is not right. So 250 quantity, sorry, my bad. Price divided by quantity, which is 31 rupees. See, 31 rupees, which I have paid as a fees to hold the rights of one quantity, right? What if, let's say, premium of my shares, let's say price moves from 3050 to 3100. See, difference you would see, which is 50. But what if the premium which is paid, changes from 31 to, let's say, 50, means 20 rupees appreciation or 19 rupees appreciation that you can see. Correct. So quantities which would be same, again 250, there won't be any change in quantity. Now let's talk about price, right? Let's talk about price, means difference or how much profit that I can make it on my same investments. See the difference here, you would see, because positive change from 50 to 30, 31 to 50. So there would be change, which is something 19 rupees. And if I talk about my profit, 250 into 19. So 4,750 rupees profit. And which is a descent, right? I have paid only 7,000. I have paid only 7,000, guys. 7,000 or this one, this much of amount to generate profit of this one. And within a 1 day, let's say if I get this amount of profit, so my profit percentage would be around 50%. Correct? Around 50% profit that I can generate. What if, let's say, if I add this quantity in a lots, because I'll have to multiply it. If I, let's say, let's say I have now 21,000 rupees in my pocket, or 20, not 20 exactly. So multiply by 4. Let's say I have 31,000 in my pocket. And if I buy, let's say 4 lots, would be for 1,000, quantities. Actual amount, if I buy, let's say actual quantities, then I need a more money. I need a more money, like, let's say 31 lakhs. So how can I, get this 31 lakhs, right? So how can I get this? Correct. But instead of that, if I, let's say, simply buy options or contracts, derivative contracts, through derivative contracts, I'll just pay, 31,000 to acquire the rights of this 1,000 quantities. So it means I can buy them in future. And if price moves from, let's say, 305 to, 31, 100. So in that case, same, premium, let's say, changes from 31 to 50, then I'll make a profit of around 19,000. Again, see the percentage, it would be somewhere around 60 to 70, 75%, right? So this is how, guys, derivatives actually, again, let's talk about risk. What if, let's say, price, let's say this was your actual price. It's just assumption. And this was your, let's say, market price. If, let's say, your market, you means actually purchase quantities at this price, or let's say contract at this price, and your price reverse it out from 31,000 to 305. So you would see loss of 50. And same way, you would see change in the premium as well from 31 to maybe around, let's say 11 rupees. So in that case, you would see loss of 20,000. So it means whatever premium that you have paid, let's say 31,000 premium, which you have paid it, right? 31,000, this premium value would be around only 11,000. Remaining would be loss. So it means through derivative options, if you just buy and sell, the contracts, that could be, very risky, because only 2%, traders, they are making money out of it. And 90% people, 98% people, they are losing money in this particular segments. Now your question would be like, sir, why and how they are losing? Because of risk only, guys. The reason is, if I talk about, the options contracts, because all are contracts, okay? Contracts. Option contracts offer weekly expiry. Option contracts offer weekly expiry. And in a weekly expiry, what happened? Let's say Monday, Tuesday, Wednesday, Monday, Tuesday, Wednesday. What is this, man? Thursday, Monday, Tuesday, Wednesday, Thursday, Friday, Saturday, and again Monday, Saturday, Sunday. See how your option market works. Let's say 31 rupees is the price, right? 31 rupees is the cost that we are paying for 7 days, right? And here, let's say on Sunday, your contracts will expire. This is what the contract is about. So it means you're not buying quantities. Understand this. You're not buying quantities. You're just buying legal rights so that you can buy that particular shares or you can sell that particular shares in between Monday to Friday. Means it could be any day, right? It could be any day. You can sell that out at any point in time. So basically, you're looking for a rights. You're not looking for a quantities. You're looking for a rights of a buy that particular contract. All right. So now, if I talk about, guys, the options, how your options works. Let's say, if I talk about now premium, the days are 7, right? Days are 7. Okay. 31 rupees divided by 7. So per day, you're paying, fees. This is something your fees. Cost is it's a fees and quantities. Total quantities like, let's say 1,000, but you're paying 4 rupees, 4.42 rupees fees for per day. And this calculate days and nights as well. Let's say you purchase, any option contract on Monday. So at the end of the market day, already this, 4.42 rupees will deducted from your total premium. Same for a Tuesday. You can see like this. 8.8 total means, on second days, your total premium that you will lose around 8.5. On this date, total premium that you will lose around 26, not 26. So you can just sum it out. 13.28, right? On third day, again, you will lose money around somewhere this. Let's calculate it. Let me calculate so that you can understand how premium works. 22 means every day we are just paying, taxes. And here, if you see, your premium will zero out. On expiry, your premium will zero out. Why is that zero out? Because, guys, see this premium, it means it's a cost that you have paid for the next, 7 days. Once the year 7 days over, then whatever premium that you have paid, that will expire. So it means your premium value would be zero. And that's the risk. If, let's say, if that particular stock price failed to perform in your favor, then your premium, every day you will lose your premium. Continuously, you will lose your premium. And even though if your, let's say, stock perform well, still you will lose your premium. The reason is it's a cost which you have paid it. If your stock moves in your favor, then only you can generate some profit. Then only you can generate some profit. And that's the risk which is, you can see lies with your options contracts like put and call options. If you want to buy any contracts, so first understand it, like how your, the premium, how that your premium works. Premium is nothing but premium is a fees which we are paying to the central counterparty to hold the rights of assets, right? Maybe for a buy and sell. In both the cases, you can buy the rights. So if we talk about, let's say, call option talks about buy certain assets, buy certain debts. and you can again sell that assets at any point in time, because as a buyer, it will not have any obligations. But if I talk about again writers of the call options, writers definitely will have certain obligations. Writers, they cannot take an exit until their counterparty take an exit. So it means they will have to pay higher the amounts to hold the rights, because option sellers, they are something writers, and they always they always, their risk would be something where maximum capital and minimum, let's say, profit. But if we talk about option holders, like call option holders or put option holders, their profit percentage would be unlimited, right? Their profit percentage would be unlimited, but losses would be limited. The reason is we are paying fees every day to hold the rights of the contracts, and that's what your losses would be limited as a holder. But the losses would be something that you, as I said, you have paid a fees to hold the rights of that particular asset. So it means every day you will have to pay fees, and every day you would see change in your premium. So it means if you are, let's say, 100% sure that even let's say not 100 but up to 70, 60, 70%, if you're sure that price of this particular contracts or stocks will work in your favor, then only you can buy that particular options. Otherwise, that doesn't make any sense to hold that particular options for a trading purpose. The another reason is why we buy and sell the securities through options, because the options help us to multiply or maximize our profit. But on the other hand, we cannot ignore the risk. See, if we see the more profit, you can also see the more risk as well. So if you're looking for a more profit, then you can lose your more capital as well. So this is how your option premium works, guys. Now your question would be like, sir, this is an investment banking session, and why we are talking about trading? See, I'm not talking about trading. Now let me tell you something, that what we do in a banking. Let's say if we join any, let's say, reconciliation process, maybe if you join any, let's say, trade processing process, or any other, the accounting process and all. So in that case, you will have to do the accounting of option contracts. So it means you will have to calculate the exposure by multiplying the quantities versus price of options. Then again, you will have to calculate the value of options, like let's say in terms of the value, it means the premium. If you see the changes in premium, then that change you will have to multiply with the quantities, and that exposure which we needed for reconciliations, processing, and to update or record that particular options in the books of account. The reason is investment banks maintain the investment books of records, because most of the investment banks, they are brokers, so they maintain the investment books of records. And if we are, let's say, if we are not sure about this premium and all, so how we can calculate the exposure of options? Let's talk about now accounting. Hedge funds or other mutual funds or individual traders, they trades in derivatives, right? If you don't know, let's say, how your derivative contract looks like, how or when your derivative contracts expires, when or how your derivatives options works, then how you can advise to your traders, or how you can manage their accounts. All right. So it is a very important from the operation perspective as well. Then apart from that, if you don't know, let's say, if any banks hire you to manage hedging, it means buying or selling different contracts to hedge your products. And if you don't know how to hedge your option contracts, or let's say assets through option contracts, then how will you manage your clients? So that's what your derivatives chapter is very, very crucial. So margin money is nothing but, guys, margin money, it means it's your own money that you have paid it, right, to the broker, or maybe let's say to the parties, and you have also taken loans as well. If you see, let's talk about this particular transaction. Open positions. See, current value of a position is 3,80,000, but I have paid around 1,95,000, right, to hold the assets of 3,80,000. But who paid the remaining amount? Broker paid the remaining amount, because I'm paying interest payment to them. let me just see if I have the data for last 1 month. See this, I'm paying interest payment on amount. Every day broker is charging interest payment to me. So total loan amount that I have is 5,25,000, 96,000 out of this. And I'm paying interest payment to the broker every day. So every day broker is charging 139 rupees. I'm paying interest payment to them. Why? Because ultimately, if I want to, let's say, multiply my, portfolio or returns, then I'll have to ask for a leverage, right? So I have taken leverage from broker and I'm paying interest payment to them. 100 rupees is nothing. If I have a plan to generate, let's say, 1,000 rupees or 2,000 rupees on capital of, let's say, 5 lakhs, then which is a decent, right? Even if I generate, let's say, 1,000, still I would be in profit because my interest cost is only 39 rupees per day. Sorry, 130 rupees per day. See how much interest payment that I have paid in the month of August, from 1st August to in 31st of August. You can see I have paid interest payment of only 2,000. So my interest payment cost is only 2,000. So on other hand, let's talk about my profit in the month of August only. I'm sure the statement would be available. So I'll walk you through. Select custom. 1st of August. Okay. So August to, till date, if I calculate, I have not generated much because August month was tough. Okay, the profit is in the month of August, the profit percentage was tough due to some trades which are in now red, right? But if I now let's go back to the another month back and see in the month of July how it was the July month. In the July month only I booked the profit of 2 lakhs. And let's go back and check the interest cost which I have paid it. In the month of, let's say, July, right? We checked for July, 1st of July to only 31st of July. See the interest cost, how much that I have paid it. 3,500 interest cost. If you can just debit from the 1,99,000. So still I have made a profit of 1 lakh. How much? 1,90,000. Let's take a gross. I have made a profit of 1,90,000. See this. So this is how you can you can means if you are really keen to let's say manage your leverage, then you can multiply your profit, and that's what derivatives actually helps. Now if we just go back to the derivatives, let's say if I want to buy any options, so how option works, first understand that. All right, so total capital gain that I have, speculative income, so losses also I have it, but I have the profit of 4,12,000. So to stocks, let's say again Reliance stocks or any other, let's take example of any other stocks as well, that's fine. If I talk about Wipro, if I want to buy, let's say Wipro stocks, this is a place. Select Wipro, buy Wipro. Let's say this one is a Wipro, right? If I select now one quantity, how much capital I needed? 538. But same stock, if I ask my broker to pay, some loan to me, right? Let's say, let's check for capital as well, how much capital that I have in my pocket at the moment. See, available limit is 74,000. So I have almost 74,000 in my pocket. See, if I want to purchase quantities within this capital, my total quantities would be, let's say, 100, 53, 150. So it means I can buy only max to max 140, correct? Even not 150, 139. But see, 139, which is again very less quantities in market, right? Even if I want to generate, let's say 74,000 profit, it will take at least 1 year to get the 70,000 rupees profit. So now you tell me how I can multiply my profit if I want to buy large quantities. If I want to buy large quantities, how I can multiply my profit? I have two options. One, that I'll ask for a broker to provide me loan, and through loans I'll buy more and more quantities. That is one way. Second, I'll look for a derivatives. So it means I can buy one, the call option, right? And through call option, we can buy multiple, or let's say quantities in bulk, and I can multiply my profit. Another one is I can also buy future contracts. Through future contracts also, I can buy more and more quantities by paying, margin like 10%, 20% margin or advance amount that I can pay, and I can buy more and more quantities as well. But if I talk about, let's say we'll talk about one by one. If I talk about margin, right? If I talk about margin, and if I pay 74,000, right? So let's see how we can multiply our quantities now. See, with this fund, I'm able to only buy 139. But if I convert this into margin to funding, let's see how much quantities that we can buy it. See, for one quantity, how much we need to pay? Let's say if I buy 500 quantities now, and the price is, let's say, even if, okay, stock market is this one. Current limit is 74,000, market price, right? If I consider market price is 139, or if you can also submit in a limit price as well to see how much the quantities that we can buy it. Oops. I'll not place a trade, but see how much quantities that we can buy it out, right? So I can buy more than 500 quantities with the same, sorry, it is asking for an initial 30% of margin, okay? And rest margin, broker is ready to pay to me. So now calculate the 35% of this one, this value, 2,69,000. If I calculate 35%, so I required almost 94,000. But if I don't have a 94,000, then so I'll go back and I'll buy almost 400 quantities. See now, the 400 quantities instead of 400, buy 380. See, so in the same margin, 74,000, I can buy the quantities of 71. Sorry, I can buy the quantities of 380. Now let's talk about total cost. See, total cost which is required. Go to here. Total cost is required 2,04,000, but I have only 74,000. I'll pay 74,000 to the broker, and rest amount broker will arrange it from the money market on interest payment. So broker will fund around 1,30,000 to me, and that's how I'll multiply my quantities. Now see, if you're buying more quantities, so it means it would be a more risk as well. If price goes down, I'll be in loss. With other position also, you can see I'm in loss, right? Now here, if you see, I'm in a loss of 44,000. So basically, I'm paying interest payment also. So it means interest payment and loss, that would be my actual loss. I'm paying interest payment as well as I have a loss of 44,000. So that would be again my loss. But if let's say if I'm in a profit, then that would be my profit only. Or interest payments, of course, you can debit the interest payment as well. But if let's say, if I purchase 400 quantities, and if price moves from 540 to let's say 600, so there would be profit of 64 per quantities. And we can easily multiply profit from 380 quantities to, let's say, 60. See the profit percentage around 22,000. Correct. But if we talk about original trades, we were able to buy only 139 quantities. And even if I calculate the profit of that, see the profit would be around only 8,340. So it's a game of risk, guys, or it's a game of, let's say, leverage. If you have, let's say, if you know or if you understand the power of leverage, so you can, whatever amount that you have, like, let's say, even if you have a small amount, you can convert that amount into margin, and through margin, then you can access the 2 lakhs, 3 lakhs, extra limit from the broker, and then you can, manage your trading business. Again, it's very risky, but as I said, derivatives are derivatives are like very powerful, the tools which the traders actually they leverage it out and buy more and more, quantities in bulk, and they, generate the profit. See, on other hand, as I said, more than 98% people, they are not able to generate any revenue from the derivatives. Why? Because of risk only. And see, anyways, I'm not buying and selling in derivatives because I'm buying and selling in derivatives only, with a very minimum quantities, only for hedging purpose. If we talk about loss of derivatives contracts, so far, like how much I have made losses from the derivatives, let's talk about that as well. So you can understand that derivatives is not so good, but again, it's for hedging and all. So 24,000 losses that I have made from the derivatives so far in entire year, means from April to August so far. But most of the the losses that you can see, I have made it because of market fluctuations only. Because see, if you want to make a profit, see, profit generation is not easy, guys. To protect my position, you will have to always buy some options. It could be stocks options, it could be your indices options and all. So sometime there would be losses, sometime there would be profit. So here, if you see, on 22nd July, I made a loss of around 26,000. But on other hand, see, on 5th of June, if you see, I made a profit of 74,000. In one day, I made a profit of 74,000. But again, on 3rd of June, I made a loss of 32,000. So it was election day. In one day only that we were carrying carrying some overnight positions, and we had a huge loss, 32,000. But very next day, we played some, around some different options and made a profit of 74,000. Right. But now I'm not, I'm not interested in derivatives at all. So I personally don't do anything, but only if I have a portfolio of, let's say, 1 crore, then I'll have to play with the derivatives. The reason is, to protect my portfolio, to protect my, I would say, the positions against the market fluctuations. So I'll have to play around sometime, options and all, but with a very minimum risk. It's not something that I'm buying, let's say, the options with 1 lakhs or 2 lakhs. No. See, derivatives market is a very risky market. Within a moment that you can see, huge losses in a portfolio. But see, even if I talk about now, your question would be, look, sir, I can still see, the loss of 40,000. See, this loss is nothing. Okay, this loss is nothing. The reason is I have made a profit of 4 lakhs on it. So it means I can still bear the loss of 5%. And after that, maybe I can exit or I'll take an exit from the few positions because I'm continuously monitoring, situations of all of this. All right. And most of the stocks, they are like good, scripts, I would say. Let's talk about, stocks as well. See, the Geo Finance, maybe, which is down at, this point in time, but you can see, jump in price as well. Let's wait for another 5 to 6 months. Right. Then this ES Bank or Polyplex Corporation, Raymond, KPIT, all are good stocks. Just hold for some time, you would see like big boom. Now your question would be like, sir, what did you check to before buying this KPIT stocks? See, KPIT fundamental wise, which is a very good stocks. And also if you see the, the chart of KPIT, still you would see the breakout kind of zone for KPIT. See, it was continuous. It was like, this is a V pattern. Okay. I was expecting some breakout at this level, right? And that's what I made a position here. or even if it is go down, that's fine. Again, it will, go up. If you just see the history of these stocks, it's a very good stock. See this. It was at 43 rupees in 2020, and now which is trading at 1800. This is a very, very good script, I would say, because dealing in multiple segments and companies continuously growing or scaling every quarter, every quarter we have seen a good growth in numbers, and we might see breakout here, right? We might see big breakout over here. So let's wait. But now, if your question would be like, so what if this goes down? See, I have a calculation in my mind. I'll take an exit at, maybe you can say around 1700, 1750. I'll take an exit from this particular stocks if this continuously goes down. But maybe on Monday, you might see around 5 to 6%, maybe if this, let's say, breakouts continues, then you might see, big price movement in this particular stocks, then my position would be in profit, right? Same applies to the Raymond as well. So why I have purchased Raymond? See the history of this particular stocks. See, before the pandemic, the stocks, it was reached with the 120, around 214 rupees something. And within a 2 years of time span, see, continuously the stocks achieve, high, and it was reached to the 3,500, right? But again, I have seen corrections, but if you see still the stocks which is in trend. See this. So continuously, which is in trend, and I don't see anything as such here. So I thought like, let's purchase at here. But if this break down this line, then I like take an exit from this particular stock as well. So this is how you calculate, means, means while taking any positions with the options, right, or stocks. Now, if you ask me, sir, on the basis of this research, will you take a, call option in this particular Raymond? Yes, I'll take it. But I'll also monitor, the situation. See, the point here is if this stocks, let's say, come down like this, let's say, so now if you see, let's say, the downside, if this, break this line, means trend line, then I'll take an exit, because eventually there is no, point to hold this particular stocks, because then you might see, it will come down around 1300 as well. You would be in huge loss. There is no point to then, hold this particular stocks. So I'm keeping an eye on this particular movement. And if this breaks out, then you can see again another level like 3,400 level. Then in that case, I will definitely buy call option. But if this breaks, this level, and if this come down like this, then I'll look for a put option. Then I'll buy a put option in this particular stocks, right? I'll select the price, maybe let's say 2000 level here, and I'll buy this particular, put option, which is basically sell. I'll sell it at 2000. I'll hold the put option. Then you might see down to, level, which is around 1500 as well. And if this, let's say if this goes up, then immediate support you can see, or resistance, I would say you can see, which is at 2600 level. So this is how, this trading game works, guys. If you have some research, then accordingly, you can buy or hold options. You can buy options, you can hold options, and you can make some good amount of profit. But again, option business, it's a very risky business. In last 4 years, I have not generated a single penny from options. Though I lost around 7 to 8 lakhs in the year of 2018. I have recovered that amount in 2023. Then after I thought like, let's not, play around any options. And even till today also, I am not an active buyer of options, or even I'm not a seller. I'm actively doing in only, this unlisted bonds, or you can see equities like through positioning and all. But I'm not buying and selling any stocks in your options in a derivative market. Why? Because of risk only. I don't want to take a risk, that level of risk. I'm not dreaming to become a rich in just one day or one night. No, I don't want to. I'm looking for a consistent, return or compounding return as well. I want to compound my returns, whatever that I'm, earning. But again, if anyone want to do, your question would be like, sir, if I want to become a rich, let's say in one day, or if even I'm ready to become like, like zero to hero or hero to zero, then derivative market is for you. You can buy options, you can sell options, you can hold options, you can again write options. So how we can do that, I'll walk you through that part as well. All right. But yes, before that, as I said, you will have to do some research as well and find out that, how this particular stock is performing and whether we should enter in this particular stocks and or not. Second stocks, if I talk about, I purchase, which is Polyplex Corporation, this one. See, this stocks, it was at 280 rupees in the pandemic. And if you see the highest in 1 year, 1 or 2 years, it was reached to the 2,800. But suddenly again, it was started, consolidation from 2,800 to it was reached to the again 700. I was just, waiting for this, V, if you see, this is a V pattern basically. I was waiting for this. I wanted to take a position at very bottom, but again, it's a risky because what if, let's say, if, from this level also, if this goes down, then it would be very tough. So I was waiting for this, means this pattern actually. I was waiting for this pattern. And now it seems like, this is at a very good level. So I thought like, let's take a position here, right? I was waiting for a candles, 1, 2, and this is a very strong support. So I thought like, let's take a position. So I have purchased quantities in this particular Polyplex Corporation. And I'm sure it will reach to the, immediately, you can see it may reach to the around 1800 levels as well, this level that you can expect. Very soon you can expect this level. First level would be this, and second would be this. See, if you have this kind of research, then only you can buy options. If you don't have a research in place, and if you don't know the, let's say, chart, if you don't know, let's say, how to buy, when to buy, where to buy, or how to, leverage out your money or whatever you have, then this market is not for you. All right. So I did some research and I thought like, let's take a position in this. So I took it. So now let's go back to the options and how you can buy it. See, options, you can buy index as well, like NSE, BSE. So let's check some charts for NSE as well, and then we'll talk about some how we can write and how we can buy it. So NSE, which is an index, National Stock Exchange, which is an index. What happened to this NSE? My bad. Bank Nifty, we have a Bank Nifty as well. Bank Nifty represent your financial means totally financial sector or reputed companies from the banking sector, I would say. Then we have a NSE, or we have a different index as well, Nifty, Nifty 50. So this, I'm talking about Nifty 50. This includes top 50 companies of India, right? So nowadays to predict, this Nifty, it's very difficult. But if we talk about, let's say, trend, every time we have seen, some good movement in this particular Nifty. See, on election date, what happened with Nifty? If you see, market open at this price and close at this. When market, felt like now Modi, it will not be in power, then most of the big investors, they sold out the position. Huge position, they just, sell it out, and then market, it was like free flow, or you can say like, the free ride. So it was for market, and then, market crashed by 1400 points. But very next day, the investors, they were very bullish about this, and they thought like this government can also, means Modi can form a government with the alliances. Then again, the market open at this level, And if you see within 2 days, entire market recovered, not only recovered, see the movement, guys, just because of, the Modi only, the market from 2,300 to reach to the 2,500. So 2,000 movements in market we have seen. Because this is all about, the confidence. But now if you ask me, sir, what will you do with this, situation? So at the moment, it is very difficult to predict because again, market gave a breakout. See the previous, the market high was 25,000. And yesterday only, or day before yesterday, I would say, market already crossed that. So you might see another high and market can reach out to the 26,000, very soon, maybe in next week, that you can see market will touch to the 26,000, mark, or maybe market will go down as well. Maybe it can come down at 24,000 or maybe, below that. So it depends. So we can't predict that. But on the basis of this only, if you ask me, sir, what would be your, let's say, next move? Then I look for, guys, see the market, which I can see market will, reach to the 26,000. Then I look for a call option. I'll simply go to the, my broking account, select this one, look for option chain, right? This is your option chain. So you can, analyze some data as well, right? So look for a data. It means, how the trend is. Basically, trend, it should be your friend. If the trend says, the most of the trends, let's say, if they're looking for a buy, then I look for a buy only. Why should I look for a sell, right? So to see that open interest, which is the highest open interest, which you can see for which option? 29 lakhs, 36 lakhs for 25,500. Okay, this is the open interest. Okay, so it means still you can, people, they are bullish. This is the call details. Okay, then yeah, 40 lakhs for 25,800. So it means market is bullish. So the buyers, right, they are anticipating that market will reach to the 25,800 maybe next week. And that's what here, if you see 40 lakhs, which is, the quantities which are there, or trades, I would say, which are outstanding. So it means most of the trades which the index they have received for a 40 lakhs. And on other hand, if we talk about, let's say, put option, let's talk about the bid. Okay, bid ask quantity change. Let's talk about the open interest. See, the open interest is very low for this price, right? But open interest, so you might see that where again the bear, I would say, so sell, it means they are bearers. So they're not happy with the market boom. They always make the profit by, pulling market down. So let's talk about that. See, bull people, they are thinking about market will come down at 25,000. And here, if you see, the most of the open trades which we have in, to this price, 25,200. But the current market, if we talk about, which is at 25,200 only. So it means it's a possibility that market will, reach to the 20, maybe, it will cross 2,200 levels, or maybe it will go up only. The reason is more and more open interest that we have at 25,800. Now, on the basis of this data, right? On the basis of this data, see, guys, this is the game of demand and supply. So more and more demand that you can see to this price. Okay. And more volume also that you can see. See the volume percentage, 2,79,000. Same for this price as well, 44 lakhs. And see the, the volume, 2,87,000. Even for this 25,600 also, you can see highest level of volume. So I would prefer this, maybe 25,600, maybe 20,700, 800. Or if I have a huge capital, then I'll also, look for this one as well. 24,800 call price, or maybe 25,000, let's say 25,000, this one as well. Now your question would be like, sir, why this one? The reason is, if I, let's say, buy in the money, see here in the option, you can select in the money, out the money, and at the money. We'll discuss that as well, what is at the money and what is out the money. But if I buy, let's say this one, guys, this one, the moment of my option price should be high. But if I buy, let's say this one, 5,300, because the current market price of the Nifty is 25,000, to 30 or let's say 50 even. See, if I buy any option below this price, would be my out the money option. Sorry, in the money options for call option. And if I buy any, let's say, options with the above, price of the market price, so that would be my out the money options. So in the out the money options, most of the poor people, they lose entire their money in out the money options only, because out the money options, price of the out the money options would be very low. See this. Let's talk about some premium. If I want to buy this one, it's the last price of, let's say, 20, let's talk about 25,000. Okay. Premium that I'll have to pay around, see this, 340 for per quantity. But if I buy, let's say, this one, 25,000, let's say even 300 also, I'll pay only 125. So you can see the difference in a premium of almost 50%. So if I want to buy more quantities, then I look for out the money. If I want to buy, let's say, quality of quantities, then I look for in the money, right? So if you pay more fees, then you can see more speed. If you pay less fees, then you can see less or I would say low speed in this your options. So that's what we always prefer to buy in the money options, even if it is a buy options or even if it is a call options. In both the cases, you can buy in the money options if you want to book, or let's say if you want to earn some money. But yes, in the money options would be costly one. So it means you will have to pay more fees to buy that. So that's what we means, most of the time we prefer the in the money options only. All right. So this is how your options, looks like. But let's see if I can, how we can buy that. Let's say, look at that. If I buy this one, 25,000 call option, this would be my in the money. If I buy, let's say this one, this would be my out the money, because I'll have to pay low, premium. First, we'll try to buy in the money, 25,000. Right? Then, see total price that I'll have to pay. See, 348 for per quantity. Total quantities would be 175 or 170 as well. But how much amount that we required? 8,780, which is margin required to buy that particular call option, and the strike price would be 25,000 strike price. Okay. So let's analyze this one. The profit possibility. Profit possibility would be, see, my expiry payoff, you can see loss. But if this, let's say if the assumption is, if this, goes in my favor, if this trade goes in my favor, my next profit would be 60,000. Another would be 1,23,000. See, the maximum profit that I can make it from this trade is 6,28,000. But if we talk about the loss, on other hand, my maximum loss would be only 8,000. My maximum loss would be 8,000. So I can simply buy this particular, option. Or if you want to again perform analysis, you can download that and save. And even you can perform some analysis as well, if you want. How this strategy works and all. I don't want to buy it now. Again, it's a, it's a non-business day. So, all right. So you can just open, let me just open. This is all about your options, payoff, 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 delta, theta, whatever it is. It's a Greeks. So you don't need to go through it all, but So in terms of, the strategy, if we talk about, see in one go, what you can do, you can buy call, you can buy also, put as well. So buy put, buy call, buy put. So through this strategy, you can buy more and more quantities basically, right? And you can increase your profit, but eventually it would be costly as well. As I said, see this business, this particular derivatives, it's a very costly deal. So we cannot predict easily. Even if I buy this one, right? And let's say if I entered into this particular contract, I need a 8,000 only. But we cannot predict about the profit and losses because it's unpredictable. See, YouTubers or influencers, they'll talk about, look, I made this, I made that. See, you can check there, the P&Ls. Most of the people like who are doing tradings and also they are in loss only. Real data nobody publish. So I'm not a trader, so I'm just trainer. So, or that is also like investment banking trainer. So I'm just helping you to understand that how it works. All right. So yeah, these are the things about derivative options. So all right. So I'll walk you through a couple of the examples like how we can place the derivatives and all, and then we have a different the slides prepared for different contracts. So, and yeah, so we'll discuss in details about it because derivatives is a complex one. So we'll pay more time on this one. And then rest is like easy to understand, or I would say it's a simple one. So let's start with this. See, now if I want to buy, any options, simply what you can do, go to your broker account. If you have any broker account, you can go to your accounts. Let's say if I talk about, Nifty, select the strike price. Strike price, it means the price which you are looking for. Okay. Let's say this one. All options have a weekly expiry because every week, options will expire. Then, through option chain, I'll select this. I'm looking for this one. So I'll buy it now. Click on buy. Required margin is 8,000, but I have only 300, which is in my pocket at the moment. So I can't buy this one. But yeah, so in this way, you can also follow the same thing and buy options. Okay. See, same options, if I select, see, this is a call option. If you read this one, this portion, on 5th September, this option will expire. And this one is a strike price. Okay, this portion is called European because in options, we have two types of options. One is European options and another one is American options. So difference between call and, American and European is call. See, American options are like, they have a weekly expiry. European have a weekly expiry. So it means they are more standard. But if I talk about American one, so expiry of options, like before the expiry also you can exercise that, and it's very bit difficult to the stock exchange to deal with all of these options. So most of the stock exchanges, they have only the European options available for a trades. So see, it means call European. When we say buy, see, I'm looking to buy this particular option because my, let's say, research says this price will go up, and that's what I'm looking for a buy. See, options that you can buy in lots, one lots for 25 quantities. So 25 quantities into price, right? Let's say if I'm looking for a 25 quantities, 25 into price, if we just multiply this, that would be a price. In terms of price, you can select two different prices. Current market of this option is 348.4. So total margin which is required 8,000, but I don't have 8,000 in a balance available. You can select limit price as well as market price. Limit price, it means, guys, your price, right? You can select any price between 0 to 10 to between 1,200. You can select any price. As a buyer, we always try to buy any product at a lower price than the market price. And in terms of selling, always we try to sell in a product at a higher price than the market price. Okay. Then you can select market price as well. If you select market price, it means if the market price is 348, then your trade will execute at this price. You can also select stop loss as well. Stop loss, it means basically if you, let's say, limit your price, maybe let's say if you buy it and if the price goes, let's say, down, so you can select maybe, let's say, 300, right? So if your premium goes below the 300, then basically, this will execute your contract at that price. So this is how you can limit your stop losses as well. Okay, but here it says like you can limit the price between 345 to 1200 for a stop loss. So select the stop loss accordingly. Then apart from this, if you see, sell options, if you want to sell, see, for a same price, if you want to sell is all about, guys, writing options. Okay, writing, it means, see, your option holders, they are paying premium, but they're paying premium to whom? Understand this one. Let's say you're an option buyer, then, and let's say I'm an option seller, then, so you guys are paying premium to me only. Okay, because I'm an option seller, so that premium, it would be my profit. But what if, let's say, that option works in your favor, then whatever profit that you would see in your options, so that profit I'll pay it to you from my pocket. So this is how it works. So option sellers, basically, they are very big traders. They have a huge capacity. Now, if we talk about the capital which is required, see how much capital is required for option. See, for option selling, we required 75,000. Right? If you want to write this option, then required around 75,000. And but for the same option, if you just want to buy it, required 8,000. So it means almost 10x, extra capital we required to buy option trades in the market. So this is how you can understand it. So this is a call option. You can buy calls. You can even sell calls. But if you sell calls, that would be your option, writing part. And if you just buy it, that would be your holding options, right? So before the 5th of September, means if you just, let's say if you entered in this option today, see, before the, or on or before the 5th of, September, you can buy this option as many times. So that depends on you, as much as many means, you can buy today, you can, sell tomorrow, you can buy, or you can buy tomorrow, you can again sell tomorrow. You can do these activities continuously. It depends on you, how you want to execute it. All right. So the important is always, before the buying, so always see your capital and try to manage that capital in an effective way. Stop loss is basically you're stopping the losses. Right. If the market goes down, then, the system will automatically book the particular loss or profit, whatever it is, if you set it. And in that way, it will help you to restrict your basically losses, means unlimited losses. That's how your limit price works in your favor. Okay. Then if we talk about, and then again, simply you can buy it out. But see, this price, if you compare with the market, we have seen that, the index price, which is at 25,000. All right. And the option we are looking at, which is 25,000. See, the option would be your in the money option. In the money, it means your call option price, which is at below the market price, and that's what we are paying higher premium for all. In the money options, we always pay higher premium. Now, if I select, let's say, if I select the different option, let's say this one, current price is 5,000. Here is your current price, this red portion, 25,235. So this is your current price. If I select, let's say, this one, 25,300, here, if you see, I'll pay only, 3,000 premium. So if you select out the money, you will have to pay very low premium. All right. Now your question would be, look, sir, if I buy this one, so what would be my maximum loss? See, your maximum loss would be total premium that you have paid to buy this particular option. If I buy this one, my maximum loss would be this one as an option holder. And what about sir profit? Profit, see again, it's a so it means you can say it's an unlimited profit. So it depends on the market. If you see big movement in market, then there will be big profit. If there is no movement in market, then you will not see profit. So it depends on the speed only. Premium works with speed. More speed, more premium change, more profit. Low speed, higher premium, more losses. If there is no profit, let's say if there is no speed in the the market, then it is very difficult to enter in this particular options. So I would not suggest to enter in this particular market. Then if there is no speed, then you should not invest, because this market works with speed only. Okay. And what about the writing part? Writing part, it means, see, for a writer, the maximum loss would be 70, or maybe more than that as well, depends on the again market. But the profit, if we talk about for a writer, is only the premium the buyer is paying. Only the, see, for a 63,000, 67,000 capital, option writer will earn only 3,000 profit, max to max 3,000. So it means option writers, for them, the profit scope is very limited, but the capital which is required is very high. And that's what it is. Not like, this deal is not for common people, so that we cannot pay, higher capital. Are you getting my point? So we only pay limited cap. We will have a limited capital. So with a limited capital, you can just hold the option contracts. So this is how you can hold it, option contracts. Now your another question would be like, sir, look, what about, put options? Put options also, you can see, these are the put options. You can buy put options at any price. If we talk about current market price, so the current market price is 25,235. If you buy, let's say, this option even, to 25,200, if you see the premium, which is a very low, right? 17,100 that you will have to pay it. But same put option, if you just write, if you just sell it out, see, we required 71,000. So writing is a costly part. Okay. But this option becomes again out the money. The reason is your current market price is higher than your own target price, which is your strike price. All right. And in that case, you should not look for this, because see, most of the common people, why they select out the money, the reason is, guys, premium, so that you can buy more and more quantities. You can buy more and more quantities. So in a 14,000 rupees, you can buy 200 quantities. If you have, let's say, 20,000, then you can buy almost 400 quantities. Correct. But if you select any, let's say, any other out the money option, in the money options, in the money would be this one. Current market price is 25,235. So in the money would be for option trades, which is 25,250. So if you just buy this one, see how much the required is. So premium which is required is 2,100, right? So you can see the increase in premium. So it means for in the money options, or in the money put or in the money call, in both the cases, we'll have to pay higher premium. And for out the money put and call options, we'll have to pay again lower premium. But for a trading purpose, you should only look for in the money options. Okay, I'm just summarizing it. For an option writers, we need a more capital, right? Only the professional traders, they look for option writing. Otherwise, most of the traders, they only do the option trading only, not writing. Common people, again, they only look for a writing, not for a trading. Writing is something, it is only for a professional people, so they easily manage it. All right. So again, so you can buy these stocks also through options, right? And we have a different indices, which is Nifty, Bank Nifty, Fin Nifty, Mid Nifty. Now your question would be like, sir, what is Nifty? See, Nifty represent the value of top 50 companies like TCS, HDFC. There are different companies. Bank Nifty represent the top, the banks in India. if you see movements in the banks, for example, let's say if you go to the NSE site, let's talk about indices. Since Nifty 50 represent the top 50 companies in India or their market caps, I would say. Okay. So 25,000 it means, which is something 25 lakhs crores. So just click on this. See this. All are the top 50 companies from different sectors. If you see the change in this company's stock price, then you would see change in indices. So basically indices represent your top companies. Okay. So your indices represent top companies. If you see, let's say if HDFC Bank, Tata Motors or all other companies, if they if the price decrease of those stocks in the market, then again your Nifty will Nifty means index will decrease. So basically index is representing to the top companies from different sector. TCS, Sun Pharma, Power Grid, Bajaj Finance, Hero MotoCorp, NTPC, all other companies. So it is very important that if the top companies, let's say, grows, then your index will grow. If the top companies, let's say, if they if let's assume it, if they don't if they haven't performed well for a particular year, then you would see downfall in index as well. So basically Nifty index is linked with your top 50 companies growth. If the top 50 companies they grows, then your index will grow. If top 50 companies, let's say degrowth, if you see in their stocks or in their business, then you would see again Nifty that index will also the price of index will also grow, or index value also it will reduce, because index value is based on, as I said, the top 50 companies from different sector. All right, so let's talk about the what is option exactly. So we'll cover the options part. So here you can note it down, please. Okay, see, options has a two types. If we talk about options, it means it's a contract of financial instruments which derives the value of actual securities, bonds, options, currencies, and all. So anyone can buy it. It is allowed to anyone. If you have a more capital, then you can write the options. If you have a low capital, then you can hold the options. Option holders, they pay the premium. Option writers, they pay the margin. All right. Total loss of option holder would be like, initial paid premium. And for option writers, initial paid premium by the holder should be the maximum profit of option writers. Option writers, they are like, highly professional traders, and option holders, they are like novice, or maybe you can say, or anyone can do it. Option holding or writing can be done for a leveraging, or let's say, making more and more profit. And it's a common thing, if you see more profit, then you will have a more losses as well. Through options, you can also hedge your portfolio as well. If you have a stocks, and if you want to, let's say, ahead of any events like negative events or anything as such, if you are planning to just, just protect your portfolio from the market uncertainties, then what you can do, you can simply buy or put the buy or sell the options, and that's how you can hedge your positions. Okay, so this is how your option works. So now let's talk about some technical things in the PPT. So option has a two types. One is American option, another one is European option. European option is more popular one, and on every stock exchange you can see like European options are only listed on a stock exchange, because European options can only be exercised on the expiration date, and American options may be exercised at any time up to the expiration date. And that's what, if you if you just exercise the option multiple times, then it would be difficult for standardization, and again to maintaining the data and all. So always stock exchange wants something very standard. All right, so this is how actually options works. Then if we talk about let's say, option types. Option has a two types, one which is call option, another one is put option. So if we talk about call option, guys, see, we always pay premium. See, call option, it means you can buy the call. Long, it means buy. Short, it means again sell. So you can buy the call option, you can sell the call option. Option buyer will call it as a holder. And if we talk about sell, then we'll talk it about, the writing of options. So option seller would be, writers, right? So for a writing, we need a more and more capital. And for a holding, with a minimum capital also, you can do it. So if we talk about, let's say, holding has a right to buy at a given price, but not obligated. So it means as a buyer, you don't have any obligations. So you can buy it anytime, you can, sell it at any time. So that's how it works. And if we talk about, let's say, selling, required to sell at a given price if a long exercise rights to buy. So it means he will give the exact price to sell it out, then only you can sell it out that, that price only. All right. And this will happen at expiry. So basically writers, they will have to wait until the, options expires. All right. Then, see, option holders, they enter in options at any point in time. They just buy it at any point in time. So they don't have any obligation as such. So that's how you can, understand the options part. So if we talk about now put options, in terms of put options, option holders again, in a put option also. So you can, take a long positions in put. So it means you can simply buy it out. But if you again sell it out options, you will have to pay margin. That works in the same, way. See, option selling and option, this buying, basically call option buying and put option selling, that works in the same direction. Because here is also target is like, if we just buy the call option, so it means we are anticipating that price will go up. If we sell the, short, or if we just write the put option, it means again, we are anticipating that price will go up. If we talk about, let's say, option shorting, in that case, again, here we are thinking that, the market will go down, and that's what we want to short the, call option. And if we talk about this, normal holding option, again, here the target is like market will go down. So this is how you can, relate. But yeah, so if we talk about put option, has the right to sell at a given price, but not obligated. So you don't have any obligations. So you can sell it out at any price and you can take an exit. But if we talk about writing, again, writing is a critical. So required to buy at a given price if a long exercise right to sell at expiry only. So until expiry, you will have to hold your positions. Before expiration, they may have a different values, right? American and European options are both identical at expiration. So yeah, so this is how your option things works. This was just a summary. Now, in terms of, let's say, interview preparation, you should know these types of options: call, put, what is call, what is put. What about the premium? Premium is the advance money that, option holders pays it. Then how much should be the maximum loss of option holders? Maximum loss would be your premium, whatever premium that we have paid, right? Then obligation on holder of options. See, there is no obligations. Basically, they can buy and sell at any point in time. Okay. And yeah, apart from this, they may give you any example as well. Look, if I buy options at this price, then what would be my profit? What would be my loss? In that case, you can carry pen and paper, or maybe you can quickly do the calculations. Ask them price, quantity, and price movement, and accordingly you can calculate it. We're done with the options part. See, at expiry, it's just simple. Let's say if you are in a profit, then you will receive profit, right? If you are in a loss, then you will have to book the loss. So it means stock exchange will book the losses in your accounts. For example, let's say we have that option this one. Go to our portfolio. Let's see here. open trade. What if, let's say, on 26th of September, the price of this average, the price of this, this option, let's say, come down to 1 rupees, right? Then my maximum loss would be whatever amount that I have paid, correct? So I have paid, let's say, 250 into 60, just calculate it, how much amount that I have paid it. 250 into 259, around 14,000 that I have paid it. So see, if the price of this option, let's say, trades under 3,100, then I lose my entire money. If market price, let's say, cross this 3,100 before the maturity, maybe let's say 3,000 like this 50, or maybe 3,000, let's say, or 3,200 like this. In that case, this option would be in profit because premium, level that you can see somewhere like this. Okay, let's take an assumption. Here, entire premium would be 0. Again, here also 0. If let's say 3,000 price, if let's say again, if you see which is at same level like 3050, my entire premium would be like 0, because that's what, every day I am paying charges. All right. But what if, let's say, before the expiry or in next week, price touch to the 3,150. In that case, so you might see the, options price from 59 to, let's say, 100. In that case, and if I, let's say, take an exit here, let's calculate it payout. I have paid 59 and current market price, which is 100. So if you just calculate the, 250 into 100. So total amount that I'll receive 25,000, but my actual profit is something different, because 250 into 59, which I have paid it as a premium, that I'll have to calculate it. Okay. This one, because I have paid this, right? This was my premium. And this is a gross payoff received. So if I calculate net payoff, my net payoff would be 10,250. So my net, this is what, you can calculate profit as well. So on expiry date, stock exchange, calculate the same thing. Stock exchange, calculate this. See, in the books of, let's say, you're a holder, and there is a writer as well. In the books of writer, holder, first talk about writers. Holder paid a premium 750 for 250 quantities. All right. Then current market price, or let's say settlement price, which is at something 25,000 for the same 250 quantities. All right. So initially this guy had paid, let's say, premium to whom? To the writer. So for the same 250 quantities, let's say writer received, right? But on this expiration date, if this particular contract is in let's say in your favor as a writer, we are assuming it you're a writer. So in the books of this one, writer will compensate in a way that writer will have to pay total 25,000 against 250 quantities to whom? So basically writer will pay 25 and this guy will receive 25. So net, if you just calculate net payout, if you just calculate net, it means only net. Your calculation looks like this. So this is the loss of writer for 250 quantities, and this is the profit of this holder on expiration date. So this is how calculation works, guys. Let's talk about now the derivatives in details. That was like options. Options was a critical part, so I thought like let's discuss option first. Now we'll discuss the other instruments that comes under your derivatives. We'll now discuss from the beginning, because difficult part always we discuss first. All right. See, if we talk about derivatives, it means contract of financial instruments, as I said, and that derives the value from the stocks, bonds, commodities, interest, FX rates, market indices, and weather. And if we talk about types of derivatives, we have a types of derivatives like forward, future, swaps, options, and credit derivatives. Okay, one thing. So let's talk about now derivatives. बार्टर सिस्टम, हैव यू हर्ड अबाउट बार्टर सिस्टम? बार्टर में क्या होता था? गुड्स के बदले में गुड्स दिया जाता था, करेक्ट? अगर तुम्हारे पास राइस है तो व्हीट आप ले सकते हो, व्हीट के बदले में दिस, इसके बदले में दिस, और दोनों की डिमांड पूरी हो जाती है, राइट? वैसा हमारे पास क्या था? बार्टर सिस्टम था। क्या था? बार्टर सिस्टम था। जो पुराना बार्टर सिस्टम है वो आज का स्वैप है। जो पुराना बार्टर सिस्टम है वो आज का क्या है? स्वैप है। स्वैप मतलब आप करेंसी को स्वैप कर सकते हो, आप कमोडिटीज को स्वैप कर सकते हो, आप रिस्क को स्वैप कर सकते हो। अगर आपकी कोई रिस्क है तो आप कुछ भी स्वैप कर सकते हो। कुछ भी मतलब कुछ भी। जैसे आप जहां पर जॉब करते हो ना, आप आपकी मेहनत को स्वैप कर रहे हो। कैसे? आप कंपनी को ये कह रहे हो कि मैं 8 घंटे डेली काम करने के लिए रेडी हूं, मुझे 8 घंटे का पगार 5,000 रुपए पर डे दे दो। सो 22 दिन का मुझे पगार दे दो। 22 दिन का पगार कितना हो जाएगा? एक करीब करीब 1,50,000, हाँ 1,10,000 हो जाएगा। सो कंपनीज क्या कर रही है? आपको पैसा दे रही है आपके एफर्ट्स के बदले में। जैसे फॉर एग्जाम्पल मान के चलो आपके पास एक प्रॉपर्टी है, राइट? आपके पास एक प्रॉपर्टी है, उस प्रॉपर्टी का रेंट आपको कभी 4,000 आता है, कभी 3,000 आता है, कभी 2,000 आता है। आप पूरे तंग हो गए हो इस चीज से कि यार फ्लक्चुएशंस इतने हैं कि मैं अपनी फाइनेंशियल प्लानिंग कैसे करूं। देन आपको मैं मिला रास्ते पे और आपने मुझे आपका प्रॉब्लम शेयर किया और कहा, अरे शिव सर क्या बोलूं, रेंट जो मिलता है ना, कभी 3,000 मिल रहा है, कभी 2 मिल रहा है, कभी 1 मिल रहा है, कभी मतलब बहुत सारे वेरिएशंस है। तो मैंने कहा ठीक है भाई, मेरे पास एक बंदा है, वो रेडी है कि तुम्हें 2,000 रुपए पर महीना फिक्स्ड ये रेंट देने के लिए, फिक्स्ड रेंट देने के लिए। अगर तुम्हें उसके साथ कॉन्ट्रैक्ट करना है तो कर लो और आपकी प्रॉपर्टी के राइट्स इसको दे दो, लेकिन इस प्रॉपर्टी के थ्रू जितना भी इनकम होगा, चाहे वो 5,000 हो या 10,000 हो, वो पूरा का पूरा वो बंदा लेगा। उसके बदले में सिर्फ वो तुम्हें 2 महीना पर महीना देगा। अभी उसमें अगर प्रॉपर्टी आपकी चली भी नहीं गई या फिर वैकेंट रही, रेंट नहीं आया, तो भी वही बंदा जिम्मेदार है, वो पूरा देख लेगा। अगर रेंट भी नहीं भी आता है तो वो अपने पॉकेट से रेंट देगा, लेकिन वो आपको फिक्स्ड रेंट देने के लिए रेडी है। तो वो क्या है गाइस? स्वैप नहीं तो क्या है? स्वैप ही है ना। देखो डेरिवेटिव्स कोई अलग टर्म नहीं है। हम अपने जीवन में, पर्सनल लाइफ में हजारों लोगों को कमिटमेंट करते रहते हैं, राइट? इसके लिए कमिटमेंट करेंगे, उसके लिए कमिटमेंट करेंगे, करते हैं ना। जैसे मान के चलो आपने आपके दोस्त को पैसे मांगे, राइट? आप क्या कहोगे दोस्त को कि भाई देख पैसे तो देता हूं मैं, लेकिन इसकी गारंटी क्या है? रिस्क तो मेरी भी होगी। दोस्त ने आपको लालच दी, ठीक है अगर तुम मुझे पैसे देते हो तो मैं 10,000 के लिए मैं आपको 12,000 रिटर्न करता हूं। क्या वो वर्बल डेरिवेटिव्स नहीं है? डेरिवेटिव्स मतलब क्या? डेरिवेटिव मतलब डिराइव करना। डिराइव करना मतलब जो भी है ऐसे कुछ पॉसिबिलिटीज को मान के चल के ट्रेड्स करना, उसको डेरिवेटिव्स कहते हैं, जैसे ऑप्शन के सट्टा में मैंने कहा कौन सा प्लेयर खेलेगा, उन सबको एक टीम में लेके आके पैसे लगाओ, वो क्या है, पॉसिबिलिटी है, पॉसिबिलिटी ऑफ अंडरलाइंग थिंग्स। अंडरलाइंग थिंग्स मतलब क्या, कोई भी गुड्स हो सकता है, कोई भी कमोडिटीज हो सकता है, कुछ भी हो सकता है, कुछ भी मतलब कुछ भी हो सकता है। अब सवाल, अब ये क्वेश्चन होगा कि सर लुक, ये तो तुमने बहुत बेसिक चीज बताई भाई, ये तो हमको पता है, कुछ और स्टॉक मार्केट से रिलेटेड बताओ। चलो उसके बारे में बात करते हैं। अगर स्वैप, मैंने जैसे कहा कि भाई ये तो आपका ये कॉन्ट्रैक्ट है, क्या बोलते हैं उसका, ये तो आपका बार्टर सिस्टम वाला कॉन्ट्रैक्ट है। पहले इसको इवोल्यूशन समझते हैं, फिर मैं उसी के ऊपर जाता हूं। देखो, जो आपका बार्टर था आज का स्वैप है, एंड जो आज का स्वैप है उसको थोड़ा सा मॉडिफाई करके एडवांस लेवल पे हम लेके जाते हैं तो वो फॉरवर्ड हो जाता है, राइट। फॉरवर्ड में भी हम वही कर रहे हैं, लेकिन थोड़ा सा एडवांस लेवल पे आपको एडवांसमेंट दिखेगा। एंड फॉरवर्ड का जो एडवांस भाई है, जिसको मंथली एक्सपायरी होती है, एवरी मंथ एक्सपायर होते हैं, वो है फ्यूचर्स। फ्यूचर्स में आपको ज्यादा मार्जिन देना पड़ता है, वो दिखते कैसे, काम कैसे होता है, वो भी हम देखेंगे। एंड उसी फ्यूचर का जो बहुत एडवांस वाला जो भाई है ना, वो है ऑप्शंस, जहां पर आपको दो दो ऑप्शंस मिलते हैं, आप बाय करो सेल करो विथ वीकली एक्सपायरी। स्वैप एंड फॉरवर्ड में कोई भी हम इनिशियली पैसा नहीं देते हैं, एंड ये गांव का हर एक बच्चा करता है, गांव का हर एक आदमी करता है, हर एक किसान करता है, स्वैप हर एक जन करता है। ये कैसे करता है स्वैप, फॉरवर्ड स्वैप और फ्यूचर स्वैप्स, मैं आपको बताऊंगा। दूसरा, रही बात फ्यूचर और ऑप्शंस की, इसमें भी गाइस अगर हम स्टॉक मार्केट को थोड़ा सा हटा दे, नंबर्स को अगर थोड़ा सा बाजू में कर दे, तो ये भी हर कोई करता है। पॉसिबिलिटी के साथ कौन नहीं खेलता, मुझे बताओ, सब खेलते हैं। जैसे किसान की अगर मैं बात करूं, चलो किसान की बात करते हैं पहले, और ये समझते हैं कि किसान कैसे इन चीजों को मतलब करता है, बट जिसका डेटा हमें दिखता नहीं है, तो उसको क्या डेरिवेटिव्स कहते हैं। लेट्स टॉक अबाउट कमोडिटीज। तो मान के चलिए आपके पास राइस है, या राइस का बहुत, लेट्स से राइस का अभी क्रॉप है आपके पास, ठीक है, आपके पास क्या है, क्रॉप है राइस का, और वो छोटा है, बहुत छोटा है। लेकिन राइस की जो अभी प्राइस मार्केट में है, जो प्राइस अभी चल रही है, वो मान के चलिए 20,000 रुपए क्विंटल चल रही है, पर क्विंटल। एंड ये 20,000 प्राइस बहुत हाई लेवल पे है, बहुत क्या है, हाई लेवल पे है। अब ये किसान का जो डर है उसको समझिए। किसान का जो डर है ये है, उसका क्रॉप तो अभी छोटा है, बट जब इसका क्रॉप रेडी हो जाएगा, मार्केट में जब इसका राइस आएगा, क्या पता प्राइस 20,000 से 10,000 पे आए पर लेट्स से 1 क्विंटल। नाउ ये क्वेश्चन वुड बी लाइक, सर ऐसे कैसे पॉसिबल है? भाई है ना पॉसिबल, क्योंकि अभी इसका क्रॉप छोटा है, मतलब सप्लाई मार्केट में कम है, डिमांड ज्यादा है, क्योंकि खाने वाले लोग अपने जैसे बहुत है, इसलिए प्राइस क्या हुई है, अप हुई है। जब इसका प्रोडक्शन रेडी होगा, क्रॉप यानी कि बन के जब राइस जब मार्केट में आएगा, तो सप्लाई क्या होगा, कम ऑन, हाई होगा, और डिमांड क्या होगा, डिमांड लो होगा। अगर डिमांड लो होगा या फिर कांस्टेंट भी रहेगा, तो प्राइस ड्रॉप होगा। इसमें नुकसान किसका है भाई, इसमें नुकसान किसका है, किसान का है कि नहीं है? अगर किसान के पास रेडी होता प्रोडक्ट, तो उसने 20,000 से बेचा होता कि नहीं बेचा होता? बेचा होता, है ना। आप नहीं बेचते क्या? तो यहां पे अगर देखोगे, किसान का नुकसान कितना होता है पर क्विंटल, 10,000 रुपए। मान के चलो किसान का जो प्रोडक्शन बना वो 10 क्विंटल का बना, राइट, 10 क्विंटल का बना। सो 10 क्विंटल इंटू अगर आप 10,000 करोगे, सो ऑलमोस्ट किसान का जो लॉस है गाइस, वो 1 लाख रुपए का है, 1 लाख रुपीज का नुकसान हो जाएगा। अब मेरा क्वेश्चन आपको यह है कि चलो, मुझे अगर ये लॉस नहीं चाहिए भविष्य में, मुझे अगर लॉस नहीं चाहिए, तो मैं इसको बेहतर तरीके से कैसे मैनेज कर सकता हूं? काफी सारी हमने चीजें डिस्कस करी है, बट अगर मुझे ये लॉस नहीं चाहिए,
मुझे अगर लॉस नहीं लेना है, मुझे 20,000 ही प्राइस चाहिए 6 महीने बाद भी। सी मार्केट तो मेरे हाथ में नहीं है ना, करेक्ट। मार्केट में क्या ट्रेंड होगा ये मेरे हाथ में है क्या? प्राइस 20 से 40 भी हो सकता है और 20 से 10 भी हो सकता है। ये मेरे हाथ में है क्या एज ए किसान? मार्केट कोई कंट्रोल कर सकता है? नहीं कर सकता है, राइट, नहीं कर सकता है। बट अगर मुझे ये प्राइस चाहिए, 20,000 का प्राइस चाहिए, तो मैं क्या करूंगा? इस 20,000 के प्राइस को, मेरे पास बहुत सारे ऑप्शंस है, अभी एक एक करके ऑप्शंस में पिटारा खोलूंगा। ठीक है, पहला ऑप्शन मेरे पास है। पहला ऑप्शन क्या है? अगर मान के चलो मेरा क्रॉप अभी बहुत छोटा है, बहुत स्मॉल है। क्या है? बहुत स्मॉल है, राइस। अभी इसका अंडरलाइंग एसेट क्या है? राइस है। हम किसके प्राइस की बात कर रहे हैं? राइस के प्राइस की बात कर रहे हैं मार्केट में। ये प्राइस कहां पे है? मार्केट में है, राइट। हम मार्केट के प्राइस की बात कर रहे हैं, लेकिन बेस क्या है हमारा? राइस है, राइट। अब देखो, अगर इसका ड्यूरेशन 6 महीने से ज्यादा रहेगा, या फिर 1 महीने से भी अगर ज्यादा होता है मान के चलो, तो मुझे कौन सा कॉन्ट्रैक्ट साइन करना पड़ेगा? क्योंकि ऑप्शंस तो वीकली एक्सपायर होते हैं, फ्यूचर्स मंथली एक्सपायर होते हैं। तो मेरे पास क्या ऑप्शन बचता है? मेरे पास बाहुबली का ऑप्शन बचता है, जो है फॉरवर्ड कॉन्ट्रैक्ट्स। क्या है? फॉरवर्ड कॉन्ट्रैक्ट्स। नाउ योर क्वेश्चन वुड बी लाइक, सर व्हाट इज दिस फॉरवर्ड कॉन्ट्रैक्ट? सी फॉरवर्ड इज नथिंग बट इट्स अगेन अनदर वर्जन ऑफ फ्यूचर कॉन्ट्रैक्ट्स। मैंने कहा है फॉरवर्ड मतलब आगे। फॉरवर्ड मतलब क्या? आगे। हम सेटल, एंड यहां पर क्या हुआ? कॉन्ट्रैक्ट हमने सेटल किया, क्योंकि मेरे पास आए, मैंने बोला भाई देखो, अब तो 6 महीने हो गए, ये डेट हो गई, अब हम इसको सेटल करते हैं। सी फॉरवर्ड कॉन्ट्रैक्ट्स में इनिशियली हम कुछ भी पे नहीं करते हैं, तो इनिशियली कुछ पे ही नहीं करते हैं, तो कैलकुलेशन काय का करेंगे? कहीं का नहीं करेंगे, बस एग्रीमेंट साइन करेंगे, राइट। एग्रीमेंट हम साइन करेंगे ये बोल के कि देखो प्राइस अगर नीचे गया तो मैं तुम्हारा जो भी नुकसान होगा देता हूं, एंड अगर प्राइस ऊपर गया तो जो भी तुम्हारा फायदा होगा तो मैं तुम्हें वो दे देता हूं। तो दिस इज व्हाट ये टर्म्स के साथ आपने कॉन्ट्रैक्ट साइन किया। अब कैलकुलेट करो बेनिफिट की। ये कंपनी की ओनर है जिसने बाय किया था, राइट। ये किसान भाई साहब है, इन्होंने सेल किया था। अब देखो, जब 20,000 प्राइस थी तो उसको उसने सेल किया था, एंड जब मार्केट में अभी 10,000 प्राइस है, तो इसमें वो क्या करेगा? वो बाय करेगा। बाय करेगा मतलब टू कवर सेल। सेल करना मतलब मैंने बेचा है, तो मुझे कभी ना कभी उसको खरीदना भी पड़ेगा ना। इसको बोलते रिवर्स पोजीशन करना। अब सवाल ये होगा कि सर रिवर्स पोजीशन हम क्यों करेंगे? रिवर्स पोजीशन इसलिए करेंगे ताकि ये ट्रेड क्लोज करने के लिए, नहीं तो आपको आपका प्रॉफिट ही नहीं मिलेगा अगर आप क्लोज नहीं करोगे तो आपने बाय किया 20,000 को, आपको सेल करना, सॉरी सेल किया आपने 20,000 को, आपको बाय करना पड़ेगा 10,000 को। तो इसका मतलब क्या हुआ, राइट? आपका प्रॉफिट कितना हो जाएगा? 10,000 का प्रॉफिट हो जाएगा। मान के चलो आपके पास 10 क्विंटल है, तो 10 इंटू अगर आप 10,000 करते हो तो आपका नेट नेट प्रॉफिट कितना होगा? 1 लाख का होगा। क्वेश्चन है कि सर ये प्रॉफिट मुझे देगा कौन? भाई ये भाई साहब है ना, इन्होंने बाय किया था 20,000 को, राइट। इनको लगा कि ये प्राइस 20,000 का 30,000 का हो जाएगा, तब जाके इनको वही फायदा होगा, लेकिन वैसे हुआ नहीं। तो 20,000 जो भी प्राइस थी उसमें से नीचे आई है, तो इन्होंने क्या किया था? बाय किया था इस प्राइस पे। बाय इस प्राइस पे किया था, तो ये भाई साहब क्या करेंगे? सेल करेंगे 10,000 को। अब आप जरा सोचिए प्रैक्टिकली, आपने कोई चीज 20,000 को खरीदी है एंड आप बेच रहे हो 10,000 को, तो आपका नुकसान कितना हो जाएगा? जरा सोचिए, आपका नुकसान होगा 10,000 का। अगर क्वांटिटीज 10 है, सो 10 इंटू, सॉरी क्विंटल्स अगर 10 है, 10 इंटू आप करिए इतना, तो लॉस कितना हो गया आपका? 1 लाख का लॉस हो गया। तो ये लॉस जो आपका है, कंपनी का ओनर, ये जो लॉस मतलब ये देने वाला है पैसा। किसको देने वाला है? किसान को। किसान लेने वाला है। फायदा किसका हुआ? कम ऑन, फायदा किसका हुआ गाइस? किसान का फायदा हुआ, कितना हुआ, 1 लाख का फायदा हुआ। अब इन रियलिटी में ये कैसे काम करता है वो मैं बताता हूं। किसान इसको नहीं बेचता है कुछ भी, हाँ इनके बीच अगर कॉन्ट्रैक्ट है वैसा तो ही ये बेचेगा इस प्राइस को, क्योंकि इसको इसको इवेंचुअली खरीदना ही पड़ेगा, राइट। तो ये इवेंचुअली वैसे होगा, लेकिन ऑन द ग्राउंड ये सिर्फ एक दूसरे को पैसा देते हैं। कोई गुड्स एक दूसरे से खरीदेगा नहीं। किसान क्या करेगा, एक्चुअली मार्केट में, ओपन मार्केट में जाके ही खरीदे बेचेगा ये माल जो भी है, या फिर खरीदेगा। बट ऑन द ग्राउंड इन द सिस्टम लाइक ब्रोकिंग सिस्टम, ये सिर्फ जो प्राइस का जो डिफरेंस है ना वही सेटल करेंगे। ये क्या करेंगे, वही सेटल करेंगे। तो ये होगा तुम्हारा फॉरवर्ड कॉन्ट्रैक्ट्स। यानी कि फॉरवर्ड कॉन्ट्रैक्ट्स का मतलब क्या है, फॉरवर्ड मतलब हम भविष्य में जाके सेटल करेंगे जब हमारी कमोडिटी रेडी होगी, या फिर हम दोनों काउंटर पार्टी जब रेडी है टू सेटल द कॉन्ट्रैक्ट्स तब जाके सेटल करेंगे। उसको कहते हैं फॉरवर्ड कॉन्ट्रैक्ट्स, उसको कहते हैं फॉरवर्ड कॉन्ट्रैक्ट्स। अब मैं जाता हूं फ्यूचर की तरफ। अगर मान के चलो यही ड्यूरेशन, आपको ये श्योरिटी है कि आपका क्रॉप 1 महीने में रेडी होने वाला है, लेकिन अभी प्राइस बहुत अच्छी है, आपको लग रहा है कि यार ये प्राइस डाउन हो सकता है, तो आपको फॉरवर्ड की बजाय फ्यूचर में जाना पड़ेगा, फ्यूचर में आपको सेल करना पड़ेगा। यानी कि फ्यूचर मतलब वो लिस्टेड है स्टॉक एक्सचेंज पे, इसलिए उसको हम फ्यूचर कह रहे हैं, क्योंकि फॉरवर्ड्स लिस्टेड नहीं है। उसके लिए आपको, जैसे मैंने कहा ना कि गांव में जाके देखना पड़ेगा, अगर कोई ऐसा डीलर है तो उनके साथ जाके कॉन्ट्रैक्ट करना पड़ेगा, वो फॉरवर्ड है। वही कॉन्ट्रैक्ट अगर आपको अवेलेबल है नेशनल स्टॉक एक्सचेंज पे या फिर बीएसई पे, तो वो हो जाता है आपका लिस्टेड कॉन्ट्रैक्ट्स, तो उसको हम कहेंगे फ्यूचर। लेकिन फ्यूचर हो या फॉरवर्ड हो, दोनों एक ही तरीके से काम करते हैं। नाउ ये क्वेश्चन होगा कि सर फ्यूचर और फॉरवर्ड में बिग डिफरेंस क्या है। फ्यूचर एंड फॉरवर्ड में जो डिफरेंस है वो सिर्फ मार्जिन का है। फॉरवर्ड कॉन्ट्रैक्ट में हम बिगिनिंग में कुछ भी नहीं पे करते हैं, लेकिन फ्यूचर में टू कंट्रोल द रिस्क हम इनिशियली कुछ ना कुछ अमाउंट पे करनी पड़ेगी। इस किसान को भी पे करनी पड़ेगी एंड इस भाई साहब को भी पे करनी पड़ेगी, उसको कहते हैं मार्जिन। सो इट मींस फ्यूचर में हम मार्जिन पे करते हैं, उतना ही डिफरेंस है। एंड उसके अलावा तुम्हारा फ्यूचर जो है बस लिस्टेड है स्टॉक एक्सचेंज पे एंड मंथली एक्सपायरी है। फॉरवर्ड की एक्सपायरी का कोई ठिकाना नहीं होता है। अगर आपको 6 महीने का चाहिए तो 6 महीने का साइन करो, 1 महीने का चाहिए तो 1 महीने का करो, 1 दिन का चाहिए तो 1 दिन का करो, 1 घंटे का चाहिए तो 1 घंटे का करो। दिस इज हाउ थिंग्स वर्क्स। तो ये था आपका फॉरवर्ड कॉन्ट्रैक्ट्स। अब जाते हैं फ्यूचर की भी मैंने बात करी कि फ्यूचर के लिए और आपका लॉस भी तय होता है, आपका लॉस प्री डिफाइंड होता है। ये किसान अगर लेता है मान के चलो और मार्केट नहीं गिरता है, मार्केट अगर ऊपर जाता है, तो इस भाई साहब का लॉस अगर ऑप्शंस में 2000 रुपए का होगा ही होगा, क्योंकि इंश्योरेंस की तरह है। जरा अब आप जरा सोचो, आंखें बंद कर लो 1 मिनट के लिए, सोचो क्या हम ये स्टॉक मार्केट की जगह नॉर्मल इस पे नहीं करते हैं? करते हैं। आपके जो डीलर होते हैं जो गुड्स लेते हैं किसान का, वो भी तो वही करते हैं ना। किसान बहुत बार आपने गुड्स ले जाके किसान के इसके डीलर के पास रखता है। अभी मेरे डैड ने ही किया, हमारे पास टर्मरिक का प्रोडक्शन आता है, 40 क्विंटल का कुछ टर्मरिक था। उन्होंने ये सोच के, हम माय डैड वाज एक्सपेक्टिंग कि प्राइस, यानी कि लास्ट ईयर 30,000 की कुछ आया था पर क्विंटल के लिए। उन्होंने ये सोचा कि प्राइस इस साल भी वैसा ही जाएगा, और इस साल मार्केट का प्राइस कुछ 18,000 चल रहा था जब हमारा वो हल्दी निकला था खेती के बाहर, टर्मरिक, राइट। और मैंने डैड को बोला भी था, डैड विच इज अ वेरी रिस्की, अगर 18,000 आया है, लास्ट ईयर कुछ अलग सर्कमस्टांसेस थे, अभी कुछ अलग है, जस्ट सेल इट आउट यार, डोंट होल्ड इट। उन्होंने कहा नहीं विल वेट, डोंट वरी, देखेंगे प्राइस ऊपर जाएगा। प्राइस ऊपर नहीं गया, प्राइस एक्चुअली नीचे आया, और उनको अभी 13,000 या 12,000 का कुछ प्राइस मिला है। यानी कि तब अगर वो बेचते तो उनको 18,000 का प्राइस मिल रहा था, अब उन्होंने बेचा है तो उनको सिर्फ 12,000 का मिला है। तो मेरे डैड का इसमें नुकसान कितने का हुआ? 6,000 का हुआ पर क्विंटल, राइट। अभी उन्होंने 12,000 पर क्विंटल से बेचा है, अगर वो 6 महीने पहले बेचते तो 18,000 रुपए का भाव लगता उनको मार्केट से। अब अगर मान के चलो, अगर आप एक स्मार्ट फार्मर हो तो आपने क्या किया होता इस चीज को? मैंने तो भाई इमीडिएटली जाके जो भी डीलर है ना, डीलर उसको मिलके कॉन्ट्रैक्ट साइन करता है कि भाई देख, अभी जो मार्केट में प्राइस चल रहा है 18 का चल रहा है, और मुझे इस प्राइस से बेचना है, लेकिन मेरी कंडीशन ये है, राइट। अगर मान के चलो प्राइस गिरी प्राइस गिरी तो मुझे 18,000 ही आप दे दोगे। मुझे नहीं पता कि अगर प्राइस अगर कल 0 भी हो जाती है तो भी मुझे कोई फर्क नहीं पड़ता, मुझे तो बस 18,000 तुमसे चाहिए। हाँ, अगर मान के चलो प्राइस अगर ऊपर जाती है तो मैं उसके लिए जिम्मेदार नहीं हूं, मैं डायरेक्टली आपको 18,000 से सेल कर देता हूं, आप 50,000 को बेच दीजिए मार्केट में जाके, मुझे कोई लेना देना नहीं, मैं अपने गुड्स छोड़ दूंगा। लेकिन उसके बदले में अब ये सामने वाला ऐसे कॉन्ट्रैक्ट साइन क्यों करेगा भाई? वो नहीं करेगा, तो मुझे उसके लिए प्रीमियम देना पड़ेगा उसको। भाई देख, एक काम कर, मैं तुझे 5,000 रुपए दे देता हूं, इसके बदले में मुझे इंश्योरेंस दे दे। अगर प्राइस गिरी 18,000 के नीचे तो मुझे कोई लेना देना नहीं, मुझे बस 18,000 से आपको बेचना है, मैं 18,000 से बेच के निकल जाऊंगा। अगर बड़ी प्राइस तो उसके लिए तो भाई देखो, बड़ी तो भाई उसका तो डीलर का प्रॉफिट है वो। करेक्ट? तो दिस इज हाउ कैलकुलेशन वर्क्स गाइस। ये हर जगह पर होता है। हाँ, बस फर्क इतना है कि स्टॉक मार्केट में ना फलाना ढिमकाना करके एक्सपायरी ये वो बहुत सारी टेक्निकल चीजें डाल दी है और कॉम्प्लेक्स बनाया है ताकि वो थोड़ा सा टेक्निकली लगे, साउंड लगे। दैट्स व्हाट। ओके।
Just a quick info, guys. Intellipaat offers an executive postgraduate certification in investment banking and capital markets in collaboration with IIM Ranchi. Through this course, you will master key skills like financial modeling, valuation, mergers and acquisition strategies, risk management, and even niche areas like private equity and wealth management. The program features 80 plus live sessions conducted by IIM Ranchi faculty and industry experts, real world case studies, hands-on projects, and a 3-day campus immersion at IIM Ranchi. Plus, you will also get exclusive benefits like executive alumni status from IIM Ranchi and complete career support from Intellipaat. We have already helped thousands of professionals achieve successful career transitions in the finance domain, and you can check out their testimonials on our Achievers channel. The link is in the description below. And for sure, this course can set your career to new heights. So visit the course page link given below in the description and take the first step towards the rewarding career in finance.
Okay. What is swap or what are swaps? Contracts. Have you heard about swaps? So let's discuss about first swaps. Swaps comes under your derivatives. So when we say swaps, it means, guys, it's an exchange. Okay. Swaps means exchange. So what we can exchange? We can exchange anything. We can exchange anything. Anything means anything. Now a question would be like, what do you mean exactly anything? So you can exchange your risk, right? You can exchange return. You can exchange commodities. You can exchange currencies. So you can exchange anything means anything. All right. So to understand the swaps contract, so I would like to go in basic first so that we can have a detailed discussion. Side by side, I would request you to please note it down. Okay. Because most of the time we also use this, blackboard and all. So you can note it down from your side. See, if we talk about swaps, as we know, swaps means it's exchange of anything. You can exchange anything means anything. So let's say you are in US, okay? Or let's say you are in India and there is one more person which is in US and this guy in India, okay? B. A is looking for, this guy is looking for INR. Why, sir, INR? Let's say this guy is looking for, 8,000 INR, 8,000 rupees in India. Looking for cash in India. Okay. Now your question would be like, so if this guy is looking for a cash in India, why this guy is not applying for a loan in India? See, as a foreign investor, let's say if you're a buyer, let's say if you're an investor and if you want to, raise loans in India, or if you want to apply for loans in India, you can't. All right. Same way as Indians, if you go to US and apply for a loans, you cannot apply unless and until you don't have any job or maybe if you don't have any assets in US, because loan is the business kind of, if you don't have assets, you can't apply for a loans. And as a foreign investor, which is strictly prohibited to apply for a loans in India, or same in every country I have seen, across all jurisdictions, they have a similar sort of regulations. All right. So it means you can't apply for a loans in India directly. Okay. So same applies to the person who is in India, but this guy is looking for, let's say, looking for 100 USD. 100 USD looking for USD in US. Now let's talk about their background. Let's say this guy is a merchant, okay? And this guy is, let's say, again, businessman. See, common people, they don't sign any swap contract as such because it is beyond their, I would say it is not something for them. The reason is, as a common people, we don't, swipe anything. We don't, exchange anything at international level. So the swaps or forwards, basically, it is not for you. But businessmen, right? Businessmen, companies, or any international companies and all, see, they always sign a forward contract. So why they sign a forward contract? The reason is very simple, guys. Let's say, what if you have any, deal which you want to settle in US and you're a businessman, but that guy is asking to settle the deal in USD only. So how will you settle it? As I said, you can't apply for even, loans as well in US. So it means, so what you can do, you can ask someone to swipe currency with you, right? And same way, if the same person is also looking for your currency in India, then you can hand over your currency to that particular counterpart in India, and same person will arrange the USD currency for you in US. It's kind of a hawala, right? In hawala, what happened? So other parties, they always provide the cash at a different locations, correct? So this forward is the standard or more organized example of hawala, I would say. Because here we sign documents and we know the counterparty that, who is going to receive, who is going to pay. That's what we can't say this officially as a hawala, but this forward contract is kind of, the another, I would say, the legal version of hawala only. Because in hawala, counterparty name should be like unknown until you settle the funds. All right. If you want to, let's say, transfer 1,000 crores from, Maharashtra to, let's say, Delhi. All right. So until you, let's say, reach to the Delhi, the counterparty name would be like unknown. Counterparty, it means that age, that, the party who is, or beneficiary name who is going to receive that payment, right? So you can just send the payment through maybe different, ways, and that party will accept the payments, and it is their job. But see, eventually in forward contracts, we sign the all legal papers, we signed everything. So that would be your, basically, legal agreement, proper legal agreement. So let's go ahead further. Let's say this guy is looking for a currency. The duration is 1 year. Again, this duration is 1 year. Let's say the cycle is for 12 months. On January 1st, the cycle of this contract is January to December. On 1st of December, both the parties, they, let's say, reach out to the broker, and broker, let's say, facilitated them to arrange this particular money and everything, and they decided to exchange it. Okay. So here the important point is, at the time of initiation, what will happen? There are two aspects. One is, if this businessman, let's say, if he or she has their own money, they can exchange it. But what if this guy, let's say, has no USD money as well, but he's holding an assets? All right. So in case of that, then this guy will apply for a USD loan, correct? USD loan. If you just convert 8,000 into this 100 USD, then you will have to check the FX rate. FX rate. And let's say the FX rate, we are just assuming it. for a 1 USD, the rate is like 80 rupees. And same for a currency, if you just calculate for 80 rupees, the dollar value is 1 USD. Okay. So this is your rate. So now the important is this guy can apply for a loan with the bank, let's say Bank of America. And Bank of America can charge interest payment 1%, 2%, 3%, whatever it is. Same condition applies to this party as well. This party can apply for a loan, let's say with 10%. The bank name is HDFC. Let's say this guy applied for a loan, HDFC disbursed how much? 8,000 rupees. This guy is ready to pay 10% interest for per annum. And this guy is also ready to pay, let's say 7% interest payment for per annum. This is a contract. Okay. So when the contract initiated, what happened? Bank transfer money, which is 100, USD to this holder A, and then A will transfer 100 USD, right? 100 USD to B, and this guy, let's say, the B will transfer again 8,000 rupees to this guy A, and then your contract will be initiated. Contract will be initiated. Now look for a exchange, guys. What they have exchanged against 100 USD, right? 8,000 rupees, which has been exchanged at the rate of 1:80. All right. But anyways, this rate doesn't affect on your, the exchange. All right. This never affect. The reason is whatsoever it is because ultimately parties are responsible for a notional amount. Notional amount, it means this principal amount. In this case, if we talk about the principal amount is 8,000 and 100. Okay. Because for Indian investor, principal amount is 8,000 rupees. And for a US, let's say investor, the principal amount is 100 rupees. All right. See this, see the contract, contract period is 1 year. And here they have exchanged it. Okay. So when they exchange it, you can see like this, minus 100 plus, 100 in the books of this A. Will create a separate book, USD party. So minus 100 USD plus 8,000 rupees. All right. In the book of this foreigner. And if we talk about, let's say, India, so this guy will maintain like 100 USD minus 8,000 because this paid it, received it, right? For a 1 year. Let's say this is at the time of initiation. See what will happen now at the time of settlement. At the time of settlement. Let's assume it. The FX rate, it was like 1:80 at the time of initiation, but at the time of settlement, so let's say rate gone up like 1:83. 1:83. Now, at the time of settlement, what will happen? This guy again will pay 100 USD. Correct? Will pay 100 USD and will receive 8,000 rupees. Because this, even if the rate changes, it won't affect on the actual amount, right? And in the books of this foreigner, this guy will receive 100 USD, and this guy will pay again 8,000 INR. See, this was just the settlement between parties, right? But what about the bank settlement? Bank settlement. Now this guy will transfer money to the bank, right? How much money will receive to the bank? 8,000 directly, right? 8,000. Along with that, here if you see, it was a loan taken from the bank, right? And 8% interest payment, which is 800. Bank will receive this. Okay. And same for here as well. This guy will transfer 100 USD plus 7% in an interest payment. It was there, right? So plus 7. Sorry. So total $107 will receive to this bank. And then finally, they'll announce contract settlement. So this is how in a reality, when we settle the contracts, this type of framework you can see. We'll call it as a reverse positioning as well, because eventually if you see, we have only transfer cash and we have received also cash. There is no interest involved in this particular transactions. No party is asking to pay interest payment. It's just a plain, change the currency. It's just to change the currency for 1 year, and same, other party also will. So it means, guys, let's say your friend has USD and you have an INR. So you and your friend can exchange, you can exchange your INR to your friends, and your friends will exchange his dollar to you. So you can, exchange that for maybe 1 year, and after that, as it is, you can transfer money back to each other, right? So this is how your currency swap works. Now your question would be, look, sir, why currency swap is important? See, if you are a businessman, let's talk about, some facts, which is a very important one. Let's say you have decided to settle your business in US. How will you apply for a loan? You tell me. Just think for a while. Or let's say you have some vendor in US. So how will you manage that transaction? Or let's say vice versa. You are like, let's say you are foreigner, right? And you have decided to establish your, let's say, you have decided to establish your own business in India. So how will you start? What do you think? USD will work in India? No, right? What about your INR? Will INR work in India? Will INR, work in US? No, it will not. Means you can't buy anything. See, your paper currency has a limitations. Okay, your paper currency has limitations. So you can't buy everything in US or even anything also. Same with the dollars as well. If you have a dollar, so pay the dollar to the auto driver, pay the dollar to the, let's say, restaurant owner, pay the driver to the builders. See, if they are aware about it, if they're educated, maybe they'll accept the payment in dollar and they'll deposit the dollar with the bank. But ultimately, you need a rupees only, because paper currency has a limitations. Okay, every currency has a limitations. Now, if you ask me, sir, is there anything that let's say currency has no limitation? Yes, the Bitcoin has no limitations, or even most of the cryptocurrencies, they don't have any limitation as such. It trades anywhere or any corner of the world, or everywhere in the world, I would say, cryptocurrencies. And that's what most of the real estate businessmen or the other businessmen in India also. I have seen a couple of the people, they reach out to me. They wanted payment in USDC, which is a crypto coin. They wanted payment in Bitcoin. So why Bitcoin? Because they can easily swipe their currencies in any country, anywhere in the world. Because through traditional system, it is very difficult to exchange the currencies, find the agent, like kind of this swiping and all. And what if, let's say, if you don't have agent, then who will swipe it? Of course, in that case, then you can approach to the Reserve Bank of India or Central Bank of US as well, so they can exchange the currencies, because central banks, they work as a swap agent, so you can exchange any foreign currencies with them directly. That's the another story. All right, but easily if you want, and again, if you directly approach to the central bank, their process would be difficult, right? They'll ask you several papers, your KYC documents, your business documents, your transaction documents, and they will have limitations. At a time, only you can deal in $2 lakhs. What if I want to deal in millions of, or let's say billions of dollars? So how I can deal with that? Now you tell me. So it will not, right? It will difficult for you to deal, correct? Let's say let's take an example of Tesla. Let's say Tesla want to start their manufacturing unit in India, but they don't have a cash available in India, right? They have a cash available in dollar. So how they'll exchange it? And to understand that, the swap, currency swap is the example where they directly, through their connections, they reach out to the people, and what they do. Let's take Adani. If Adani has a good repo in Indian market, what Adani can do? Adani can apply for a loan in Adani can apply for a loans in India and ask government to pay, let's say 10,000 crores. Okay, and same 10,000 crores Adani can transfer to the Tesla owner, which is Elon Musk. Then Elon Musk can also do the same thing in US. Elon Musk can arrange the, let's say, same dollars with the worth of rupees 10,000 crores. It could be around, let's say, 800 crores somewhere. So that 800 crores dollars that Elon Musk can transfer to the Adani in US. So both can, they can maybe access that currency, reinvest it, depends on the businessman's, the business goals or objectives. Then accordingly, they can execute the contract. Because if you just invite bank to be a member of it or member of your transactions, then you can see lots of scrutiny checks, and it will take again longer time than the expected, and then as a businessman it is very difficult. So that's what your currency swaps, which is one of the widely used tools. Even your Indian government, state governments, I have seen lots of cases where they sign swap contracts. If you talk about, let's say, Japan and India, for a monorail project, India and Japan both have signed the swap currency swaps, where this Japan government will disburse the funding to the government with no interest rate cost. Now your question would be like, sir, why is there no interest rate cost? The reason is, guys, there was zero interest rate in Japan. Not even governments, but most of the US investors, what they did, they just signed the currency swaps with Japanese government or Japanese banks. They apply for loans in Japan. They took a loans from the Japan and invest in Indian market on return, and again withdraw that amount and return that as it is money back to the bank, because there was a zero interest rate in Japan. There was a zero interest rate. So most of the investors, they did this. I have seen because I worked with hedge funds, so I know it. Trillions of Japanese, and they just applied for loans, took a loans from a bank and invested in Indian market, or Indian, or I would say in different markets. Even few businessmen also, which I know it, they did the same thing through their, one of my investors from Kerala, what he did, he has good connections in Taiwan and even Japan as well. Through Japanese, he asked them to apply for a loan with a bank like Bank of Japan, and settle that Japanese loan in India through a foreign exchange route, and they did it. Only he had to pay transaction cost to the government of India and received fund, and now that same fund, this guy invested in real estate, right? So now let's say if I use 10 billion Japanese in India for 10 years, still, see, you just need to pay $10 billion back to the Bank of Japan. So you don't need to pay any interest payment at all. So it means there is no cost involved in the loan. You just need to transfer as it is, Japanese yen to them. And it's a better deal, right? So this is how you can, this is how you can sign the swap contracts. So that's what I said. The swap contract is not a tool for common people. But let me tell you something interesting. Let's say if you have your brother or someone in, let's say US, UK, and if they're working, when they deposit money with the bank, means let's say every month they transfer some amount to their parents, right? So what they do, they deposit the amount in US bank, then US bank settle that payment with the Indian bank, and then Indian bank finally send you the notification that money has been debited. I'm working with one of the international fund, and they settle my salary in USD every month. But again, I can't accept salary in USD, correct? So I ask them to deposit that salary with my bank, and my bank convert, dollars into INR, and then finally I receive INR in my account. But again, that also comes under your swap contracts only, currency swaps, because here we are swiping a currency with other currencies. All right. So this was the example of currency swaps. So now let's talk about interest rate swaps. Okay. Interest rate swaps. So it means here we are talking about interest. So now your question would be like, sir, how we can exchange, the interest rate, or how you can swap that interest rate? Yes, you can do it. If you are smart, if you know how to manage your, interest payments and all, you can easily deal with that. But first understand this, guys, why derivatives come into picture. Okay. Why derivatives come into picture? Derivatives come into picture because of differences in price and differences in, let's say, rates, or differences in, the risk parameter. And that's why we always look for a something, which can help us to maybe, generate some return or to make some money out of it. How? Let's say we have a stock. Okay. We have a stock. You have buy it at 100. Again, same stock. You have sell it at, let's say, 100. All right. So there is no opportunity to make money, correct? No profit, no profit, no loss. No loss. So in that case, we cannot expect any derivatives. Even if you try to derive the value, but eventually there is no change in the price, right? There is no change in the price. Same example, if I talk about, let's say in other way, we have buy it at 100, and if let's say sell it out the same, security at 1110, So here you can see the opportunity of, profit of 10 rupees. And that's how your derivatives come into picture. Because this, if you just buy it at 10 and you can sell it out, 100, and if you just sell it out same security, maybe at 110 or maybe more than that, then you will get some, some benefit. You will get some benefit. And that's when, derivatives come into picture. Because derivatives help you to buy the same stocks in bulk or quantities. You can pay just minimum amount, hold, let's say, quantities in large, and you can make more money, right? So it means if there are no differences in price, then you don't need to even trade in that particular securities. Not only buy and sell, but even you don't need to, look for any derivatives opportunity as well. Because derivatives is all about differences in price. Derivatives is all about differences in price. Or even if I ask this question to you, why we buy securities? Why we buy? Right? Let's say there is a business. If you invest 1 crore today, then after 10 years also you'll get only 1 crore. Will you invest? I'm sure no. Let's say there is a business. If you invest 1 crore, after 10 years, your money will be, let's say, 10 crores. Will you invest? Of course you will invest. Why? Because you are seeing an opportunity to multiply your wealth. Correct? Am I right? So you're seeing an opportunity, and that's when your derivatives come into picture. If you have any opportunity like this where you can multiply your money, then instead of 1 crore, why don't you buy, let's say, same assets with worth of rupees 100 crore? Buy it and wait for 10 years then. If 10 years becomes, let's say, your 1000 crores, then you can make more and more money. So this is how your derivatives come into picture. So same logic applies to the now interest rate as well. So let's discuss about it. How businessmen, or let's say even common people also, they can, but again, this interest rate swap is not available for common people. It is available for businessmen only. So how businessmen, they can, let's say, take advantage of this particular interest rate swaps? Let's discuss. If we talk about, let me just start it out, interest rate swaps. A businessman, B businessman, but here the again condition is both are from same country. For interest rate swaps, so condition is both are from same country. All right. Let's say both people, they have taken a loan. Both are businessmen. They have taken a loan of 1 lakh rupees. This guy, condition is like this guy is paying fixed interest rate, which is 10% per annum. And this guy is paying, let's say, variable interest rate, which is 12%. See, variable interest rate is linked with the RBI. When RBI announce interest rates, this rate continuously, it will change. Fixed, it means it's a fixed. Fixed for, let's say, the loan maturity is 1 year, right? So for entire 1 year, interest payment would be 10%. But if we talk about variables, every quarter, rate changes, because RBI and their team, they connect and announce new interest rate. So new interest rate will be applied in case, when you have, let's say, loan obligations under variable interest payments. Correct. So let's take an example. We have, let's say, A and B. A is a businessman, which is a builder. Right. Applied for a loan and loan received with 10% in a fixed interest rate. And if we talk about this, let's say A guy is again businessman and paying interest rate on loan, which is around 12%. See, if you want to sign any derivatives contract, first the condition is you should have something, assumption in your mind. If you don't have any assumption in your mind, then you are not a fit for a derivative contract. Assumption, it could be this guy B is worried about fixed interest payment, which is a 10%. If you compare this 10% with the variable one, of course, this guy, let's say, this guy is at a better position, correct? Because variable wala person is paying almost 12%. It means 2% extra. 2% extra interest payment that the variable interest payment guy is paying to the bank. All right, on this amount. So this amount, we'll call it as a notional amount or principal amount in interest rate swaps. Let's go ahead. So if we talk about now, let's say, if the first assumption, if they don't sign swap contract, interest rate swaps contracts, how the condition would be at the end of the, let's say, year, because the loan maturity is 1 year. If we just calculate the benefit, this guy, let's say, had taken loans from ICICI Bank, and this one is from Axis. See, the payout this guy will pay to the bank is 1 lakh into 12, So 12,000 for interest payment and principal amount, which is 1 lakh. So this guy will pay it, right? Without swap contract. And same if I talk about this B1, B will pay 1 lakh into 10% divided by 100, which is 10,000 plus 1 lakh principal amount. So this amounts will receive to the bank, ICICI Bank, at the end of the maturity. All right. This was just a plain one where they don't have signed any, let's say, exchange contract. But if they sign exchange contract, what will happen? See, this interest payment, let's say assumption is now the second assumption is they have already initiated the contracts because this guy was worried about, variable and this A was worried about fixed. The reason is eventually this guy was looking for a variable and this was looking for a fixed. Now your question would be like, sir, if the interest rate is high like this, why this guy will look for a variable? See, the assumption would be maybe when what if, let's say, now we have an inflation, that's what the interest rate are higher side. But maybe next quarter interest rate can also reduce. See, RBI can announce reduction in interest rate as well. So at that time, interest rate will reduce and then reduce interest rate. What if, let's say, if that interest rate reduce and which come down at, let's say, 10% or maybe 9%? What if this happened? Then ultimately this guy would be in profit, right? Because this is a fixed one and to pay the interest payment throughout the year like fixed, which is something, difficult, correct? And that's when this guy is looking for a fixed interest payment. And again, let me tell you something. If the fixed interest rate is 10%, and again, variable interest rate is also 10%. So it means in that case, you don't need to sign any swap contracts. If the both interest rates are in the same line, variable and fixed, then we cannot find any opportunity to make some, arbitrage or benefits. So to make some profit or make some, let's say, revenue out of it, there should be differences in interest payments or interest rates, like fixed and variable. Then only we can, look for interest rate swaps. Otherwise, we don't sign any interest rate swaps. We don't sign it. There is no difference. So here in this case, we have a difference. And as I said, this guy is looking for a variable. This guy is looking for a fixed, and they decided to enter in the contract. So this one is your duration 1 year. Here, what happened? See, contract initiated. B, A. Initially, they don't pay anything. No payment required. Just sign the contract on paper. So they just sign the contract on paper. They don't need to pay anything, any value to anyone. It's just a plain contract that they'll sign because the contract duration is 1 year. And in contract, they include the term, which is notional amount, fixed leg, F leg, then your duration 1 year, right? They'll include everything. Okay. And they'll appoint one broker as well. So broker will track the flow and everything. So now the one more important thing is here. See, throughout the quarter, every quarter, you might see change in interest payment. One is fixed and one is variable, right? Let's say fixed is 10%, 10%, 10%, 10% for every quarter. And let's say this variable was like 12% for first quarter, then 10% for second quarter, 9% for third quarter, and 8% for fourth quarter. So if you see this 12%, it means here you can see 2%, opportunity. Here, no opportunity. Here again, 1% opportunity. And here, 2% opportunity to gain some or to earn some money. So here, see, this guy means B will actually, pay fixed interest payment to whom? To A, and A will pay variable interest payment to, B throughout the quarter. So every quarter they can calculate the interest payment and exchange with each other. So if we talk about V, let's re-chart it out so you'll not get confused. B and A. B is paying fixed, but looking for variable. A is paying variable. Looking for fixed. All right. Fixed, variable, okay. Quarter 1, Quarter 2, Quarter 3, Quarter 4. See, this variable originally, this variable is from this guy. And this fixed one is from this one. Originally, the B is paying fixed only, and this A is paying variable. But this guy is looking for a fixed one. And this guy is looking for, B is looking for variable one. So after initiation of a contract, you can just change the side. You can just change the side because this guy is expecting variable. It means pay variable interest to this guy and pay fixed interest to this guy. Simple. So every let's see the amount. What was the amount? 1 lakh. So interest payment would be 10,000, 10,000, 10,000, 10,000. So all 10,000, 10,000, 10,000. So 40,000 payout it will receive to A. Okay. And if we calculate the variable, it was 12%, then 10%, 9%, and 8%. Every year there was a change in interest payment, and here only 10. It was fixed. It means only 10, 10, 10. Originally it was a fixed, right? 10, 10, 10, 10, 10. So now if we talk about the calculate the interest payment, here you can say 12,000, 10,000, 9,000, and 8,000. So just total it out, 22, 22, and 8, 30. Right? 30 plus 9, 39,000. So there is a difference of 39. See, variable interest, this guy was paying, correct? Already this guy was paying. But after the contract, this variable goes to this one. 39 will goes to the B. And this guy will pay fixed one. So this fixed one goes to this one, which is 40,000. So instead of sending, 40,000 and 39,000. So see, with this example, if you just think 40,000, it might seem, easy that, we are transferring this 40,000 and 39,000. But if we talk about, let's say, 1 billion, 2 billion, or 1 million, 2 million, 3 million. So that comes with a cost because banks also, charges fees to each transactions if you initiate a payment or if you process a payment. So it's not easy to transfer a payment. So it's a very difficult one. Okay. So instead of transferring full amount, so parties only settle the differences. Parties only settle the differences. So if we talk about this guy, variable guy is responsible for 39,000, which is a pay for him, and 40,000, which is a receive for him, right? So 40,000 will receive, 39,000 will pay. Instead of that, if we just, let's say, settle 1,000 rupees in the books of A, then it would be easy, right? Instead of transferring all the, let's say, interest payment from one account to another, it would be difficult, correct? But instead of that, if I only settled 1,000, would be easy. And 1,000, which is a receivable for him, so which is a benefit. So it's a benefit actually. And same if I talk about, let's say this guy's payable amount is 40 and receive amount which is 39. So receive is less, pay is more. So it means for B, it's a loss of 1,000. So total, this B will transfer 1,000 to A. So in this particular business, who lost the money? Of course, B lost the money by 1,000 rupees and A made a profit out of these transactions of 1,000 rupees. And that 1,000 rupees A can use to mitigate the risk, which is the interest payment risk. The reason is A was paying 12% interest payment. If we just see this, A was paying 12% variable interest payment, but due to effective hedging, that A made some profit out of this in a particular swap transactions, which is around 1,000, and that 1,000 A can use to repay the debt of a bank. All right. So just tweak this example in a way. Let's say this transaction size was 100 crore. Now, if you say 100 crore, and if you just calculate all of this interest payments and all, so you can see the difference of 1 CR interest payment. See this 1 CR interest payment, and 1 CR is a very decent amount. All right. With a small amount, if you just think, it might seem okay, which is not interesting. Just we are making 1% or 0.5% interest payment. But if you just increase the value, then you would see difference in millions. And for a big investors or businessmen, even 0.05% interest rate also it matter a lot. If I apply for a loans, let's say with a bank for 100 crores, and the bank, let's say there are two banks. One bank is ready with 10% interest payment, and another one bank is ready with, let's say, 9% interest payment. Of course, I'll go with the 9%, but I'll check other terms as well, because interest rate cannot be let's say, only one thing that I can look for. I can also look for a flexibility as well, like which bank is giving me more flexible options to repay. So I'll look for that option also. But even if you talk about, the interest rate, let's say the one bank is offering 9%, another bank is offering 10%. So now here, if you see the difference there is a difference of 1%, right? Even if I think about 1% interest payment on 100 crore amount, so it would be around somewhere 1 crore. So why should I pay 1 crore extra to the bank now, you tell me? So this is how interest payment come into picture. So interest payments, this interest rate swap is nothing but it's, the look for an opportunity, right? As a businessman, you should always look for an opportunity. How opportunities that you have on 1 crore amount, 100 crore amount, HDFC, Axis. So let's say Axis is charging 9%, and this HDFC is charging 10%. So now which one you would prefer? Of course, this one. Why? Because the interest rate is lower than the HDFC, which is 9%. But annually, how much that you can save? Let's calculate it. 9%, 100 crore into, so 9 crore. Total interest payment would be 9 crore. And here, 100 crore into 10% divided by 100 would be around 10 crore, right? So if you apply for a loan with HDFC Bank, then you will have to pay almost 1 crore extra every year. Correct. And if you just apply for a loans with the Axis Bank, then you can save 1 crore at least, the minimum 1 crore that you can save. See, as a businessman, interest rate factor is a very crucial and critical to manage, leverage. See, I always believe that you should not even pay 0.01% interest payment, means interest cost, higher or extra, because it is to generate an income, it's not an easy process, guys. For a businessman, it's not like a nokari. For a nokari or job, it's just a 10 hours job, all right, or 8 hours job. If you join anywhere, you are just entitled for, ABCD tasks, just manage it and go to your home and sit, relax, right? But for a businessman, it's not an easy process. It's not an easy process to pay the salary of thousands of people on time, to manage the clients, to always look for expansion of a business, to think about business 24/7. And businessmen, they're like, even they don't take any leaves and all. So you always look for a sick leave, look for this leave, that leave, papa ki shadi, mummy ki shadi, falana damkana. You will have thousands of things. But for a businessman, no. See, I have not taken single leaves in the last 5 years, to be very honest, because on a weekend I have a session with you. I have other my businesses as well. I'm into also like fund management, real estate. I have other my private clients as well. I'm working with them as a consultant. I'm working with them as a partner. I'm working with them on a different products. We have recently launched one, the fund administration platform in US. So I have a lots of things. I'm managing the investments portfolios as well, and I'm working with startups companies as well as a consultant. So it's very difficult for me to take a leaves for even 1 day or 1 week at the moment. But as a let's say job holder, it is very easy for you to apply for a leaves. Enjoy weekend. Even you can apply for a 2 weeks leaves, 3 weeks leaves, and you can enjoy it. It's a very difficult, so that you can understand it. Then to generate the money also, it is a very difficult. So while selecting, the interest rates or interest cost, so always see which one is benefited for you and look for an opportunity. If anyone is offering more, let's say, flexibility with lower interest payments, so you should only look for a lower interest payment, because this affects on your profitability of the business. So they appoint the intermediate person. So you don't need to appoint your banker, but you can appoint someone. See, both can make, there are platforms, okay? So there are platforms, swap platforms, exchange platforms. So both can register and submit their quotations, and they can appoint broker as well. So broker will take care of it, everything. Broker maintains swap accounts. So for example, let's take example of Citibank. Citibank work as a swap agent. So you can approach to the Citibank to swap your swap your interest rates. You can also check with Morgan Stanley as well, because Morgan Stanley also works, as a swap agent in international markets. I have also seen that Goldman Sachs, JP Morgan, then Wells Fargo, they work as a swap agent. In Indian market, HDFC Bank work as a swap agent. Then your Axis also work as a swap agent. So you can check with them if you guys are really interested to settle. But with the same banks, you can't do this. So you will have to appoint a bank, or you will have to register yourself that you are looking for interest rate swaps. But as a common man, I don't think so. You would be able to find any someone like good party. But if you have a, let's say, if you, now your question would be, look, sir, as a common man, if I want to hedge, then how can I do this? See, if you want to hedge your interest rates, then in that case, you can look for a forward contract with any parties if they're really interested. Okay. And then you can look for, but to swap this, instead of that, the common or popular instrument would be, maybe you can, invest in a, any other instrument like mutual funds or maybe real estate or anywhere to generate more returns, so that you can, offset it. Because at an individual level, I don't think so any of the instruments will work, and even they'll not entertain. Because let's say even if you apply for, let's say, 20 lakhs rupees loan, the profit from the contract would be very less, so it would be very difficult in that case. And so always they look for a big contract size. I'm thinking about to build the platform for currency swaps or loan swaps, interest rate swaps, then rent swaps. I'm thinking that I had a meeting with my investors. If I get a funding, then I'll work on it, because the cost of investment, which is cost of development, would be around almost 10 crores. Even if I just consider development cost to build a product and to work on it, and again to marketize that product in the market. So it's almost 5 years journey. One year it will take for a feasibility test. Then 1 year again it will take to marketing, promotion, right, at an international level, and then after we can onboard clients. But yeah, so once you onboard the clients, then you can make a huge money. Then you can have a multi-billion-dollar company then. But yeah, so this is how your swaps works. So I'll take one more example for IRS, which is total, or you can say TRS, total revenue swaps, how it works. And then maybe we can go through the PPT. On a PPT, you can see more technical terms as well. Okay. So let's talk about now total revenue swaps, how TRS works, total revenue swaps. Let's say you have a few properties, okay? A, B, C. Yearly income of this property is 50,000, 20,000, 30,000. All right, it's a rental income. So rental income, we can call it as a revenue as well, okay? It's a revenue from the properties. So total revenue that you have is 1 lakh. But the point here is this 1 lakh is not a fixed, so which is a flexible or variable, I would say. So how it is variable? See, what if, let's say, due to COVID, you don't have any tenants, then property would be vacant. Let's say, you are not able to get the strong tenant. So it means the retail people, they are just, signing 1 month, 2 months contract. So it means continuously you are seeing, after 1 or 2 months, your property is vacant, right? Your property vacancy rate is high. If the property vacancy rate is high, then it would be very difficult for a businessman to, do some financial planning with this. Are you getting my point? So if let's say 1 year you have received 1 lakh, but next year you have received only 50,000. Maybe let's say third year you have received 60,000. Maybe fourth year you have received again 30, 40, 60, 70. Right. So this is how yours is getting interest payments from the properties. All right. So it's a very difficult in that case. But what if, let's say, what if you can swap interest rate, let's say, this rental income with someone, all right, who is ready to pay you fixed, let's say, income, or you can say interest payment. So you can exchange anything. So here is the example of revenue. So it means you can exchange your revenue. All right. Let's say this guy is interested to exchange with the interest payment. All right. This guy is ready to pay you 30,000 interest payment for 4 year, which is a fixed. So ready to sign agreement with you. Every month you will receive fixed interest payment. So you don't need to worry about, even if the property is vacant for a year, whole year, that's fine. So you don't need to worry about that. Your responsibility is like just to hand over whatever, revenue it will receive to you as a rent. You can transfer that rent to this guy, and that guy will pay you 30,000, which is a fixed, interest payment to you every year, because it's yearly contract. So let's take an assumption now, since both you guys are ready to sign and you have signed contract. Contract now has been initiated for 5 years. Rent and interest payment. See, rent interest payment is fixed every year. 30,000, 30,000, 30,000, 30,000. Interest rate is fixed for entire schedule. Okay. Now, if we talk about, let's say, rent for a first year, the rent generated from the property is 1 lakh. Right? So if you see in this particular, at the end of the, let's say, first year, this guy, the rent owner will pay 70,000 to whom? To this guy. Because if you don't want to pay 70,000, then eventually this rent owner will transfer 1 lakh and this, or see, even if the rent owner don't want to transfer and to maintain all of this, so both can appoint broker. So simple. If you just appoint a broker will settle that. Broker will take care of that everything. So broker will take care of this settlement of broker will collect the rent, which is 1 lakh. Again, interest payment from the party, which is 30,000. So net, this broker will settle this 70K in the interest holder who is paying interest payment. So they'll settle it out. All right. So this is how actually your contract works. Let's say in another month, this property was vacant for almost for a year and rental income generated, which is only 20,000. So in this case, this guy will pay, interest holder will pay, 30,000 to rent holder directly, 30,000 to the rent holder. Let's say for an entire year, again, the property was vacant. See, it's not the problem of this rent owner then. Because if the property is, even if it is vacant, still this guy will pay, fixed interest payment. Again, it will receive. If you talk about the loss, here you can see a loss of 20,000 because the rent, the generated, which is only 20. So you can see the loss, which is 10,000. Here you can see the loss of 30,000 because no let's say rental income generated. So here let's say 50,000 rental income generated. Then in that case, you can see this guy will pay, rent owner will pay 20,000 and this guy will again receive 20,000. All right. Let's say again the property was vacant. Loss. Property was vacant. So now you tell me what you have understood from this schedule. The one party exchanged or wanted to exchange their rental income with other party at a fixed rate, and the other party was looking for a rental income with a fixed amount. So they just exchanged that with each other. So this is how you actually TRS, total revenue swaps, works. So at settlement, every year we'll have settlement, and every year the broker will settle the fixed amount of that amount or variable amount of the differences in the both parties' accounts. So they just settle it. Let's take an example. You are interested to you are interested in commercial properties. Commercial properties rent. But you don't have a huge money to build properties. Why you wanted to build commercial properties? Because your purpose was to generate some rental income, right? But you don't have your own capital like 1 crore, 2 crore, 10 crores. You don't have your capital. Let's say your budget is only 50 lakhs. So within that 50 lakhs, what you can do, you can find some commercial properties and identify their problems. Maybe let's say irregularities in interest, that rental income. See, as a businessman, if I have a irregularities in income, so which is a bottleneck situation for me, because I won't be able to take any investment decisions then. Let's say if I have invested 10 crores to generate maybe 10 lakhs interest payment for per month, sorry, rental income for per month. What if, let's say, in 1 month, I'm getting 10 lakhs, but in other months, I'm getting only 5 lakhs, 6 lakhs, 4 lakhs. So this is variation, variation in rental income, which is a big problem for a businessman or to anyone. If you are an investor also, if you invest, let's say if you have invested huge money, like 10 crore, 20 crores, and if there are variations in rental income, then which is not a good, because they want something, fixed, which they can maybe reinvest, or they can plan, something different. All right. But as a, let's say, arbiter, it means arbiter always look for an opportunity. See, they don't hold any, assets, but if they have a capacity to at least enter into obligations, so that they can. So one person is looking for a, fixed, whether it is a rental income or any income, that's fine, looking for a fixed. And the other guy who don't want to hold any assets because the capacity of this guy is very low, but ready to at least invest, let's say 50 lakhs. But that 50 lakhs, you don't need to invest in one go. So what you can do, you can find the properties, like commercial properties, find their problems. If they have problems with the properties, like let's say irregularities in rental income, you simply ask them, first evaluate the market and everything, right? If their variable, let's say rental income is, let's say 1 lakh variable, then you can apply maybe, your vacancy rate or all other, I mean, there are different ratios, just apply to it. Your discounted amount would be somewhere, means considering all possibilities and all, like, the property was vacant for 3 months in a year. So in that way, you can apply the logic and compute the interest payment, or maybe you can commit, let's say 50,000 that you will pay, which is a fixed interest payment to the this property owner, and then property owner will provide you whatever rental income will be generated from the property, so that entire rental income it will receive to you only. Even if you generate, let's say 10 lakhs per month, right? So you will receive that entire income. So in return of that, you are going to pay only 50,000, which is a fixed for every month. So every month you can pay fixed 50,000, and whatever rental income will generate from that property, it is yours. Whatever means whatever. Even if, let's say, there is no income, but still you will have to pay 50,000, which is a fixed amount to that property owner. And this is how you can, sign a contracts with property owners, or maybe you can say the people like who are looking for fixed returns. You can sign a contracts with them. All right. So this is how your swaps work. So let's now talk about technical some words, how your swap contracts works. So if we talk about the swap contracts, at the time of initiation, we don't pay anything, no payment at initiation, and you can see periodic settlements, maybe quarterly, yearly, even daily as well. So it depends on the nature of the contract. So accordingly, just we continuously settle the contracts and process that out. But the very important is to find someone which is a who can actually exchange with you. It's very difficult, and that's what we appoint broker. That's what we appoint someone who can help us to exchange. Okay, so in a theoretical term, if you just ask me, sir, what is swap contract? It's an agreement between two parties to exchange a series of future cash flows on a periodic settlement dates over a certain period, maybe 1 year, 2 year, 3 years, depends on your contracts. A swap contract can be decomposed into a series of off-market forward contracts as well. All right. So off-market, it means if the security is not available in the let's say market, like stocks, currencies, all are like available in the market. But what if, let's say, the rental price you can't see in the market, right? So it means that would be with the parties the parties, it means who is the owner of that property, you can only reach out to him and get the price. All right. So this is how, means there are two types of contracts. One is on market forward contract and off market forward contracts. Off market, it means it is for a real estate or commodities and all, where the price of the securities which is not available at all. You can sign a contracts with those commodities or that particular, let's say, real estate products and all. Apart from that, you can sign contracts, swap contracts with listed securities as well, like stocks, bonds, and debentures, whatever instruments that you have. Right. If you talk about types of swaps, we have a plain vanilla swap, which is your normal that rental swaps. You can consider it as a plain vanilla swaps. Interest rate swaps are just exchange of interest flows that we have already discussed. Then settlement date. So how actually it settles? So on settlement date, whatever it is, but this is something for a different, but you can see settlement date as well in the swap contracts as well. All right. So you can appoint broker. Broker will actually settle the contracts on a periodic basis, like as I said, daily, weekly, monthly, yearly, even at the time of maturity also. So depends on the contract. So you can sign the contracts from 1 day to 100 years. So there are no limitations. Plain vanilla swaps. Plain vanilla swap, you can just simply exchange the interest rates. If you just see interest rate in which one party pay a fixed rate and another party pays a floating rate, both payments are in the same currency. So this is how you can just settle it out. So we have already discussed this one, right? But there should be something, a base to compute benefit, and then you can exchange interest rates continuously. Means every quarter you can just exchange until that expiry reached. Then there is a one more contract, which is a credit default swap. Credit default swap is nothing but, let's say it's like an insurance contract against the default, a type of credit derivatives in which the buyer makes a series of regular payments to the credit protection in a seller. And if the underlying issuer defaults, the CDS buyer receives a payout that can compensate him and her for the financial loss from the default. So this, I would say, CDS, it's like your insurance. And CDS, the LIC of India is allowed to sell the CDS, as well as in US AIG, America's insurance group, AIG, which is allowed to sell the protections in the US. So it means in every country, the insurance companies are only allowed to sell the protections. Okay. If we have, let's say, Project A with the worth of rupees 1 lakh. The value of project is 1 lakh. But you are worried about, if something happened, so it would be your loss. So how you can protect that project A? Let's say project A is very critical or crucial for you. If something happened to the project A, it will lose, your asset. So how you can protect to your asset? So we cannot say, buying insurance in this derivative space, we'll call it as a CDS. So we can buy CDS. If the project value is, let's say, 1 lakh, maybe you can pay 100 rupees or 50 rupees, whatever it is, for per month. To whom you can pay this, regular premiums to the LIC of India. All right. And if something happens, so you don't need to worry about it. I have got you covered. So it means if something happened to project A, so this company will compensate that, losses with you. So let's take a hypothetical example. So what happened? You invested in project A. It was very crucial for you, but due to XYZ reason, now project A collapsed, right? And you have incurred some losses of around 80,000 loss. So you don't need to worry about at all. Just submit the project details and everything to this guy. It's like an insurance, as I said. So this guy will process you your payout, which is 80K. right? You have a loss in your investment 80K, but on the other hand, this guy will process you 80K along and you will have a remaining amount of also in project like 20,000. So 80 plus 20, still you have a value of 1 lakh. So you don't need to worry about at all. But yeah, your loss would be like the premium which you have paid it, because premium which is non-refundable. All right, premium which is not refundable. If you pay premium, the premium which is non-refundable, so your entire premium, that will be your loss. If something happened, then only you would be in profit. If something, let's say, doesn't happen at all in future, then that whatever premium you have paid, which is irreversible, so it means it will not receive any penny to you. So it is your loss. So while selecting CDS, always look for a risk. If you really have a risk in your project, then you can look for a CDS. If you don't have a, let's say, risk in your project, then don't buy any insurance contract as such, because it is not worth to buy it. So again, let me just summarize it. If you're a businessman and if you're dealing in real estate, or if you're dealing in any fixed income securities and all, so you should look for a CDS. As an investor, if you have invested in, let's say, fixed income securities like bonds, then debentures, then in that case, you can try to buy some protection like credit default swaps, because if something happened, then at least, see, if you buy a premium, definitely that will affect on the profitability, because premium, which is a loss for you, correct? But it will also help you to protect your investments in case of default event or against any bankruptcy and all. So smart investors, they always buy a protection. If you want, you can do it. In India, LIC, because LIC is the government company. The government companies are only allowed to sell the protections. In US, the AIG group, America's insurance group. In UK insurance company, which is allowed to sell this out. Only government approved or government entities are allowed to sell the protection in case of event. The rest, they are not. Private insurance companies, they are not allowed, because it is very risky for them. See, if we can go and check the 2008's Great Recession, you can see, just because of CDS only, that entire world was in, you can say, entire world was in this Great Recession, because the AIG group aggressively sold out insurance protections in the market. And then on other hand, companies like Lehman Brothers, or there are other companies as well, so who sold the securities in the market without even worrying about that, what if the default event happened and all, because they thought like, I have purchased insurance, now I can do anything whatever I want. It's like, let's say you have purchased a new car, and again you purchase a insurance as well, and you decided to drive your car roughly on a highway. Just imagine that if you drive your car with the 140 or 50 60 speed, so there are two ways. One, maybe your car can ram to any other other cars, or maybe other vehicles, or maybe you'll collapse it. But something happened to you, of course your insurance company is there. So this is how actually change the mindset, means actually that CDS changed the mindset of the big companies, and they sold out securities and loans in the market very excessively, and that led to the 2008 global recession. And the final result was the Lehman Brothers collapsed. Now we don't have a Lehman Brothers in the market. That bank collapsed. Same example, if you see recently, your Credit Suisse collapsed, right? Too big to fail. So this is how it happens. All right. So let's go ahead. So this we have discussed it, but in a technical way, how it works. So you can read this: a type of credit derivatives in which the underlying is the credit spread or bond. So if you have investments in bond, you can just buy this out. The spread is the bond yield spread relative to a benchmark. A bondholder typically pays a premium. It's like a call and put option, guys. Okay, it's like a derivatives that put and call options to be compensated if the bond's credit quality decreases. and the bond holders chooses, the strike level of the option. So when bonds credit quality decreases, its yield against spread will increase, and at expiration of the call option, if the yield spread is above the strike, then bond holder will collect the payoff based on the difference, and this payoff compensate the bond holder for the drop in the market price of the bond. So in short, this credit, default swap, it's like your call option and put option. Simple. All right. Because in a call option and put options, what we do, we pay the premium, right? We pay the premium to get the rights, buy rights or sell rights of an assets. So same way here, in exchange of risk, we just purchase the this protection and pay the premium to the company, means LIC company. All right. So if we talk about interest rate swaps, swaps in which underlying is an interest rate only. In a credit derivatives, a type of contingent claim derivatives that pays a compensation to the holder in the event of downgrade or default by the underlying borrower or issuer. In a credit default swaps, what we do, we pay the premium, and if something happened with the assets, so insurance company will pay your claim. Okay. So in case of forward contracts, an agreement between two parties in which the long agrees to buy from the short and underlying assets at a fixed settlement date for which the price which is established at the start of the contract, and most forward contracts are custom contracts. See, if we talk about future and forward contracts, future contracts which are listed one on a stock exchange. But if we talk about forward contracts, they are not listed one. Okay. The contracts, they are not listed one. It's just a contracts which you can sign through your papers and execute the contract. But the base would be your future contracts only. For a pricing and all, we always refer the price of a forward future contracts to calculate the value of forward contracts in the market. This is a forward contracts valuation. It's a very simple one. So you don't look at this ES, EFT, that creates lots of confusion. So we'll walk you through simple thing. See, first talk about the settlement of the forward contracts. How we settle the contracts, settled. We can settle the contracts in even physical assets as well as in a cash differences. But if you settle the cash, if you settle the let's say forward contract in a cash only or a differences, I would say, in that case, that contract you can call it as a non-deliverable forward contract. So it means you are not going to deliver any assets to anyone. It's just to settle the contracts in cash difference. And that's what most of the people, they prefer it. So you don't need to, let's say, even if you sign, let's say, 100 crore contract, your liability would be only 1 crore or 50 lakhs or around somewhere, max to max 1 or 2 crores. Your liability won't be like 100 crore or 200 crore. So that's what they sign it. So it means if you have a 2 crores, then you can sign the forward contracts of, let's say, 100 crores. See the profitability and ratio and everything. And if you're ready to take a risk of 1 crore, then you can sign a contract of 100 crore even. So that's how we can leverage out derivatives, as per your risk taking capacity. And in case of deliverable contracts, see the most of the oil companies, gold companies, right? And even in a stock market also, like bonds or equities or even dollars, we always ask for a delivery as well. Delivery, it means, let's say if I have purchased, let's say XYZ, bond at X price, and let's say after 6 months, if that price changes, still I'll pay the price which I have, let's say, agreed 5 months back or 1 year back. Only I'll pay that price, not the current market price. Okay. So this is how your forward contracts works. So read this one. So on the settlement date for a forward contracts, the difference between the contract price and the spot price is calculated. If the spot price, it means current market price. If the spot price is higher than the contract price, then short has to pay the long. So it means seller has to pay the buyer the difference amount. And conversely, if the spot price is lower, then the long has to pay, means buyer has to pay. Longer it means guys, buyer, okay, has to pay the short the difference. So let's look for that. So this portion, if you see this one is the part of deliverable. So here in the deliverable, actually parties that are delivering product to buyer. The price is 50, but in the market price is 45. Spot price, it means, guys, it's a here if you see actual market price of the security is 45, but the contract was signed for a 50. So that's what this guy is delivering, the assets, selling the assets. And this guy is actually buying assets by paying 50. So eventually, who is in profit? Of course, seller is in profit of 5. Yeah, if we talk about the future price, the agreed upon price of the future contracts, the long is required to pay this price to the short for the underlying assets at the price on settlement date. So always see, in terms of valuation of a forward contracts, we compare the price of a market, securities or market contracts, I would say, because see, in terms of equities and all are the listed securities, right? So you can easily check the prices of securities in the market. So same prices you can refer to compute the value of forward contracts. So what about forward rate agreement? Forward rate agreement, which is a contract to borrow and lend money at a certain rate at a sum in a future date, usually require one party to make a fixed interest payment and the other party to make a floating rate payment. So determined at contract expiration. LIBOR is now ceased, so we don't have a LIBOR. LIBOR stands for London interbank offered rate, but now they have a different rate, which is SOFAR something, SOFR and SONARS. So they have a different rate, sterling overnight risk-free rate. And future contracts again, it's an agreement between two parties in which long agrees to buy. I believe we have discussed that. But in the future contracts, you can see the central parties which take care of everything. In stock exchange, work as a central counterparty and take care of that settlement of contracts and everything. So this is how you can differentiate between your future contracts, futures, options, and even credit derivatives. In a credit derivatives, options and futures, see, stock exchange like NSE and BSE plays very crucial role because they work as a clearing agent. All right, they'll have a standard contract, central location, deal with clearing house, standard contracts, and which is highly regulated one. And if I talk about, let's say, over the counter, forward and swaps both comes under OTC, over the market. So it means it's a customized contract. Buyer and seller, they can directly sign contracts. Buyer and seller, they can directly sign. They don't require any exchange at all. No central location. Deal with anyone. And custom contract, it means you can see different terms and condition with different contracts. All right. It is an unregulated market. So this market is basically highly unregulated. So there are no regulations at all. So you can see, anyone can buy with anyone. So you can define terms as per your own, comfort zone. So that's how you can sign different terms. All right. So forward and future, if we just differentiate both the contracts, as I said, future contract is the advanced version of forward contracts only. But the reason is here, the future contract is listed on a stock exchange, so price and everything which could be easily available, and you can buy and sell. But if we talk about forward contracts, it's non-standard contract. It means you can only sell it out with your parties only. If you have purchased from A, you can only sell it out to A. So you cannot sell it out to B or C because there are no central counterparties. Central counterparties, it means marketplace like NSE and BSE, because NSE and BSE both are marketplaces. So which you can buy and sell your securities easily. Okay. So here direct between buyer and seller. So it means they can directly deal with each other. But in case of future contracts, so they don't exchange directly to each other. Basically, they directly buy and sell securities, buy and sell their contracts to the NSE and BSE. NSE and BSE, it means BSE stands for Bombay Stock Exchange, NSE stands for National Stock Exchange. So they buy and sell to the NSE and BSE only. So they don't directly buy and sell to each other. So that's how you can differentiate. Okay. Yeah. So let's take example of forward contract as well, how it looks like and the possibilities of forward contracts. See here, if you see, let's say you're at a farmer side, okay, and the price of the rice, whatever, let's say, so it's a beverages company, all right. So the price of coffee beans, which is 500 rupees per kg, the beans price is 500 rupees per kg. If you enter in contracts, like let's say 3 months from now, if you have decided to just enter in contracts for next 3 months, and after 3 months you want to execute this contract, okay. So simply you can find someone who is ready to sign contracts with you, sign a contracts, define the quantities, let's say 10,000 kgs, and hold for 3 months. So after 3 months, so this would be your current market price, so which is basically spot price. Means after 3 months, let's say the price which is at 480. So here you can see the difference of 2 rupees, right? Difference of 2 rupees. So net, the exchange of cash flow would be 10,000 quantity into 2 rupees, which is a 20,000 rupees, right? So this could be your loss, profit, or maybe no loss, no profit. So now you should, let's say, take a first side. Let's say if you are a buyer, or if you wanted to buy this out because your research was like this price may go up, like maybe 505 or 5010, right? This was your expectation, but eventually what happened? Price dropped by 2 rupees. So it means as a buyer, if price drops, guys, that would be a loss. And as a seller, if price drops in the market, then again that would be a profit. As a seller, if price increase of any products in the market, then that would be a loss. So simply the equation is, it's a very simple. Now let's take a hypothetical situation here. If we talk about the flow, there would be three possibilities, guys, right? One is current market price after 3 months we are talking about. Contract price was 500 and current market price after 480. So difference was 20. So 20 into 10,000 quantity. So it's 2 lakhs. The difference is 2 lakhs. So now there would be possibilities, let's say. The first possibility is after 3 months, what will happen? Current market price, which is 480, and contract price is 500. Okay. If you are a buyer, then you are in a loss of 20 rupees per trade. If you are a seller, right, you are in a profit of 20 rupees. Correct? This is the first case. Second probability would be current market price, right? Current market price, let's say, which is at 520 and contract price, which is at 500. So it means if this is the case, then as a buyer, you can make a profit of 20 rupees per kg. Seller will lose the money, which is 20 rupees per kg. And the third probability is there is no profit, there is no loss. So it means current market price after the 3 months, which is same like 500, and the contract price of the contract is also same, which is 500. So contract price is 500 and current market price after 3 months, let's say, which is the same like 500. So zero potential profit or loss to both the parties. So it means this is the case where no loss, no profit. And if there is no, let's say, possibility of, the difference in price, then you should not sign any derivative contracts. It is just a wastage of time. See, even if you made a losses, that's fine. This is how the market works. Profit, loss, profit, loss. But if there is no opportunity to make a gain, then you should not sign any derivative contracts. It is a game of probability. Derivative market, entire market, it works on probability. If there is no possibility of, let's say, gain, then we should not sign any contract as such. So this is all about option, but options we have already discussed. No, don't want to. Call option, right to buy, put option, right to sell. And call option again, right to buy, right to sell. So you can buy, sell. So this, if you see the premium, this would be a premium, we'll call it as a premium, but this portion we have already discussed. So I don't want to discuss the same thing again. Yeah. So there is one more term which is arbitrage. Okay. See, arbitrage, it's an opportunity to make some profit. Let's say there is a Wipro stock or any company you can say, or KPIT. KPIT stock price, which is in market, is 1,000 rupees per quantity. Okay. And in a future market, future, it means in future, maybe in 1 week or 2 weeks, price of shares will rise, and that would be somewhere around 110, maybe in 1 week. All right. So what you can do, you can buy shares today at 1,000. You can sell tomorrow at 110, and you can make a profit of around 10 rupees. So this profit, you can see that it's an arbitrage opportunity. And this opportunity you can see between two stock exchanges as well. Sometime what happened, let's say same company stocks trading at, let's say, X price on BSE and Y price on NSE. Maybe you can understand in a way that, let's say Wipro shares trading on a BSE market at 100 rupees and on NSE, which is 102. So you can see the difference of 2. So it means you can buy shares from BSE market and you can sell in NSE at 2 rupees different price. So this is all about arbitrage opportunity. Okay. So arbitrage always look for an opportunities. If there is no opportunity, then arbitrage, they don't place any trades as such. So they always look for an opportunities. All right. Yeah. So here you can see the swap contracts again through presentation in a better way. If you have a swap contracts, so every quarter or every month, every year, you can settle this. The difference is only this guy is like, I have to pay 50, I have to pay 40. But the important is party with the greater liability makes net payment to other party. So instead of paying 50, so just pay simply 10 plus 40, it would be 50 only. So nobody pays the entire amount. Okay. So exchange a series of payment on a periodic settlement dates over a certain period. See this. Let's take an example how your forward contracts works. Forward and future both are same contracts. The difference is, guys, future contract is listed on a stock exchange and forward contract is not listed. Okay. But entire framework like price and everything that we always consider from the future contracts only. Let's say here contract initiated, the price of security which was at 50, maybe USD, rupees, whatever currency that you want to take it. So I'll buy the assets from you at 50 on settlement date. So it means here the security it will purchase out. Or maybe difference of securities it will settle. Again, short it means seller. Seller is agree with, okay, I'll sell the assets to you at 50 on settlement date. So both can sign a contract. So on settlement date, let's say there is no change in price, contract price and future price. Future price, both is same. So it means there is no difference. If there is no difference, no parties pay anything to each other. So this was just wastage of time for both the parties, because on settlement date, the price of security, it was same. See, sometime what you can see, let's say maybe the security price, let's say, changes like this. Maybe from, 50 to 40, like this. But at the time of settlement, price reached to this. Let's say someday price reached to 60, 48, maybe 38, but on settlement date, price reached to only 50. So we'll consider that price only for a settlement of a contract. All right. will consider this this future price only to settle this out. So this is how your forward contracts actually works. All right. Now, if I talk about here, you can see the another example, let's say, of forward contracts. Contract initiated at, if you see this price, contract price 50. All right. And at the time of settlement, on settlement date, because settlement date would be a future date. So on settlement date, let's say price reached to at 60. Maybe let's say price started from this level, security prices, and reached to here somewhere. Because this price will consider it for a settlement. So here you can see the difference of 10. As I said, as a buyer, if price goes up, that would be a profit. As a seller, if price goes down, then that would be a profit. So in this case, price goes up, it means buyer made a profit of 10 rupees. Buyer made a profit of 10 rupees. All right. Then if we talk about the another example, let's say how seller will make a profit. I have it. Let's see. Contract initiated at same price, 50, but at the time of settlement, right, price reached to at 45. So here you can see the loss of loss. It means as a buyer, it is a loss of $5, and seller made a profit of $5. The reason is price come down at 45 from 50. So this is how you can, understand this contracts. It's a very interesting one as well. But there is a one factor in future, so which is a margin. So margin works with your price, guys. Margin is nothing but margin. It means whatever amount that you have paid. Let's discuss about margin. So in a future contracts, we actually pay some margin. So we should discuss that. Let's say if you have decided to buy assets, any XYZ assets, and that asset price is 100, means as per current market price data, price is 100. Okay. So at the moment, let's say 10% is required. 10% is required. 10% it means your contribution to buy these assets. Means if you want to buy 100 rupees worth of assets, so you just need to pay at least 10, right? Or 10% of these assets. So let's say which is a days price. Sorry, 10, 9, 8, 7, 12. All right. So if you see, let's say stock price, it was at this price. Okay. And then you just paid 10% of this price. What if, let's say, this price, you are like buyer in this case. Okay. You bought the stocks by paying only 10%, because 90% it was paid by your broker only to acquire these assets. Now, this price moves, let's say, from 100 to 90. So now you tell me, if the price, let's say, come down from 100 to 90, right? So if you just calculate 100 plus loss, you will have to add like this, because 100 was the actual price of the assets, and there is a loss of again 10, right? Loss of 10. So it means 110. On 110, you will have to calculate 10%. So just calculate it. So you need a margin of rupees 11 in your account. Why? The reason is, see, broker and you paid means 100 rupees, right? Broker paid 90 and you paid 10. So your 10, it means you paid actually 10%. See, your 10%, it should be always, that balance maintained in your account. Due to price changes, if you see, affects in the quality quality of assets, or if the price, let's say, changes continuously, then you will have to continuously add margin to the accounts to ensure that your 10% percentage which is maintained. So it should continuously update. Continuously, it means continuously. So it is a very mandate. Okay, and it happens. So if we just see the example here, same thing you can relate. So the difference is, let's say, long positions you have taken, which is at 100, right? If the price moves from an initially margin that you have paid is 20, margin maintenance, it means if the margin goes the below the 10, then your position will be square off. So it means you need to refill the margin again. So it is a mandate thing for everyone. See, price changes. If you see, price changes from this 90, it was not 90, I believe it was 100, 110. If the price changes from 110 to 76, so here is the loss of 41, right? And same, if the initial margin was again 40, then your 40 margin would be at 0 directly. The reason is you paid only 40, but same day there was a loss of 40. So your margin and loss, which is equivalent. So it means, so you lose the control of that collateral or assets. So if you want again the control of that asset, so you will have to pay again 10%. So this is how you actually margin games works. In a margin is nothing but you are just paying 10%, 20%, whatever it is required to hold the rights of that assets. But make sure that as a buyer, if that asset is in profit, then only you can make a money. If your asset, let's say, which is in a loss, then you cannot make any penny from this particular contract. So you lose your money as well as margin as well. See, broker, see, the point here is it's a game of money market. Okay. Broker reach out to the banks. The banks like who are dealing in this liquid assets, or who are dealing in this very, the money market segments. So those banks quickly provide funding to that counterparties. It's a money market fund only, because it's a broker sponsored entities. They enter in this contract. So basically, broker reach out to them quickly through their private network and ask them to look, we have a securities, and if you are ready to pay, then pay it. So we'll take the control. So it means broker take the control of that collaterals, and banks provide funding. So in this particular transaction, see, it's a win-win for everyone. Broker make the commission, banks receive the interest payment, because on loan, it's a loan only, guys. It's a loan amount that we have, means we are taking loans from the bank, and bank pays interest payment. In last session only I showed you, right? So bank pays or charge interest payment to us, correct? So the interest payment, they charge interest payment. It's for see the duration of the contract. See, the short transaction contract should be at 1 year. Within that 1 year you can execute it, but future contracts has an expiry of monthly. So every month your future contracts will expire and settle in your account. And if something happened like plus minus, broker always keep an eye and they directly execute the contracts. They don't wait actually, for your permission and all. They directly execute the contract. It's a risky as well. One of my friend last month only, he got a call from the broker to purchase the HAL, which is future, and he purchased it. Even I told him, do not buy, because already stock is at a very high level. So don't buy it. If you want, you can buy it in a spread. Maybe you can carry any put option of HAL So he said, no, I'll just buy it. I got a call, so I have a surety. And then now he's in loss of 5 lakhs because he purchased the future contract at the time when the price was 5,500 or 600 something, and now current price which is at 4,400 something or 500 or 600 something. So almost 30% loss which he has in the one lot, you can say. So it's a very difficult. I mean, it's not easy to manage the margin and all. If you have a sure shot only, then you can make a money. Otherwise, you cannot. Yeah, there are people, who actually hedge their futures as well. So it means, options we need, low amount, which is premium. So you can pay that premium. I advise him at the time only. So if you are looking for a buy option, then do not buy directly. So make sure that, you are buying the other position in swaps so that you can hedge. But they never listen sometimes. So we can't do anything in that case. Now he's in loss, so he was saying, now what can I do? I told him, now you can't do anything, just book the losses if you can and wait for another opportunity. This happened, right?
Just a quick info, guys. Intellipaat offers an executive postgraduate certification in investment banking and capital markets in collaboration with IIM Ranchi. Through this course, you will master key skills like financial modeling, valuation, mergers and acquisition strategies, risk management, and even niche areas like private equity and wealth management. The program features 80 plus live sessions conducted by IIM Ranchi faculty and industry experts, real world case studies, hands on projects, and a 3-day campus immersion at IIM Ranchi. Plus, you will also get exclusive benefits like executive alumni status from IIM Ranchi and complete career support from Intellipaat. We have already helped thousands of professionals achieve successful career transitions in the finance domain, and you can check out their testimonials on our Achievers channel. The link is in the description below. And for sure, this course can set your career to new heights. So visit the course page link given below in the description and take the first step towards the rewarding career in finance.
Our main focus would be on different types of, the fixed income securities like bonds, ABS, MBS, or all other different, securities. So we'll try to decode that in details. So let's see how it goes. See, if you talk about, let's say, same example first, if assumption is if we have understood this process, like how we create a securities, how the issuers actually redeem that particular securities, or maybe how create securities and all. If you have understood entire this process, then you can easily understand the different aspects of fixed income securities also. All right. So let's talk about all other factors. Let me start with that. So let's say same. I'll continue same example. ABC Corporation. Okay. First, let me chart out the terms. What was the terms? Terms of financial instruments. Terms were like face value, right? Then your interest rate, then maturity, right? Options. This one is very important one. And frequency of payment. Frequency of payment. So there are the basically terms, okay? Terms of a bonds. And as we know, as per our example, if I continue the same example as per our example, so we'll refer the data of this one, right? This one. Face value was, I believe it's 10,000, right? Then interest payment, it was 10% for per annum. Let's say maturity date 2030. Options maybe at maturity, or let's say it's a redemption. It's a simple. We'll take a simple example first. Redemption. Frequency of a payment, which is annually per annum. So interest payment, it will process out every year, right? So basically every year will process payments to the borrower. So this is how your investment terms are. Okay. Now, first try to understand this, the process, how it's actually happened. If I now talk about, the schedule. So let's say this is for 5 years, right? So 2000, 25, 26, 27, 28, 29, 30. So here your bond will mature. Okay, this is your schedule. So we have a two legs. One is principal. We have two legs. One is face, then issue price, or this one is, you can say, it's a face value, and another one is interest payment, interest payout. Right. See, interest payout, again, another assumption is this is a fixed one. So this is a fixed one for entire cycle for next 5 years. At the time of issuance of a bond, right? At the time of issuance of a bond, if let's say company, let's say investor is here, okay. So we'll create a same, means at the time we'll create a same two sides, so that investor, company. Here we'll maintain the data for investor. Okay. So one side that we have investor, and second side that we have a company. So here I'll help you to get clarification of many terms in one chart, right? See, if the company issues, the bonds, face value of a bond is 10,000, and same price if company issues at, the same price, which is 10,000. So that becomes your par situation. Bonds issued at par. Why? The reason is the issue price and your face value of a bond. So face value, basically it's a redemption value, right? Face value becomes your redemption value. If company issues this at the same price, right? Same price means issue price and face value. So that becomes the bonds issued at a par value. This is the first condition. Second, again, the same bonds, let's say face value of a bond is 10,000 and actual bond issues in the market is 9,500. So this is the case of bond issued at a discount. Bond issue at discount. Now your question would be like, sir, why sometime bond will means company issue bonds on discount? See, this investing is a game of, guys, demand and supply. Okay, what if, let's say, you have decided to issue bonds in the market, but there are no enough investors or demands to your bonds in the market? So then ultimately it will affect on the bond price, right? It will affect on the bond price. So it means company will reduce the actual issue price and offer some discount to attract the attention of investors on your bonds. So that's how companies, they basically plan the fixed income securities event in such a way, right? So see, they always try to make it grand. It means they'll spend amount, they'll ensure the marketing and everything, so that they can invite more and more people to avoid discount on assets. Because if any company is offering discount on assets, so it means it's not a good for that particular company, guys. It's not a good for that particular company. The reason is, whatever difference that you can see, which is another 500 rupees different, it's a liability eventually, and that company will have to adjust it. See, in this case, the amount is small, which is 10,000. 10,000 minus 9,500, the difference should be 500. So it might seem okay, this 500 difference is very small, but if you look at, let's say, the company wanted to issue the bonds worth of rupees 1,000 crores, but due to market demand or XYZ other factors, company was not able to sell out bonds in the market. And definitely company will plan something and offer a discount on the original issue price. And once company, let's say, announce discount on original issue price, then that's actually a liability for the company. So it means company is not sure about the demands of the bonds in the market, and that's what company decided to announce discount. And discount is not a good for a company. Now your question would be like, sir, if I think from an investor perspective, of course this discount is good for us. Yes, agreed. Discount is good for investors because he will receive this at the time of redemption he will receive full amount, but at the time of investments you're paying 9,500. So every year your benefit would be if we talk about amortization, one more term is, sorry, accretion. So if you calculate the interest payment, just calculate the interest payment for per annum. An interest payment company will have to process on face value, not issue price, right? 10% divided by 100. So every year, company will have to pay 1,000 as an interest payment and even accretion as well. Accretion, it means difference between original in a face value and issue price. So in this case, there is no difference. So company don't need to pay it. But if in case of, let's say, discount, in case of discount, so along with interest payment, company will have to pay 500 divided by 12. So 100 extra, 100 rupees extra to the investor. So it means every year investor will receive, accretion is the income for investor, okay? Investor will receive 100 rupees as an accretion, 1,000 rupees as an interest payment, and face value, which is again the actual investment's price. But in reality, investor only invested 9,500. So here investor is in profit with this, second scenario. If you just look at with this, so investor is in profit. But if I talk about the company's perspective, the discount is not a good. The reason is we are paying higher liabilities. Correct? I hope you get this. So one condition we have discussed about issue at par, another one is issue at discount. But I explained that, see, discount, which is not a good for company, if any company issues, the discount on their bonds capital. Then apart from this, there is a one more type that you can see, which is issue on premium. Now, when we say premium, it means here, guys, it's something, the actual price of a bond is 10,000, but due to high demand, so investors, let's say in an IPO event, what happens? If the company is really good, then more investors, they submit their interest or applications. So on the basis of interest or applications, company process subscriptions or allotment, I would say, and then you receive your equities or whatever securities that you have purchased through IPOs. Then you receive your benefit. Am I right? So same way, if you just plan it out, your means fixed income issue process. All right. For example, let's say 10,000, which is the actual price of means redemption price or face value of a bond. But in the market, due to high demand or high, let's say, the request where company have received from the investors. So in that context, the actual issue price, it could be, let's say, 11,000 or maybe let's say 10,000, whatever. It's just a hypothetical example, right? So in this case, if we talk about the benefit of, see here in this case, see, by default company will have to pay interest payment on this amount only, not the issue price. See, company or even investors, we both calculate interest payment on face value. Okay, so don't get confused. So always we calculate interest payment on a face value, not the issue price. Okay, so now if you look at this particular means third scenario, issue on a premium. So this is the case where investors paid higher expenses, right, which is around 1,000 extra than the market price. And if we think in a very different way or a very practical way, if you see, investor is not generating single penny of interest payment for a first year. Why? The reason is, here if you see, face value of interest payment was 10,000 and we have purchased, means as investors, we have purchased at 10,000. So actual investment value was 10,000 and we have paid only 10,000. So it means it was a win-win situation, and the interest payment for 2025, we have generated around 1,000. In the second case, of course, it was an additional benefit of 100. 100. The reason is there was a discount on bond price. But in the third case, if you see, we have paid 11,000, so which is 1,000 extra to acquire the assets worth of rupees 10,000. Worth of rupees 10,000. So it means we have paid extra amount, and that is something, it's a loss of investor, which is 1,000. You can say loss, or maybe it's not a benefit actually, and which is 10. And now if you just calculated the benefit, the interest payment which will treat as a income, right, for investor. So it's income. If you have an income of 1,000 and also you have a loss on investments of 1,000, so it means in terms of income, in the third scenario, investors, they are not able to generate any sort of income. Now your question would be like, look sir, see, in equity still we can understand, in the secondary market, that we can pay higher amount and we can purchase securities. But in a bond market, how can we pay higher premium? See guys, in every market, there are big players, there are big investors like insurance companies, right, fund businesses, family businesses, mutual funds. They have a huge appetite, and when they buy or enter in any securities, that automatically security prices will go up. Automatically share price will, or stocks or bonds prices will increase. And that's what you can say in a in a market. If you have a high demand, basic equation is high demand, high price. It will lead to the high demand, stable supply, increase in price. So basic equation. Then low demand, stable supply, decrease in price. Instead of stable, you can also see that high supply, because this is a game of demand and supply, because your price is purely based on your demand and supply. High demand, high supply, high price. Low demand, high supply, again low price. High demand, stable supply, or let's say if the supply is very low or even constant, in that case also you can see increase in price. And same thing happened with here as well. So at the time of security issuance event, if company receives lots of the applications, and if there is, let's say, high demands, interest if they have received, ultimately it will affect on price, then company can increase the price. All right. But so let me just tell you some other background as well, in which case company can charge higher fees than the actual face value. If bonds are highly rated, like AAA, or let's say AAA or AA or A plus, in that case only it's a possibility that company will receive premium on bonds. Otherwise, in 99.99% cases, investors, they don't pay premium on bond investments. They always try to prefer invest at a par, or maybe invest on or at a discount. Invest at a par, or maybe invest on or at discount. This is the basic one. And in 90% cases, this happens. But in an exception where, as I said, if the bonds are triple rated, now your question would be like, sir, what is this rating? And where, where we can see the linkage of the rating in this fixed income. See guys, in a fixed income, with a fixed income instrument, every year or every quarter, I would say, the valuers of the company, they perform the valuation. So we have seen this here, right? So the valuer, this guy performed the value of company's balance sheet and everything in details, and assign the rating accordingly, whether companies are stable or not, whether companies in the strong position or not to repay the debt and all. So they basically check everything. Everything means everything, and accordingly they assign ratings. So once they assign ratings, if the rating is triple A or A plus or AA, so it means it's a clear indication that they have a strong business growth, revenue, profit, and everything. So their entire debt is covered, and they are at a very sound position. So it means they can repay their debt at any point in time. So their capacity is okay. So when we talk about this discount, if company, let's say company's rating is below the B rating, right, below the B, maybe C or B, I would say, or even D, in that case, it's a clear indication that companies, the asset quality is not at a good position, and that's what investors they are asking for more and more discount on investment, or I would say discount on assets. So this is something which is a difficult zone, I would say. If the ED bond is rated, A plus or triple A plus, here definitely you can see low interest rate. Low interest rate. Here you might see high interest rate, but the risk of investing would be very high, right? Very high means very high. Let's take an example of Byju's. Byju's was struggling to raise funds from the market. Am I right? Now, if Byju's want to raise funds from the open market, no investor will purchase securities at face value or par. No means no. 90% cases, investors will ask for a discount from Byju's on their asset. But on the other hand, what if, let's say, if government of India announce bonds, I'm sure in 90% cases, investors will not ask for a discount. Instead of that, they'll pay the premium as well. Premium, it means higher amount than the face value. Why? Because they have more trust on Indian government and even stability also. So their investment should be safe and secure. All right. So yeah, this is it. And if we talk about, let's say, par, which is again, which is kind of, let's say, companies which is at a stable or win-win situation, I would say. In that case, investors, if they feel that the valuation of the bonds is fair, in that case, face value and issue price would be in the same line. And here the rating of the bonds also that you can expect is maybe BB plus or even A plus. It depends on the rating agencies, their label or bandwidth, how they rate the particular securities and all in the market. Now, another question would be like, look, sir, who assigned this rating? See, in a market, the prime brokers like JP Morgan, Goldman Sachs, then in India like CRISIL, right? Again, the prime brokers like UBS, CLSA. So they always do some sell side analysis of securities and publish the reports in the market, because all our broker or banks always they work at sell side and they publish the reports. And the mutual funds, insurance companies, and provident funds, they also perform the reports and assign rating to that assets. All right. And all insurance companies, provident funds, retail investors, mutual funds, universities, they come at buy side. They also perform the report. And on the basis of that, they assign rating to it. But if you are new to this industry, again, you will have a questions like how it works. See, guys, if you know, at the time of, let's say, credit card application process or a home loan process or personal loan process, the credit agencies like different we have a credit agencies where they check the CIBIL score, right? And if the CIBIL score is above the 700 or 650, then we consider that that person is at a stable. If the CIBIL score is more than 900, we assume that that person is very strong. And if the CIBIL score is below the 500, so it means that person which is at a very critical level. So how that particular CIBIL score that companies derive and how they come to at 700 point, 500 points? Because see, for a CIBIL score, it is the study of individuals' incomes and expenses and other obligations on the basis of your personal obligations like pay in and pay out for a particular month. So they actually calculate the capacity. For example, let's say if your income is a salary, individual in a person's salary is 1 lakh, and total expenses, including means everything, which are 50,000, your net income is 50 in this case, correct? And if this income, let's say, if you are able to saving in maybe stocks, bonds, whatever it is, so it means you are at a very strong position. Why? You are able to save your 50% of your income. So on the basis of this data, if I assign rating, of course I'll assign rating like more than 900. Why? Even if you apply for a loans of 20,000 per month, still you can manage that, right? You can adjust the loan amount, which is, let's say, 20,000. Still, it will have a total net income 30,000. So it means you have a positive cash flow. This is the clear-cut example of positive cash flow, and that's when I can rate highest side rating. But what if, let's say, your total income is 50,000 and total liability that you have along with expenses and all. See, so instead of net income, you have a loss. So every month your balance sheet is like, or personal balance sheet or account is like, you need a more money. In that case, your CIBIL score would be somewhere around 300 to default. Why? Because you don't have any additional income to cover your liabilities and your credit capacity is a very low. So on the basis of basically income and expenses, the credit agencies, they derive the rate and update in the system. So in the same way, at a corporate level, we means as a let's say different institutions like prime brokers or research agencies, they collect some input or data, and on the basis of that, they assign rating to the fixed income securities. All right. So now look, let's discuss few points from the investing perspective. As an investor, if you want to invest money in fixed income instruments, so you should invest in E-rated bonds because the risk of a default would be very low in an A-rated bonds. But if you're not, let's say, if your priority is more interest payment, right? If your priority is more interest payment, not the safety, then in that case, you can invest B-rated bonds or C-rated bonds. So the possibility of recovery of face value would be very low, but you may earn interest payment, which would be very high as compared to the bonds which will issued on premium. And in case of par, so this is something win-win situation, I would say. And if anyone is looking for like with a moderate kind of risk, but decent interest payment, then you should invest with the bonds with a par value. Now, your most important question would be, sir, where can we check this? So let me try to log in my account if I can quickly to walk you through. So here, see, if we talk about the private bonds, see, there's two deals now we have at the moment. One is government, deals, government gold bonds, okay, with the interest payment of 2.5% per annum, and the another one is the National Highway Authority bonds with interest payment of 7.69% per annum. Okay, so interest payment frequency, if you see, so both the bonds, they have one is means this national highway bonds have a yearly maturity, yearly interest payment frequency, but for a government bonds, you can see half yearly interest payment frequency. So if you want to buy, simply click on buy. You can select the market, buy, sell. Now I want to buy it, so I'll select buy. Quantity, let's say 1. You can select the price, whatever price that you want to select. Then see the terms and condition. If you see, the face value of a bond is 1,000. Maturity amount, so it means at maturity you will receive only 1,000. So basically, this is the case where you can say it's a par value of a bonds. Face value and maturity, both price are same. Okay, but eventually in the market, guys, the bonds is trading at 1110, right? Means 1,110 rupees. So here basically you can see the interest payment is included in the bond price. The interest payment is included in the bond price. That's what the bond price seems like different, but actual issue price and maturity price, if the both are same, so it means there was no discount which was offered by the government of India. It was just a plain like face value and maturity price. But the current market price, which you can say different, the reason is every day interest payment which adds into the bond price, and that would be your updated price for a market. The reason is, see, with all tradable bonds, market always calculate interest payment and add it in the bond price, and that's how the bond price and actual means face value of a bond price or maturity price, that looks different. So it means the interest payment is included in the bond price. There are other platforms as well, like Bloomberg and all. Bloomberg bond interest screenshot example to look over. So here also, if we see the principal amount, see face value of a bond is different, or which is we have separately recorded it. Bloomberg provide that information for all fixed income securities, and the accrued interest of a bonds for 11 days. You can see differently we have calculated, but the total value, if you see, which is around 10 lakh 292.22, and this is something your tradable price. So if you want to buy a bonds at this price, so instead of 9,88,000, you will have to buy a bonds at 10,292. Did you get this? Why? The reason is, so eventually the the accrued interest payment, it will be adjusted in the bond price, and if someone buys that bond, so buyer will have to pay interest payment. Buyer will have to pay interest payment along with the principal value. And again, understand this one, another term. So that, if you see, if as a buyer, if you are paying interest payment to buy a particular bond from the another buyer, so it means, so that bonds become, or that bonds price become, I would say, dirty price. Dirty price. Why? Think from a buyer perspective, we are paying interest payment to the seller along with principal value of an asset. So it means as a buyer feels that it's a dirty. So that buyer is paying interest payment in advance, because buyer will have to wait to get the payments of the interest payments actually from the issuer, because actually issuer pays interest payment, right? But issuer will pay the interest payment at the end of the year. But in between, if you trades in a bonds and sell it out that bonds to someone, right? So someone will pay interest payment to you, correct? So that price become dirty price. That price becomes dirty price, all right? And if you buy the bonds without paying interest payment to the other parties, so that becomes your clean price. So for example, let's say, to understand this one, how dirty price and clean price works, and what is the benefit of that, we'll discuss that as well. So ultimately, along with the term, let's say this is the ABC Corp, issue bonds with 10% interest payment per annum with 10,000, and total interest payment would be 1,000 for 364 days. Okay. So original buyer is, this company is the issuer, issue bonds to A. This person is, let's say, A. This one is B. So originally, let's say, this person invested and purchased the securities originally. So let's say invested in securities, invested in bonds. Take a hypothetical situation where this person invested this benefits, but after 180 days, now this guy is searching or looking for selling of securities. After 180 days, this guy is looking for selling of securities in the market. Now, see, this guy definitely, see, the company will process the payments. Let's say interest pay frequency is yearly. So it means company will process the interest payment at the end of the year. Company will not process interest payment in between the year. Correct. But this guy is looking for a sell of securities after 180 days. Then who will pay the interest payment to this guy? Who will pay? If this guy approached to the company for interest payment, then company will not, bond investment. It means it's a legal document. So you cannot go back to the company and ask for a reversal or ask for a, early payment. You can't do this. You don't have any other options. Correct. So it means you have decided to go to the marketplace. Let's say here, go to the marketplace, send a request to the market, and wait for a buyers. Wait for a buyers. See, if you get a buyers, right? If you get a buyers from the market, and if you directly, let's say this person is interested to invest in your, to buy the particular shares, bonds from you. So this guy, if this guy is ready to buy your securities, but the point is there are two ways. One, if this person buys securities at price of, let's say, only 10,000, then this person would be in profit actually. Why? The reason is, if you just see, as per is, the investments calculation and all, so actual bond price would be 10,000 as a principal amount, right? And interest payment of 180 days would be somewhere around 500, right? Interest receivable 500. So actual bond price is 10,500. But same bond, 10,000, 500 bond, buyer is ready to buy at only 10,000. So it means buyer is not ready to pay interest payment to A. And if this is the case, then we'll call it as a clean price trade. Clean price trade. Why clean price? Because buyer is, see, from the open market, buyer is not ready to pay additional interest payment on price. But eventually, if you see, this guy holded bonds for 6 months or 180 days. So it means, as per the legal agreement, this person is entitled for a 180 days interest payment. All right, 180 days interest payment. But reason is, this company will process an interest payment yearly. So if this person, let's say B, is ready to buy bonds at interest plus this one 500 at a dirty price to pay this amount. In this case, for a B, this price should be dirty price. But eventually, if you just think from a finance perspective, because in a finance, time has a value. Time has a value. If you just calculate your finances as per the time, then you can relate that. So here, this buyer would be in loss. The reason is, buyer is paying additional 500 interest payment to the let's say seller. But this person, like buyer, new buyer will have to wait at least for additional 180 days to get the interest payment from the company. Because after, this 1 year, so it means, of course, after 180 days for this person, company will process interest payment. Company will pay interest payment this guy. Because now the original buyer of bonds is now this guy B. Because see, continuously name of B will reflect once the B execute trades in the system. So company will now process interest payment to B, and B will receive entire interest payment, which is 1,000 rupees. So 500, which is already paid to this guy, and 500, which is the actual interest payment where this guy is already holding, bonds with him. So now I hope you got this. See, dirty price, which is not a good for a buyer, but this is a good for a seller. Why? Because seller has received interest payment, accrued interest payment from the new buyer. All right. And the clean price, which is not a good for a seller. The reason is, then seller will have to wait until this company process interest payment. Then company will split payment to both. So A will have to wait. And in a finance, guys, wait is not good. Okay, wait is not good. Let's say if you hold in a XYZ investments for a 10 years and still you are in a loss. So it means you are in a double loss actually. You are in a double loss. So sometime it is a good to book losses, take the exit and reinvest that money somewhere so that you can again, at least you can take the advantage of time and new opportunity. So same logic you can apply it here as well. So in a finance or in even in a fixed income securities, if you are a seller, of course you will try to see how you can get the entire money, means fixed, let's say the capital which you had invested, as well as the accrued interest which your investment incurred or accrued from the particular XYZ investments. So always we look for that. And as a buyer, if you look at from the buyer side, we always try to buy the assets at a lower price. It means we always try to avoid additional cost. But yes, if sometime if you are not able to, let's say, avoid cost, so that's become your dirty price of a securities. The difference between dirty price and clean prices with interest payment and without interest payment. If you see the interest payment is included in the price, so that becomes your dirty price. If you see if the interest payment is not accrued interest payment that I'm talking about, if the accrued interest payment is not included in the price, then that becomes your clean price. So I hope you get this clarity now. What is accrued price? What is dirty price and what is clean price? So in practicality also means, while dealing with the fixed income securities and investment banks, we always evaluate the certain trades on the basis of dirty price and clean price. So this applies to you as well, guys, to go and check the Bloomberg or the broker system to see what is the price quotations that they are charging to you or to asking you to pay. So if I take this example, let's say, see, this is the example of dirty price. Why dirty price? Can anyone tell me? The actual, see, now if I want to buy the particular, this particular bond, then I will have to pay this price, 1110. So it means I'll have to pay 110 rupees extra to acquire this particular asset. So why should I do this? So why should I pay this? Right? Because actual price of this bond is different, correct? But as per the market, the price is different. So it means in this price, your accrued interest is included. And that's what we'll have to pay a higher price, right? Then let me take a few other examples. If I have government bonds, if you guys want to invest in government bonds now, with ICICI Direct, we have a facility. You can go to the FD and bond section, select the government bonds, and invest accordingly. Recently, government launched series for gold bonds. So you can look for gold bonds. And here you can continuously check the government securities as well. Few bonds, there is no. So apart from that, you can see other bonds as well, private bonds and all. Tata Capital NCDs. This is a deposit scheme. To this IIFL Home Finance Limited. Again, they have a scheme which is offering 12% interest payment for per annum. And interest payout is monthly. So if you have a huge amount like 1 CR, 2 CR, 20 CR, and if you don't have other investment plan at the moment, let's say for next 12 months or 1 year, then you can invest your fund in such a schemes with a monthly payout. But see the maturity as well. So because your fund again, it will lock for maybe 1 year, 2 year, 3 year, 4 years. Depends on the investment scheme, but you see this. Kerala infrastructure, all are E-rated bonds. Structured products not available at the moment. See the corporate bond list. Akara Cap, UP Power Corporation issued bonds. Let me take a decent example to see how it looks like. India Bulls Housing Finance with the coupon rate. If you see coupon rate, it means interest payment. Coupon rate with 10%. Maturity of bonds 26th March 2031. Bonds yield which is 40%, it says. right? Offer rate and all this is not provided. It face value details also not provided. It coupon payment, again, this company will process interest payment in a monthly, which is a good scheme. The reason is if you get a monthly interest payment, so you can reinvest that, right? Get the information of the bonds. Every company, they also publish their investment prospectus as well. The details is not available. Much of information is not available. With the corporate bonds, you can see call option and put option also. We'll discuss that as well, like what is call option and put option with fixed income securities. It's like a derivatives only, but it works little. So these are the securities, guys, with the different payouts and different, other coupon rates and all, and ratings. Rating is important, right? Because if anyone is really interested to invest in a bonds, you can. To ICICI Securities, you can invest. Here the price is given, which is maturity rate and face value. Maturity, it means redemption price, right? And issue price, it means that the time of buying securities from the company will sell the securities to you, at certain price. So that price will call it as an issue price. Face value, it means the actual price of an instrument. Broker to add that out. If anyone is interested to buy this bonds, you can buy several bonds and see. So you can generate minimum 10 to 11% return. 11% which is decent. Okay. If you have a 1 CR capital, then you can earn almost 11 to 12 lakhs interest income per annum. So it means around 1 lakh per month. So every month you can earn 1 lakh. If you have a 5 crore, then you can invest in bonds with a portfolio, let's say, 1 crore that you can invest in highest interest rates bonds. You can 1 crore, you can invest in, moderate, then lowest. So this is how you can diversify your bond portfolio so that you can continuously, with the risk mitigation, you can generate at least 4 to 5 lakhs per annum, per month, and which is a decent. So it means annually, if you generate 50 to 60 lakhs, so that 50 to 60 lakhs you can reinvest it, right? See, even if you do your business, so ultimate goal is to make money. So you can evaluate that certain factors, like if you invest 5 crores in the business, then how much money that you can generate. If you have any better idea which can help you to generate, let's say, more than 10%, then you can invest in your business. And if you feel that, let's say, even if I invest 5 crores in the business, my return, it will not exceed 10%, then instead of doing business, I would say invest in bonds or a different fixed income, securities. The reason is that will give you monthly interest payments, and monthly interest payment, which is fine, so that you can reinvest your money, which is monthly interest payment, in different businesses and diversify your portfolio. Okay. So this is how your clean price and dirty price works. Fixed income security price would be remain same, but due to the interest payment adjustments and all, so that price means you can add the interest payment, accrued interest payment in the price, and that would be your actual price of the that particular bond instruments. See, after paying interest payment price, okay, let me explain that as well. Let's say bond price, interest payment. First, we'll calculate month-wise. Okay, in January, actually in a Feb, means after the January only we'll calculate the interest payment. Let's say in the month of Feb, the actual price and interest payment, it would be at somewhere 100, not 100, I believe. This one into 10% divided by 100. This one, so 80. 183.33. Up to 3 decimals, you can consider the price. So for Feb, your interest payment would be this. For March, price would be 10,083, which is your bond price. It looks in the market. And again, if you add the interest payment for a March, or let's say Feb, in the month of March, that would be, then in the month of April, price of a bond should be this. The interest payment for per month for March month, you can add it. Even if you calculate like this, 83 plus 1000, it goes around 10 to 4. So if you just add this again, it would be that only. Let's say here in the month of, let's say, April, on the 1st April, it was a quarterly payment, let's say, system, and the company paid that interest payment. Means from a company side, company paid that interest payment. So in the month of maybe beginning of the April, you would see the bond price in the market if company process all the accrued interest payment. So it means company, let's say, paid this interest payment, accrued interest payment to the trader. So net, the price which you can see looks like this, clean price. Why clean price? Because the accrued interest for January, February, and March, which has been paid out. In April, this total interest payment, it was, if you just calculate, it will tie with your calculations. Put this into the chart, so it means it will looks like your market chart only. But in the month of April, all this due interest payment, which is 83 for all 3 months, if company process that out, here maybe beginning of the April month, you can see this scenario where the price is 10249, and in the first week of April only, company can schedule a payments, right? Schedule a payment and process that, let's say, due interest payment. And if that process, the due interest payment processed, the chart of that particular bonds looks like this. Say this, it will come to at the same base level. All right, and again for a April month interest payment, it will be generated like 83. For a May, you can see calculations like this, and if I add this. So this is how your chart looks like. And in a stock market screen also, if you just see and calculate things on a proper pen and with in your notebook, so you can relate with the same calculation with the market screen as well. Because whatever the changes that you are seeing in the bond price, those changes are there because of interest payment. Okay. See, in a stock market, what happened? You will see the changes because of capital gain, right? You will see the changes because of capital gain. But here you will see the changes because of interest payment. But that doesn't mean, the bond is actually offering any capital gain and all. Now your question would be like, sir, is it true that, bond will offer capital gain? Yes, bond can also offer capital gain, but that would be very, in a fraction of amount, or maybe due to if something happened in the market with that particular company, in that case you might see big change in the bond price. For example, let's say suddenly Hindenburg leaked the report of Adani Group, and Adani bond prices dropped in the international market, and we have heard that argument like George Soros and his company took a short position in the bond market, and they made a huge profit in Adani Group. So that happened. If any special event happened, or maybe due to demand and supply, if you see fluctuations in the bond price, so that would be because of only maybe due to company's financial health, or maybe because of high demand or high supply of a bond, which is, let's say, pushing price to be very volatile in the market. But that doesn't mean the bond is offering capital appreciation. See, bond never offer capital appreciation. And even if you see, let's say, capital appreciation, see, that doesn't affect on the bond's main terms, because bonds main terms are like the maturity price. Let's say the maturity price is issue price and face value is 10,000. Then original bond, the price which is 10, it means at the time of At the time of, let's say, in a maturity only company will process you this amount, which is 10,000. So even if you see the, capital gain, let's say actual bond market in a trading in market is at 10083, but the maturity value of a bond is this one. So it will receive only this amount from the company. So company will not offer any capital gain on the bonds from company sides. And if you see capital gain in the market with the with XYZ bonds, so that, see, it means just because of demand and supply gain or pressure of demand and supply gain, there is a friction which is created in the price, and that's what you are seeing change in price. Did you get this? So, but from a company side, they never pay any capital gain or they never settle any capital gain to any of the investors. So, company is only responsible for the maturity value which is provided on the paper. Company is not responsible for any of the prices like capital appreciation in the bond value or bond value, let's say, drop or increase, whatever it is, whatever happens in the market. कंपनी सिर्फ मैच्योरिटी वैल्यू ही रिटर्न करती है इन्वेस्टर्स को. अगर प्राइस कितनी भी बढ़ जाए बॉन्ड की, 10,000 भी हो जाए, अगर ऐसी भी प्राइस हो जाए, लेट्स से दिस वन भी अगर प्राइस हो जाए 20,000, company is not responsible for this price, means 20,000. Company is only responsible for this price. Now your question would be like, so who will pay my remaining amount? The remaining amount, nobody is responsible for this. It's just a price created through friction. It means you can try to sell the bonds in market, then instead of the company try to sell the bonds in market, if you get the price of 20,000, that's fine. If not, then mandate, on maturity date, company you'll have to surrender the securities and company will only process 10,000. And if there is any interest payment and all. Okay. Okay. So we'll talk about now different types of bonds, guys. Okay. So what are the different types and how the types work? So we'll discuss about that in details. Okay. So first type is that I would like to discuss, apart from all of this, we have other different types and those are very interesting ones. So we'll discuss that. So the first one is redemption at maturity. The first type is redemption. See, if I take the example of same bonds, the terms and all again still remain same. But at the time of issue, issue this bonds in the market, issue or offer, I would say bonds in the market. At that time, company will define redemption terms. Redemption at a maturity, it means after the 5 years, bonds will mature here, right? Bonds maturity. Bonds will mature at same price. There is no change in this. Okay. But when we say redemption, see this particular maturity or at this maturity level, I would say company will simply redeem this value, redeem this value, and investors will receive this particular cash. So initially means at the time of investing, it looks like this. Investor paid this amount. Investor purchased this bonds at this price, which is 10,000, and company has received it. Means in the books of company, you can see positive cash flow. In the books of investor, you can see negative cash flow initially. Right? When you purchase it, of course, cash will out. And at the time of, let's say, every year, company will pay interest payment. Every year, it looks like this. And here also, company will process interest payment plus principal. Means total interest payment, accrued interest payment for that particular year and interest payment. Or maybe, let's say, 1, 2, 3, 4, 5. So here, only company can pay interest payment also. And in the books of investors, of course, will treat as an income. The investor will receive income from this particular bond investment, which is 1,000 every year. See, to this investments, okay, investor will treat as a future expected cash flows. Future expected cash flows. Cash flows, it means, because see, in the books of investors, continuously it will receive the cash flows on the invested amount, and at the end, investor will receive, this redemption value as well. Redemption value in cash. So this is how we'll call it as a redemption at maturity. It means this bond simply will, redeem at maturity. This bond will simply redeem at maturity. But sometime you can see the provision where company is not ready to pay full amount. Means at maturity, company is not ready to pay full, this amount. So every company hold some rights in terms of redemption. Because see, redemption is purely based on, guys, cash flows which are available in the books of a company. At the time of, let's say, repayment of, the final debt, what if company is looking for a, let's say, what I can say, company is looking for some liquidity issues. In that case, company won't be able to pay that, entire amounts in one go. Am I right? So company will schedule something. Bonds will redeem at maturity in cash, right? And investors will receive cash. Okay. But as I said, if company is facing any liquidity issue, so this amount company can redeem in parts. Parts, it means 1 parts, 2 parts, 3 parts, 4 parts, 10 parts, 20 parts. There are depends on the company's financial plan. If company redeem or repay full amount, we'll call it as a, redemption value in cash at full. The language would be redemption value in cash at full. तो इसका मतलब क्या है? कंपनी ने पूरा का पूरा पैसा इन्वेस्टर्स का एक ही बार में रीपे किया है. So that process or that value, we'll call it as a redemption value in cash at full. But what if, let's say, at the time of maturity price is this, but company is ready with redeem at half. So it means company is ready to redeem only 5,000 at the moment. Why? Maybe due to some, let's say, other circumstances, like companies looking for some, positive cash in the books, or they're looking for additional funds or cash. There could be different scenarios, guys. Okay. It's a very means the practical thing that if the company, they don't have a, available, let's say, cash, means working capital, or I would say liquid cash in the company's books, then company will hold the, even they can hold the redemption at maturity process as well, or they can extend that, redemption. So we have seen all of these cases or scenarios. If we talk about, let's say, this one, if we talk about the process of what I would say, Future Bazaar. What happened with Future Bazaar? Future Bazaar went on a bankrupt because they don't have, they had no cash in their books of accounts to repay the debt of bondholders, right? Same thing happened with the Byju's as well. Byju's was also facing issue with the, debt payment. Same happened with the Reliance Group, that Sony Erection and all other companies. They were facing issues with the payment, right? So at the time of maturity, and that's what, when we say risk, it means at the time of maturity, what if company is not able to repay your debt? Then your money would be in risk, right? On the other hand, now your question would be, look, sir, you told that, we can sell the company's assets as well. But see, means alone you cannot sell it out. So there would be legal process. So it means company can appoint arbiter, or maybe company can appoint, the government's that, directors, and then they'll evaluate it, they'll communicate with you, they'll sell the assets, they'll process it out. So it will take time. It's a time consuming process. It will not happen in overnight that, let's say, company went on a bankruptcy and now you're directly invited, let's say, potential buyer to purchase the assets. So you can't do this. So there would be a legal process. So that's what, when we say risk, it means at the time of maturity, if company is facing some liquidity issue, then company can hold or extend the redemption process as well. And so there would be stages like full redemption. Full redemption, it means maturity value is 10,000. And if investor receives, let's say, 10,000, so that becomes your full redemption. And if maturity value is, let's say, 10,000, but company decided to redeem only 5,000, and if investor receives only 5,000, so that becomes partial redemption, partial redemptions. And remaining amount also company can process it maybe after 1 month, 2 months, 3 months, full or remaining redemption. And company can again redeem or paid out the remaining amount to the investors. So that's become full final. So when we say final, it means this particular investments, it will close out. Started in 2025 and it will close in 2030 with repayment of principal amount. So at the end, it looks like this negative cash flows in the books of company because cash will out from the company's books of account or bank balance, and investors will receive that cash amount. This cash investor will receive it. So that becomes your redemption at maturity. So now same example, if I replicate, let me see if I can copy and paste it. So let's say another scheme would be terms, face value, interest rate 10%, maturity 10, options, let's say, which is call option after 2.5 or maybe 2 years from date of issuance. So what is this provision which is all about the call, right? So let's discuss about the another type. The another type of a bond is callable bonds. The first one is redemption at maturity. That means redeemable bonds. All right. Second types that we are discussing now, type second, which is callable bonds. All right. Callable bonds. So in terms of callable bonds, what happened? Let's say if I talk about first 2 years, it means this one. So this is something, the block period. Block period, it means like in red. Okay. So bond issued in 2025, right? Year 2025. So in first 24 months, company cannot call these bonds. Okay. Company cannot call these bonds. Callable, it means company will call it out. So my bad, price should be different. Company will call these bonds after the 24 months. So it means company can call these bonds at any point in time here, right? Company can call these bonds at any point in time here. So this period would be like callable period. Callable period. So now your question would be like, so what do you mean callable period? Callable, it means buy back bonds at any point in time. At any point in time, but after the blocking period, right? In Hindi, if you want to understand this in better way, so callable bonds means nothing but कंपनी को राइट मिलता है अपने ही बॉन्ड्स फिर से खरीदो अपने ही इन्वेस्टर से. Simple. Why company will do this? That we'll discuss now. Why company want to buy the bonds from the investor bank, right? Why company want to do this? Company will buy the bonds, back from the investor when, let's say, if we talk about these terms, we are assuming this was the, the market interest in 2025. Let's say in 2027, assume it, right? It's a 2027. In 2027, the market interest is 7% for per annum, right? 7% for per annum. And your competitor, if you are ABC Corporation, let's say there is a XYZ Corporation company, they have issued fresh bonds in the market at 7%, and still investors, they have subscribed it. Then now you tell me for a same bonds, you are paying 10% interest payment, and for a same bonds, your competitor, they are paying 7% interest payment in 2027. So now you tell me who is paying higher cost on capital? ज्यादा पैसे कौन पे कर रहा है? Of course, you are, as a company, you are paying higher cost, right? Your competitor issued bonds in 2027 with 7% interest payment. So it means for per 10,000, for per 10,000 rupees bonds, this is the, let's say, investment scheme of ABC Corp, right? In 2025. But after 2 years, your competitor, XYZ Corp, they are paying for the same amounts, they are paying only 10% interest payment. Sorry, 7% interest payment. And still investors, they have, let's say, subscribed it. Now you tell me, why as a company, why you want to pay 3% extra than the market, right? 3% extra than the market. Now with a small amount, you would feel that looks are only the difference is 3%. And if you compare with the ABC Corp, here the difference is only 300 for per annum. So 300 is nothing, right? 300 rupees is nothing. Okay, hold on. What if I say this amount is 1,000 crore? Let's say 1,000 crore amount. 1,000 crore. Now calculate the interest payment. So this difference should be somewhere around 300 crore, right? If the difference is 300 crore, so don't you think that you are paying higher interest payment on same loan amount, right? Again, to understand this example in a better way, let's say HDFC Bank is offering 10% interest payment to you, right? Let's say you have taken loan from HDFC Bank at 10% in 2022, and in Axis, let's say Axis Bank is offering 7% interest payment in 2024, and you have an option. Let's say there was a closing period, let's say a cooling period of you can say 2 years, since 2000 January 2024. So before that, you can't close the loan, but after that, you can close the HDFC's loan. So if you are a very smart investor, right, or let's say financial planner, what will you do? If you ask me, simply what I'll do, I'll close the loan of HDFC Bank, right? HDFC Bank. How I'll close it? I'll apply loans with the Axis Bank at 7% interest payment. I'll ask HDFC Bank to issue the DD with the HDFC Bank name, right? Whatever amount is outstanding, let's say 5%, 10%, and Axis Bank will transfer outstanding amount. Let's say outstanding amount is 1 lakh or 10 lakh, whatever it is. So 10 lakh. So this 10 lakhs, HDFC, Axis Bank will transfer it 10 lakhs to the HDFC Bank, and I'll pay only 7% interest payment to the bank every year, means Axis Bank. So now let's calculate the liability, and you are saving 7% divided by 100, 70,000, and here you are paying interest payment. See that you're saving, means how much amount that you can save it once you change your way. Almost you can save 30,000 yearly. What if this amount is, let's say it was 1 crore that you had taken a loan of 1 crore, just add 1 0 and see the impact. So annually you can save how much? You can save almost 3 lakhs. What if I add 1 0 and see that you're saving? Because bigger the loan, you can see bigger the saving. You're saving. There is. Your saving would be almost 30 lakhs per annum. Now the question is, again, sir, would it be easy to do this? Of course, no, because you will have to convince to the Axis Bank, you will have to pay the processing fees, right? Processing fees, then loan application fees, GST, stamp duty. You will have to pay to the Axis Bank, and you will have to bear the foreclosing charges, right? Charges in HDFC Bank. But let's say all of that expenses, if we just calculate, total cost is 5 lakhs that you have incurred to close the loans and open the new account with Axis Bank, take the loans, and then again close your previous loan. Let's say now you have to close this account and activate this one. So still your saving would be around 25 lakhs, which is a decent, guys. And at a business level, there would be huge saving. 25 lakhs still you can save it if you just smartly manage your liabilities. Now same example आप replicate कर सकते हो companies के decision. आपका competitor 7% interest payment से securities issue कर रहा है and आप already 10% से issue कर चुके हो and you are paying higher interest rate to your investors. So don't you think that if you have an opportunity, मान के चलो you have opportunity to close your previous accounts, so it means this account, and issue the new bonds at a 7% interest payment. So don't you think that it would be a smart decision if your size of the loan is, let's say, 1000 crores, and through this process, if you are able to, let's say, save almost 300 crores annually, don't you think that you should quickly take a decision and redeem the previous bonds and issue the new bonds in the market at a different interest payment rates? You will do this, correct? You will do this or not? If you get opportunity to redeem the bonds here, let's say, redeem the bonds and issue the bonds at 7%, will you do this or not? If you ask me, I'll do this because I'm a businessman. I know the pin, to pay the extra costs to the investors, because if my other competitor is, let's say, already issued bonds at a 7% coupon rate, then I'll also try to do the same thing. So it means I'll close my, I'll repay the amount, I'll repay the amount, and I'll reissue the bonds at a 7% interest payment. But the biggest question is, what if you don't have a liquidity? Then how will you, restructure your loans? Because this is a part of something you can say restructuring of a debts. So how will you restructure your debts? And here your investment banks come into picture, because you need a temporary liquidity, correct, to issue the bonds, to redeem the bonds. So it means you will have to repay the loans, correct, repay the loans. So how it looks like? So here, let's say you have decided to, let's say company had an option, company decided to close that previous bonds. So we'll close out this one. And how it looks like, see this. If the company has a liquidity, which is good, because company will, repay whatever principal payment is, and even, interest payment. Interest payment is pending, then you will have to pay interest payment and as well as principal payment. Company will repay this one, 10,000. If the interest payment is also, let's say it was due, then we'll pay interest payment as well, repay this and close out. Previous investors will receive the same thing, which is investors will receive 10,000 plus interest cost, or interest receivables. Investors will receive this, and finally company will close this bonds. Close this bonds. Why? Because company had a rights to buy company's bonds back from the investors. But the question is, why company will do it? The reason is, other competitor, which is let's say XYZ corporation, that guy means that company already raised funds. This company already raised funds with the lowest interest rates, and that's when you can also restructure your debts and reissue the bonds. Here you can reissue the bonds, at 7% interest payment. 7% interest payment. And again, if you can sell out all the bonds, so issue price and all everything, you can keep it as it is if you want, or maybe you can reduce or increase. See, if the interest payment is, let's say, low, then company can issue the more bonds as well in the market. So it means company can increase this particular original capital base also. The reason is, see, lower the interest payment, higher the amount, and if higher the interest payment, then company can always raise the lower the principal amount. So it's a you can say like the inverse relationship between interest payment and raising capacity. Okay, and interest payment, the interest liability would be hereafter at the 7%. Company will pay only 700. So every year company will pay only 700. This is how company will save the amount, guys. But in terms of the issuance process, let's say here was a investor, which was the investor name was, let's say, A. But here it might equation change. Instead of A, there could be different investor where, let's say, B, or a different investor now, because see, if the interest rate is the 700 and there is a change in income of almost 30%, maybe the existing investors, they'll not continue. They'll say, look, we'll look for a better one. So we don't want to continue with your investment scheme now because the 7% interest payment is low. Or maybe the existing investors, they can look for a better option, right? Are you getting my point? So this is how, guys, it works. Like your callable bonds, it means company hold the rights. In terms of callable bonds, company hold the rights. Note down this one: company hold the rights to buy back bonds after agreed period. One thing that we have missed: your company will repay the call price amount. So this would be the price, because investor will ask for a premium as well, and always investors will ask for a premium. Otherwise, why investors will buy back it, right? Why investors will buy back it? So this is the another game. So company will have to pay additional price as well. So company will pay additional price. So that would be the different price than the actual issue price, because if company want to call the bonds before the maturity, it means company will pay the premium to the bond holders, and of course that is some sort of benefits as well, which will receive to the basically investors. But investors will lose 300 rupees every month if they continue with the same investment schemes, so which is a loss for them. So company would be in profit, but investors would be in loss. So this is how your callable bonds works on the ground. If you work as a consultant, or if you work as a fixed income analyst, or if you worked as, let's say, CA, CF, or FRM analyst with any company, and if you're a part of capital raising process, so you will have to prepare the graphical representation or a model like this to explain to your board of directors, so that accordingly that they can take an investment decision. And even if you're, let's say, if you're you're a businessman, you're running your own firm or institution, so you should know this, the nut and bolts of debt financing, because debt, it means it's a leverage. And if you know how you can smartly manage your debt, then you can generate more and more profit. So here, if you see the example, see, initially means 2 years back, we were paying for a same debt amount, we were paying 1,000 rupees interest cost, correct? But when we change the strategy, it means we just understood the market, how the market is working now, or how the interest payment is in market, how our competitors, let's say, they are paying interest payments and all. So on the basis of that, we just restructure the debt. So this is what we'll call it as a restructure of a debt. Restructure of a debt. So we have this restructure the debt, and through this restructure, we have reissued securities at a different interest payment, and that will save your cost, basically. The cost, which is 300 rupees extra. So it means eventually this decision will help company to increase their productivity, increase their profit, guys. So eventually profit will up by 300 rupees. Let's say here company's PAT was 700. Net PAT means profit after tax. After the debt restructuring, same PAT, it would be somewhere. This means you can see the increase in profit by 30%, which is a sick, right? So you means this is your benefit, correct? So this is how you can save your extra liabilities to increase your profit. Increase your profit. So if you are a, let's say, smart entrepreneur, and if you're looking for debt funds, then you can issue the bonds through callable bonds types. So it means you can include the type and options in the terms, and if investors are agreed that they can buy it, and you will get the rights of a buy. So it means as a company, you can buy that particular securities after 2 years, and that's what you would be in a good position if you are holding callable rights as a company. And this was the explanation of callable bonds. All right. Now let me explain the other bonds. In that case, everything remains the same, but the little bit, you can see the change in, scenario, but it would be like exactly opposite. Okay. Rest, redemption at maturity and all that benefit would be remain same. So I don't want to create a mess over here. So that redemption part and all everything would be remain same. But in this type, we are going to discuss about putable bonds. Putable bonds. Type number 3. In terms of putable bonds, what happened, guys? What if, let's say, see, in terms of putable bonds, first understand this. Investors will receive the rights. Okay. Investors will receive the rights of investments, rights of their own investments, or rights of, I would say, sell of investments. See, in putable bonds, investors will receive the rights, or investors will receive the rights, sell the bonds to the company after specified time at agreed price. Right? In terms of putable bonds, investors will receive the rights. All right. So let's say in a market in 2025, when this bond was issued, the interest rate was 10%, right? Interest rate was 10%, but in the market, means in 2027, XYZ Corporation is offering the interest payment of 12%. Interest payment of 12%. Now think from an investing perspective. Think from an investing perspective. So as an investor in 2027, if you, let's say, sell it out this bonds, right, which was issued at a different, let's say, if you sell this bonds at the current moment, let's say as an investor, you are earning only 1,000, interest income on your investment. But in 2027, let's say here, if you sell it out, if you sell old bonds, right, and if you buy, let's say, new bonds maybe from different company, then you can increase your interest income, like, on the same amount, which is, see, the interest, your principal amount is 10,000. On the same 10,000 amount, you can earn additionally 200 rupees for per month, for per annum. So don't you think that, if you have another opportunity to generate more income than the, let's say, previously, whatever income that you have generated or earned, right? So if any opportunity is available like this, don't you think that you should grab that opportunity? You should grab, right? If you ask my opinion, definitely as an investor, what I'll do, I'll simply sell it out. I'll sell the securities of ABC Corp. So it means bonds, I'll sell it out to the same company back. So I'll get my money, which is face value plus, interest payment and all. And I'll save money, reinvest in this company. And I'll buy the bonds of this company. Why? Because here the interest payment is 12%. So it means my profit would be 2% extra. And as an investor, 2% matter a lot. Matter a lot, it means matter a lot. Let's say I have invested 100 crore. If I have invested 100 crore, my yearly income would be somewhere, with this calculation, it would be 10 crore. 10 crore. And with the new interest payment, or as per the new interest payment, my income would be 12 crore. If I buy these bonds of this company, if I sell this and if I buy this, then additionally I'll generate 2 crore extra. Now you tell me, don't you want this 2 crore extra? If no, that's fine. I'm not forcing you to, sell it out ABC Corp securities and buy it XYZ. But if you ask me, sir, what will you do? Of course, I'll sell it out the securities of ABC Corp and I'll buy the securities of other company, which is XYZ Corporation, which will help me to generate more income on my securities or on my same investment. So this is how your putable bonds works. So basically, guys, putable bonds, it means nothing but it's given a right to the investor to uh, sell the old bonds, right, to the same company back. So it means investor will directly, investor will directly sell this company to the same company, means ABC Corp, and it is a mandate to the ABC Corp to buy the bonds back from the investor. Why? Because investor has purchased securities at an option after 2 years, date of issuance. But here, the one thing is very crucial. Option call price should be something different, or it will different. It means investor will sell it out securities, or company will pay, let's say, only 9,500 as per the that call price, it was agreed, and interest payment, of course, whatever the interest payment was due, that will also company will process it to you as per the agreement, and investors will receive 9,500 apart from that income. But here in this case, it might seems like investor will lose some amount of money, right? So you can select 500 rupees loss, something, it will incur on the this particular deal, but that is fine, right? That I'll recover from my new investments. 9,500, which is something in a decent amount that I have received. I'll reinvest that somewhere because original maturity amount was 10,000, but if I early redeem my investments as per the callable, the putable options, then company will process or company will redeem that securities on discount, and that is something, it's a benefit of a company only. The reason is company will have to arrange the additional buyer of their securities, then additional expenses will incur to the company as well. From a company perspective, debt restructuring is a very costly event. It's not an easy one. Okay. So if company is facing liquidity issues, then company will have to take a loans as well to repay your debt. But it is a mandate to repay your debt. But yeah, so this is how your putable bonds work. So putable bond is works in favor of investor because investor receives the rights to sell the bonds to the same company back after predefined period, and as well as an agreed price. Okay. And if I talk about callable bonds, it means company receives rights, legal rights to buy the bonds from the investors at pre-agreed price, and you can see even date as well. So this is how putable and callable bonds works. Callable and putable bonds. Let's talk about other type. I'll cover one more type. Okay. So let's take a same bond example, but with a different. Let's say you have invested in this bond. You are investors. You invested with ABC Corp. All right. Bonds terms. Again, it's options, but not options. I would say value. Redemption price. Face value is 10,000. Redemption value is, let's say, again 10,000. But the issue price is, there is a problem with issue price, which is 7,000, and there is no interest payment. So it means there is a zero interest payment or zero coupon rate. Zero coupon rate. So basically, there is no coupon on this. And this bond type would be this is a fourth bond type. Different bonds. This is fourth number. Right. So bond type is zero coupon bonds. See, there is a coupon which is with a zero interest rate, but the issue price of the bond is 7,000. All right, 7,000. So how it looks like, every year it will not receive interest payment. There is no interest payment, right? Face value is 10,000. The issue price is 7,000. So it means investors will buy these bonds at this, and bond will redeem at this, right? So basically, there would be a 3,000 rupees gain to the investors throughout the period. Investors, it will not receive interest payment because it's a zero coupon bond, right? but investor will receive full amount at maturity. So here would be the maturity basically. All right. So how this process works, right? What would be your main means net profit in this particular investments? See, if we talk about profit from an investor's perspective here, your investing amount is invested amount. Let's calculate that. Invested amount is 7,000 because your issue price, it means that's your investment value, right? You're investing at 7,000, and redemption value at maturity, value at maturity, which is 10,000. So it means net revenue or profit, you can say profit would be 3,000. Am I right? 3,000. But in an interview also sometime you would expect question like, what will you call to this amount? I know it's a discount, but what will you call to this amount? 3,000. You can't call as an interest payment, right? Because it's not an interest payment. Then what we can call? We can call it as an accretion. Accretion. I wrongly spelled. It's accretion. Accretion, it means incremental value. Accretion, it means, so this will not call it as a profit. We will call it as a accretion. Accretion. Accretion, it means in short, you can treat as it's an incremental value. Incremental value of a bonds. It's an incremental value of a bonds. So throughout the period, investor will receive 3,000 as an accretion. And if we divide this 3,000 across all the period, it looks like this. 3,000 will split across 5 years. It is 600. So it means investor can assume that investors main, the net income would be, which is again estimated income. It means benefit if we just convert into the years, it looks like this. So investor can treat that, or even company can also record this as a liability, I would say, or as an accretion, and it looks like this. But eventually, this accretion would be, accretion. Why we'll call it as accretion? Throughout the period, we'll treat as accruals. Accrued means liabilities. We'll just treat as accrued liabilities, and that's what this accretion words comes from the accrued liabilities. And even same in the books of investor also, investor will treat that the issue price is investor paid only 7,000. The benefit of investor is 3,000, and this 3,000, if we just split across all the throughout the year, it looks like when 6,000 that the investors can 600 investors can treat as a income, but it's not an actual income. Okay, it's not an actual income. Or instead of this interest pay, you can also treat as a accretion only. That's fine. Accretion payable. So company will create an accretion payable like this. Every year, company will book this in the books of account, because at the end of the year, company will have to pay agreed amount, which is 10,000, right? Manually update this. 600, 600, 600, 600, and 600. So investor will treat that total accretion amount as a benefit or income, I would say, and at the time of maturity, investor will receive 10,000. See, the point is investor invested 7,000 and investor will receive 10,000. So net profit, which you can see with the zero coupon bond, is 3,000. Profit would be 3,000. All right. And this is how your company will also maintain the same thing. Accretion in a schedule, like company will prepare it and update in the books of account, and annually they'll convert that accretion into liability. So company will treat this as a liability, and every year company will book the liability of 600, 600, 600 throughout the year. And at the end of this period, company will process your maturity price. If you just calculate, it looks like this. Maturity price 7,000 of investments, and total accretion value, which is 3,000, company will pay it. Accretion payable. This one, and that investor will receive actual payment be 10,000. 10,000. So this is how investor will receive. And investor also maintain the same thing. So actual redemption value, the issue price, 7,000 as a maturity price, and 3,000 as total receivables, right? And total payment received 10,000, right? It will debit from the company account and investor will receive it. See, and in terms of, we perform the accounting at investors level. So make sure that at investors level also, what we do, we actually treat this as a capital gain, and we apply the capital gain tax. Okay. So, but in US and UK, I have seen argument over this to treat as an income or capital gain, because for income you can see different tax rate, and for capital gain you would see different tax rates. But again, it's a choice that whichever that you want to apply, you can apply and disclose that. This is how it works. This was the example of zero coupon bonds.
So if we talk about, guys, bonds, it means which is a fixed income instruments. When we say fixed, it means if you invest in the bonds, the issuers or governments, they'll pay you fixed income instrument or fixed interest payment, I would say, on your investments. All right. So I'll walk you through a portal as well. Bond portal means where you can actually buy and sell the bonds. I'll walk you through that portal as well. So now your question would be like, sir, why we should invest in the bonds? Why we should not invest in stocks? See, for every financial product, you can see few pros and few cons. If we invest in a stocks, see, stocks prices always fluctuate. Always, it means always. If there is a change in, let's say, company's policies or maybe business or revenue, so you can see drop in the the stock prices. And if any business is, let's say, growing, then definitely you can see like positive moment in the stock price. So basically this everything is depends on the stocks that company's performance in a stock market. But in terms of bonds, if you invest in the bonds, even if, let's say, company doesn't perform, that's fine, because the company has signed bonds with you for a fixed income portion. So every year, every quarter, depends on the the investment that bonds investment type, companies will process interest payments to you. And the drawback of stock market, you can see you need lots of research as well, right? Maybe hedging part, how you can hedge your portfolio, maybe, let's say, identifying the good stocks, again, which is a difficult. See, normal buy and sell, anyone can do it through stock market, that broking apps and all. But to identify good stocks, which is a very difficult one. Right? So that's the another drawbacks. And the most of the stocks investment, which is a volatile, it means it depends on the demand and supply force. But in a bond market, most of the bonds, like, they're non-tradable. It means easily you cannot buy and sell. So it will take time to buy and sell, or to get a buyer to your securities and all. And that always offer fixed income. It means even if, let's say, that a company doesn't perform well, but still you will receive your portion. You will receive your profit, or you will receive your income and all. And at the maturity, you will get your portion, means value as well. Correct. So this is how actually bonds and stocks work. So stocks and bonds both have their different pros and cons, I would say. But in terms of, let's say, if we talk about means practical difference between stocks and bonds. See, in a stocks, what happened? The investors, if we talk, let's say, if we call all are the investors. All investors, what they want the ownership of this particular, let's say, assets. So this color you can assume as assets, and this asset is belong to the ABC Corporation. Now, asset can be technology, asset can be office space, lands, furnitures, or XYZ things of that particular company. If anyone really want to acquire or want ownership in all of these assets, so they can simply invest in this business, right? So that process will call it as equities. So it means if you hold equity, basically we'll get a ownership right of that particular company. right? So would be like indirect ownership, right? So it means you can participate in elections, you can participate in meetings, you can participate in any other events or corporate action happen. Basically, you can participate. So that process we'll call it as a equities. So it means basically, so again, I'll refer the same example. If you have your 1 BHK flat, right? Your own 1 BHK flat. Let's say initially you were the only one owner, but after 6 months, you felt like, you need a fund, to maybe renovate your furniture. When you approach to the bank, then bank told like, look, we can't offer you funding. Correct. If that's the case, then of course we'll approach to the maybe other the investors as well, like who are really interested to acquire ownership in your flat. Why they'll acquire ownership in your flat? Because of, if they acquire ownership and if let's say property prices grows, then definitely after a few months, maybe 1 year, they'll sell it out, so they would be in profit. So equity is nothing but equity, word meaning, it says like equity means ownership. If anyone is really looking for ownership in assets, right? Now assets can be anything. Anything means anything. So that process will call it as a stocks, or that, let's say, that structure comes under your stocks process. Actually, stocks, it means it's not a debt instruments, it's actually ownership instruments, provide ownership rights if you invest in a stocks. And on other hand, if we talk about bonds, what happened in bonds? See, on a same assets, see, equity structure looks like this. So it means before equity investment, you are the only one, let's say board of directors, two board of directors, they're holding 100%. And after the IPO, or maybe let's say once company decide to allow other people also to invest, it looks like this. So it means A, B, C, all are investors, mutual fund, LICs, again, they are also investors. They can, grab position in business, or basically they'll get the ownership rights in this particular ABC corporation. And if they're holding, let's say XYZ, shares, see, all participants, they are holding one share. So everyone will receive one equity, rights. So they can participate in meeting and everywhere means everywhere. And the board of directors who are holding 50%, they'll run this business and they'll work as a board of director for a company. Now, if we, compare this structure with the bonds, see, with the bonds, what happened? In both the cases, company is looking for a fund, but the difference is here in this case, company, wanted to raise funds through equity. Why? Because company wanted a long-term capital, which is a perpetual capital. So you don't need to repay that capital back to the company in company's life. Until means you shut down the operations, you don't need to return the capital to the shareholders. If you're looking for a long-term capital, then of course equity capital is the best way to raise capital from public and invest. On other hand, let's say you don't want the intervention of shareholders, and you don't want to dilute your stake, then you can raise capital through loans or maybe bonds, right? So you can raise capital through bonds, and once you raise capital through bonds, so what you can do, same assets don't allow to be a part of these assets, but you can collateralize these assets. So how you can collateralize? So same space, you can sign agreement. It's like rent, you can say, for a rented property. What happened? Owner actually transfer the property to the tenants for 6 months, 1 year, and again tenants pays rent to us. Correct. So you can consider this in a same manner. If, or maybe you can let's say take the another example, like home loan. In a home loan, what happened? We actually transfer collateral to the banks, right? So bank will get the rights to sell the properties at any point in time. Correct. And bank provide funding to us on 10%, 15% interest rate. So we pay basically interest payment to the bank, and at the end we also return the principal amount as well back to the bank. Correct. So same way your bonds works. So bonds is nothing but it's actually your form of loans only. So we raise loans. Again, we invest loans as a businessman in a XYZ securities and return the loans back to the the investors on a predefined maturity date. Correct. So that process, we'll call it as a bond process. But in a bond process, one thing is very important. The bond holders, they don't interfere in day-to-day activities. Even they don't participate in meetings. They don't care at all. What they What they want is, if you have signed a bond to offer, let's say 10% interest payment on investments, so it is a mandate to provide or offer a 10% interest on investment. All right. Even if you don't perform well, they don't care at all. So if it is, let's say, if the agreement is signed, then it means it is a mandate to, share that. For example, let's say when you joined in an XYZ company, you started earning 1 lakhs per month, and then you decided to, let's say, apply for a home loan, and you took a home loan to purchase a house in Shapurji Palanji with the price of 1 crore, and you purchase it. Even let's say after 6 months you lost your job, so can you request to the bank, look, I lost my job, now I can't pay interest payment, or let's say even principal? No, you can't. Correct. Then what bank will say is, look, if you don't have money to repay my interest payment and loan, that's fine. What I'll do, I'll transfer or sell out this property to someone else, and I'll get my money back. So same way bondholders works. If they don't get their money back, they'll directly sell your company's assets. But in case of equity, if equity holders, let's say, doesn't receive payout, but again, they are not allowed to sell the company's assets because they are owners. So they'll ensure the repayment of capitals of everyone. So in terms of risk, if we talk about, yes, of course, equity capital is highest risky capital than the others. The bonds, the secured bonds, of course, they are not a risky one, but always, you would see the risk of default or repayment or latency or delays in repayment. That risk always you can see with the bonds as well. So this is how you can differentiate bonds and equity investments. Now, in terms of, let's say, definition, if you ask me, if anyone is here or really interested in definition of a bonds, it means it's a fixed income instruments which offer the periodic interest payment benefit to the investors who have invested in a bonds. Bonds has a types: redeemable bonds, zero coupon bonds, callable bonds, putable bonds. Right. So in that way, you can explain. If we talk about stocks, which is, if company, let's say, split the company's capital into small denominations, right, that each denomination we can call it as equity, or let's say maybe stocks. Stocks offer dividends and also allow investors to participate in annual general meetings. And stocks has, let's say, other features like capital gain, corporate action benefits, or all other etc. things that you can highlight. All right. If you just ask me only simple definition of bonds or definition of, let's say, equities. Did you get this? Now, if we talk about the flow of bonds, how we can create bonds. See, if you have assets, it can be anything. It means even if you have, let's say, your car, you can collateralize it and issue or raise the loans on it. If you have your gold, let's say this gold, let's say if this gold price is 1 lakh, you can convert this into securitize through, let's say, loan agreement. So what is if we talk about gold loan, so how gold loan works, we actually deposit this collateral rights and even collateral with bank, correct, or the agent like who is offering loans. So we basically deposit loans with the bank. Let's say if this asset value is 70,000, then of course the bank, they can apply the discount of, or bank can apply the discount of 10%, 50%, whatever it is, and as per their policies they'll apply the discount, and remaining amount they'll offer it to you as a loan, right? See, you're depositing your collateral, you're taking loans from a bank, and you're paying interest payment. So same process, companies also, they are doing it. They are not doing anything, let's say, rocket science. We are not inventing anything. We are not on Mars where we are actually doing something extra. No, everything is available here. It's just, see, finance is all about whatever that you have, you can treat that as your assets. Home, properties, agriculture, flats, plots, gold, cash, money, all that comes under your assets. So if you basically, let's say, need funds, additional funds to do extra, anything. See, if you have any assets like this, if you have assets like, gold, then simply go to the bank, sign agreement and raise funds on this particular, this asset, correct? So same way, if we talk about, company, if they have any assets, it could be building, land, machine, any raw material, any technology, team, talent, it can be anything. Anything means anything. just simply convert that into, collaterals. So conversion of collateral process happened through, valuation of business. So we actually appoint valuer and ask valuers to compute the business value. And after that, you can set, your you can split that value into tranches, 1, 2, 3, 4, whatever, tranches that you want to create, just create it and sell that tranches to the public or even other people as well. And once you sell it out as a business owner, you will receive a cash, right? So once you receive a cash, that cash you can treat as a liability and pay interest payment, correct? And then as a investors, if anyone is, let's say, really interested to buy your bonds, then they'll buy bonds from you. Or maybe see, nowadays, we are moving towards the digitalization. And in digitalization, you don't need to purchase any bonds physically. You can directly purchase bonds through brokers or through your banks, through RBI central banks. You can open accounts within RBI as well to buy the bonds and all. So basically nowadays we are means we have a facility to buy a bonds through online. So you can buy the bonds, and once you buy the bonds, then of course, if company has, let's say, committed 10% interest payment per annum, so they'll process you 10% interest payment per annum. So then you can enjoy that benefits. That's the process of a bonds. You can say it, and that process will call it as a securitization, correct? So see, this means see this paper symbol, it represents the certificate of a bonds and how it looks like. Let's say this one. See this, if you can see, this is the bond picture. It looks like a note only. So companies issue such a bonds to the investors. Investor buys it. Companies sell the bonds, and investor then provide funding, because businesses, they need a funding actually, right? And same bonds, if investor receives, then if the investor, let's say in between, if any investors want to sell it out bonds in the market, they can simply go to the marketplace. So in India, we have a marketplaces like BSE, Bombay Stock Exchange, NSE, National Stock Exchange, ICICI broker, HDFC broker. There are many brokers who offer this facility. So you can open account with broker. If you have a securities in a demat account, link your demat with the broker account, and then through a broker account you can send the order to the marketplace, and through marketplace you can simply buy and sell the securities. Again, NSE's team, national stocks, NSE's or BSE's team, they'll take care of it, correct? So see, NSE, NSDL and CDSL provide kind of locker. If you see the symbol, it's a locker. So it means you can keep your securities in locker with the NSDL. Means digital securities you can keep in your wallet. It's like a wallet. Demat account, it's like a wallet. So if you purchase securities from this guy, let's say business owner, so those securities it will receive in your wallet under depository accounts, and then thereafter your depository NSDL or CDSL provides safety and security. But if you again buy the securities, see, if as a, let's say you're the original buyer, then again you would be like seller, and if you sell the securities to other person, you need a marketplace, right, to at least reach out to the investors in a broader level of investors, so that you can reach out to them and buy and sell securities with them, correct? Then you can transfer securities to the buyer. Then again buyer will receive the same certificate, and CDSL or NSDL provide safety and security services to them. So this process will call it as a basically trade process of a bonds. So most of the bonds, like government bonds and all, so they settle in the same day. And again, the corporate bonds, sometime it will take 2 to 3 days to settle in your account as well. So on trade date, basically we send the order, and on settlement date, it actually received securities in a demat account and cash in a bank account. See, NSDL and CDSL, they exactly works like a bank. In a bank, what happened when we deposit a money, bank transfer that money into your digital wallet, and that's how you can track your money as well, like how much balance is available in your account. If we talk about depositories also accept the deposit of shares. So it means if you have any physical certificates, you can deposit with the depositories. So depositories will convert your physical shares into digital, and that securities it will available in your wallet, digital wallet. So means through digital wallet you can transfer that securities to anyone. By sitting home, you can transfer securities to the Delhi investor, maybe Mumbai, Pune, Hyderabad. You can transfer to anyone. So this is how basically NSDL and CDSL come into picture. right? We also discussed about, like, if you're a buyer, then always banks also come into picture, where they actually block the funds in the books of buyer, and depositories, they block the securities in the books of seller. Why? Because to avoid trade fails. Because guys, in a market, what happened, in a real estate also, we have seen, such a kind of frauds where, let's say, brokers, especially brokers, sell the same plots to many, people. And at the time of ownership, always we have seen, legal issues and conflicts. One of my close friend, who had purchased, lands in Pune with a value of rupees 20 lakhs in 2015. But when he actually went to the spot and, checked, he was actually surprised, because same land, that guy sold it out to the almost other 10 people, and everyone was fighting now. Everyone is saying, look, this is my plot, this is my plot, this is my plot. Why this happened? Because in a real estate, it is very difficult to restrict that property or control that property. But in case of shares, even if you don't, let's say, restrict shares, same thing that you can expect in here as well. So we have seen lots of frauds in a stock markets also, because of restrictions only. Harshad Mehta scandal happened just because of restriction only, because at that time there was no blocking system available. So it means, in most of the cases, what we have seen, like, the securities, it was available with the broker only, or intermediator, who was working as an intermediate between buyer and seller. For more than 8+ days, broker used to hold the securities, and that's when we have seen frauds as well. Like, broker will get opportunity to short sell them for a while to generate some money or profit. But to avoid that, now we have a blocking system where we directly block the securities if that particular security is sold to any other people. And same for a funds as well. So buyer should not utilize same funds for multiple securities. Buyer should only utilize the funds for that particular dedicated security. So that's when we also block the funds as well. So how that fund blocking works, how your security means, blocking works, I'll walk you through that process now, means on a portal only. All right. So this was the brief explanation of basically your bond product. Apart from that, we discussed like redeemable bonds. Redeemable bonds is nothing but at the maturity directly, company will, buy bonds back from the investors and settle the amount, and investor will receive the money. Simple. So redemption is means at the time of maturity, company will buy the bonds back, because at the time of issuance, what is happening here? Company selling bonds, right? Here company selling bonds, investor is buying bonds. But at the time of maturity, investors, they are selling the bonds to the company, and company is buying the bonds. So it means investor will receive their money. At the time of maturity, simply investor will ask money, give my money back, capital plus interest payment, that's all. And this guy, issuer, means who have issued the securities, this guy will ask for investors, look, give me back, or give my securities back actually. Why? Because securities, it means it was a collateral securities. If we don't buy back, then they can claim on your properties as well. So that's what it is important to buy the securities back, is also important process, right? And this was the example of zero coupon bond. We also discussed about, redemption bonds. We also had discussed about zero coupon bonds as well. Zero coupon bonds, it means if let's say issuer issue bonds on discount. So it means, let's say this actual price is 10,000, but same bonds, if company sell to 7,000, then investor will pay only 7,000 at the time of buying. Then what about the benefit? See, at the time of maturity, company will redeem at 10,000. So basically, investors should be in a profit of 3,000 on investment of 7,000. So this is how you basically zero coupon bonds work. So zero coupon bonds, it means nothing but, you will receive the OID fees. OID, it means original issue discount fees. As an investor, you will receive the OID fees as a profit, but that will receive at the time of maturity only, not initially. See, if you compare these two bonds, redemption bonds and zero coupon bonds, in a redemption, you can go and check, every year company will pay interest payment, right? Every year. But in zero coupon bond, company, it will not process any interest payment as such. Instead of that, they'll say it's a OID fees, or let's say accretion, or incremental value of your assets. So that will basically company will process at the time of maturity only. So that's become your discounted bond. So it means it's a zero coupon bonds offer a huge discount, which was equivalent to the interest payment. So they have just offer it out. Now your question would be like, sir, look, why company issue redeemable bonds and why zero coupon bonds? See, every bond has some unique feature. If you're like very smart investors, then you will go ahead with the zero coupon bonds. Why? Means not investor, I would say businessman. Why? Because if you issue the zero coupon bonds, then you don't need to pay this interest payment every year. So instead of that, what you can do, instead of paying interest payment every year, you can invest this money as a company. If you generate, let's say, more cash, then reinvest that money and multiply your money, right? At the end, you're entitled to pay fixed liability, which is 10,000 for per bonds. So just repay that only. But if you talk about this interest payment case, so every year company will have to pay 1,000 interest payment to the bondholder. So it means every year company will have to maintain a healthy cash flows or cash available in bank to manage these liabilities. If not, then again, bondholders, they can, penalize to the company as well. See, if you fail to make a payment, interest payment as per obligation, then bondholders, they penalize. Okay. Let me tell you something. This David Kemper fund, they have penalized around 100 to 200 crores something to the Byju's for not to paying interest payment on time. So it's a very difficult, right? But in a zero coupon bonds, of course, here also you can see one risk means from an investing perspective. What if, let's say, at the time of maturity, your company announced bankruptcy or let's say default on payment? Then again, you will lose entire thing. See, from an investing perspective, zero coupon bond is not a good option. But from a company's perspective, of course, this zero coupon bond is a good option if you don't have a regular or healthy cash flows in your business. Did you get this? So this is how you can relate this zero coupon bond and the other bond types. Apart from this, we have also discussed about callable and putable bonds. Callable is nothing but callable bonds give rights to the company, rights to the company. So to buy a bonds means this bonds back from the investors, right, at a pre-agreed price, right? Pre-agreed price, we have discussed this. So it means every company decide price, pre-agreed price, XYZ amounts, and then company will pay the process to you accordingly. So we have also discussed the flow of callable bonds. So it means, let's say the total bond maturity is 5 years. Out of 5, you might see 1 or 2 years as a lock-in period. During that lock-in period, you cannot sell bonds back to the company. But after lock-in period, company can, or same applies to the investor as well. Then company can buy that bonds back from you. So why company will call the bonds back from the investors? When the interest rate drops in the market. When the interest rate drops in the market, then of course company will reissue the bonds at a different rates to raise capital. So that will call it as a callable bonds. What about putable bonds? Putable bonds is basically, it's a it's you can say it's a rights that it will receive to the investors to sell the bonds at a pre-agreed date. All right, pre-agreed date. Pre-agreed date means at the time of issuance only company will confirm the pre-agreed date as well. So at a pre-agreed date, basically investors will sell it out stakes or investments to the company. Why investors will sell it out? Again, if let's say if any other bonds, if they're let's say if they're offering higher interest rate in the market than the, let's say, your investments, then of course always you will look for like how you can sell out your investments and reinvest that money in the other bonds. So that's how, see, investors, they always play smartly with investments. They know how to multiply their wealth. They are not like a common man where buy SIP units and wait for 20 years to become a rich. No, investors, they are very smart. They know it. Means big investors that I'm talking about, they know how to multiply their wealth, how to assess the other different investing options to multiply the wealth and all. So they play very differently. Another bond type is convertible bonds. So this one is very interesting one. Convertible bonds. See, when we say convertible bonds, bonds will convert into preference and common equities at the time of maturity, right? And see, from a company perspective, this will provide more flexibility. The company to manage the debt effective way, and also company can avoid bankruptcy as well. See, a question to you. Let's say you're a businessman. You had raised funds from a bond holder, right? Let's say you're a businessman. Take this case for you. You had raised 1 lakh USD from B investor. When you had raised it, you had assets of 1 lakh USD, and right. So it means at that time your condition was good, but at the time of repayment, you have a liability of 1,50,000. So now you tell me, so how, as a business owner or entrepreneur, how will you deal with this condition? How will you deal with this? I'll give one practical example as well. There is one company called ATOS, right? Debt crisis. This company. See this, ATOS reaches deal with creditors on a debt terms. If you read this, full case, French technology ATOS reached an agreement with a group of banks and bondholders on terms of its, debt restructuring. The company said on Sunday that, the restructuring plan involves 233 million euro contribution via capital increase with the preferential subscription rights. And it said in a statement, about 2.8 billion euros ATOS debt will be turned into equity during the total amount of converted debts to 2.9 billion euros, and that will reduce ATOS net indebtedness by around 3.1 billion euros, the statement said. So the company again said Sunday's agreement was a significant milestone towards reaching a final restructuring agreement by July. ATOS announced last Wednesday that a consortium led by investor David Liani, 1Point, had withdrawn from discussion on its restructuring. So 1Point, again, it's a fund manager. They had also invested, right? So 1 euros, 1 is equal to 0.933 euros. So basically, this is the ratio to convert their securities into, bonds into, common equities. So basically, this is basically, it's a debt burden company. So they have raised huge debt to acquire business. But in terms of revenue, if you see, every year they are just posting, negative revenue. So it means there is no revenue or there is no cash inflow much. And now this company is facing lots of problems. If you can go and check it out. See, they have stated that, they'll convert the bonds into equities, right? So now, if we just, try to understand this case in details, let's say you have, raised funds with a commitment of 10% interest payment that you will pay to the bondholders. But at the time of actual repayment of interest payment, or maybe let's say actual, repayment of, principal, you are facing some problems, that you don't have a cash. So how will you manage that? How will you manage the repayment? So in this case, if you see, in this case, the company CEOs or, the managements, they were facing lots of challenges. Lots of, it means lots of, because I was keeping an eye on this particular business, because one of my investor was very interested, to buy this company. So he said me to track this out, progress, and tell me. See, if you are not able to, repay the debt, and as an entrepreneur, let's say if you don't want to lose your company, see, ultimately what will happen, go to the, here and check the ATOS stock price, how bond and that stock price works. See this, ATOS price reached to the 0.65. So it means at any moment, this price can reach to the zero. And if that reach to the zero, trust me, bondholder they'll take the entire control of, this business, entire control. If your stock price become negative, so it means business has no capital and no cash. So now entire company is entire company's assets belong to the bondholders only. Why? Because they have signed collateral agreement and all. And I'm also shocking now because few weeks back the price was, let me check. Few weeks back price was, I believe price was, yeah, yes, see this. Here in 2023 price was 7.8 something, and now price reached to the zero, means almost zero. It's become penny stock now. See, price was around 700 euros, guys, in 1998. But in last 20 years, what happened with this company? See, means every year on year basis, we have seen almost, the reduction in price, and now this stock reached to the 0.65. And I don't know whether this company will survive or not. The reason is, I'm sure debt holders will, this company is all, looking for a buyer as well. Like they just wanted to, sell it out this business to the other companies and monetize some, cash so that they can repay the debt. If they don't repay the debt now, they don't have any, see this, even negative earning also, see revenue is which is very low, 44 million. And if you just compare the debt, which is in billion, you can see this revenue and everything year on year, they're just losing, their clients. And I don't know how long they'll, survive in the market. See, in terms of valuation also, now the data is not available, but they don't have a fund eventually. Debt to EBITDA is over the software average. So it means now debt is over, EBITDA is very low, negative growth rate, and companies facing lots of problems. If you look at the balance sheet, shareholders equity value is 56 million. Let's talk about revenue, 10 billion, 10 billion. See, their average revenue was 10 billion. And if we talk about, let's say, net profit, only for 2016, 17, and 18. And even here also we have seen where in 2020, they were generating positive cash flow. So it means they made a profit as well, like 51 million, 82 million, 1 million, 149 million. Sorry, this one, 500 million, 771 million. Profit they have generated, good profit they have generated. But what suddenly happened, from million to billion losses. So see this, in 2021 they had a huge loss, which is 2.92 billion loss. Then in 2022 900 million loss, and in 2023 $3.3 billion loss. And now we don't know, means whether this company will survive or not. And see, on other hand, see, they are making huge losses. Why? Because they have an interest payment due, right? The interest payment due, and they don't have a cash. If we look at the cash figure, they have a negative cash flow around, see, 600 million. In 2022, still they had a cash of 160 million, 76 million. So it means even they don't have a cash to pay the salary of their people. This is the brutal fact. And at any point in time, that company can announce. See, the ATOS is one of the largest, French IT company, one of the largest, and that company is now on a verge of bankruptcy. Why? Because of debt only, guys. Because see, if you are buying any assets on a debt, and if that, let's say, that asset has no potential, then always you would be in trouble. Even if you buy, let's say, apply for a home loan, so always see that whether that home will offer rental income opportunities, or maybe, let's say, capital gain or not. If not, then do not buy that home, do not invest. Same for bonds as well. If you want to acquire any bonds, let's say you have decided to apply for a loans and then invest in stocks, bonds, any other financial instruments. See, if that instruments or assets, if they don't have a potential to offer you good benefit, then do not invest. So my point here is, I'll show you as well in detail case study of this only, how they have got trapped in 2022, or before that only they got a trap, right? So why and how, let's discuss that. We'll go to the now they are in a negative cash of 600 million. It means they need an immediate cash of 680 million. And immediately what they did, term loan. See, French technology company ATOS said that on Friday it had successfully secured short-term financing via 2 tranches of loans from creditors, adding it still expected to reach a final restructuring agreement this month. So it means they had no cash left. See, could ATOS be rescued by creditors? So their creditors actually paid amount to pay the salary of people. So it means even they don't have a cash in their pockets to pay the salary of their people, right? So they applied for a quick loan. And how long this loan will also help the support to survive, I don't know. And more than 1,50,000 people they're working in ATOS. Now your question would be, sir, what if let's take a hypothetical condition tomorrow that stock reach to the zero, what will happen? See, there are bond holders. Bond holders will directly take a control, right? And they'll just remove the existing people by disposing the equities, right? And if you dispose the equities through legal process, so it means that existing shareholders they'll not have any rights of investments. They'll not have any legal rights to be a part of this ATOS as a investors. And new investors, they'll take care of it. Means new investors, what they'll do, they'll convert their debt into equities, and they'll then operate business from there. Because see, eventually ATOS is revenue making company, but few things happened in that business. And what are those few things? So let's talk about now. And this message to everyone that if you want to acquire any assets, so make sure that you guys are following means at least you guys are checking something. If you don't check, and if you directly try to acquire assets, it will put you in trouble. Here you can track the details of this company. They have secured 1.6 billion committed by group of banks and group of bond holders. But I don't know, in July only they were facing to the problems. But if they have received any commitment for a 1 billion, so they might survive. Lockup agreement reached between the company, group of banks and group of bond holders covering all key terms of financial restructuring plan. Supported by the creditors only, they are paying it. In terms of financing, 800 million secured, providing the liquidity necessary to fund the business until close of the financial restructuring plan. So it means continuously they are raising funds. Even government of France also, they have funded to this. Now, I don't know means how long it will take. But maybe what I'm thinking, they'll wait until this, the stock price gets zero, and then they'll convert this entire their new debt into equities. In that way, they might release their securities, and they'll just wipe out or clean up the public equities and all from the business. So that happened in business. Target new secured financing of up to 1.67 billion, but nobody want to offer funding to this business because of several reasons. What I want to show you is, see, more than 48,000 people they're working. And if you see the company they're operating, means they have offices across 69 countries. See, if they have 48,000 people or they're doing, so that doesn't mean they're doing great. See, ultimately for investors, what matter is, profit. If they're not able to, let's say 40,000 people, even they're not able to generate, let's say, $1. So see this, how this, the big fraud that, you guys are seeing. Even the YouTubers also, they are making profit in crores. One of the YouTuber posted 300 crores profit, right? And more than 48,000 people, even they're not able to generate 1 crore. So it means it's a very, very difficult, I just want to see one thing, their acquisitions. Yes. And by the way, this company was managing, Olympic, right? And post Olympic only, we have seen, a big drop in value, the share price value. This company was taking care of safety, security, and everything. So in terms of technology and infrastructure, they have infrastructure, they have a technology, no doubt, but they're not able to generate a profit. So this is very tough, So since very long, they are, managing this Olympic since 2002, and in 2024 as well, in Paris, they have managed everything, means system, security, arrangement, and all. So they have managed it. Timeline infographic, operating model, testing lab capabilities. So there was one thing I am not able to, get this flow chart. So maybe let me just search it in different way. ATOS total Let's see if this allows us to track it out. See, they have acquired list of companies. Okay, so you'll get surprised to see the number. They are continuously acquiring and acquiring and acquiring. Means continuously means continuously. 11 billion in revenue, 95,000 people, employees, 69. This is something old data. I don't know whether it is real or not. But the point is digital formation. There one acquisition which was actually, made them trouble, which was like ATOS. Sorry, ATOS and Sintel and ATOS. They acquired Sintel by paying around 22,000 crores, right? But the business wasn't worth to pay 22,000 crores. And then after they started falling, because Sintel was also already in a blacklisted company and they did the same thing. But anyways, I'm not a consultant for them to advise why they did this. And then if we get the complete transformation, they have a chart somewhere. I'm not able to see that chart where you can see everything. Anyways, so one of the company, that they wanted to acquire, which is ATOS, and they acquired it even by paying 22,000 crores. But as I said, if you acquire the assets and if let's say if that asset has no potential to deliver return, then you would be in trouble, right? And that's when now they are in a trouble, like they are planning like how they can repay the debt. So as per my as per my knowledge or research, the debt holders, they'll take the control of this company within next max to max 1 year. Once the price reaches to the let's say zero, then security will be delisted from the market. And once the security will be delisted from the market, so it means company will be under control of bond holders only. So bond holders will take the control of a company, and they'll then from there they can operate it, or maybe they can sell it out to the others. So that's how actually business model works. So it means in this example, if you see in terms of convertible bonds, see at the time of repayment, if the businesses, if they're facing problems to repay the debt in cash, then instead of that, what they can do, simply they can convert this equity, right? Sorry, this let's say raised liability into equity. And after that, simply you can remove this liability from here, and instead of that you can just add capital. So basically your capital will increase. Capital base would be 1,50,000. So instead of liabilities. So at the time of maturity, basically you can convert your total bonds into equities. Company will of course come up with the ratios, like maybe one equity into one bonds, or maybe one bonds into one bonds. Let's say for one bonds, company will pay 10 equities. So see this swiping ratio, you may see that at the time of maturity only, but company can provide you that ratio and all. On the basis of that, sometime it will get option as well, option of conversion at maturity. So it means, let's say you decided to participate in conversion, then your bonds will company buy it back, and company will pay you like equities, common equities, right? For example, let's say if this is the bond example, you had let's say investor invested in bonds here, but at the time of maturity, what will happen? Instead of company will not pay any cash to you. So instead of that, what company will do? Company will let's say company will now company's equities company will transfer to the shareholders, and company will buy it back their bonds directly here. So at the time of maturity, instead of cash, if you see in other examples, investors, they have received cash only. Here investor received cash, here also investor received cash, and company purchased the bonds back. But if we look at this bonds one, which is your convertible bonds, at the time of conversion, company will buy their bonds back, and they'll convert these bonds into equities, and equity will be transferred to the investors. See why this is this is important, I'll tell you. Now if you take the same example of ATOS, if let's say bond holders, if they are not ready to allow conversion of bonds into equities, then by default the shareholders of ATOS, they have lost the control. So it means, let's say, the board of directors, they are like in a driver of vehicle. And what if, let's say, if you lose the control? Just imagine what will happen if you lose the control, or maybe let's say what will happen if there is no brake to that vehicle. What will happen? Just imagine. So it means it feels like there is no direction, and which is true as well to some extent. And the same thing has happened with that company also. And same company, same can happen with your business as well. If you, let's say, if you're raising money, that is fine, you are applying for a loans, that is fine. But if you don't know how to manage that liquidity, or how to manage that, let's say, debt fund, or how to manage the loans in an effective way, it is a very essential, guys. And if you don't know that, then it means you may lose the control of your asset. Because after all, we are, if you go and see the flow, see, basically the owners of the business, they are giving you power of attorney, means sell rights of assets. So if company is not able to pay, then definitely they'll take the control of your business, right? They'll directly take the control of your business. And if they take a control of your business, it means as an equity owner, you will lose the control of your equities. And if you see, this example, now share price, which is reaching towards the zero now. And if this reach out to the zero, so it means shareholders has no liquidity or assets, or let's say ownership interest in that particular business. So by default, the stock will be delisted from the market. Did you get this? So if anyone invest at this price in this group, then they will not receive anything. Anything means anything. All right. So I have done lots of research on this, so I know it. In last 1 year, stock price, see the performance, 90% down continuously, which is down, down, down. See, the problem is not with the business model. The problem is with the high debt. If you see the $10 billion in revenue, which is still fine, yeah, 10 billion, right? Not even million, 10 billion, which is still fine. But the problem is with debt, higher debt. Now they have got trapped. And I don't know whether they'll survive, or if you see their competitors, see their price, which is at 95.36, and see their price, which is 0.645. But few days back when I checked it, price was around $4 something. It might have happened something. That's what price now, this particular stock crash. But anyways, so now we'll go to the ICICI Direct site. Let me access. Let me log in. So if you have a, let's say, account with ICICI Direct, okay. So whatever flow that we have discussed, see, the brokers, they are member of stock exchange, guys. If you see NSE and BSE, it is a marketplaces, okay, and ICICI Direct is a broker. So it means ICICI Direct, they have access of NSE and BSE. So it means they can access the marketplace. If you see this HCL Tech listed on NSE, Shriram Chemical listed on NSE, Sun Pharma listed on NSE, Tata Motors listed on NSE, right? Titan listed on NSE. Most of the stocks, they are listed on NSE, BSE, NSE, BSE. So it is depends on you, means, which stock that you want to buy it out, or which, let's say, bond that you want to buy it out. If you want to buy, simply, you can, select any stocks, whatever stocks that you're looking for. Buy limit order, price is given. Always look for a limit order. Why? Because if you select the market one, so it means stock exchange, the system will book your trades at this price, which is higher price. But if you just restrict the price, which is limit price, let's say market price is 1626. So always select lower price if you can, if you're looking for a buy, right? And then send the order. So once you send the order sent to the exchange. See this pop-up. Now, pop-up says we have sent the order to the market exchange, right? And go back in our discussion, the flow which we have charted out. See this guy is, basically the security is listed, means this, they have listed their bonds. Company listed their bonds on exchange. So once they have listed on exchange, so it means marketplace. So it means this investor, they can send the order to the marketplace, and once the order is sent to the marketplace, this will available here. Now
if I go to this, or if you see this, any stocks or any click on the market date, see this order quantity, bid order, bid order. So basically this bid, it means buy, offer, it means sell. So if anyone want to sell it, quantity, it will reflect here. And if anyone want to buy it, it will reflect here, and they can quote the price as well. So stock exchange track that. Okay. And that order, goes to the order system. So see this, I have sent the order and my order is here reflected. This is a delivery trade. So now if I click on this status, or so it's the segment is rolling T1, it means on the same day this will basically settled, traded, or maybe very next day it will settle this particular trade. See, margin amount blocked. If I purchase securities through broker, then broker will block it out. But ultimately, this amount is blocked from my account. I was talking about this one. If you buy any securities, broker will block this amount. This amount got blocked from my account. So I cannot use this amount for another trade. So it means this amount now, which has been blocked in my account. All right. And this is how it looks like. But see the flow first. So your trade life cycle flow. Let me search on the trade. See, this is your marketplace, BSE, NSE. When we send the order, you can see the quantities and all, how it looks like. Seller orders, buy orders. I want to see the flow. I had purchased almost 1000 quantities of this Wipro, but I sold it out very early because with the loss, I just sold it out. I thought let's not take a risk. 1000 quantity was a very high amount at the time, but I was looking for something else. So see this, guys, how your flow looks like when you send any orders to any stock exchange through your broker account. See, I wanted to buy this particular stock, so I purchased 300 quantities at 177 price. Okay. And very next day, this particular trade will settle, means actually securities will reflect in my demat account. On trade date, it will not reflect securities, it will not reflect in my demat account, but on a settlement date, securities, it will reflect in my demat account. So I'll walk you through that as well. So how it looks like in demat account. See, when sellers sell the securities, I purchased the security on Friday, I believe, 20th of September. My portfolio will be updated on 21st. So it means Saturday, but this portfolio updated. But I can access the contract note on again 21st. Right. The shares will be debited from your linked account. So it means seller's account. In this case, I'm a buyer. Okay. See, in the books of seller, shares will be debited from your linked demat account earliest by 20 September 2024. Once the order get executed on a stock exchange, immediately stocks will blocked in the account. Why? To avoid the risk of trade failure, right? And funds will be credited to the account 23rd. So it means, see, on Monday the seller will receive the money, right? Seller will receive the money on Monday. Now, if we talk about buyer side, if you buy the security, see, I have purchased securities on Friday, which is 20th of September. Then again, I can access my account, but the shares will be credited in demat account on Monday, right? I have purchased it on 21st, but shares will receive in my demat account on 23rd September. But if you see, funds will be debited from your bank account on same date. If I send the purchase order, then fund will again debited or blocked in my account. And if you see, fund has got blocked in my account already. But I have not received securities in demat account. So we'll see that. So this is actually your trade life cycle flow. So this is how your trade life cycle works. On first day or trade date, only securities will blocked or fund will blocked. But actual transfer, if you see, means actual transfer, when it will actually transfer from one to another accounts. So on a settlement date only, actual transaction will executed. Shares will received in demat account to the buyer. So in case of buyer, if you see, shares will be debited on 23rd and sellers fund will be credited on 3rd. But if we talk about trade date on 20th of September, shares will be debited from the seller's book and funds will be debited from the buyer's book. So this is how, see, this activity which will happen on trade date, and this SBCA activity means fund or debit, demat account transfer, it will happen on your settlement date, right? So see this, I have purchased this on 20th of September, right? I purchased at 177 and stock price which is at 182. Go to the now demat account. I have demat account here. If you see demat holding, see if you see this stock name, there is no, that stock is not available. See this. In a demat account, you can see IRFC, Indian Renewable Energy, then Kilton Tech, Leod's Engineering, Mirk Electronic, NCL Research, Shipping Corporation, Visagar Financial, and Yes Bank. But that security I have purchased it out, right? That security I have purchased it out. You can see here in orders. See this. I have purchased this, but that security is not available in my account. You can check the status as well. Executed status. Status is executed. I have purchased it out, but that security is not available actually. Why? So this is how, see, on a trade date only you can see the details, right? On a trade date only you can see the details, but on settlement date, actual security it will receive in my demat account. Meanwhile, that security is now with the broker. Broker will take the control of securities of sellers, right, through depositories, and also broker will take the control of funds as well through escrow account, or let's say, separate account. They just ask parties to transfer the funds and broker will take care of that part. On settlement date, actually broker will exchange that out. So this is how your actually settlement works, right? 5,46,002. See, I made a profit of 3,57,000 on this, but in last 2 weeks, I lost almost 50 to 70,000, I believe, 70, due to market fluctuations. Now I have transfer money to the different investments as well. So I thought, like, let's not take a risk. If you have made a money, do not get stick with it. Anyways, now if we talk about bonds, go to the bonds here. See, these are the securities which are available. If you want to invest in government T-bills, you can invest. This is a gold bonds actually. So you can invest in gold bonds. IRFC, they have listed their stocks on a stock exchange. But again, if you want to invest in IRFC through bonds, you can invest. Corporate bonds, tax-free bonds. If anyone want to really, save your taxes, then you can invest in this particular bonds. They'll pay the interest payment to you yearly. Maturity of the bond is like in 2031. So bonds will mature in 2031. And if you want to, buy these bonds, simply click on this buy, select the market, because this IRFC bond is listed on a BSE and NSE as well. Because NSE and BSE both are marketplace guys. We are looking for a buy, then again click on buy. Whatever quantity that you want to buy, again select the quantity. One, get the quote from the market, whatever quote that you are looking for. This is a marketplace for a this IRFC. Only one order that I can see for a sell, but not in NSE. There is no order open in NSE, but on a BSE I can see 2 orders, right? This one, someone want to sell the 100 quantity, 250 quantities, 245 quantities at price of 1255 offer price. But the buyer is looking for, see this guys, this buyer is looking for price of 1,000 only, but the seller want to sell the quantities at 12,550. And there is another seller who is looking for a sell of almost 600 quantities at a 1,400 price, right? So, but those orders, again, it is not possible to execute it. You can see this order, still will remain, open. And that's what you should not select, if you're a buyer, then don't select market order ever. If you select it out, trust me, broker can execute your trades at this price also. Why? Because you have clicked on market order. So it means broker will always try to apply higher price to your order, or even your stock exchange also, they'll apply the higher price to your securities, right? So the reasonable price is reasonable price, I would say it should be 1052, but someone have updated 1255 again. So you can select the price, whatever price that you're looking for. So I'm looking for a cash buy. Then here you can, I have limit the order. I'll select the, see, in this case, if you select the price of this, if you select the price, let's say this one, this is a market price. If you see there is no price updated over here, right? Then broker will directly, stock exchange will directly execute the price at this price. So it means if anyone select market price at the time of buying the securities, it is a clear indication that you are ready to pay more fees or more premium to buy the assets. So do not, again, do not select market price if you are buying or trading securities, and also do not do this. Same for a ceiling as well. If you want to sell, then do not select market. Always restrict your price. Restrict your price like 1250 or whatever price that you want to buy. Right. So if you ask me, then I'll always select, the lower the price at the time of buying. And if you select this price, broker will try to execute, or let's say your marketplace, it will try to execute your trade around this price, 1052, around, at least around, I'm saying. Not at maybe exactly the same price, but at least around. Update the quantity. Every security you can track it through their number, which is, the script code, right? The price which is required, this one, and update it. So this bond. Again, I have sent this bond to the stock. See this. Read this first. It's a very important one. Your order will be sent to the exchange when the exchange opens. So it means your order will be executed on exchange only. Exchange will match the order and confirm to the broker back. Look, this is the buyer, this is the seller for this particular security and all. And then broker team or broker, system will work with custodian, work with, clearing agents to clear that particular trades in your account. I have sent the order. My order is open for one quantity. I have requested that I showed, the interest, I'm looking for this, but I don't know the price. Why this? They have updated 1255. We had updated different price, right? So this is not a right thing. The price, it should this only. See, you can modify that. We have modified it and send the order, say this. So now my order has been sent to the exchange. So once the exchange opens, the exchange teams, they'll collect the orders and they'll match the order with the other orders, means seller orders on the basis of time. Let's say I have sent order today. It means my order would be like, first. And if they received any first trades for the same price, they'll try to match my buy order with the seller order. And if that match, then that trade will announce as a, that trade will announce as a buy trade, means executed. They have executed the trade. See, in a stock exchange, everything works on a bid. Bid, it means boli, right? You would have seen in movie as well, like मैं 10 पे लूंगा, मैं 11 पे लूंगा, मैं 14 पे लूंगा. You would have seen that in movie as well. Am I right? In Bollywood movies, or maybe in Harshad Mehta and all. So brokers or agents, they actually quote the price. Hey, I'm ready for 10 rupees, L1 rupees, L1.5, L1.10, whatever it is. And if someone lets you offer best price, then stock exchange will deliver that security to that person. Correct? So this is how actually you can understand this stock exchange term. Stock exchange, it's a marketplace. When we say exchange, it means it's a marketplace. They actually sell the securities, right? They actually sell the securities or offer the securities. If they received any securities, they offer it. Look guys, हमारे पास इतना ये है. Look guys, हमारे पास वो उतना है. And if they received buy orders, then they execute. All right. So this was the example of your bonds. Now that someone asked question like, how to evaluate bonds. See, there are ways to evaluate bonds. First, check it like, who is offering. If it is a government is offering, then see, always good to invest in government bonds. If you don't want a risk, means if you're let's say looking for a zero risk, then always invest in government securities. Always, it means always. If anyone, again, let me reiterate, if anyone is looking for a zero risk, zero means zero risk, then invest in government securities. Let's say if the government securities, if they're not available to invest, then go to the corporate bonds or listed bonds, right? And target the public enterprises like IRFC. It's a public enterprises. See, government bonds is also available. The government of India, they have announced bonds. Then government of Indian Railway Finance Corporation, Bank of Baroda, right? Then IIFL. See, this is a private one. See, private companies, they offer higher interest rate. If you see, IIFL, they're offering 8.2. And if I compare this with the government bonds, they're offering only 5%. 2.5 half yearly, it means 5% would be for per annum basis. Government will offer you the security and safety to your investments, but the same safety and security you can't expect from this IIFL, correct? Rural Electrification Corporation, again, it's a government bonds, but it is offering best, which is 8.6. So you should invest. It's a government enterprise. Then IIFL, it's a private, but they have a NCDs or, the deposit schemes and all. National Highway Authority of India offering 8.3%, right? Power Corporation offering 8.92. See the tax benefit as well as rate of return. If any government enterprises or government, if they're offering higher interest rate on any bonds, then you can invest. But also you should look for a frequency as well. See, higher interest payment, government enterprise, and let's say half yearly payment. That would be a best investment opportunity. Why? Because if you receive, let's say, more and more interest payment frequently, so you can reinvest it and then you can, multiply your yield. Yield means income. But let's say you have two opportunities. One is this one, 8.92, and another one is 8.97. If you compare this two, of course, you should invest in this one. Why? The reason is there is a slight, change in the interest rate, and both are government enterprises. Now, if I compare with, let's say, same security with this one, this 8.3, 8.71, 8.92. So again, I would suggest this one. The reason is all are offering like yearly or annual interest payment on assets or bonds. All right. But if I get any opportunity, let's say this one, NTPC, tax-free bonds. They have a yearly. Government of India, gold bonds offering 2.5 half yearly. See, gold bonds are also profitable nowadays. Instead of buying, let's say, physical golds, so you should invest in gold bonds. Now your question would be like, sir, why? Because gold bonds, they offer capital gain as well as 5% interest payment for per annum. If you have a 25 lakhs to 1 crore, then it is a good investment to invest in gold bonds. Because every year we have seen like 10 to 15% appreciation in gold prices due to international market demands and all. In coming time also, gold would be in prime focus because the gold is one of the metal, which is accepted worldwide. And so you can invest in those bonds. Nowadays, if anyone want to invest, you can, you can select the government entities for investments and you can invest. If you are looking for a very safe and secure investments. Secure, it means safe, secure, and average rate of return would be around 8.5 to 9 or max to max 9% at the moment. But on other hand, if anyone is really interested to invest in corporate, structured product or corporate, let's say, corporate bonds like this, then you can invest. See, there are the again, public companies or maybe state companies or, the private limited companies and all. See their interest payment. If you see higher interest payment, Akara Cap offering 11% interest rate on investments, right? But rating is BB. So make sure that, rating also matter a lot. BB rating, it means company is not in a good position. A rated, which is still fine. Nindo Home Fin Limited offering 11%, 10%. So if you now compare this two, I would go with this one, 10.3 interest payment. Why? Now you will question me, look, sir, the, Akara Capital is offering 11%. But dude, if you see, they have a rating B. So it means risk would be very high with B, right? Risk could be very high. And if I compare with those, then 10%, which is decent with a moderate risk, right? Then apart from this, India Bulls, again, private company. let me see if we have any highest. Let me filter it out. So these are the listed bonds, okay? So you can find the same information on a stock exchange as well. So all are listed bonds which are available. There is nothing in my demat account, so I will not say anything. See, the highest interest rate which I can see, which is 11%. See, now here you can understand this, guys, the term which is, putable bonds and callable bonds. Let's say you had invested in UP Power Corporation, right? You had invested in UP Power Corporation, but you got to know that the other companies like Akara Capital or Nindo, they are offering almost 10% or 11%, which is high, like 2% extra that you can earn. Then always you will look for how you can sell it out bonds to the company back or maybe to anyone so that you can reinvest in other bond series, right? So that's how your putable bonds come into picture, where that offers more flexibility or rights to the investors to means liquidate the existing investments and invest the funds in other investments, right? And same for a callable bonds. Let's say if the other if other companies, they have issued bonds at 9.7 or maybe let's say below that, or let's say 9%, then why should I pay, let's say 11%, right? Why should I pay 11%, 2% extra interest rate? Why should I pay it? Then what I'll do as a company owner, I'll redeem these bonds. I'll buy back my bonds, which was offered at 11%. And I'll also reissue the bonds with 9%. So net, I can save 2% interest payment, right, on bond investment. The reason is, see, as a business owner, bond investment, it's a loan. Sorry, bonds capital, it's a loan. We are paying fixed interest payment to the bond holders. Correct. So that means callable and putable bonds gives more flexibility. You can rate the, but if anyone is really looking for 11%, so you should invest in this. The rating of this Muthoot Finance is AAA. CRISIL rated it, so it means you can see at least to some extent safe and safety to your investments. So you should invest in Muthoot Finance bonds then, 11%, which is decent. If you have a 1 crore and if you invest in Muthoot Finance, then you can earn 11 lakhs per annum. Okay. See, big people, they don't expect 50% return, 100% return. See, this is the expectation of poor people. They always expect 1000% returns. Let's say, 5000% returns, because all our stories which we have heard through your YouTube channels or Facebooks and all, that's what we always get, trapped. The big people, if they have a big money, they'll not look for a 100% return. If I have, let's say I'm a businessman and I have 100 crores, see, what I'll do, I'll find 10 different companies like Muthoot Finance and I'll invest 1 crore in each company or maybe 10 crore in each company. And every year I'll earn 11 crores on my investments. And same 11 crores, I'll reinvest in other companies. So that's how they multiply their money. So they don't expect the 100% or 500% returns from the one company, right? This is like something rare where, let's say your grandpa, Nanaji, they have invested in XYZ companies and now your share price is now multiplied like 10x, 20x. But at this point in time, if you ask me, see, most of the businessmen, they have a different mindset. They always look for 10 to 15%, decent return annually. They invest in, assets. It could be business, it could be any fund or anything. If that offers 10 to 15% fixed return to them, the big investor only target to that. But common people like us, they always get trapped in equity market or here and there. And see, there are traders. Now you tell me, SEBI publish it, 90% traders or let's say investors, like small investors, they are in losses. 98%, only 2% people, they are making profit from the stock exchange. But in a bond market, only 10% possibility that you can see, you will lose your money. 10% that I'm saying. But in a 90% cases, you can make a money. At least you can make a 10% on your investment. Right? 10% is also very decent. Okay. 10 to 12%, which is very decent. If you compare with America, Europe, Japan, they have a bond yield around, 2 to 3% or below that. But in India, we have a decent around 8 to 9%. And which is fine, yeah. So if you have 10 to 15 lakhs, you should invest in this. So every year on 10 lakhs, you can earn 1,10,000, right? So it means 10,000 rupees per month that you can generate. There are businesses who invest in a crores of rupees in the business, but still, if you see their profit, no, they are not in profit. They're making huge losses. Take the example of Amazon. Amazon is not making any profit from Amazon, India. They're making huge losses, but still you have something, right? If you invest in this product, you will receive 11%, 10%. At least you can expect, means it is kind of an assured return. But what about the assurity and guarantee in equity market? There is no guarantee. There is no assurity. Maybe in 1 month you will generate 1 lakh. Maybe another month you will lose 2 lakhs. It's just a gambling, right? So big investors, they always target fixed income instruments and government securities to invest. And the people like us who want to become a rich in overnight, they always target the stock markets where they want to become a rich by earning 10x or 20x returns.
Just a quick info, guys. Intellipaat offers an executive postgraduate certification in investment banking and capital markets in collaboration with IIM Ranchi. Through this course, you will master key skills like financial modeling, valuation, mergers and acquisition strategies, risk management, and even niche areas like private equity and wealth management. The program features 80 plus live sessions conducted by IIM Ranchi faculty and industry experts, real world case studies, hands-on projects, and a 3-day campus immersion at IIM Ranchi. Plus, you will also get exclusive benefits like executive alumni status from IIM Ranchi and complete career support from Intellipaat. We have already helped thousands of professionals achieve successful career transitions in the finance domain, and you can check out the testimonials on our Achievers channel. The link is in the description below. And for sure, this course can set your career to new heights. So visit the course page link given below in the description and take the first step towards the rewarding career in finance.
See, when we talk about asset management, so asset is the key component of your asset management business. All right. So when we say asset, it means why we want to manage assets. Why we want to manage? Maybe let's say because that we have a plan, so that we can generate revenue out of it, right? Because assets offers appreciation in value. Assets offers, let's say, income, dividend, and other benefits, right? It could be any other benefit. So basically, asset offers different, benefits, and that's what everyone want to acquire asset, right? Everyone, it means everyone. Even if I talk about, let's say, individual person, even that individual person also want to acquire an assets. If I talk about, let's say, any institution, if any institution, it means any institution, that institution also want to acquire assets or manage assets. Why they want to manage assets or why they want to, let's say, acquire assets? Because of simply there's reasons: appreciation in value and appreciation in value of assets, and as well as gain in assets, right? See, whether you are individual or institutions, both have your own investment objectives, correct? Why we want to invest? Maybe that you're looking for appreciation in value of asset, right? If I talk about, let's say, bonds offer income opportunity so that we can generate 10 to 12% interest payment on bonds investments. If I talk about equities offer appreciation in value of equity, income, dividends, and other benefits, which could be anything, right? If I talk about loans offers again fixed income or interest payment. So that would be your income basically, right? From individual investors to HNIs, when we say HNI, it means highly net worth individuals. Everyone want to acquire an assets, right? Everyone means everyone. Then what are the assets basically? Stocks we treat as assets, bonds we treat as assets, loans, investment into loans again we treat as an assets. Then merger and acquisition of, let's say, your startups, again we treat that acquisition as an assets, and we always look for benefits like appreciation in value, income, dividends, and all. Then any other even any other contracts, it could be anything, that all comes under your assets. See, the purpose of this asset would be, it's very simple. Everyone, see, they have a money, right? They have a money, but they want to multiply their money. See, there are two mindsets, guys, which are exist on this planet, right? If I talk about, let's say you have a 1 crore, right? You have a 1 crore. Will you work? Means will you work hard? I'm sure your answer would be no. If you ask me, then again, if you don't know, let's say, how to multiply your money, then maybe you can say, look, sir, even if I have a 1 crores, I'll still work very hard. I'll do 10 to 6 job and try to make some money to let's say fulfill my dreams. But if I have a 1 crore in liquid cash, see, even if I don't want to lose any money in stocks, cryptos, or any other financial instruments, then what I'll do, I'll simply look for loans or bonds investment opportunities which they offer around 12%, which is a fine for me, because on 1 crore investments, see this, how much I can generate annually, almost 12 lakhs that I can generate. So 12 lakhs, guys, which is a package of the experienced banking professional, like who's having around 10 to 15 plus years of experience. Those people, they're earning 12 lakhs, means average that I'm talking about. Maybe someone is earning, let's say, 1 crore, or someone, let's say, 2 lakhs or 5 lakhs or 10 lakhs. So if we just average it out, average salary of investment banker or other the professionals who are into banking, they're earning around 12, right? They're earning around 12. So if you have a 1 crore and if you just invest that same money in let's say low risky financial instruments, still you can generate 12% return. And this 12% return, which you can use for maybe your expenses, lifestyle, and also you can reinvest some money as well. Same money you can reinvest also to multiply your returns. And within just 5 to 6 years, you can add another 1 crore. See, trust me, to earn 1 crore is just difficult process. But if you have a 1 crore, or if you, let's say, earn 1 crore, then you can easily convert that 1 crore into 10 crores. Then if you have a 10 crores, then you can easily convert your tens into 100 crores, right? Then after that, see, after 1 crore, process is very easy, but to achieve 1 crore, it's very difficult. It will take at least 10 years to reach to that benchmark, and which requires a lot of hard works, ideas, or a lot of things to build portfolio like this. It's not an easy process. But if you let's say if you generate 1 crore, then trust me, you would see very easy process to multiply your money, right? You can earn 1 lakh rupees by just investing your 1 CR in financial instruments. You don't need to do anything at all. It's just go to the broker side, identify good assets, and invest your money. And same, let's say, interest income means this 12 lakhs. Maybe you can split into the risky investments like stocks. Every year you can invest around 5 lakhs in stocks, because 5 lakhs, I'm assuming your other expenses, right? From a same bond investments, you have invested your 1 CR in bonds, you are generating 12 lakhs per annum, and out of 12 lakhs, you are investing 5 lakhs around in equity investments, and around 6 to 7 lakhs, which is enough for your family expenses, 50,000 family expenses, which you can, means you can live a decent life along with your parents, mom, dad, and your kids. Did you get this? So it means, see, this is how, see, everyone looks for a same. Even if I talk about, let's say, institutions, see, when we say institutions, so there are, different institutions, guys. So individual and institutions, both will have a same financial set of objectives, individuals and institutions. So now if I talk about institutions, there are different institutions, let's say mutual fund, again, which is a institutional, or organization or a trust, I would say, where they raised money from the common people like us, and they invest money in financial instruments, right? Why mutual funds? We'll discuss that as well. You can also see like hedge funds. Again, hedge funds also raise funds from the investors. and raise that funds, invest that funds in a variety of different financial instruments. You may see, private equity funds as well. Private equity funds. Again, private equity funds raised investments from the people and invest money into the different asset classes. Then you may see SPVs as well, special purpose vehicle entities. Special purpose vehicle entities. So when we say special purpose, your special purpose could be fundraising, investing, or maybe to convert your bad assets into, let's say, tranches to create or generate more liquidity. So basically, it's a CSP is basically used for converting your bad debts into liquid form, or maybe let's say if you want to raise any capital from any different financial instruments, still you can use SPVs to raise the funding through your securitization process. All right. Apart from that, see, governments, they also raise funding from the common people. Then private companies, they also raised funds from the common people. Public companies, they also raise funds from the common people. And finally, let's say insurance companies, they also raised funds from the common people. See, ultimately, who is investing into their businesses? Who is investing? Only common people. Common people like us, because we participate in IPO, we participate in secondary market, we participate in bonds events, we participate in derivatives, and we are the people only. We also run the startups or own the startups or own the companies. So it means this is a model kind of, I would say it's a public model. So in both, to both the sides, you can see public only, common people only. Maybe from buyer side, maybe from seller side, you can see them only. So ultimately, all, let's say, if I talk about mutual funds, it's an institutions where raise funds from common people to invest in stocks, bonds, and money market. Mutual funds intention would be to raise funds from common people to invest in stocks, bonds, and money market. Now your question would be, look, sir, why should I invest in mutual fund? So you should invest in a mutual fund if you don't have a total full gyan of capital market. Answer is very simple. There are people, even they don't know the basics of, let's say, this financial market, like equities, bonds, debentures, the rules of markets, or how they can generate, let's say, income from different securities. They don't have even basic idea about it. Now you tell me how they can make money. Let me tell you about myself. In 2014, I lost around 2 lakhs in the stock market. In during 2015 to again 2018, I lost around 4 lakhs. Right. Again, when I lost that money, I took a loan from my couple of friends as well, with the promise that I'll repay them with the 12% interest rate, and I took a loan from them to invest in stock market, because I got influenced by the influencer. Like, if you invest in stock market, and if you get a penny stocks, your assets will be 10x, 20x. Even I had invested in one of the penny stocks. I was holding around 10,000 quantities of TTML. But see, purchase price was 1 and sold price was only 14. But that stock, it was reached to the 283. So I missed that target. So my point here is, I wasn't aware about it, how stocks works, how, let's say, price works, how, the market fundamentals are, what we need to follow during trading, during investing, during, let's say, scalping, during maybe, let's say, directly buyout, and large stake of a business and hold, during merger and acquisition. I wasn't aware about it. So it means I had no idea, and where I had invested around 4 to 5 lakhs in the market. Trust me, I lost everything, and I was under debt of around 7 to 8 lakhs by 2019 ends. 2020, when pandemic started, again I picked up another idea, which was a business. I wanted to do a business now, but I believe early, it's 2020 or maybe end of 2019, started one startup, and again I lost money and everything, right? And my debt was around 10 lakhs somewhere, because 3 lakhs almost that I spent on startup, and again I lost that as well. See, the point here is, at that time, let's say if I would have invested my money, same 7 lakhs, through mutual funds, right? Same mutual funds. Trust me, I could have saved my time, my interest payment, right? Then my again efforts, and also if you see in terms of returns, most of the investment instruments or even mutual funds, means most of it, means I'm talking about 50% mutual funds, they have generated around 40% return, 30 to 40% return for per annum, right? Even if it was the loan amount, still I would have generated at least 12 to 15% returns for per annum without any risk. But because of, let's say, understanding of market, I lost everything which I had. Then I met with few fund managers, because since I was into investment operations or banking, middle office operations and all, then I met with few of the very talented people, means they are still they are into this banking and all, and I took advice from them about the investing. Then after, see, I got enough understanding about market behavior, trend, price trend, and the news or the inside details and everything. I built my portfolio with the size of 25 lakhs after that, and with you can say around 10 to 15% IRR. I'm not talking about normal returns. IRR, it means which also considered your time value adjustments and all. All right. And overall return, it was somewhere around 30%, 30 to 5% returns, and which was again decent. Few scrape it was in loss, and few scrape it was in profit. But if you just average it out, portfolio, it was performing very well. So now see, there are two scenarios. When I wasn't aware about this mutual fund, hedge fund, and private equity, right? I started on my own. I lost my money, right? And if you, let's say, think other way around, basically I lost my money as well as time as well, correct? And which is very important, correct? So same way, if you invest your money through mutual funds, if you invest your money through hedge funds, private equity funds, SPVs, or government any schemes, or private company schemes, or public company schemes, see, they are a team, they have an infrastructure, they have a well qualified people, so they'll operate your money to generate return for you as well as for them. Let's take example of, let's say, private companies. You're a startup founder, you're looking for a 1 crore. Why you want 1 crore? Maybe you want 1 crore to invest, or maybe to hire talented people who can help you to scale your startup business to the next level, correct? So you need a money for that. Let's say I'm the person, I don't have a skills to do my business, I don't have that visibility to convert that idea into multi-billion dollar company, but I do have a money, and even I have a capacity to invest. There are two aspects. One, I have a money, I'm ready to or willing to take a risk, but I don't have a, let's say, understanding of business, right? Then in that case, I can simply invest my money in startups, because startup founders, see, maybe let's say they have a zeal, or they have an idea, or it could be like they have a potential to generate or employed your money to convert that money into 10x returns or 20x returns. Did you get this logic? So one class of people always, you can say, is they are always hungry for money or capital, which they want it from you guys. And the other class of people is, you have a capital, you have a, let's say, you are willing to take a risk, but you don't know where to invest, or maybe let's say you don't have an infrastructure, you don't have a business idea, right? But again, you have a business vision, you have a business mission, you have, let's say, your vision about your investments, correct? about your investments. And that's what you are looking for someone else. So someone else, it could be individual investment manager who can guide you to manage your money or invest your money in different asset classes, or else it could be any institution, including mutual fund, hedge fund, private equity, SPVs, governments, companies or public companies or any other institutions where they need a money from you to invest. Now your question would be, look, sir, I got in case of startups, that startup founders, they need a money. If public invest, they'll reinvest that money in sources and they'll generate returns for public money as well as for their efforts as well. That is how business entrepreneurs or startups founders works. But if I now talk about governments, why governments need a money? Why governments need a money? Let's take example of, let's say governments, any ministry like National Highway Authority of India, which is Nitin Gadkari's ministry. And as we know it, this is one of the ministry who have built road across nation. Before 2015, we had no highways. It was, but the slow of development of highways, it was very low. But if you see now, I am from Maharashtra. In Maharashtra, you can see almost means across everywhere you can see national highways across all the districts. So most of the districts he has connected through national highways. Right now, let's talk about funds. How did he raise funds? Who gave this money to him to build the roads? I'm sure most of the people that you guys will think about, look, sir, Modi, promising everywhere that we are building roads, It means definitely Modi would have given enough fund to him to build the roads. Answer is partially, agreed, because they have a quota. So since Modi is the, prime minister or president of the development council, so he'll approve some funds and allocate it to the ministry. But the national highway ministry budget would be around somewhere 1 lakh crores, max to max 1 lakh crores or 2 lakhs crores, since it is a big portfolio. But he built the roads more than hundreds lakhs crores even, because go and check the worth and data. But how did he achieve that target and milestone? Now here is an answer. Nitin Gadkari's, that National Highway Ministry raised fund from public. See guys, public has a huge potential and capacity. Huge, it means huge. Even if you target, let's say 1 crore people, in the nation, because we are like around 140 crores, let's say 150 crores gross, reported and unreported. Out of 150 crore, let's say 50 crore are kids or minors, which they can't invest. Right. Even if I talk about, let's say, remaining 100 crores. So out of 100 crores, the assumption is, let's say 50 crore people, they are aged. Again, they can't invest. They only invest in maybe X, Y, Z, or even they don't want to invest. Now let's talk about remaining 50 crores. Out of 50 crores, I'm just saying, if you target only 1 crore people, and if 1 crore people, let's say, if they invest 1 lakhs in your any project, it means any project, multiply the value, guys. Come on, just multiply it. 1 lakhs crores into 1 lakhs crore people into 1 lakh investment. It would be somewhere around 1 lakh crore. Am I right? 1 lakh crore, more than that. 1 lakh into 1 crore, it would be somewhere around 1 lakh. My calculation may be wrong because it's just a hypothetical number. See this much amount of money that you can raise. And if you have a 1 lakh crores, and if you reinvest that 1 lakh crores anywhere, if you reinvest that money anywhere, see how much, if you have, let's say if you have a solid idea or any assets, then you can generate more and more money. See, same ministry offers 10% interest payment or coupon on investments. Coupon is nothing but again interest payment. So they are ready to give you almost 10,000 crores return back to the public if you invest 1 lakh crores in their business. And that's how even businessmen also apply the same logic. We criticize to the Adani, we criticize to the Ambani, we criticize to the Birla or other business families. See, the fault is not in the business idea. They know it how to capitalize the assets and raise funds from the public. because they're not forcing you to invest in their stocks. Did Adani force you to invest in their stocks? Did Ambani force you to invest in their stocks? Did anyone, as of, from the business families, did anyone from the business families, did they force you to invest in their business? Then how they are selling their securities? See, guys, the model is very simple. Public has a money, but they don't have a resources. That's what I said. For example, let's say, why will invest in Reliance Group? Why will invest in Reliance Group? If you ask me why will invest, let's take an hypothetical situation. I want to do business, right? My capital is 10 lakhs. I want to do business in, let's say, petrochemical. If I invest, let's say, money, this 10 lakhs in petrochemical, again, this 10 lakh is nothing, correct? So we need at least 5 crores to set up units or to, let's say, import, the raw oil or other chemicals, alkenes or alkynes. There are a number of components which is needed. We need a processing units. We need hundreds of, the labor force, then hundreds of different licenses from different ministries. So how will you manage that? First question, ask this yourself, right? Again, at the end, you will say, look, sir, this seems more complicated. So how can I do? So it means this petrochemical business is not for me. So within, let's say, 1 hour, you will say, I don't want to continue with this because my capacity is only 10 lakhs. How can I arrange another, 5 crores or maybe 10 crores to establish factory or, other things, distributions, marketing, processing, labor cost, market, research, regulatory licenses. How can I do it? So within a 1 hour, your mind will say to you, look, this is not, your cup of tea. So you should not look for business, but you are very passionate about it to invest or to start, your business, something to maybe, let's say, generate ROI of, ROI of 20% on 10 lakhs. So basically you're looking for 2 lakhs income out of it, right? See, you have an idea, understand this one, then only you can understand the perspective of this, the financial ecosystem, like how this system is, based on. One group of people now, see, they have a fund, but they don't have a dare to kickstart any idea or business, but they want to do something. Maybe they want to do business and all. But again, when they think about, let's say, capital, planning, business, strategy, architecture, and everything, they're not ready to or willing to take it forward. Then here you can see, the best option as a public. What if I don't want to do my business? That's fine. What if I look for any, let's say, petrochemical business, and if I invest my money, let's say same 10 lakhs, and if that business has a capacity to generate 20% return annually, then that's fine. Then see, if you invest your 10 lakhs here directly, Ambani personally doing business, Ambani will, pay attention. Ambani will hire people, marketing, factory, technology, R&D, distribution, loans, if it is needed. See, everything your Adani will take care of it. Everything, it means everything. Everything, if Adani will take care of it, then see this, your responsibility is only to take a risk up to this amount. If something happened, Adani will take care of it, everything. This is how, investing come into picture. So one group of people, they don't want to take a risk, but they want return on investments. They want, entire setup like company and everything, but they don't want to manage that, on, let's say, they don't want to manage on themselves because they're not ready or willing to do this. Maybe because of time, maybe because of, let's say, they're interested in petrochemicals, but they don't want to own petrochemical company. That's when your investing journey will start it. Then simply you can invest your money or put your money with Ambani or Adani, whosoever, they'll take care of it, everything. They'll manage your money. They'll produce, they'll, process, they'll do R&D, they'll distribute, they'll take care of it, everything, and generate money for you. and for themselves as well. If they generate profits, they'll also keep their profit, means business profit, for them, maybe as a salary or commission, and remaining profit they'll distribute it as a dividend distributions to all holders. So don't you think that it's an opportunity to, let's say, one group of people, they're sharing investments, or let's say fund to the others, and other people who has the skills, who has, let's say, capability or ability to establish business, right? They'll establish business, but they'll raise funds from the common people and grow or scale business to the next level. Did you get this? So this is how basically this business works, or your investing works. And then you can simply go to the market and purchase securities of Reliance and invest into it. Let me give you my example. I wanted to do something in solar. Solar, it means why? Because solar is rapidly growing, and in future also, see, we are like more than 800 crores people on this planet. Only I'm talking about peoples. Apart from peoples, we have other living organism as well. If I consider them, the population would be around more than 1200 crores people that we are exist on this planet. Let's talk about one by one thing. We don't have any alternative for food. We don't have any alternative for water. We don't have any alternative for energy. We don't have any alternative for clean air, right? Even your hospital things. Let's say if you are infected by any kind of critical disease, it could be AIDS, it could be cancer, it could be any other things. We don't have any other option. So it means you will have to go through the hospital treatment. Defense, due to rapid expansion of globalization, now we are under threat of safety and security as well. So defense automatically come into picture, right? Then of course agriculture. So if we talk about, let's say, food, automatically agri come into picture. So now how can we, let's say, meet all of this requirement? Just think about it. See, there are my top sectors. If you ask me as an investor, sir, where or let's say even not investors, if you ask me, sir, means in which segment you would like to do something. See, I would like to do something in food, water, energy, clean air, hospitals, defense, and agri. It could be other sectors as well. Let's say if I want to do business, then maybe I can start from the, let's say, Vada Pav center, maybe let's say your small restaurants. It could be my small or that energy distribution center or supplements, or it could be anything, correct? The difference between investments and businesses, in a business you can operate all of that activities, and in investments you can give a funding to someone else. So someone else will operate that activities on behalf of you and will generate money for you and for himself. That's the difference between, I would say, investing and doing business, investment and doing business. So if you ask me, as I said, I'm interested in, let's say, all of these sectors. So I would like to do something. I would like to maybe do something maybe as a startup in this particular field. But what if, let's say, I want to do that is something different, but am I ready to take all of that responsibilities? Because as a startups, what we need, see, we need all of these activities, but I'm not ready to do all of these things at the moment, because see, as I said, my capital is very small, like let's say 1 crore or maybe 50 lakhs or 20 lakhs. So within a 20 lakhs, maybe if we can kickstart the business, but fundraising and again to inviting people, convince people, it's a lengthy process. So why should I do this? Instead of this, maybe whatever money that I have, 10 lakhs, I can simply invest in a startups or in a companies who are operating in food business, who are operating in water management. It could be Bisleri, right? Who are already operating in energy, clean air, hospitals, defense, agri. So when they, let's say, in agriculture, when they, let's say, start doing business, automatically my money will grow, right? Automatically my money will grow. So this is how you can define investment approach and, let's say, businessman or entrepreneurship approach. Now let's come back to the main point, right? See, as I said, we have two different class of peoples. One is investors, another one is businessmen. How businessmen raise fundings. Even if I talk about, let's say, businesses, governments, or any other institute, how businessmen or businesses raise funding. So now if I talk about, let's say, how they raise it, they simply sell securities or their resources. Why, sir? Because they are a team, they have skills, and so on and so forth. They have everything, but they need a funding. Now let's talk about investors. How investor can make money? How investor can make money? By investing funds in the businesses. So buying securities is nothing but buying securities. It means basically buying business percentage. It could be 1%, 0.001%, right? So and so forth. So basically, as investors, investor want to buy a stake in the business. Why? Because see, as a alone, I cannot buy the company of 1,000 crores or company of, let's say, I cannot build company of 1 lakh crores. But if I invite you guys to come and join my club and contribute, let's say, money, then we can build empire of 1,000 crores or 1 lakh crores. Then it's very simple. So the approach is very simple. So investors, they buy stake in the business through investing. As I said, maybe they can invest in loans, invest in bonds, invest in stocks, invest in any coins, contracts, deposit, money market instruments, or etc. So investors, they simply purchase it and invest it. Now, see, every time businesses or business owners and even governments, they don't educate to educate to the people or educate to the anyone to invest in this instruments or that instrument. Since you would see, let's say, lakhs of or crores of instruments, or the companies are exist on this planet and they are selling their securities. So as an investor, see, for me, what matter most is we need a solid businesses. We need let's say, solid ideas. We need, let's say, fundamentally strong businesses to invest. Am I right? But as an individual investor, now you tell me, how can I assess the information of top 100 companies and their research? If I start doing research of all of those companies, it will take at least 1 or 2 years to get the detailed information of such a businesses. So it would be very difficult then in that case. Would be very difficult. It means would be very difficult. So how can I manage it? If I talk about, let's say, Reliance Group, right? If you want to understand the Reliance Group in details, then you should know first, let's say, basic of accounting, like how to read P&L, how to read balance sheets, fund flow statement, their business model, idea, revenue streams, then multiple revenue streams, then bank date, cash outflow of bank date, then equity percentage of Ambani Group, or their the parents companies, funds, then revenue history or profit history of that same company. What if, let's say, under one Ambani, let's say, name, there are hundreds of other entities. It could be A, it could be B, it could be C, and that C again has invested in multiple, let's say, levels. How we can read all of that complex reports? Now you tell me. See, my point here was, if you're a cognizant investor, cognizant, it means, let's say, well versed with detailed research of companies, their balance sheets, businesses, and fundamentals, then you don't need to invest your money through anyone. Then you can manage your money on your own. Even if you invest money through mutual funds, still you can see the risk of your capital is like, you can lose your 100% capital also. Even if you manage your money by own, still you can see a risk of losing capital of up to 100%. In both the cases, the risk is 100%. Now your question would be, look, sir, if you see the risk of, let's say, the investment is like 100% in any mutual funds, then why should I invest my money through mutual funds? See, mutual funds, they work in between. Mutual funds,
hedge funds, private equity funds, and SPVs. Because again, they are like team of professional people experienced into funds, into fund management or investing part, I would say. They have a technology which is needed for research. They have an infrastructure, maybe catering the requirement of different people along with their, in different investment objectives. And they have connects across businesses. So it means they're holding the information of different, the databases or companies where easily they can deploy funds, maybe 1 crore, 2 crore, 3 crore, 10 crores, 20 crores, 1000 crores. They can easily deploy the funds. So this is how you can see the intervention of funds into the, the business. So basically, if you are, let's say the difference between like why we need a mutual fund, now I'll decode that. First, try to understand this one. See, as a team, always you can expect better result or outcome in terms of research, in terms of identifying, potential opportunities, or in terms of, let's say, generating return on investment. But as a team itself, you may see different threats as well. It could be, let's say, lack of skill set, cooperation, right? Then the information breach or, lots of other, the risk which you would see, which will be involved in the, that transaction as well. But again, if someone is offering technology, infrastructure, and let's say they have connects across businesses, then you can save your time as an investor. Am I right? You can save your time. Now your question would be, look, sir, why these guys will offer, something in free of cost? No one offer anything in free of cost. Mutual funds, hedge funds, everyone, they charge fees. Mutual fund charge fees, management fees, or expense, like up to 2% annually. Hedge funds and PE funds, they charge management fees up to 2% and incentive fees up to 20%. It's like a profit share which they charge to the investor. So why investor? Because if you want to manage your money on your own, you can manage. If you want to manage money on your own, it means it's a direct investment. So you don't you don't want anybody's intervention, or you don't want, let's say, anybody in your this particular transactions. You're capable to handle the transaction, research, and everything. Then you can simply or directly purchase securities from the market. You can purchase any securities, any means any securities or whatever securities that you want, you can purchase it, right? But if I talk about, let's say, intermediate form, then as I said, we can't, do the research of each and every company thoroughly. But as a team, mutual fund company, your hedge fund company, private equity company, they can do it because they have a team, they have a technology, they have everything which is needed to do the research of the business. So they can easily manage your money. And in return of, management of money, they'll ask you to pay 2% management fees, 2% incentive fees, 20% incentive fees, or any other, different expenses. They'll directly ask investors to pay it. So it means if you invest your money through mutual funds, through hedge funds, or through private equity funds, investors will have to pay extra cost. That's the difference. Extra cost. Why? Because if you hire me as an investment manager of your business, of course, I'll work with you, but I'll ask my profit share because I'm going to give you my expertise. Through my expertise, I'll generate money for you and I'll generate money for other businesses as well. If I generate money for, let's say, for you and, for other businesses, then I need my profit percentage. It could be 1%, 2%, 3%, 20%, 50%, depends on your partnership agreement. And this is how your asset management come into picture, guys, hereafter. So it means simply, if any investor has a, let's say, capability to identify businesses and investment, as I said, investment is nothing but it's all about approach. I want to invest because I don't want to do business. And if I talk about businessman has a skills, has a team, resources, and infrastructure
So businessmen, they are ready to manage your funds. So they'll employ your funds on behalf of you, and they'll generate money for you and for them as well. So this is how you can define investors and businessmen. But ultimately, both are people. So both need a funds. Both need, let's say, both have their own expectations like income, interest payment, appreciation in assets, and value of investments, I would say. Now, see, if I talk about asset management companies, simply why you should go through the asset management companies, because as I said, maybe you're lacking with skills, you don't have a time, or maybe let's say you don't know how to invest. In that case, you can simply approach to the hedge fund managers, private equity managers, or maybe let's say any other companies who are into this particular segment. So basically, asset management companies, they are intermediate person. All right, they are intermediate person or intermediator between investors and the business owners or governments who are looking for funding. Now, sir, in this particular spectrum where we see investment banks, you can see at top, because investment banks basically offer advising, consulting, underwriting services to whom? To the investors as well as to the business owners. Why? Business owners need a funding. So investment banks, they basically underwrite business, calculate value, and sell the securities on behalf of company. That's what we'll call it investment bank as a sell side entity. What we'll call to the investment banks? We'll call it investment banks to the sell side businesses. And also investment banks do some R&D as well, research and development, I would say. So it means if they want to do research of any businesses, they can form a separate business, perform some research, try to understand the requirement of or immediate requirements of the clients. They can also support companies or investors to raise fundings through different methods or through different strategies. And they offer consulting facility as well, consulting in terms of capital budgeting, merger and acquisitions of entities or assets. So this is how you would see the role of investment banks in this particular business. If I talk about mutual funds, hedge funds, private equity funds, and SPVs, relation between, let's say, hedge funds and these two other segments. So the relations is like, it means they closely work with each other, guys. Why? Because the investment banks, they have contact details, or they will have, let's say, research paper and everything. See, same research paper, who want it? Mutual fund companies want it, because mutual fund companies, hedge fund companies, they raised funds to invest. But in which company that mutual fund company can invest? That research they can access through investment banks, or other way around. Investment banks actually hold the security information of businesses. The reason is businesses only hire investment banks to underwrite or calculate the value of their stocks as per the market circumstances or conditions. So it means investment banks and hedge funds, they work in a collaboration, because investment banks fulfill the security requirement of fund businesses, and fund businesses can meet the funding requirement of investment banks clients. It could be, let's say, TCS, Infosys, Adani, Ambani, or other businesses. So this is how actually the model that works in this particular segment. So basically, all these companies will call it as AMCs, asset management companies, because they manage the assets. They own the assets on behalf of their clients. Clients, it means investors, and invest that money into the different financial instruments and generate returns for themselves and even for investors also. Now your question would be like, sir, how investment banks then generate money? See, investment banks, they have a different ways to generate money. So nowadays the investment banks, they have multiple functions, or I would say roles and responsibilities. It could be research, it could be underwriting, it could be holding securities for some time. It could be consulting and advising to the businesses and governments. So this is how you can see the role of investment banks into this particular picture. One more important thing that you should know it as an investment banker, a professional, or let's say, since you have enrolled to this course, so you should know it. Investment banks, they work at sell side. So it means sell side companies like business owners, they actually hire investment banks to do the underwriting of their business and also to support to get the potential buyers of for their securities. And potential buyers, it could be retail investors, or maybe let's say HNI or AMCs like hedge fund, mutual funds and private equity funds. So basically investment banks, it's like a breeze between businesses, investors, as well as to the mutual fund and hedge fund businesses as well. So basically mutual fund businesses, they are like sell side entities. They are sell side entities, and even investors also, they are sell side entities. Sorry, my bad. Buy side entities. Sorry for this. Now your question would be like, sir, look, why buy side entities? And who are the sell side entities? See, businesses, governments, and any other entities who are selling securities. They come at sell side businesses, and who is buying securities by investing funds, they come at buy side securities. Buy side securities. So we'll talk about now buy side companies. And one more category that I would like to add here is to HNI. HNI, it means highly net worth individual investors. Okay. So we'll call it them as HNI investors. We'll start from the very basics. Okay. If I talk about now HNI investors, see in India, your chartered accountants can provide you certificate, but you should have to have a liquid cash of 1 crore. Then only you can approach to your CA to certified you as an accredited investors or HNI investors category. And then after you can directly buy and sell securities from any companies. It's like mutual fund, but you can't raise funds from others, but you can invest your money anywhere, right? That's the criteria of HNI category. For a retail people, when we say retail, it means you can invest minimum of rupees from even 10 rupees. If your broker allowed to add, you can add 10 rupees and purchase any penny stocks, like 1 rupees value stocks or 2 rupees value stocks, you can purchase it. Correct. But yeah, for HNI category, so we have a special provision, and your CA must do the audit of all your financials and provide you the certificate on the basis of that, because that certificate is needed while opening broking account, bank account, or even any investments account with any firm. That certificate is must. All right. See, retail people are allowed to invest in mutual fund and other financial instruments, stocks, bonds, money market instruments, preference equity, and other securities. And if I talk about, let's say, HNI investments, HNI investors are allowed to invest. But apart from that, they're also allowed to invest in hedge fund, P funds, all right, mutual funds, and even SPVs as well. Mutual funds, see, they are the institutions, basically, they raise funds, right? Public. When they raise funds from public, see, minimum investment size, or I would say, minimum investments, which I have seen, like, from 250 rupees, they can invest. Means they can raise funds basically from anyone. Anyone means anyone. And in terms of investments, fund manager manage funds, raise funds from the common people, and manage that funds, take investment decisions, invest funds anywhere in any asset classes which is approved or authorized by the mutual fund or that particular scheme, and they can easily manage it out. Mutual fund has a types. One is open-ended and close-ended. So in terms of definition, if you ask me, just a pool of investors' money. Now your question would be like, sir, what do you mean by exactly pool? Let's say if I create a pool, let's create a pool now. Let's say all are investors, okay? Let's say that everyone's capacity is like 500 rupees monthly. Their capacity is like investments of monthly. Okay. There would be one fund manager. Fund manager basically create a pool. So when we say pool, it means fund manager will create the one designated bank account, and legally, fund manager will ask to everyone to deposit this money, deposit money here. If we just total out all, so they can contribute, around, let's see the calculation, 3,000. So this pool would be for 3,000, right? And who manage that pool? Your fund manager basically manage that pool, because all rights will be with fund manager to take care of that money. So I'm talking about legal rights. So this is how your flow looks like. Fund manager will receive money, and then same money, fund manager will get the access to withdraw money. Let's say maybe 3,000 to invest in stocks, bonds, or let's say money market. Money market, it means government securities. So this allocation that you might see like this, 1,000 in stocks, 1,000 in bonds, 1,000 in government securities. So this is what we'll call it as an allocation. So if you invest your money, that money will be allocated to all of this companies, and fund manager will take care of it, that money, management, investing, or all other activities, I would say, whatever it is required. So that fund manager will take care of it, everything, and money will be withdrawal. It means basically money will be withdrawal for investment purpose, correct? The fund manager will take care of that money, withdrawal and investment part. So this. Now your question would be like, sir, look, if they invest all of this money, so how we can measure their ownership in this particular fund? See, if they come at same time, then you might convert this into units. Let's say the unit price, because in the mutual funds we allocate units, correct? So unit price, let's say 10 rupees, right? So the calculation would be total investments value divided by units, whatever units that you have. So investments and units allocated. So you can, if you are investor, go and check on the sides, you can see the same thing basically. So units will be allocated to you with the price, and to every investors, then you can allocate equal units on the basis of their capital or contribution, I would say. Since it is a pool, so it is mandated to record everything. So fund will out and they'll receive the ownership, as a this units, and units will have a value. So investors can redeem units at any point in time. They don't have any restrictions. In an open-end funds, they can invest at any point in time. But in a closed-end funds, let's say closed-end funds has an expiry of 2026 December. So until 2006 December, we can't redeem that investments. All right. So in a closed-end funds, fund will closed for 5 years, for 2 years, for 3 years, and then it will not allow investors to invest again in that same fund. So it would be like a risky fund business, risky for investors as well, because the investors won't be able to, I would say, redeem their investments and withdraw money back. So if you want to invest as an investor, think from an investor perspective. If you want to invest your money in mutual funds, then my suggestion would be, do not select date, because they always ask you for a date, 1 month, 2 months, 3 years, 4 years. So they always ask. So do not select any in a specific period, maybe 3 years, 4 years. If you select the date, your investment will be locked for that particular period. So it means you have selected close-end funds for that particular scheme. That's the difference. But in open-ended, no restriction on entry and exit. So at any point in time, you can take an entry. At any point in time, you can take an exit. So it's on you basically. But here, entry and exit not allowed. Sometime I would say entry is still allowed, maybe not in the same scheme, but in other scheme. But exit, which is something I would say it's a mandate to follow the deadlines or mandate to follow that in a specific period. So within that, you cannot means take exit early, right? So this is how you can define. And maybe let's say this mutual fund, open-ended and close-ended, they can put a restriction as well, put a charges, I would say, in terms of restrictions. In entry, you might see 1% charges of total capital. Even exit, you might see they can charge 1% fees. So this fees, we'll call it as a load expenses. It's just a name, but expenses are expenses. They can charge load expenses. They can also come up with the fund manager can also design framework like if you stay in the investment scheme or pool for maybe 1 year, more than 1 year, they'll not charge huge fees. They'll just charge, let's say, below the 1% or below the 2%. So it depends. I'll walk you through one or two schemes and their prospectus. Suddenly, I forgot the name of app here. It is asking for a login. Yeah. So here you can check the mutual funds. Select the sector. Okay. In a mutual funds, you can see little bit categorization, I would say. Small cap, it means this fund invested in a small cap companies only. Flexi cap, it means you can see the fund invested amount or fund manager, let's say diversified amount in different companies. Large cap, it means total fund invested in large cap companies like TCS, HDFC banks, right? They comes under large cap only. ELSS, it means equity linked saving schemes. So this is something the fund will be invested in equities as well as the deposits or even government securities. So it means you cannot see 100% risk. So but yeah, up to 50% you might see risk. And if I talk about core money market bonds, it means, so here if you see in their subject line only, see money market bonds are lowest risk which you can see, and in terms of liquidity, it means highest liquidity will have with the money market in funds. But in terms of return, you may expect only 2 to 3% return on money market funds, not more than that. Max to max 5 to 6%. Corporate bonds, high risk, high return, then FD, right? Around 10 to 11% return that you can expect on corporate bonds. But duration would be like medium term duration for 1 to 5 years. If you have a goal of 1 to 5 years investments, you can invest in corporate bonds, mutual funds. Small caps, high growth potential and higher volatility. Most of the small funds, see in last couple of years, this is a fact that the small cap funds have delivered strong return, but even we have seen huge volatility as well. Flexi always they maintain a balance. Large cap, low risk with consistent return. So we'll see that. First we'll target the small cap one. So we have these schemes, small cap schemes. In terms of AUM, there are small funds as well, like LIC, Quantum, Quantum small cap. So all are like very small cap funds. So you can target them if you want to invest in any of the securities. If you want to check the higher size AUM, it means the asset which is under management. So when we say AUM, so as per our example, let's say stock investment price is this, but current market price, it could be different. Let's say current market price of 1000 investment is 1500. Bonds accrued interest is 100. Government securities also accrued interest is 100. Now, if you see the total AUM, total value of investment, if you ask me to calculate, AUM, asset under management. So asset under management is this one, 4700. It means 4700. But out of this, we'll have to also debit expenses as well if there are any. Debit payables. For example, let's say payable expenses are 100. Then you need AUM would be, asset under management would be 4600. So AUM is nothing but it's an asset which the fund is holding or this fund manager is holding. So we'll call it that, process as a AUM, asset under management. Now, if I click on, let's say, assets, this fund scheme, it is their NAV. See, NAV is nothing but again, NAV of a fund, it means if I calculate the NAV of, this portion, see, we have total number of units. Total number of units, see this, units allocated to each investors. Total units are 300, right? So 300 units, AUM, NAV per share, 15.330, which is NAV, net assets value for per share. So if you ask me, sir, what is my current, the benefit? See, it was book value of NAV, this one. The current value of NAV is 15.33. So if you just allocate, that price to each one, so investor looks like this, current market value of investment. So everyone has equal investment percentage. So equally we can allocate to each investor. Now your question would be, what if, sir, if investor want to sell it out, his units? So investor can sell it out his units to anyone in the open market, or even they can directly sell it out in the same units to the market, that mutual fund company also. So mutual fund company would be responsible for buying back your units. And that's what you should select open-ended. When you select open-ended, so you can sell it out, your security, that units, this allocated 50 units to anyone, or even you can sell it out same units to the company also. So it means in terms of, units sell procedure, you can see low risk. But if you select, the closed-end ones, it would be difficult for you to sell it out your investments, and that would be very tough, right? Now, in terms of your personal, benefit, if you ask me, current market price minus 500. So per share, your benefit for your basically this would be your unrealized gain. So unrealized gain on investment is 226.5 on investment of 500, which goes around more than 50% return on investments. So this is how we compute the return, or even this is how we compute the NAV of mutual fund. In an interview also, by default, if you, let's say, apply for any company like BNY, JP Morgan, Goldman Sachs, all they have a mutual fund businesses, because along with investment banking, they have a fund admin as well as, investment bank, this asset management side as well. So they'll definitely ask you questions around like what is NAV, how NAV works, right? How units we allocate. See, unit allocation part, which is something, whatever capital that you have, capital divided by price, any price that you want to put. Initially, you can allocate with that. And then afterwards, your current market asset value of, the investments that you can just directly split between your units. So this is how your means calculation works, right? NAV, and NAV always fluctuates based on the price, because if you see, initially NAV was at the time of, let's say, issuance, NAV was only 8.9 or it was 7.79. But in last couple of years, see, this was the duration of 2012, at that time price was 7.79, and if you see the current market price of same in a mutual fund is which is at 180 rupees somewhere, or I would say 178, because this is the NAV. If anyone want to buy it, you can buy this mutual funds unit at this price only, right? Now, in terms of returns, if we talk about in 2014, this fund delivered 97% return. In 2015, 15% return, then 5%. 2017, again, 62% return. 2019, it was tough, 18 and 20, maybe because of pandemic, I would say. But again, that fund recovered and we have seen like 74, 29, 48, and 29% return every year. So continuously this performed well. And if you see extended return, which are around 40%, right? In terms of now investment, if we talk about, see the small cap funds invested in HDFC Bank, Tube Investments, Multi Commodity Exchange, Old Map, Apar Industries, Kirloskar, Bale, Tejas Network, NLC, State Bank. Market price, but what is missing is like purchase price is missing, right? Purchase price, it means quantity that we can see for a few stocks like 21,000 K, ETK, quantity which is available. But the purchase price, we don't see exactly. And that's what the SEBI has raised question around, like, can you please disclose the per share price, actually acquisition cost of a price of each securities. But again, mutual fund companies, they have denied it. So that's a different story, I would say. All right. So these are the companies, guys. Basically, NAV depends on the performance of these companies. You can check all the details of a fund. Even this fund is also invested in for a liquidity management, invested in net cash is available around 1,400 crores. So if they receive any subscriptions or redemptions, they can manage very well. And they have also three-party purchase agreement. It means invested few of the money in, I would say, money market instruments, right? Collateral basis something, maybe they would have deposited money to raise liquidity and all. So they can do it sometime. It is just a routine practice of mutual funds. So they have the value around 58 lakhs under margin as well. Maybe if they have a position so that they can hold. If you see minimum investments that you can do in mutual fund is 100, so which is affordable, but you will have to pay 1.42% cost for per annum. It means on 100 rupees, you will have to pay 1.42. So this fees directly goes to the mutual fund manager. So if I talk about this AUM, basically, see, if you ask me the income of AMC companies, guys, or buy side businesses like hedge funds, private equities and all, details is in front of you. Just open your calculator and invest it. Open your calculator and calculate their income. 60,000 crores into 1.42%. Just calculate it divided by 100 and see the price or amount, how much that they are earning. If you see their tenure, Samir Raj, the total experience is only 7 years. Kinjal Desai, experience is only 6 years. And within that 6 years, they have raised almost 60,000 crores from the market. They have also mentioned the investment objectives. Their primary objectives of the scheme is to generate long-term capital appreciation. And that's what I said. When we say buy side, it means they'll invest because of capital appreciation and income. And equity and equity related instruments of a small cap companies. And the secondary objective is to generate consistent returns by investing in debt and money market securities. Exit load, it means at the time of exit, 1% fees will be charged if you sell out your investments within a 1 year. But up to 1 year, they'll not charge anything as such. But this is expenses like 1.42%, which is a mandate expenses for everyone. Every year, company will charge. See, this mutual fund managers, they'll charge every year 1.4% on AUM, asset under management. This is annual fees. more the expense ratio, which is a danger for investors because they'll directly, debit from your pocket. And this affect on the total AUM of a fund. Even if you perform, let's say funds perform losses, they don't care at all. They'll directly charge 1.42% fees on AUM. More the AUM, maybe, it would be more benefit to the fund managers, and lower the AUM, it would be maybe, again, loss for them as well, but still they'll make a money out of it. How your funds perform, whether it is, let's say, in a negative or positive way, fund manager, they don't care at all. It is not their responsibility. Legally, they are responsible, but if something happened with your fund, see, in an ad also, if you see, they always give a disclaimer or warning, which is investing in mutual fund could be highly risky. While investing, please review or read all the scheme related documents before taking any, informed investment decision. So it means, as per SEBI, it's kind of, that gutka or cigarette and gutka, which is a ban, but they have just, label it. If you still consume this or take this, it causes cancer, but we don't want to ban it. So same way, it is a risky, but government, and they have all, they have already declared it. It is your individual's risk. If you want, if you're ready to, take a risk, then take a risk. That's fine, and invest. If we talk about now AMC details, so see this. See, if you, buy the units of mutual funds, so this one, who track this mutual fund units, right? Maybe buy unit, sell unit. Who track this? KFin track this. KFin has a technology. So they track the units of mutual funds and take care of it, everything around mutual fund units, buy, sell, etc., etc. Right? They have launched, scheme in 2018. So I'm also wondering how they have, raised 60,000 crores from common people, guys. Just imagine. Within just 6 years of time span, they have raised 60,000 crores from the common people. And that's what I said. The businessmen and governments are also, the smart people on this planet. They know it, the potential of common people. And smart people, they can easily make a fool to anyone. See how much profit that individual person is making. Maybe let's say if I would have invested 10,000, max to max, I would have, achieved 40,000, rupees. I invested, let's say 10,000 at maybe in the year of 2018. And now my value of investment is 40,000. What really, change in my life as an investor? Because see, it was just a penny amount for me from 10 to 40. That's the other story, is like I didn't, put any efforts. That fund manager, invested, managed and everything. He just applied his skills and made a profit for us. That's a different story. But my point is, 10,000 is just a penny amount, yeah. Just a penny amount we have invested. Then what really matters? But other way around, if you think about, this fund manager now, because 1.42%, this Samir Ranch and Kinjal Desai, they'll get it. Maybe they can, or maybe let's say their AMC, like Nippon Life India Asset Management Company, that 1.42% fees will receive to the Nippon. So now if I go to the Nippon site, show you something. Where is the PAT? PAT, it means profit after tax. Consolidated one, which represent the accurate. Okay. Profit and loss statement. Go. See this. Revenue from operations, 1,600 crores. How much? 1,600 crores. And let's talk about now profit. Consolidated profit and loss after MI and associates, means whatever that they have, performed the audit and all. Just wanted to clarify it. So if I see the profit, which is 1,100 crore, even if, let's say, if you lose your entire money in stock market, they'll still make profit out of it. But definitely you would see impact on their profit in a way. if I take you through the March 20, it means it was a pandemic time, market crashed, but still, see, investors, they lost their wealth and money, but this company made a profit of 400 crores. And that's what, if you start your mutual fund business in India, it's a very easy to make fool to the people. You can raise money as much as you can and invest money anywhere. Of course, you'll have to follow some rules and regulations, but this is how you can, link. So this 2% fees, it becomes like, 1,500 crores. And see the profit percentage, guys. It's a huge. All right. So this is how this businesses works. I hope you got this. All right. So again, come back to this one, details and all. So they mention everything and run their, scheme basically. All right. So you can check the details of mutual funds on their sites as well. Nippon India, how they are managing and everything. So SEBI and AMFI, Associates of Mutual Fund in India. So you need to have a license from them if you want to establish your firm as a mutual fund company or start as a mutual fund company. You can start. You need to have around 25 crores as a deposit, which is required with SEBI. Then the same deposit which is required for a brokers or banks, custodians, SEBI and everyone. So which is needed. And then you can establish, if you have a 20 crores, then you can start your mutual fund business. So recently, see, the one more news is, Ambani got the license. Means Friday only I saw the news that Ambani got the license to invest in mutual funds. So it means now Ambani can also, raise funds from the common people for in mutual fund business and make a huge profit out of it. All right. Whatever NAV that we produce, guys, it is mandated to publish that NAV here. You can download the NAV of any funds if you want. Select the mutual funds. Let's say Nippon India mutual funds. Select the type, which open-ended, close-ended. These are the type which I already, spoke about. Select the date, which date NAV that you're looking for. Maybe let's say we're looking for NAV of Friday's NAV, it will produce on Monday. So we'll check the NAV for Thursday. Click on go. See, all their schemes NAVs are available here. They have a lots of schemes. Which schemes that you are looking for, you can check. So basically this AMFI control the NAV and everything, and for all Indian funds, which is a mandate to produce NAV and publish on this site. So if you see, they have a list of schemes under different schemes, FlexiCap fund, direct, regular, direct. So they have hundreds of schemes that they are managing, more than 100 plus schemes which you can see, and you can track the investments through this. See this. This is the NAV price on October 3rd. The NAV was 99.1570. So your SEBI will perform the audit of this data from their end by referring the data which is posted on AMFI. So it is a mandate for every fund to publish the data on AMFI site. All right. So this is how your mutual fund works. Now let's come to the from investing perspective. Now, if you ask me personally, sir, which mutual fund is best and what to check, what not to check. See, guys, this is something based on your personal investment goals. Let's say your age is 70 plus or even 60 plus. What matter, most to you? Because you need a liquid, cash, maybe to fulfill your hospital bills, functions, right? And at the age of 50, 55, 60, we can't work, right? So it means we need a regular income plus low risk. So if you have a 60 to 70 lakhs, you can, or even 1 crore as your pension corps. So why don't you invest in FDs, maybe RDs, or even you can directly invest in you can invest in money market mutual funds. You can invest in money market mutual funds. Whereas, if you compare money market mutual funds with other investment vehicles, of course, money market would be more safer than others. Your money will be safe and you can generate consistent return. But let's say your age, which is at 25 18, let's say maybe 17, or in between, I would say 18 to 30. See, in that age, you can take a higher risk. Then you should look for a small cap. Why, sir, small cap? See, 40% CAGR, it means you just compare it. The NAV was 8, and at this point, the NAV which is at 182. So huge return that you could have generated. Simple. So did you get this? So it means this fund already multiplied the invested value by maybe 100 times, I would say. Not 100 times, my bad. 10 or 17 times, right? So you can say like 17x return already this fund has generated. It's a good. Again, on the other hand, you might see risk as well. Risk, it means you may lose your money also. See, guys, risk would be every year. But in a mutual fund business, what I believe, it is not possible at all to get the loss in all the companies, and that's when they maintain the balance. Maybe let's say total companies details which you can see more than 50 plus in companies they have invested. Correct. More than 50 plus companies they have invested, and it is a very difficult to say that all companies will bankrupt and will lose all the money. But again, market is full of uncertainties. We can't say anything, but it will not happen easily. Correct. So that's why you should invest in mutual funds. But as I said, if you are at a teenage, you can directly invest in small cap funds. You can generate more and more money. Again, my suggestion would be, let's say, if you don't have a time, you're like working professional and still you're ready to take a risk, still then you should invest your funds in small caps. Try to figure it out in a few top rated mutual funds and invest your money and take a risk. That's fine. But if your age, let's say 30 to 35, or even let's say 40, see, at that age, you will have lots of responsibilities on your shoulder. So you can't behave like, reckless behavior means, look, I can take it. But if you're financially sound, if you have, let's say, multiple income sources, in that case, you can still look for a small cap. Then otherwise, I would suggest you should look for a large cap. Risk would be moderate, and you can still generate 10 to 15% return annually, which is fine. But apart from that, if you have 100 rupees, then you can 50 invest in small cap, and you can invest in a 15 large cap, or maybe let's say 30 you can invest in small cap, 30 you can invest in medium or large cap, and again 30 you can invest in large or medium cap, and then 10 you can invest in bank deposit or maybe let's say liquid funds. This is how you can also diversify your fund. See, in one of my accounts, because I have multiple accounts of broking and all, so I'll just walk you through. This is my portfolio. It looks like. See, I'm earning around 4 to 5 lakhs from different sources. This is just for educational purpose again. So do not refer for same in your investment journey. You can take a personal advice from anyone if you want. I have invested in a small cap. I have invested in again a PSU banks, mutual fund. I have invested in a technology based funds. I have invested in again commodity based. But if you see, most of the funds, there are small cap funds, right? Extended IRR 30%, 33%, which is a very good 30%. It means still if I sell my investments, I'll receive around 24,000, and in just 3 to 4 months, I believe. I started this, in one of my sessions, I was just teaching to my investors and students like how you can pick up the schemes and invest. I have just invested it, right? So this is how you can also look for, correct? And apart from this, the one of the investments which I have again, payable. This looks bullshit. Anyways, recently I have invested. See, mutual funds, companies, they also schedule their new offerings. If you want to generate quick return through mutual funds, and let's say if you are not able to get the lot in, that stocks IPOs, then you should also look for initial public offering as well. Here also you can make a profit like 10%, 20%, 30% in just 1 month or 2 months in the mutual funds also. Because I do invest, so See, I have recently invested in this particular schemes as well. So I have invested around 40,000 in this particular stocks. So let's see, means how this perform. Why I have invested? Because market also corrected for a defense stocks. So I thought like let's take opportunity to invest 40,000 in this particular scheme, and I have invested. So I'll track this investments for at least for next 2 to 3 months or 4 months, and I'm sure at least NAV would be at 15 rupees or 14 to 15 rupees. So it means within a 6 months we'll have a 50% returns. So this is how you can see your investment goals. What are your investment goals and everything. See, you can also track, guys, the superstars investors details. Superstars, it means the big investors. Mukesh Ambani is holding 3,93,000 crores portfolio value. Radha Krishna Damani holding 2,14,000 crores. Premji 2 lakhs crores. Rakesh Junjunwala 53,000 crores. Invested around 26 stocks, and most of his stocks generated huge returns, guys. But again, he has a losses with few companies as well. It's not something that he invested. It means in all the companies that he's making profit, which is not true. Then Akash Bansali, Mukul Agrawal, Ashish Dhawan, Ashish Kacholia. But I would say, if you want to, again, if you don't want to invest in a mutual funds, and even if you don't have a, let's say, knowledge like how to invest in the stock markets, simply, you should follow the big bulls like Rakesh Junjunwala or Radha Krishna Damani, because if they have invested, it means you might see, they would have maybe done some sort of research, and on the basis of that only they have taken investment decisions. So now if I talk about Rakesh Junjunwala, and he's not there, but his wife is managing this. See, in 15 portfolios negative, his net worth was 1,500 crores. That's what I said, guys. If you have your 1 crores, then in next 10 crores you can build a portfolio of 1,000 crores even. The compounding has a potential, but you should have to have a 1 crores in your pocket. From 2015 to 2021, his net worth he multiplied by 2x. So it means around 4,000 crores. And since 2021 to 2024, he built the portfolio of 42,000 crores. To see how he made the profit. Right? You can also track the bulk deal as well. Bulk deal, it means, which is a big deal, because big investors, they buy, in a big quantity, and you can track their sales as well. See, when they'll sell it out, you definitely see the change in, prices, stock prices. They have purchased in Jubilant Pharma and sold out from Billcare and Rallis India. So if I now go and check the price of Billcare, see this, in last 6 month price dropped from 68 to 69. So when they sell it out securities, always you would see price will drop for that particular period. So you can follow the big investors also. And it depends on you how you want to take it forward, all of this conversation. But from investing perspective, it is important to follow. Investor Rekha Junjunwala buys Tata Communications shares. So recently they have purchased almost 19 lakhs shares of Tata Communications. And you can invest now in Tata Communications. But their average price, it was 370. See guys, how they made a profit. The purchase price of Tata Communication is 370. Right? Now, if I go and check the Tata Communications, share price, which is at 2,000. In last 5 years, the stock performed like, skyrocketed and delivered 469% returns. Just imagine that guy invested at 200 price, 370, and stock trading at 2,802. If you would have followed him, right, this guy, still you would have made a profit around 400%. So this is how they actually means big investors, they do some research and then only they invest. If you don't have a time, but still if you don't want to invest in mutual funds, then you can follow the star or superstar investors, I would say. See their major holdings and invest accordingly. But also track, it is also important, track the changes as well. See in Aptech, they haven't changed their percentage so far. Still, I can see the investments like 23%. But in yeah, right. So sometime what happened? They just purchase and continuously also sell it out. We don't track it, then we lose money as well. So we should track to them very well. So in NCC, if you see, they purchase, it was 13%. Now they have reduced it. So it depends on see, big investors, they don't sell entire stake. They always sell the 10, let's say, 10%, 20%, 30%. So they sell it very slowly. They don't sell entire stake in one go. They have reduced holdings from the Tata Motors. Why? Maybe recently I have seen some problems with the valuation with the Tata Motors. Tata Motors stocks price. See this. But again, this stocks also generated returns, but it was reached to the L100 and now which seems like at a downtrend. So you might see correction in this particular stock. And that's what, if you see now, same stocks, if try to compare with them, so they know it, which stocks they can hold and sell it out and how they can manage. So basically, you can follow their strategy as well. See, guys, there's if you see Rekha Junjunwala's portfolio net worth fell by 3.4% to 42,000 crores. So it means it's not something that everyone every day they can see a profit in their portfolio. In a stock market, profit and loss is just a part and parcel. But if you have a strong, let's say, stocks details or businesses details, and if you invest in them, small money also, then you can still build your wealth. It depends on you now. So yeah, this was all about mutual fund and how your mutual fund looks like. This was the example of mutual fund. And then in terms of interview, NAV calculation, which is important. So NAV calculation formula is total assets. Note down this one, minus total liabilities divided by number of units. All right. This is the formula of NAV calculation. Mutual fund is just a pool created by the professional fund managers so that they can raise funds from the investors and invest money in stocks, bonds, or other financial instruments. Fund manager receive their salary and AMC receive AMC fees around 1%, 2%, depends. AMFI, which is All India Mutual Fund, something sorry, asset management. Let me see the stand, that full form of AMFI, Association of Mutual Fund in India. So they track the NAV and everything, all the details, and it is mandated to the Indian mutual funds to publish the reports on their sites. Right, this key information is important, and along with that, the open-ended and close-ended. Open-ended, it means investors, they can buy and sell the mutual funds at any point in time. There won't be any restrictions. In terms of close ends, it would be mandate to the investors to hold the security, units in the funds until the maturity. So it means they cannot sell it out before the maturity. Minimum investment band is now 100, so anyone can invest it. So basically, mutual fund is for poor people. So this was all about your mutual funds.
Just a quick info, guys. Intellipaat offers an executive postgraduate certification in investment banking and capital markets in collaboration with IIM Ranchi. Through this course, you will master key skills like financial modeling, valuation, mergers and acquisition strategies, risk management, and even niche areas like private equity and wealth management. The program features 80 plus live sessions conducted by IIM Ranchi faculty and industry experts, real world case studies, hands on projects, and a 3-day campus immersion at IIM Ranchi. Plus, you will also get exclusive benefits like executive alumni status from IIM Ranchi and complete career support from Intellipaat. We have already helped thousands of professionals achieve successful career transitions in the finance domain, and you can check out their testimonials on our Achievers channel. The link is in the description below. And for sure, this course can set your career to new heights. So visit the course page link given below in the description and take the first step towards the rewarding career in finance.
Borrowing and lending. Borrower let's say on trade date, what happened in the books of borrower and in the books of lender. So lender, it means actually holder of securities. Lender, it means actually holder of shares, right? In a holder of shares, what happened? Let's say this guy is holding 1000 Wipro shares, right? Originally, this guy is holding in his demat account portfolio. So on a trade date of SBL transaction, borrow lending in a transaction, in the books of lender, how it looks like, sell securities, which is, let's say, all 1000 securities at market price of, let's say, 500, right? Let's calculate the price into, so your QTY, quantity, price, and amount, right? Then see, this happened on trade date, and in the books of borrower, see, happen, it means lender is selling now. But in a demat account, if you see the impact, demat account, see, this was in, or let's say opening balance of demat account, and close balance, you would see like 1000 Wipro shares will out. So in short, opening balance was 1000 quantity, but closing balance in demat account, you would see there is no balance. So it means there is no balance available. It's a zero balance. All right. And on a trade date, lender, will update the status like lender sold the securities to the borrower, and borrower, in the books of borrower, it looks like buy trade, buy at same price. Let me put it. So this is how your borrower books looks like, right? But whenever you would see like the SBL trade, this SBL trade will have an expiry. Let's say expiry of 5 days. So it means after 5 days, borrower will return 1000 quantities back to the lender. So let's say this on day first, this transaction happened, and on a fifth date, you would see like kind of settlement date, sell securities. So it means borrower will sell the securities at same price. There won't be any change at all. Okay, in means in terms of return. But what if, sir, market price, current market price was 500, but at the time of selling, the current market price, let's say 600. See, this price change has nothing to do with borrow and lend of securities. First, understand this. Why? Even if price change, this guy will still ask 1000 quantities only, right? So then on settlement date, simply will have to transfer, the securities with price of 500. Why? This should be the buy trade. See, from a technical perspective, if you see this trade, first, this trade will call it as a short sell trade, short sell. And short sell need a buy cover to settle. If you see this, so borrower, successfully transfer securities to the lender back. And as it is securities will transfer. Now your question would be, look, sir, why this, lender will lend the money if there is no benefit? Look, this borrower may pay fees of rupees, let's say 10 rupees for per quantity, because they charge quantity wise, fees in the market. Let's say 1000 quantity, fees around 10, and just calculate it. So this 10,000 amount, so we'll call it as a fees. Who will pay it? Any guess? And to whom? It would be debited, and same amount will be credited. So basically this fees, it looks like negative amount, and here it would be like positive amount. So positive amount, you can call it as a income or fees or commission on securities, right? And if I talk about this one, basically again it's a income fees, but will treat as a, means borrower will treat as a expenses only, expenses as a or fees on borrowed collateral. All right, so this is how you're basically actual means trade open and close. So this short sell will call it as open trade, and when lender receives securities back, it will close trade. In the books of borrower, the terminology would be this buy trade. This buy trade will call it as short short cover. So this buy trade is like, short cover, right? Because eventually whatever securities has received to the borrower, they're not from the borrower actually, right? So borrower will call it as a short cover securities, and borrower need, uh, you know, sell to, sell to sell or sell to cover, will call it as, the language would be like, sell to cover the securities to close the trade. And this trade will, will call it as a complete trade. So it means if you only borrow the securities, that would be like, your open trade. You have just opened the trade now. But if you want to settle that out or close the trade in a proper way, then see, this is how your actual trade closed in market. So it means in first case, we'll open the trades, right? We'll close it out. And, in the books of lender and in the books of borrower, say this. Borrower will record like, it's a buy cover, but buy cover need a sell to, consider it as a complete trade. So this is how your stock borrow and lending process works. Now let's talk about some key other aspect, like sort of why someone will borrow securities or someone will, lend security. See, one thing that we got to know, why someone will, uh, you know, this lend securities, because that person will receive, income. See, if you need a side income apart from capital gain, apart from, let's say, dividends or interest payment, you can lend your securities, right? So as I said, in a properties, what happened when you rent out that property to someone else, still that capital gain or depreciation, or, the price change benefit always received to the original owner, right? Because tenant is only responsible for access that space, then, leave it again in same space for maybe 1 year, 2 year, whatever the agreement is signed for, and hand over that property as it is back to the original owner, correct? But if you see the actual benefit of the lender receive only fees or commission, right? So now let's talk about this borrower. Why borrower will borrow the securities? See, let's take a hypothetical situation. In a Wipro stock, that borrower got to know current stock price, which is at 540, my bad, current market price. So borrower got to know that this price may go down or drop in near, let's say, term like maybe in 1 week or in a 2 week, price may go down. What if, let's say, price changes from contract price like 540 and current market price, let's say after 1 week, which is at 500. So it means in this case, if you try to compute the income of, the borrower, see, again, it's a hypothetical, guys, situation, because in reality, you might see, lots of ifs and buts, right? When you actually try to execute in this way. Let's say this is a, sell price minus this one, because this was a sell price for a borrower, because see, if you this, lender sold the security to the borrower. So borrower wanted that securities for what? To sell it out in market, right? In open market. And that's what borrower did it. It's an assumption, right? And again, when the security price, which was at 500, then borrower will again buy it back securities from the open market. Borrower will buy the securities from the open market and hand over that securities to the lender, correct? But if you see the benefit of this, the borrower, if this happened, right? If this happened, so it means sell price, which is at 540, then current market price of securities, which is at 500. So net benefit of this borrower is 44 per shares. And total quantities, if you see, which we have in this particular contract, which are 1000 quantities, correct? So total profit, if you see, which is a gross profit, 40,000. Out of this 40,000, only fees will be debited. Why? The biggest fees that borrower will have to pay to the lender. So this fees will receive to the lender of securities, and this profit will receive to the borrower, because borrower took a risk, executed trades in the market, managed very well, and generated profit for borrower. So this is how you actually, SBL calculation works. And if you ask me now, sir, what is the net profit of borrower? See, borrower made a profit of 30,000. See this, right? In the books of now, see, in the books of borrower, you can report it out this as an income, and in the books of lender, only 10,000 you can report it out. See, lender has nothing to do with market price change, as I said, because the contract only was signed for quantities. For example, let's say, again, if I give you another example, if you ask me to rent out my iPhone to you for 1 month, I'll rent it out, but I'll charge, let's say, 10,000 for per month. So it means you can access my iPhone for 1 month, and you can return that iPhone back to me as it is, with iPhone plus committed fees like 10,000. See what the, now your question would be, what if, sir, if I sell it out this iPhone to someone else in the market? So you can sell it out, but on my contract expiry date, I need my iPhone back. I need my iPhone back. Now your question would be, look, sir, on maturity, you have a fees to, pay to me, but you don't have this iPhone available to you, available with you. In that case, I can penalize you because I'm the original owner. So I can penalize you huge penalty. Huge, it means huge. So this is how, it's actually works, means in this way. And in a stock market also, what if, let's take again a hypothetical situation. On settlement date, this guy, like borrower, is, short on quantities. Only 500 quantities are available to return. Only 500 quantities are available to return. So it means now in this case, borrower is short on quantity. And then lender may force borrower to pay the entire quantity, because since this, it's a borrow lending, it means the contract is for borrow lending of securities. So lender can file legal case against borrower in the court, and then, borrower will have to pay that dues amount or penalties and everything. That's how, things are like critical. It's not something that, you just decided to borrow and lend it out, as per your comfort. No, there are some certain, regulations, rules that you need to follow, because those are like very critical. All right. Let's say another question would be, what if, sir, this particular, the Wipro company, during the this 5 days period, right? During the 5 days period, on third day, stock received dividend. Total quantities, which are 1,010 rupees dividend received for per equities. Now, who will receive this dividend? Who will receive this dividend? So this dividend, see, during the SBL period, during the SBL period, on third day of, this particular contract, basically Wipro company announced dividend, right? 10 rupees per security. See, your contract is on, and in between, company announced dividend, 10 rupees dividend. Then who will receive that dividend amount? To this lender or to the borrower? To whom? Borrower is holding the securities. If you see, technically, if you see, borrower has already received the securities on first day, right? And this is the third day of the contract. So it means on third day, still your borrower is holding that securities. So borrower will receive that 10,000 amount, correct? See, guys, company will not process dividend to the original owner, because if you see, technically, if you see, lender was the original owner, correct? Lender was the original owner. So lender already sold out securities to the borrower for 5 days. And if lender, let's say, transfer securities to the borrower, so it means borrower is the actual owner of securities. So borrower will receive, dividend amount, right? But here is the catch. The point is, lender of security is original owner, but for a company, see, company doesn't care about who is the original owner, who is the borrower, who is the lender. They don't care at all. See, company directly process dividends in the books of, company directly process the dividend. Directly means they directly process the dividend to the, borrower, because the borrower name will reflect in the books of company. So company will process dividend to the borrower. But throughout this SBL transaction, broker will play, very crucial role. So broker will take care of it, that part. Broker will, reach out to the, borrower and ask borrower to reverse that dividends amount. So it means company will directly credit this amount to the, borrower, because as per the company's, let's say, ex-date rule or recorded rule, the actual or original owner of securities is the borrower, for a company that I'm talking about. But as per the SBL agreement, security master lending agreement, that borrower and lender they signed. So as per the agreement, lender is the original owner of a security. So it means lender always claim dividend. Lender always claim dividend. And then broker reach out to the borrower and ask for the payment. So it means broker will ensure the settlement of this payment to the lender. So on X date, lender will not receive the dividend. Basically, borrower will receive the dividend, but after the X date, broker will execute this process like manually, reach out to the borrower, ask borrower to repay the money back, and then through that borrower's account, money will be like debited and transfer it out to the this lender, and lender will receive this amount. See guys, one more term that you can understand it here. See, this dividend portion, will call it as a manufacturer dividend. Manufacturer dividend. Why? Because the dividend actually generated through SBL process, security borrowing and lending process. Sometime in the interview process, you may see question around like, hey, do you know about manufactured dividend, or what is that, the manufactured dividend, or what is the term called like, the manufactured dividend. So you may see sort of questions around it. So when we say manufactured dividend, it means you should explain in a way, look, due to the SBL, what happened, lender, who is the actual owner of securities. So lender, let's say, who have transferred these securities to the borrower, right? So it means as per the company's book, so actual owner would be like borrower. So company will process dividend to the borrower only. But this SBL transaction actually execute, through the brokers. So it means broker will reach out to the borrower and provide, the security lending agreement copy to the borrower and ask borrower to refund or repay the dividend amount, whatever that they have received. And same dividend amount will transfer or settle to the lender account, and then lender will confirm that payment. So it means lender can also file claims with the broker stating that, look, I'm claiming the ownership of the securities because I'm actually the owner of this particular securities, but I have just lent it out, and everything defines in lending agreement. So you can see this. So I would expect the dividend payment. So this is how your actual cycle works of your stock, borrow and lending process. All right. So now let's talk about theory part. So if we say, let's say, why security lending in investment banks, broker, or market makers borrow securities for a number of purposes, such as to ensure that trade settlement can occur, to support market making and other trading operations such as hedging or short selling, basically, and by supporting price creation and promoting high settlement success, securities lending contributes significantly to the market liquidity by ensuring the smooth operations of the financial market. Some investors may utilize security lending as a mean of generating extra revenue in terms of lending from their investment portfolios, because if there is a demand for a borrowing, so you can simply borrow and make passive income out of it. But again, what I would suggest, we should not, if you are basically promoters, promoters of company, they participate in stock borrowing and lending, because for them, like stock borrowing and lending, because they hold the securities for a longer term, like 1 year, 2 year, 10 years, 20 years, so they can participate. But as a common man, if you ask me to participate in stock borrowing and lending, would be very difficult. Why? Let's take a hypothetical case. Let's say stock price which is at 500, right? And at that time, if you lend the securities to someone, and what if, let's say, price stocks, let's say, fall from the 500 to 100. So So eventually, as a original lender, you would be in a loss of around 400 for per shares. Max to max, you will just gain 10 rupees or 20 rupees for per shares as a fees. Correct. So if your security would have with you, then definitely you can quickly call to the broker and sell it out security in market. But if your security is under obligation, then you can't do anything. So to lend security to someone, it's a critical, I would say, or we should not do this as a means in a normal investor. But if you're a promoter of the business and if SEBI allow you to lend the securities to generate some passive income or side income, you can do it. All right. Securities lending who participate in SBL: banks, market makers, hedge funds, traders, mutual funds, broker dealers, all the participants in this security lending. See, mutual funds, they participate because they also even hold securities for 1 quarter, 2 quarter, 1 year, 2 years, so even for years, so they can participate, right? Why they'll participate? See, if I have decided to hold the securities for 5 years, in that case, it makes sense to borrow the lend the security, so that fund can earn, apart from capital gain, fund can also earn like fees as well, and that fees we can treat as a passive income. So that fees creates actually liquidity. All right. So this is how your basically SBL come into picture. Now, if I talk about the flow, securities that will treat as a collateral. Collateral moves from lender to borrower, borrower to lender, lender receives fees. All right. Then who pays the fees? Of course, borrower pays the fees. Why they have said interest pays to the borrower? I don't know. Why lender will pay the interest? This seems like securities lending cover securities as equities, fixed income. That all securities basically come into picture. We need to correct this flow. Then trading process in SBL: when a security is lent, the borrower acquires the security title. Read this. Right. By becoming the owner of the security, the borrower gains the benefit of owning it. All coupons and dividends payments, as well as any additional privilege like voting rights, will go to the borrower. And there's dividends or coupons must typically be returned to the lender in the form of manufactured dividend, as the term goes. But this term basically, the dividends and coupon payment, it sometime, depends. See, as per legal law, it should receive to the original owner. But in the agreement, if it is mentioned that dividends, coupons, it will receive to the borrower only, then borrower also may claim that as well, right? Manufactured dividend refers to a payment made to the transfer, dividend and interest payment from the borrower to the lender of those securities. All right. Triplicate SBL, company A, company B, and company C are receiving custodial services from the custodian Adani. This again, it's an example like 1,000 shares are needed by company A and Adani stock is held by company C, because the custodian knows both the counterparty and becomes the guarantor in the situation. There is no market risk. Both parties will be charged fees by the custodian. All right. So company A, company B, company C, so they can sign, means A company and C company, they can sign SBL contract and borrow the securities if they need for a time being. And custodian help to all counterparties, because custodian that hold the information of securities. So collateral management in SBL: collateral, it means assets. So when we say collateral, it can be your cash, government securities, mortgage-backed securities, corporate bonds, letter of credit, equities, government agency securities, covered bonds, all that we treat as a collateral, right? Then fees and rebate rate: SBL fees paid by the borrower to the lender vary according to the nature of the securities. See, that fees will call it as a rebate as well. If in a SBL, means whatever fees that borrower pays to the lender, that fees will call it as a fees or rebate fees. Other factor include credit worthiness of a borrower, duration of the loans, and type of collateral used will also affect the fees. So it means if the borrower credit CIBIL is very low, then you can charge high fees. If the, let's say, borrower CIBIL score is very high, then you can charge low fees. So it depends. The lender who receive cash collateral from the borrower and will reinvest it. Whatever that lender receive, that they can reinvest it even. How will on spread between reinvestment rate and the agreed rebate rate which he pays to the borrower? See, to cover short position, borrower borrowed securities, settlement coverage, naked shorting and market making, arbitrage, selling securities for a loss with no corresponding long position is known as naked shorting. Selling securities for a loss. So it means if there is nothing to cover, then you can book the losses. So when you book the losses in transaction or trade, that trade you can call it as a naked trade, naked, right? And for a buy orders to be filled and tight two-way pricing to be created, market makers must be able to borrow securities. Support a financing deal driven by a desire to loan money to temporarily transfer ownership for the benefits of both the lender and the borrower. Tax arbitrage, dividend, reinvestment plan, arbitrage. So it basically that security borrowing, also support to the financing and all. Now let's talk about pros and cons. SBL pros and cons: increase the liquidity of the securities market by allowing securities to be borrowed temporarily, and those reducing the potential for failed settlements and the penalties this may incur. So it means, let's say on a settlement date, if you're not able to fulfill the obligation, so you can borrow the securities from the others and transfer that securities to the parties on time. And after the, let's say, once you have a liquidity or funds, you can again buy it back securities and return that securities to the lender. So this is how basically, SBL is very, very crucial in this market to ensure timely settlement of the contracts. Second one is support many trading and investment strategies that otherwise would be extremely difficult to execute. Allows investors to earn income by lending their securities on to the third parties, and facilitate the hedging and arbitrage of price differentials. So it means borrower actually makes money through pricing differences. Cons of SBL: market risk. The price of the securities that is held could either go up or down depending upon the market situation. But when we say risk, it means if the price goes down or up, what if you're not able to sell the securities due to SBL obligation? So that's how risk come into picture. Counterparty risk: the probability that the other party in the trading transaction may not fulfill its part of the deal and may default on the contractual obligation, right? So as I said, if counterparty announce bankruptcy, then we can't do anything. And high fees: the fees paid by the borrower to the lender is very high, so they charge huge fees. Difference between repo and SBL: repo, which is in case of the government securities, I would say same thing happened. Repo, it means repurchase option. So you can means sell the securities and to the parties, right, at let's say 100 rupees price, and same securities you can buy it from same counterparties at let's say 120. So it means basically that the original lender will offer the 20 rupees discount to the other counterpart who have borrowed securities for 1 month or 2 months. So basically SBL and repo both are same, but if you just compare these two things, right, here in terms of participants in SBL you can select agency and principal, but in repos you can select professionals only that they sign. In terms of delivery, in SBL, free movement of stocks and separate movement of collateral that you would see. But in a repos, you can select delivery versus payment. So it's just one way you can see, like in a first case we are transferring securities, and in second case we are reversing it out. But in a repos you can see along with the securities we are paying payment as well. So that's when your DVP come into pictures, delivery versus payment. So it means every time counterparty will deliver the securities and make a payment or receive the payment against delivery. That's how it works. Collateral. See, collateral can be securities or cash in SBL, but in a repos, your securities would be the collateral. Fees earned by, the parties like, lender of securities or lender of cash, that you can say, so lender basically make the that receive income as a fees, right? Over collateralization received by lender of securities and received by cash lender if applicable is just term that you can see we use in SBL and in a repo. Maturity primarily, it's open term, so it means open and close. And in repo rate, you can select primarily it's a fixed terms like open and close, maybe for a 1 day, for a 1 month, 1 year. So this is how it works. And fee payment in SBL, you can see like monthly arrears, and in repos, you can see at a maturity, basically fees will be paid out. So this is how you can see the difference between repo and SBL.
Let us begin by looking at investment banking beginner interview questions. First, what are the three financial statements? First is income statement. The income statement is a financial statement that shows the profitability of the company. It begins with a revenue line and works its way down to net income after various expenses are deducted. The income statement is for a set period of time, such as a quarter or a year. Second is balance sheet. The balance sheet does not cover the entire period, but rather provides a snapshot of the company at a specific point in time, such as the end of the quarter or the year. The total number of assets and liabilities must always equal the total amount of equity and liabilities. Third is cash flow statement. A cash flow statement is a magnified version of the balance sheet's cash account that accounts for the entire period, reconciling the cash balance at the beginning and the end of the period. Next question is, what is the difference between enterprise value and equity value? So enterprise value is the company's overall current value, whereas equity value is the value of the company's shares and loans, which can provide an indication of the company's current and future value. Third question, what is beta and how to calculate beta for a company? The beta of investment security is a measure of its volatility of returns in comparison to the market as a whole. It serves as a risk indicator and is crucial to the capital asset pricing model. A higher beta means a greater risk and higher expected profits for the company. Because 1 is the benchmark for beta, everything above 1 is more variable and carries more inherent risk. Next question, what is the difference between a merger and an acquisition? A merger is a combination of two or more commercial companies to form one joint entity with a new management structure, ownership, and name that capitalizes on its competitive advantage and synergies. In contrast, an acquisition occurs when a financially powerful entity acquires all or a portion of the total shares of a less financially powerful commercial firm. Next, what is DCF? The term discounted cash flow refers to a valuation method that determines the value of an investment based on its expected future cash flows. The purpose of a DCF analysis is to determine the current value of an investment based on projected future earnings. It can assist those deciding whether to acquire a company or buy securities in making the decisions. Discounted cash flow analysis can assist business owners and managers in making operational and capital budget decisions. Next question, how do you value a company? A company can be valued in three ways: comparable company analysis, discounted cash flow analysis, and precedent transaction analysis. First, comparable company analysis. It entails locating companies that are similar to the one under consideration and comparing their EBITDA, stock price, and price to earnings among other variables. Next is DCF. The discounted cash flow analysis uses the amount of money that the company is expected to make in future, discounted to present values. Finally, precedent transaction analysis. Precedent transaction analysis is similar to comparable company analysis, in which you look at how much similar companies have sold in order to determine the value of the company you're valuing. Next question, how do you calculate terminal value? Terminal value is the estimated value of a company after a certain period of time and is a key component of DCF analysis. There are two methods for calculating terminal value. First, the growth in perpetuity method and the exit multiple method. The growth in perpetuity approach assumes that cash flows will grow at a constant rate indefinitely. The exit multiple approach does not assume perpetual growth, but rather examines the net value of a company's assets at a given point in time. It is used to describe a company that will be acquired or liquidated in the future. Next question, when should a company issue debt instead of equity? Because the cost of debt is typically lower than the cost of equity, there are many situations in which issuing debt makes more sense than issuing equity. Issuing debt rather than equity makes sense if the company can benefit from the tax breaks by issuing debt, the company has consistent cash flows and can pay interest. As a result, the WACC is lower, and with more financial leverage, the company can get a better return on investment. Next question, what is the PEG ratio? The PEG ratio is an abbreviation for the price earnings growth ratio, which includes the PE ratio as well as the EPS growth rate of a company. Rapidly growing stocks have higher PEG ratios, whereas conservatively priced stocks have the same PE and PEG ratios. If a company has the same PE and PEG ratio, one could argue that its stocks are overpriced when compared to companies with the same EPS but a lower PE rate. Next question, what is net working capital? Net working capital is the amount of money a company has after paying off all current short-term debts. So it is given by current assets minus current liabilities. So current assets include balance sheet items such as accounts receivable, inventory and prepaid expenses, whereas current liabilities are short-term debts such as accrued expenses, deferred revenue and accounts payable. Now we're going to look at investment banking intermediate interview questions. Starting with the first one, what does negative working capital mean? When a company's existing liabilities exceed its current assets, it has negative working capital. This means that liabilities paid within a year outnumber monetizable working capital during the same time. Buyers frequently regard a target company's negative working capital as negative because it represents the additional capital required to operate the company after the transaction is completed. A buyer prefers a working capital ratio of 1 to 1.5, which means at least $1 in current assets for every $1 in current liabilities. This gives the buyer confidence that the company will be able to meet the sellers and payroll obligations in the short term. Second question, what is the difference between cash-based accounting and accrual accounting? So cash-based accounting records revenue and expenditures only when cash is received or spent. Accrual accounting, on the other hand, records revenue when it is reasonably certain that it will be collected and expenses when they are incurred rather than when cash is actually spent. Because credit cards and lines of credit are so widely used for payment these days, most large organizations use accrual accounting. However, very small businesses may choose to use cash-based accounting to simplify their financial statements. Next question. Two companies are identical except one has debt and the other does not, which will have a greater WACC. The company with no debt will have a higher WACC because debt is less expensive than equity. Debt interest is always tax deductible. Debt is ranked above equity in a company's capital structure, which means that debt holders would be paid first in the event of bankruptcy or liquidation. Contrary to popular belief, debt interest rates are typically lower than equity cost of equity figures, which are typically higher than 10%. As a result, the cost of debt component of WACC will account for a smaller portion of the total than the cost of equity component. Fourth question, give an example in which you encountered a difficult situation while working in a group. So you can frame your answer in a way by saying, during my senior year internship in financial management, I worked in a variety of small groups. Each student had a very busy schedule and I took the initiative to help everyone reprioritize their schedules and find areas to compromise. This aided in the group in balancing workload and work quality. In the same situation, there was a member of the group who was not carrying out his responsibilities, and I contributed to the solution by assisting him in discovering his strengths and allowing him to focus on them while the others filled in the gaps. Next question, what is terminal value and how do you calculate it? So terminal value is the value of a company, project or asset after a period for which future cash flows can be predicted. So terminal value assumes that a company will continue to grow at a certain rate indefinitely after the projected period. The terminal value is calculated using the following formula, where FCF stands for free cash flow for the last forecast period, G stands for terminal growth rate, and D stands for discount rate. Sixth question, how is the balance sheet adjusted in an LBO model? The additional debt is first added to the liabilities and equity sides, and then the shareholders' equity is wiped out and replaced with the maximum equity contribution from the private equity firm. After cash on the assets is adjusted for and any cash is used to fund the transaction, goodwill and other intangibles are used as a plug to make the balance sheet balance. Depending on the transaction, there may be additional implications such as adding capitalized financing costs to the asset side. Moving on to the seventh question, what is the difference between high yield debt and bank debt? Some of the major differences are: high yield debt has a higher interest rate than bank debt. Bank debt interest rates are not fixed like high yield debt rates. They fluctuate based on the Fed interest rate and LIBOR. Maintenance covenants apply to bank debt, whereas incurrence covenants apply to high yield debt. The main difference between the two is that incurrence covenants prohibit you from taking certain actions, whereas maintenance covenants require you to maintain a certain level of financial performance. For example, the debt or EBITDA ratio must always be less than 5 times. And finally, in case of bank debt, the principal must frequently be amortized over time. However, in the case of high yield debt, the entire principal is payable at maturity. Eighth question, determine if an acquisition is accretive or dilutive. So this is an important question whenever a company considers acquisition. Fundamentally, any transaction that increases the buyer's earnings per share is accretive. Any transaction that reduces the buyer's earnings per share is dilutive. So here's a quick rundown of how to respond to this question. Inquire your interviewer if the deal is all stock, and if the transaction is all stock, it is simple to determine whether it is accretive or dilutive. It is accretive if the buyer has a higher PE ratio. It is dilutive if the seller has a higher PE ratio. Ninth question, what is an LBO and what are its value drivers? A leveraged buyout is a debt-financed acquisition, typically a very high percentage of debt. The following are the primary drivers of an LBO's success or failure. First, the cost of acquisition, then the amount of debt used and the debt cost, and finally the anticipated exit price. It is also worth noting that the actions taken by the acquiring firm to increase the exit price of the target business have a significant impact on the success of an LBO. Successful LBOs, for example, typically involve expanding or restructuring the business to increase its value. 10th question, what is the difference between goodwill and other intangible assets? When a company is purchased, a goodwill premium is paid over the fair value of assets. As a result, it is linked to a company or business and cannot be purchased or sold on its own. Other intangible assets such as licenses and patents can be sold and purchased separately. Moving on to investment banking advanced interview questions. Starting with the first question, what is the distinction between capital and operating leases? Operating leases are used for short-term leasing of property and equipment and do not involve any ownership. Operating lease expenses are shown on the income statement. Capital leases are used for long-term items to provide the lessee with ownership rights. They depreciate, require interest payments, and are classified as debt. Second question, explain an IPO valuation for a firm that is about to go public. We only consider comparable public company IPOs as opposed to traditional valuations. We choose comparable public companies, apply the most relevant multiple, and base our estimate of the company's enterprise value on that multiple. We can calculate the equity value by working backwards from the enterprise value. We also consider IPO profits because they are new funds. The price per share is then calculated by dividing the total number of existing and newly issued shares by 100. This is what it means when people say an IPO is valued at. Third question, tell me about major items in shareholders' equity. The first is common stock. The most common type of stock in which most people invest is called common stock, which represents a portion of a company's ownership. Second is retained earnings, the amount of net income that the company has saved up over time. Third is treasury stock. The monetary value of the corporation's shares are purchased. Finally, additional paid-in capital. This accounts for the number of new shares issued as a result of employees exercising their stock options as well as the amount of stock-based compensation granted. It also considers how much additional money a company receives from an IPO or other equity issuance. Next question, in a DCF, why would we use the mid-year convention? This is because a company's maximum cash flow does not always occur at the end of a fiscal year, but can occur evenly throughout the year. We would use the discount period numbers of 1 for the first year, 2 for the second year, 3 for the third, and so on if there was no mid-year norm. Instead, with the mid-year convention, we use 0.5 for the first year, 1.5 for the second, 2.5 for the third, and so on. Next question, what are your strengths? If you are asked this question, this is one of your best chances to demonstrate why you would make an excellent banker. Your analytical, quantitative skills, communication skills, the ability to learn quickly, detailed orientedness, and ability to work extremely hard are likely to be highlighted. You should be prepared to back up what you say about your strengths with 1 or 2 concrete examples from previous jobs or school. Next question. Explain the use of revolver in an LBO model. A revolving credit line is used when you need more money to make your mandatory debt repayments than you have available. The revolver, like credit cards, begins undrawn, which means you don't borrow money and don't accumulate debt unless you need it. Before calculating mandatory and optional debt repayments, add any required revolver borrowing to your running total of cash flow available for debt repayment. You assume that any revolver borrowing from previous years is paid off first with surplus cash flow before any term loans in the actual loan repayments. 7th question. Why are deferred tax liabilities and deferred tax assets created in the merger and acquisition transactions? These are generated as a result of the writing up and writing down of assets in a transaction, which include both tangible and intangible assets. An asset write-down generates a deferred tax asset, while an asset write-up generates a deferred tax liability. Because of the frequent differences between an asset's fair market value and its book value, which appears on the balance sheet, the asset must be written down and written up. A write-up of an asset results in a deferred tax obligation because the new item will have a higher depreciation expense, which means you will pay less in taxes initially but will have to pay them back later, resulting in the liability. For an asset, write down and a deferred tax asset, the inverse is true. 8th question. How do you approach problem solving in a complex financial scenario? You could answer this question by saying, when faced with a complex financial scenario, I follow a structured approach to problem solving. First, I gather all the relevant information and data. Then I analyze the information to identify the root cause of the problem. Finally, I evaluate various options and make a recommendation based on my analysis. I always ensure that my solution is feasible, practical, and aligns with the client's objectives. Next question. Can you walk us through a recent transaction you've worked on? So you can answer this question by saying something like, yes, I worked on a deal for a company and my responsibilities included conducting due diligence, developing financial models, and negotiating the terms of the transaction with the counterparties. The transaction was completed successfully and it was a valuable learning experience for me. And for the final question, what are some of the examples of non-recurring charges that are reflected in the company's EBIT or EBITDA when reviewing its final statements? First, goodwill detriment, then charges for restructuring and asset depreciation, legal expenses, expenses related to bad debt, accounting procedures have changed, expenses associated with a disaster.
Just a quick info, guys. Intellipaat offers an executive postgraduate certification in investment banking and capital markets in collaboration with IIM Ranchi. Through this course, you will master key skills like financial modeling, valuation, mergers and acquisition strategies, risk management, and even niche areas like private equity and wealth management. The program features 80 plus live sessions conducted by IIM Ranchi faculty and industry experts, real-world case studies, hands-on projects, and a 3-day campus immersion at IIM Ranchi. Plus, You will also get exclusive benefits like executive alumni status from IIM Ranchi and complete career support from Intellipaat. We have already helped thousands of professionals achieve successful career transitions in the finance domain, and you can check out their testimonials on our Achievers channel. The link is in the description below. And for sure, this course can set your career to new heights. So visit the course page link given below in the description and take the first step towards the rewarding career in finance.